for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Friday morning, good morning. You're not there yet. Friday's session is going to be really interesting, I think, to watch in light of what we saw yesterday over in the United States. Big rollover in tech. That obviously had a big implication for the indexes. You certainly saw it in the S&P, but you saw it in the NASDAQ. You've seen it overnight in the Cosby as well. Take a look at what's happening with Bitcoin. This is what the S&P looked like yesterday. We rolled over. We finished near session lows. And I think just in terms of the narrative around the price action, just finishing near session lows is something you want to pay attention to. That's where we went out in Europe, so we've got that to price in. That's some of the downside you've got to factor into your thinking first thing this morning when it comes to this. Euro Stoxx 50 down by 0.5%. FTSE futures are down a little bit more.
is coming under a fairly negative, broadly negative market. So I'm curious how much of this actually stands out.
Okay, let's talk about kind of what we are going to see in this session. So you're expecting a negative start. How negative, which stocks, which sectors are going to move here, I think is going to be really interesting in terms of what it tells us about the market narrative. Got a reaction to the States. Got to think about what happens next as well. Is this all about the Fed, or is there something more in the mix as well? Okay, here we go. FTSE 100 expected to be down, let's call it circa 0.8%. Is it going to be a little bit more? Is it going to be a little bit less? You're going to see some of the big names opening out this morning. What is interesting is that oil prices are back up this morning, so maybe that is a more positive story for the likes of Shell and BP. So maybe that limits maybe some of the damage you're going to see in the FTSE 100 this morning. But the FTSE 100 is dropping towards that kind of circa 0.8% move to the downside, which is what roughly we are expecting this morning. I think roughly what we are seeing. So futures reasonably accurate there. So yeah, we're down a little bit more now. The CAC is opening fairly quickly. We're down by 0.6%. Stock 600 down by 0.7%. The IBEX is getting hit harder. It's down by 1.23% this morning. We'll look for some single stocks there. I think it's going to take a while to get the DAX and the SMI open first thing this morning. But a measured reaction, maybe you could argue, in European indexes this morning to what we saw in terms of the big losses we saw pretty yesterday stateside.
Absolutely. We're still seeing some of this market kind of shake out as we get these early reads on. But right off the bat, to your point on the tech space, you are seeing some weakness. That seems to be what's driving down this index. You see it on your screen here from a sector basis, red across the screen, but the kind of pain points very concentrated in the FTSE 100, although I would say the CAC, the Stoxx Europe 600, not far off. That divergence we saw in the futures picture, certainly not showing up here. Let's get to some of the single names, though, that we're starting to see here, because ASML, to your point, is moving to the downside. We're seeing some of the British banks really take a hit. Lloyds, Barclays, and kind of a couple of other UK names as well. So that Sell UK trade that we were talking about leading into the open, starting to permeate here as we're getting some of the early reads.
So you are getting a huge move in gilts this morning, okay? Massive move in gilts. We're up by 11 basis points. Just for reference, you've got the Bund is up by 1.9. So we are up 11 on gilts this morning. That is why you are seeing what you are getting in the UK banks this morning, which obviously have some sort of relationship with that gilt market. But that is a very big move this morning. We're now up to 4.547 on a UK 10-year. So a huge sell-off coming through into UK gilts surrounding the concern off the FT report this morning that we are getting potentially a ripping up of what was expected by Rachel Reeves, the Chancellor of the Exchequer, that she is going to be raising income tax. That looks like it is going out of the window for political purposes. The question is, what fills the gap that she has to fill? And what is that going to do in terms of her political future as well, and Keir Starmer's? Big reaction, I would argue, in the gilt market this morning, coming off the back of that first thing this morning.
Absolutely. You mentioned the gilt space. We certainly saw it in the stock market as well. I'm just very quickly looking up where we are starting to see some of the pain points, at least in the equity index. It's not just the FTSE 100. You want to start looking at the small caps as well. If you go down that range, the FTSE 250, for example, down about 1.2%. You're seeing more pain in the FTSE 350 as well. The smaller, more domestic-focused stocks you go to, the bigger the pain point. Let's get a little bit more analysis here, perhaps this morning. Patrick Armstrong, Chief Investment Officer over at Plurimi Wealth, joins us around the table. Patrick, we were all ready to get you talking about the tech story, but we got to talk about the UK now, given that we are seeing this kind of reaction. The stories aren't all that different from what you're seeing over in the States in terms of fiscal issues, taxation, tariff risks, geopolitics, et cetera. What do you do with the UK?
Well, it's completely similar situations. The UK's debt and deficit, very similar to the US's debt and deficit, both untenable. US is hoping for the best, hoping to grow their way into their debt. The UK is considering tax increases and then reconsidering tax increases. And I think the market's reacting to the uncertainty about what kind of tax increases. And the Laffer curve that we talked a lot about in the 80s, the other way as well. When you increase taxes, do you reduce your tax base? And there's a negative impact from that. So a flight of the high net worth out of this country. It's something that's very difficult to do. I don't think either strategy is going to work. Yep. The US isn't going to grow enough to manage their debt, and the UK won't be able to tax enough to manage their debt.
Is the fear in the UK now, though, that Rachel Reeves and Keir Starmer go and ultimately get replaced by somebody that is a team that is harder left, and you get much more issuance and you get even more spending?
It could be, and the way the polls look, it could be very fragmented. You've got a lot of support coming on the far right as well. So you could have a far left come in, but a real minority government with an extreme far right on the other side of things. So politics is a bigger risk than normal because there's more uncertainty than normal. Governments don't last as long as you'd expect. And the problem with populism is everything sounds great, and then it's a short-term fix for a long-term problem, and you never address the long-term problems, and that's why the populations of the Western democracies are always frustrated that nothing fixes the long-term issues. It's basically a sugar rush for short-term fixes, and long-term problems always stay.
And sugar crash that comes after it.
That's how it goes,
It's always fun.
Well, speaking of sugar crash, let's talk about the tech space here, because they really took the brunt of the hit in yesterday's trade. A 1.7% plunge that we saw on the S&P 500, starting to see elements of that in today's trade as well, with the likes of ASML and other tech names here on this side of the Atlantic. Just walk us through the logic of that. If we're worried about all these worries, we're worried about a slowdown, well, growth stocks are supposed to be the winners.
They are. And we think it is going to be a scenario where there are going to be winners. There is going to be growth, but everyone was priced as a winner. And we're keeping some of the long positions we have in tech that I still like. We own Alphabet. We own Apple. We started shorting Oracle at the beginning of this week. That's a stock that's at 50 to 60 times forward earnings. The stocks I own are in the 20 times earnings. So if they both win, one stock's pricing maybe a small win, the other one's pricing a huge win. So I've been shorting some of the frothier elements of tech. We started shorting Riot yesterday as well, and Supermicro Computers. So stocks that were priced for incredible growth that they may not achieve are the stocks that have rolled over, and I think there's still further downside there. Some of the great companies that are slightly expensive, I'm sticking with because I do think they grow their way into the multiples.
Riot's been smashed over the last few days, so your timing's pretty interesting. Are you more confident putting shorts on?
Yes, I am. So that's what I've been trying to do. Recently, we've been selling a lot of consumer stocks throughout the summer, and it's worked really well. Like companies like Nike, we closed our short on Monday, and that was a stock that could be impacted by tariffs, by the consumer, and we've moved it into the frothier elements of the no earnings and the low earnings.
So is this market getting easier to understand?
Well, recently, yes, things are behaving as you'd expect. Whenever your positions are rewarded, you think things are rational. Whenever your positions don't work, you think it's irrational. But for me, things make sense again right now, that you're not just seeing everything that says I'm spending on AI, therefore my market cap goes up by 4 times what I spent. You are seeing a little more discerning market where I prefer that kind of market.
How do you feel about NVIDIA?
NVIDIA I still own. It's the 3rd biggest weight in my portfolio.
Yeah.
But the perverse thing with me is I've got a 5% limit on my portfolio, so I'm underweight versus the MSCI world weight. I think earnings are going to be strong. I think guidance is going to be strong. I wouldn't be too worried about going into NVIDIA earnings because all the hyperscalers aren't showing any signs of slowing down.
They're not, but you are seeing it on the hyperscalers. You're seeing it in some of NVIDIA's peers. You're seeing it in AMD. You're seeing it in TSMC. You're seeing these big promises with some of the kind of jitters underneath the hood. So isn't there a question here of deliverability?
There is. People are clamoring for NVIDIA chips. AMD is trying to get the pieces that NVIDIA can't fill. So I do think they have this strong position that continues. In my most flexible portfolios, I don't own NVIDIA anymore. I'm short put options at 170 on it. So it's a stock that I'd like to own a little bit cheaper, and I collect that premium. And if there is that market sell-off, it creates a buying discipline for me.
The whole debate, though, is about how long an NVIDIA chip lasts.
Yeah.
Like, is it 2 years? Is it 4 years? Is it 6 years? What do you think about this whole depreciation debate?
Yeah, it's a big debate. As long as they keep innovating as well, the shorter turn over time, if they replace it with a higher chip.
That's bad for the people that are buying it because they're depreciating.
It is.
These chips get cheaper.
Yes, and
or less valuable.
NVIDIA's exerting the strength they have from a near monopolistic position and what they've carved out. So it's something that NVIDIA is profiting from and impacting the clients of NVIDIA, which eventually it's going to create, you're inviting competition, but right now...
But those are the people that buy the stock, that buy the chips, and if they're having problems, then...
That's true, yeah. You don't want to create too many problems for your customers, I suppose.
So you're still looking at individual tech stocks. Walk us through some of the other sectors that are looking good. Is it really just the company that talks about AI or the company that wins? What else are you liking right now?
So we're underweight tech, actually. In my long side of my portfolio, we're 5% underweight tech. So it's the biggest sector exposure, but it's underweight versus a benchmark weight. We've added oil in September. Repsol's a new stock we added. Actually, it's in the news again today, but it's a stock that's still cheap. I was probably a bit too pessimistic on the outlook for oil prices based on what Trump talked about on deregulation and maybe a slowing macro backdrop. Macro backdrop hasn't slowed as much. Demand for oil hasn't slowed as much. And it's something that, oil still looks good to me. It's still got a geopolitical hedge. We've seen refinery disruptions happening in Russia as well. That's something that you don't think about all the time, but it is incrementally getting rid of supply on the market, and anyone who has supply that's undisrupted is benefiting from that pricing power.
It sounds like you're not really worried about supply gluts at all when it comes to the oil space.
I was, and I'm less worried now, Demand has been a bit stronger than I thought, and supply hasn't grown as much as I thought it would, and it's OPEC's increasing production, but not dramatically. It is still that scenario where demand's growing in line with supply, and that's pretty healthy.
But we're talking about yes, OPEC has kind of their foot on the pedal for that point. But on the other hand, you're talking about all this narrative coming out of the States in terms of mergers, deregulation, affordability, et cetera. That, to me, and we talked about this earlier, that screams to me as Trump wants prices lower.
That's definitely what he wants, and that was one of the reasons I was hesitant to own oil coming into the year, and I've reassessed, and we've added Repsol in September. It's a 3.8% weight versus a 3.6% weight in the benchmark, so it's stocks like that we've been adding, and sticking with great companies that are trading at reasonable multiples, I think, is a winning strategy. Hedging some of the risks that come from that by shorting companies that are trading at extreme multiples and are more hope than very clear cash flows right now. Oracle, negative cash flows right now.
Does it when you talk about those multiples, do those multiples, those very high multiples, require Fed rate cuts? And if those
100%. If the Fed doesn't cut, the thesis is maybe it's a correction and maybe a bear market, because I think another December cut comes. I think Powell talks very hawkishly in the market. Just covers their ears. Don't listen to it, because we know a new Fed chairman's coming in who's applying for the job saying, I'm going to cut towards 1% interest rates. That's what the market is partially pricing, and that's how you apply for the job.
Do you believe that thesis?
Yeah.
Well, I think that's, if Trump's appointing a Fed chairman, it's going to be the most uber dove he can find.
So that support that, but that argument continues to support multiples going forward.
Definitely, It's I think Powell's going to talk very hawkishly, but still cut, and then after that, the market's going to ignore all the hawkish rhetoric.
If he doesn't cut in December,
that means something's probably happened. Either inflation surprised to the upside, or there's been further strength in the job market. But I do think the December cut comes. He'll try to present it as a hawkish cut.
It's 2-1, isn't it?
Yeah, Guy and I are
we're keeping score this morning in terms of our guests.
Guy said hold, I said cut, and
guess the 2-1.
And I think I'm winning. Just saying. Patrick, very quickly, if I could just quickly ask, if we're talking about cuts though coming in, The entire thesis of a hold is that exacerbates inflation risk. Should this market be pricing in inflation risk more seriously?
The market is completely complacent on inflation. It's just totally mispriced. For the next decade, inflation swaps are 2.2 to 2.3%. I don't see many scenarios at all where Western politics allow inflation to be that. Trump's whole plan is to create nominal growth to fix the debt to GDP ratio.
Yeah.
He's not going to get real growth that's doing it. It's going to be the inflation that does the heavy lifting there. So populist policies, interest rates that are cut far too low, that fuels inflationary fires, just completely mispriced for the next decade.
And the market's just going to digest it all.
Well, it's going to lead to a very strong steepening. Tips are massively going to outperform conventionals. Index links are going to outperform gilts that you talked about rising today. Inflation is completely mispriced. There's so many forces going to push prices up.
Yep.
Western debt and deficits don't work unless you have inflation.
And stocks have to go higher in that kind of environment.
If you do get the Fed cutting aggressively, you probably do get a melt up in stock valuations. Long term, you see a real multiple compression. So probably the end of this quarter, beginning of next year, I do think stocks grind higher. And then you start to see multiples come down, and companies that are producing real cash flows wins. Companies that aren't producing them in the near term really get punished because you can't buy future cash flows when you're discounting them at a high rate.
Great to see you. Fascinating conversation. Patrick Armstrong, Chief Investment Officer at Plurimi Wealth. Lots going on. Okay, let's take a look at what's happening with the Core 6 this morning and figure out what the picture looks like. There's some really interesting names out there that are certainly under significant pressure. ASML is under pressure, as you can see, to the tune of nearly, well, 2%. We're kind of moving in that direction, not quite yet, but moving in that direction. Defence stocks, interestingly enough, are down, despite the fact that the Germans actually green-lit some fairly significant defence spending last night. Luxury, though, is on the front foot. Siemens Energy is up. Chloe Melly's got all the details.
Good morning, Guy. Yeah, very good morning for Siemens Energy. It is up 10% after raising its medium-term outlook thanks to really strong demand for gas turbines and also for data center equipment. So that is a company that is really a big beneficiary of this data center build-out, and we can see that reflected in that higher medium-term outlook. It also said that the restructuring process at its wind turbine unit was progressing quite well. So all of that is very positive, and it's being taken quite well by the market this morning, up at 10.3% right now. Moving on to UK banks, and we have got some weakness across the board as part of this broader Sell UK trade that we've seen as reports are coming through that Rachel Reeves is considering making a complete U-turn on some of the budget proposals. The budget is coming in just a couple of weeks, and she is reportedly considering abandoning some of the measures that were floated before and that had been digested by the market. And so we could see that reflected in some weakness, in particular for Lloyds and Barclays, which are down above them more than 3% each. Moving on to Alstom, which is the maker of high-speed trains. It hiked its guidance for sales, and also its cash outflow was lower than expected, and that was being received really well by the market this morning. We are up 5% for that company. And finally, let's end on another positive move with Bechtel, which is a maker and retailer of personal computers and office supplies. And there the profit came in way ahead of estimates. And so they're very positive, very strong earnings. And we can see that in a very positive, very high positive movement here, we are up almost 15% for that company.
Chloe Melly from our equities team walking us through some of those early movers. We thank you so much. Let's talk a little bit about the UK bond market. She hit it from the bank story. The bond market also feeling the pain.
This is a huge move in UK gilts this morning. The market is clearly very nervous. And you wonder kind of how far down the road we're extrapolating. This feels like it's more than just simply Rachel Reeves tearing up her budget because of internal political dispute. This is the market signaling its serious concern about, A, the need to get the fiscal house in order, but the fears about what is happening politically within the Labour Party as well, and how tenable Rachel Reeves and Keir Starmer's positions ultimately are.
I'm just very quickly going to look at cable here. 131 and dropping as we speak. So I feel like that pain is the only thing, by the way, keeping up the dollar. Everything else against the dollar is
essentially yields are going higher and the pound is dropping.
Yeah.
So this isn't this is an interest rate differential story here.
No,
this is a fear about the UK's...
This is a Sell UK trade.
Yeah, precisely. We've got a Sell UK trade. The FTSE's down, you've got the pound down, you've got gilts under significant pressure, yields spiking sharply higher. There's a lot going on here and it's all negative.
Well, we're going to continue this coverage. We're going to walk us through some of the scenarios here. We've been debating it all morning about how this all shows up. We'll talk about UK assets more coming up, but we're also going to stick to the earnings story with Richemont sales climbing for the first half, signaling a possible rebound for the luxury sector, specifically in China. We saw the story yesterday as well. We'll dive into the details. More on that next. This is Bloomberg.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to the opening trade. 20 minutes into today's session, and the markets are selling off across the board. You're seeing a lot of pain right here in the FTSE 100, down about 1%. We'll dive into the UK story briefly, but it's not looking that rosy anywhere else either. Perhaps taking cue from the sell-off we saw over in the States in yesterday's session. One place where we are seeing some green on the screen is in the luxury space. Richemont coming out with their earnings this morning. Those shares bopping by about 8%. Yes, I said bopping and not popping because they're doing both. The Richemont sales have risen on better than expected demand in the Americas and the region, including China. A positive sign that the luxury industry may just be coming back from a slump. All over this is our Paris-based luxury reporter, Angelina Raskoway, and she joins us now. Angelina, just walk us through these details. Is this a fluke when it comes to the luxury space?
Hi there. Indeed, basically, Richemont is going from strength to strength. This year, it's been a very difficult year for luxury groups. There's been a downturn, in China. Consumers in China have not been buying. There are worries there. The U.S., there was worries about the U.S. tariffs. And actually, what we saw with Richemont is that they weathered that downturn very well. The shares year to date are up, I think, by more than probably today 20%. Today, as you said, they're up 8%, and that's because they're very exposed to hard luxury, to Cartier, to Van Cleef, and actually in these times of uncertainty, consumers deem this category as probably more resilient and as a better store of value compared to pricey ready-to-wear or pricey handbags. So it's been very, very positive overall, across all regions as well.
Actually, tell me about the tariff story. And what does Richemont think about it? Richemont, the big CEOs of the big luxury companies have had a big impact on this tariff story over the last few weeks. And I'm really curious to get kind of their take on what is happening here. So what did they have to say?
Absolutely. And what was interesting with Richemont is actually in the second quarter, the Americas was actually the strongest region. They grew 20%. So despite the announcement of this tariffs of 39%. So actually Switzerland was slapped with a 39% duty from the US administration. That was the highest tariffs on any developed country. But in recent weeks, there's been talks, as you say, you know, like a few top executives and billionaires of Switzerland, they went to the Oval Office, they met with Trump, they're trying to make a deal, and it sounds like we're on the right track. It sounds like Switzerland could now have a tariff of about 15%, which would be on a par with the rest of the EU. And that would be very helpful. However, what we saw with Richemont is that they have a lot of pricing power. Johann Rupert, the chairman of Richemont, has said that they haven't applied, you know, the greedflation. Other brands following the post-pandemic, they got ahead of themselves, they increased prices by a lot, and actually Richemont was very reasonable. And so they still have that margin of maneuver, and that's what we saw in the results in the Americas, up 20%, which is pretty staggering.
It's amazing, isn't it? Angelina, thank you very much indeed for updating us. Angelina Rusco joining us out of Paris on what's happening with the luxury space. Let's bring it back to what is happening in the UK. Gilts are getting battered this morning. This on reports that the Chancellor, Rachel Reeves, is dropping plans to raise income tax. Now, there were only plans, but apparently they've already been dropped. Anyway, the budget is coming really, really soon. Got concerns over what is happening with the UK finances. You've got concerns about the politics. Let's try and figure out what the message the market is sending this morning. Bloomberg Markets Today blog editor Sam Unstead joining us around the table. If you're sitting at the Treasury this morning and you're looking at the gilt market, what signal are you taking?
I think the big signal you're taking is that they don't want the politics to win. You know, so when you're trying to price in all, there's a lot of uncertainty about the budget anyway, but one of the key things that you have to do is this trade-off between getting a more sustainable fiscal picture that takes this question of fiscal headroom off the table a little bit more, that it's not something we're basically talking about almost every day in between the 365 days between budgets. Raising income taxes does that. Whether there was any kind of firm plan to do that or not, don't know, but by the looks of it, it's gone. And that would indicate that the politically toxic side of it has won out. And what that effectively raises the possibility of is that you get another budget, very similar to last year's one, where there's a lot of tinkering around the edges, where there's a pretty narrow amount of fiscal headroom that can get wiped out pretty easily. And then over the course of the last year, we've had consistently, you know, sort of every 3 or 4 months really, a little blow up in gilt markets, you know, often driven by not a huge amount. And that kind of febrile atmosphere underneath it, a lot of that is driven because there's this question almost every day about fiscal headroom, about the fiscal picture in the UK. And if you don't do these big taxes, then that's going to rain.
So the smorgasbord, as Alex Lippman called it, is not,
Sure.
it's not what markets want. So let me just make this super simple and super clear, maybe a little reductive. Gilt investors, gilt bulls want income taxes.
What they want is to take that question that's effectively asked every, as someone who's reporting on the UK market, every single day for basically the last 360 odd days, where's the fiscal headroom? How much fiscal headroom does she have? Over and over and over again. The income taxes takes that off of the table, and that just allows a little bit of space.
But are we moving beyond that? Are we now moving beyond where the politics, her position becomes untenable, and the fear is that we go further left, and you end up with more issuance and even more spending, and that the gilt market will be terrified by that.
Yeah, and actually that's a good point, because this comes in a week when you've had this extra little blow up around West Streeting and these sort of questions of whether Starmer's position is good. Reeves's position sort of gets questioned again every couple of months. There's kind of questions coming in about that. That lack of stability is a key problem for gilts and has been a key problem for UK markets over the course of the last year. And the pound as well. You know, the pound has become extra volatile. Will probably continue to do that, you know, over the course of the next couple of weeks.
Sam, interesting run to the budget now, isn't it? Wow. Okay, we're going to be busy. Sam Unstead from our Bloomberg Markets Today blog joining us. Remember, we've got some great specials around that budget coming up in a couple of weeks' time. What are we going to be doing next? The CEO of Vinted is going to be joining us. Thomas Pantenka is going to be joining us. We'll get a take on what is happening at that business. Revenue growth is extraordinary. Anyway, we'll come back to that in just a moment. This is Bloomberg.
climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
On a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome back to the opening trade. 30 minutes into today's session. Happy Friday. It's not exactly a rosy one. You're seeing a sell-off across the board. A little bit of catch-up from what you saw in the States yesterday. 1.7% sell-off in the S&P 500. Similar story here in Europe. The FTSE 100, though, Guy, is where the pain is. Walk us through what you're seeing.
It's pretty broad-based, the pain, I have to say, this morning. Take a look at this. Stock 600, 70 up, 69 up. 523 stocks are lower this morning. 523 out of the stock 600. And look at this, volume is high as well. You're getting some real churn within this market. Volume's been actually reasonably anemic throughout this week. Been pretty much at the average. Don't say anemic. It's been average this week. Now we're getting a big spike higher in terms of the volume story. I just want to show you what's happening in the UK, because the UK narrative is the one that is dominating here in Europe this morning. FTSE 100, international but affected by UK sentiment, is down by 1% this morning. The UK 10-year yield, 10 basis point move to the upside. That is huge. There's a really big reaction in the gilt market this morning to the FT report, suggesting that maybe the whole idea of raising income taxes is out the window. Look at sterling, it is down. Now, normally you'd think, you know what, higher yields, actually sterling would do better, but it's not. And that is fascinating as well. Normally you think, actually the pound is lower and the FTSE 100 should be higher. Translated earnings, it's not. It's a big kind of move in terms of what we're seeing around UK assets this morning, Critty, and it's not looking good.
It's not looking good. Let's go to the heart of it. It's our top story and some of the things you need to know this morning. UK Prime Minister Keir Starmer and Chancellor Rachel Reeves reportedly scrapping a plan to raise income tax rates and a slew of other levies. That's what's moving the markets this morning. First reported in the Financial Times, sources now telling Bloomberg the move comes over a potential backlash from voters and labor lawmakers. The Chancellor, of course, still needs to fill a budget hole of as much as £35 billion. Let's go to another part of the world here. China's economic activity cooled more than expected the start of the fourth quarter. Beijing reported an unprecedented slump in fixed asset investment, which shrank by 1.7% in the first 10 months of 2025, while the National Bureau of Statistics says industrial production saw its smallest gain of the year at just under 5%. And U.S. President Donald Trump is readying substantial tariff cuts designed to address high food prices. The administration has unveiled new trade deals with Latin American countries as they seek to address voter concerns over the cost of goods. The push comes after key electoral victories for Democrats last week in state and local races, where they ran on the platform of affordability. Guy.
Okay. Let's talk about what is happening with the consumer from another angle. The online second-hand marketplace Vinted is expected to bring in over €1 billion in top line in revenue this year and 10 billion in gross merchandise value. Just in terms of that revenue top line, that's up circa 25% on a year earlier, which implies some significant growth that we are seeing here. Thomas Plantenha joins us now. He is the company's CEO. Thomas, thank you very much indeed for joining us, and I hope I got the pronunciation right there. We were practicing, you and me, during the break.
That is
great to have you. Great. It was okay, wasn't it?
Very good, very good. Best non-native Dutch has ever done.
Okay. I'll take that as a tick in the box this morning. Let's talk about the numbers. Look, you're up by 25% on the top line. Where is that growth coming from? What's the message that a 25% top line increase tells us about what is happening at Vinted?
Yeah, so it's actually a plan coming together that we set out many years before. We've built 3 different businesses, which is the marketplace business, the shipping business, and the Vinted Pay business. And we see that all these 3 vectors we are now accelerating. So the marketplace has been accelerating because Germany has been doing very well. We fixed that market. It's one of our biggest growth drivers right now. And at the same time, we've expanded into new categories. And then with Vinted Go, our shipping solution, we've expanded to the 5th market, and we see that the other markets are really progressing very well as well. And Vinted Pay, our payment solution, has been scaling onto our members in the last months, which also helps us to drive costs down and bring revenue up.
In terms of the move into the United States, what happens with that? Does that turbocharge the kind of growth we're seeing once you make that stick? What does it look like? Will it stick?
So obviously the US is a massive market, and we've been very successfully now in Europe, and we've built it for like 9 years in a row to really build that foundation to be able to get good economics, steep growth curves, and penetrate that secondhand market to a completely new level. And with that knowledge, we now see that the US market is actually very immature. So all the players that are there are kind of struggling, and the penetration level of secondhand is actually very low. So for us, that is a huge opportunity. Yet every market and every continent is different. So we started now, as of Monday, we will connect London with New York. So finally, New Yorkers will have a very tasteful European fashion that they can buy secondhand. And we'll start testing. So we have a very analytical, cost-conscious approach where we have all kinds of phases we go through to test and see if the market is ready, to see if in the next year we'll lean in with bigger investments to develop this market. But it's a huge opportunity, and we're carefully testing as we are launching and testing every year multiple markets. So let's see how that goes, but definitely a big opportunity if that plays out well for us.
Could you agree with him? Better European fashion?
I mean, I hate to say it. I think he's right. I think the Europeans have the edge on the Americans when it comes to fashion. But, Europe versus New York, I don't know. But, Thomas, I'm glad you brought up New York. As a New Yorker myself, I'm going to claim that title. There's already a player in New York, a pretty big one, on the Upper East Side. It's called The Real Real. They're expanding across the board when it comes to luxury resale specifically. What is The Real Real not doing that Vinted can?
So the Real Real is a great example of a good company that is doing secondhand, and they're doing that in luxury. And they're very focused on, let's say, they have their shops, brick and mortar, and bringing that quality and authentication that people love in New York. And I think they're really speaking well to a certain segment. But what Vinted does is that we're building a proposition that makes secondhand accessible for anybody. Any type of secondhand good, whether it's regular fashion or electronics, adapters, mobile phones, we can bring anything to you at a very low price with very high sell-through rates. So we're as a platform that is built for anybody, not just for luxury. And that gives the opportunity for many people to join and practically be this mass market proposition that enables people to buy and sell things. So what we've seen in Europe is that there were many players in all the different countries, all kinds of luxury players, but also low-value players in many different forms. More the ones who are authenticating, more the ones who have shops, all kinds of different players. What we've seen every time we enter a market, we completely grow the market. So the other players stay in that market in the same way and continue to grow, but we completely grow the total market because the total addressable market grows, because we bring a proposition that has way lower cost and much more value than what the other propositions are.
Well, Thomas, as part of your expansion to the United States, I think what's really interesting, what seems to be the edge that you're bringing about, is that connection to the UK market. So it's ultimately a UK seller can find a American customer and vice versa.
Yeah.
But my question to you is, how does that affect your profitability, your margins? Because anyone who's shipped anything into the UK has to pay a massive fee on it, and now you're starting to see the same policies in the States as well. Don't you get hit on the shipping?
Yeah, of course. So that's not a long-term solution. Yet it is a part of a longer-term strategy that works very well for us in many, many different countries. So we've always used well-working countries to, on the back of that, launch new countries. So you bring the liquidity of that well-working country, for example, France, into the Belgian market, kickstart that market, and then let that market on itself later on thrive and have perfect cost and profitability margins. So it is a kickstart strategy that has worked for us in 26 other markets that we're now applying, let's say, with the New York, London connection. So yeah, obviously we're not gonna, in the future, continue to subsidize US, UK shipping.
You're in Vilnius, you're in Lithuania, you're the country's first kind of major unicorn. And I'm wondering what exposure in the United States is going to do to change the nature of people's perceptions of the business. US investors are going to take a serious look at you guys, and I'm just kind of wondering if the move into the States has other implications as well in terms of where you see the business going, not in terms of kind of where you're going to sell, but where the business itself is going. Does this, if you do well in the States, does it make an IPO more likely? Does it make a US IPO more likely? How does the exposure to the US change Vinted?
So I think it's a fundamental change if a market like the US works, because if you have Europe and you have the US, then you can really be a global player. And the sad reality is that in Europe, we've not built many global players. Spotify has surpassed 100 billion, but that's the only company that did that was started in the last 30 or 50 years. While in the US, they've built $7 trillion companies. And if we want to thrive as a society in Europe, we need to build massive companies that contribute well to the tax coffins of our countries and Europe. So for us, it is very important to see if we can go on a scale that is beyond Europe, because then we can be truly a global player, can truly make second-hand first choice worldwide. And that obviously has impact on how investors look at us. Because as you expand into a new continent, the TAM that you can possibly capture it's much bigger, and therefore the returns on future investments will be better. So that is definitely a big part. We've very much chosen to carefully go country by country in Europe to build a strong base, to then go outside of Europe also carefully. So we're making careful steps now. We're testing in the US as for Monday, and we'll see how things go. Hopefully we can make that change, because I really believe Europe needs more global tech companies.
Thomas, just let's take a 30,000-foot view of this, if we can. We've talked a lot about your business, your ambitions, your expansions. Talk to us about what you're seeing in the data, in the customers that you serve. What are they responding to? What brands are working? What kind of sales are you seeing? What are people gravitating to in the various markets that you're seeing? And are they different? Or is every kind of global consumer kind of veering towards the same thing?
Yeah, so around fashion, especially, we have a lot of fashion on our platform. There's a lot of smoke and mirrors and like brand thinking that people think that is important. Yet all across the world, across all people, we see the same trend. People are very cost sensitive, and they're very much look forward to make some money out of the clothing that they don't use anymore. So the monetary driver is very big for people. Then a second thing that is incredibly important is that the ease of use is very high. So that means selling very quickly, being able to transact very easily, and when all that happens, that it's all happening safely. So yes, fashion trends are different in every different country, and there are all kind of particular trends, but the fundamentals of our business stay exactly the same. And our strategy is exactly around these fundamentals. So since the beginning, I started running this company, we focus on cost efficiency and adding value to our users. So we want to be the most cost efficient, and we want to be the most reliable to our users. And that is what we focus on, and that has driven the success of the secondhand market for us.
All right. The Vinted Group CEO, Thomas, I got to do it. Plantegna, I'm sorry. I can't even attempt it. It was lovely having you. Thank you so much on the program. Coming up, we have one more conversation with the C-suite. Anders Malmström, CFO over at Swiss Re, joins us to discuss the reinsurer's earnings next.
Okay, let's talk about rockets. Blue Origin finally finally launching New Glenn. A big, it's the second launch. The key thing here was they actually brought the bulk of the spacecraft down as well and landed it as well. So this is a reusable spacecraft now, like SpaceX. The landing in the Atlantic was actually the key moment. Jeff Bezos was there. Remember, he is the guy that backs this company. They're trying to break the grip that SpaceX currently has. It was a huge moment. This is what it sounded like.
10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Liftoff detected. Tense motion.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome back to the opening trade. About 46 minutes, we'll call 47 minutes into today's session, read across the screen. When you look at the pain points here, I mean, it feels like the sell-off is fairly broad-based, but your massive underperformer this morning is the FTSE 100. Lots going on in the UK political space that is spooking UK assets from equities to bonds to the currency. We'll dive into that story in just a moment. In the meantime, of course, we are still in the middle of earnings season. We should go to one company we have our eye on, and that is Swiss Re. Those shares dropping this morning by about 3%. Despite them confirming their full-year profit outlook, the results in the first 9 months actually benefited from fewer natural disaster claims. They did, however, see some lower profit when it came to their life and health businesses. Let's get a quick check on this company here and bring in the CFO of Swiss Re, Anders Malmström, joins the program. Anders, a pleasure to have you. Thank you so much for your time this morning. you're reading the analyst commentary, or I'm reading the analyst commentary off the back of this earnings report, and there's some questions here about where the growth strategy actually is. Can you just walk us through these numbers and maybe what you think these markets are responding to?
So good morning, and thanks for having me. It's always a pleasure to be here and walk you through the results. Overall, we're very happy with the results. I think we achieved a net income result of $4 billion for the first 9 months. This puts us in a very good position for the full year target. Remember, the full year target is $4.4 billion or to be above that. So we're well on track of that. Overall, we got great support from the property and casualty business units. Very clearly, they benefited from the benign NatCat seasons events or non-events that we had in Q2 and Q3. But I want to remind everybody, we had a very severe Q1 with the California wildfires, but also with events in Australia. The third business unit, Life and Health 3.
Yeah,
I just want to finish on Life and Health 3 because that was part of your questions. Okay, very good. Thank you so much. So Life and Health 3, overall, a solid performance with $1.1 billion. But as we mentioned also beforehand, we saw some smaller portfolios. We saw negative performance. So we took actions to make sure that we put this business unit in a good position for the future. So that's where the underperformance in Life and Health is coming from.
Why do you have to withdraw guidance for that Life and Health business, though? What is it that when do we get guidance for that sector? When do you think you're going to be confident enough in the outlook to give us some guidance on that space?
So maybe just overall, look, I think when we started the year, we have two objectives. One is to meet our financial targets, and second, to build resilience to Swiss Re. Overall, for the group, we're meeting and we will beat the target for the full year, as I mentioned that before. But at the same time, we also want to build resilience. On Life and Health 3, we decided to do that now because it was underperforming. But also want to mention the large portfolios, particularly the US mortality, is performing very well, is performing in line with expectations.
Anders, I want to come back to some comments that you have made previously, basically confirming that Swiss Re had negligible exposure when it comes to First Brands and Tricolor. But can you just give us a little bit more insight of what that means and where in your business you had that exposure?
Yeah, so just to clarify, we have no material exposure to these two papers.
But you had some exposure. Where was it?
Yeah, we have a very small exposure on the investment side, but at the very high end, so we don't expect any impact there.
Yep.
And then, that's it. Yeah.
Anders, how much of the portfolio, though, is in private assets right now? How much exposure do you have to private markets?
So private markets are a good diversifier for the investment portfolio. Private markets also give us an illiquidity premium that will help the portfolio. Overall, it's less than 6% that we have in private debt. The majority of that is in infrastructure, which matches very well with our business model. We take a very conservative view on the private debt side. It's important we have really good due diligence, but overall I feel very comfortable with the private debt exposure that we have.
Anders, I'm going to switch topics with you in the last kind of few minutes that we have left here. Switzerland very much in the news this week as there's conversations from a geopolitical and tariff perspective between Washington and Bern. We know that you've set up a task force to monitor some of the impacts of that tariff exposure. What have you found? What are you thinking about? What are you hearing about from your colleagues who are engaging with Washington?
So we are monitoring the situation obviously quite well. I think the US for us is a very important market. We're very committed to the US market. For us, it's important, good trade situation, I think, helps the economy. And if the economy is going well, then I think this is good for society, and this is then also good for the insurance industry.
Anders, great to catch up with you. Thank you very much indeed for all the clarity you provided this morning. We always appreciate you joining us on the programme. Anders Mellström, the Swiss Re CFO. the Treasury clearly has been watching here in the UK the reaction that we've had to the headlines in the FT this morning in the gilt market, and we're getting some headlines as a result of that coming through. This is basically briefings that are happening at the moment on the back of the moves that we've seen. The headlines basically say the following. The Chancellor, Rachel Reeves, is still expected to deliver a headroom of 15 to 20 billion. The improved UK forecast, so economic forecasts apparently have been improving enough that she's been able to drop the tax hike story that we've been talking about over the last few days. Now, there's a lot of kind of politics involved in all of this, and the market will make up its own mind. What we have seen, though, is a move that is slightly more positive towards UK assets since those headlines have dropped. Apparently, the latest UK fiscal forecast put the gap at 20 billion. So we talked at the beginning of the show about a 30 billion hole. Apparently, it's only 20 billion. That's still a big hole.
That's still definitely a big hole. I don't really know what you do with this, though, because it feels like we started, or we're going towards right where we started 2 months ago, since the manifesto, or since the speech that she said. Was that? I can't even remember when that was.
That kind of special. It was only about 10 days ago. But the
feels like months ago.
It feels like definitely feels like longer. But the market's going to look at this and say, is this just internal politics? Is this basically her having to change her plans because of concerns about the manifesto pledge? So the market's going to look through a lot of what we're hearing in terms of the briefings that are clearly going on. Mark Cudmore, our executive editor for Markets Live, joining us now. Mark, again, kind of the UK stuff. Is the UK idiosyncratic here, or is the UK emblematic of what is happening more broadly?
Can it not be both, possibly? I think clearly the UK is idiosyncratic in some way. I mean, they have some ongoing and sustained problems politically with a fiscal hole that I'm not sure how they ever get out of it. So, you know, I think that it's at the forefront of a problem which is probably emblematic globally. There are more and more Western economies that do have growing fiscal holes that they don't have the will to kind of get out, escape them, and it's kind of a long, slow decline, and the UK is at the forefront of that. This is interesting. I don't know what to take of the latest headlines. I've been off the desk for the past hour. I walked to the studio just as the headlines kind of came on. You know, I thought there was an overreaction initially to the FT story overnight, and now it seems we've entirely erased those moves. My suspicion is that overall into next week, none of this is good. You know, the UK story is not suddenly positive, even though we've kind of changed the narrative on the overnight headlines. It's saying there's a lot of uncertainty out there. The UK is in a tough spot, and I think sterling will remain under pressure overall, even if some of the short-term pressure is alleviated.
Mark, very quickly, what do gilt bulls need to hear? Outside of everything solved and the budget is balanced, what do they need to hear in the run-up to the budget?
Yeah, it's really interesting, actually, Credit. I think there's a bias to buy gilts here. A rate cut, I mean, I'm not sure what the latest pricing is, I must admit, but as of yesterday, the rate cut was about 80% priced for December, and the market kind of really wants there to be a rate cut in December, so it seems like people were biased to buy gilts. It was going to have to be, 24 hours ago, I was thinking it would have to be a shockingly high CPI print next week to kind of not get that cut in December, and therefore we've had a positive backdrop for gilts. In terms of the structural story, though, there's just this big fiscal hole the UK is never going to sustainably solve. They're just putting off problems. So, I think gilts are ultimately heading towards a disaster, but I think it's much farther down the line.
So, Mark, what do you watch this weekend? Do you watch the crypto market, which you were talking about this time last week, or do you watch the Australians beat Ireland?
I watch Ireland beat Australia. They're not as bad as you might think. The red card against the All Blacks kind of was deceiving in that game. I think Farrell will have learned a lot from the Lions tour in the summer. I know Ireland haven't been brilliant. I know Australia have been much better than a year ago, but Ireland should still win this game, even though they weren't brilliant against Japan last week. Much more importantly, though, is Irish football team has a chance to go to the World Cup, and we're terrible at football at the moment. This is not like the good team in the 90s when I was growing up. We're useless, but we beat Portugal 2-0 last night before Ronaldo got sent off in frustration that Ireland were outplaying Portugal. So we have a chance of still getting into the playoffs. That is the weekend excitement.
Okay, plus all the other stuff that's on the screen as well. There's an NFL game somewhere as well.
A film festival.
That's important too. There's a lot of rugby this weekend. Fantastic. Anyway, enjoy the weekend. Mark, thank you very much indeed. Lots going on.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The sell-off in US stocks deepens into Friday as mounting fears of a hawkish pivot by the Fed fuels a retreat from risky assets. The pound and gilts pair losses after sources say improved economic forecasts were behind government moves to scrap plans for income tax rises. And Richemont shares jumped the most since March as shoppers from the US to China snapped up the luxury goods' expensive Cartier and Van Cleef jewellery. Well, welcome to the programme. For a moment there, I thought we needed to start saying Rayco. Reeves always chickens out. Gilts were selling off the most since the UK Chancellor cried in Parliament. The pound was tanking against the dollar. But now we have an explanation for expected U-turn on income taxes. Better forecasts. And as you can see, those moves reversing now. More broadly, though, stocks on the back foot this morning as doubts about AI valuations rear their heads again. And as that December Fed cut looks rocky, Nasdaq futures pointing south and oil surging on a Russian port attack and tougher US sanctions. Let's dive into what's happening across the European continent. It is red across the map. Domestic UK stocks not liking the ideas of a Reeves U-turn, so the FTSE 250 pairing some of the earlier losses. Switzerland, though, performing the least badly thanks to those Richemont earnings. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. Well, it's been a turbulent end to the week for the pound after Bloomberg learned that the UK Chancellor, Rachel Reeves, was considering dropping plans to raise income tax and a slew of other levies at the upcoming budget. Reports in the last few minutes, though, say that that decision may have been driven by improved economic forecasts. Let's clear all this up. We can bring in Bloomberg's James Woolcock for the latest. James, we had Reeves saying in her speech last week, or at least hinting, that she was going to break the manifesto. Then it seemed she wasn't going to raise income tax in the budget. And now we've got these latest developments on forecasts. What's going on? What's the thinking behind all of this?
Well, to understand the thinking, there are 3 constituencies you bear in mind. The public, Labour MPs, and the markets. Reeves is trying to keep all of them happy. And so that was why 2 weeks ago she started saying tough decisions need to come. And that led to lots of speculation, even from her own backbenchers, that a manifesto break, a break of her election pledges was coming, and that would be income tax. Now, the markets and business took that very well. Her own backbenchers did not. And what can't be escaped is this has been an awful week for the government. You have had rumours of plotting. We are now in a doctor's strike as of today. And the Prime Minister has seen a low polls, making him one of the most unapproved of Prime Ministers in British political history. That led to this bombshell report we had last night that income tax was being dropped. Markets did not like that an hour ago, and within an hour, government sources have spoken to Bloomberg and saying the forecasts have improved, and they now are expecting to have between 15 to 20 billion pounds of headroom at the end of the budget. This is a balancing act as the government goes between those three constituencies I mentioned, trying to keep all of them happy. The question is, can it?
And how is she likely to balance the books here? If it's what tax levers or spending cuts are available to the Chancellor at this point, pleasing as many of those constituencies as possible?
We can kind of see the markers at this point. Imagine a tank, if you will. We started with £10 billion headroom. We know the welfare backfiring over the year loses about £5 billion. We expected the OBR downgrade to lose somewhere within 20 to 30 billion based on our reporting. And now we're told that without income tax, she's still going to end up somewhere between 15 to 20 billion. That's according to our latest reporting. It all might change by the budget day. That leaves a roughly, give or take, a kind of 30 billion hole to fill. That we are hearing that salary sacrifices and a cap on those, which has been reported, so that's how much employees can put in tax-free into their pensions per year, could be a good way of getting to that. There are others on the mix. You could imagine, say, an EV tax has been floated, a tax on limited liability partnerships, gambling and betting companies. At one point, a bank tax had been effectively ruled out, but it's worth saying at this point, with the Treasury looking to raise money, a lot of these smaller, sort of low-digit billion-raising options are back on the table, and the focus for us and the team here is reporting what might be in the budget in 2 weeks' time.
Okay, Bloomberg's James Wilcock, we thank you so much for breaking that down for us. We're looking at gilt yields still up 6 basis points on the 10-year. They were up about 13 basis points at the start of the session, so pairing some of those gains now. But let's get some more analysis. We have Mohit Kumar, Chief Europe Economist and Strategist over at Jefferies. Really good to have you. Well, what an exciting moment, Mohit. I mean, I started the day wondering whether we should start saying Rachel always chickens out, because she couldn't get the spending cuts past the left of her party. Then it seemed like she couldn't get a big income tax past the left of her party, tax rise. Now it seems like the forecasts are going to give her cover for a fudge. Is this enough for the bond vigilantes? Yields still up on the 10-year.
I don't think so, unfortunately. So I fully agree with what James was saying, that you're trying to balance the voters, the Labour MPs, and the market. And it's very easy to say that we have better forecast and because of which we have more headroom. But let's look at numbers. If you remember last time, OBR had 1.7 to 1.9% UK growth for 2027 to 29. It will be reduced downwards, we know it. But we could come with something like 1.4, 1.5. Our expectation is close to 1. So I fear that the forecast that we would have in the budget, which gives an optically good budget, are just too optimistic.
So you've got a global focus. Put this into context for us. How much worse a position is the UK in to, the likes of the US and France?
Versus US, absolutely in a worse position, simply because dollar still remains a reserve currency. And yes, there are lots of talks of people moving out of the dollar. Problem is there is nothing but the dollar. France, I would say UK and France are in similar situation. Potentially UK is in a slightly worse situation compared to France, because a lot of investors look at France, they look at spreads versus bonds, they look at spreads versus Italy. There is a limit to which France can sell off. UK, unfortunately, doesn't have that natural investor bias. So the way we are looking at, maybe optically we get a good budget. I think yields will probably not rise till the budget. But the moment we get the budget, all the analysts do their analysis, they figure out actually it's not good. We should see a steepening of the curve again.
Do you know what's interesting, Mohit? I'm just looking at traders' bets for a Bank of England rate cut in December. It's still 19 basis points of cuts priced for December, so that's not really changed here.
No.
Are you seeing one?
We are in the December rate cut camp. We actually think, like, going back to the growth forecast numbers, if it is going to be close to 1 for the next 3 years rather than 1.4, we think Bank of England needs to deliver more than what's priced in, even now. So the latest U-turn, or if we call it a U-turn, is not about Bank of England. Growth is about Bank of England. So we are definitely in the camp of a December cut. Actually, we go a step further and believe that Bank of England takes rates to 3% by end of next year, which is more than what's currently forecast. So we are long gills at the front end. Long end is a different story. That's about the fiscal part. So that's why it's a steepening of the curve.
But what could Reeves do to derail that?
Well, have a credible budget, which is numbers which are not just based on productivity gains or based on optimistic growth forecast, but numbers which make sense from a tax cuts and spending cuts perspective. The problem is, and exactly what James was saying earlier, you need to make the voters happy, you need to make the Labour MPs happy. It's a very delicate balancing act.
All right, Mohit, I hope you'll stay with me because there's loads more I want to ask you. That's Mohit Kumar, Chief Europe Economist and Strategist over at Jefferies. But I also need to talk to you about the US because there are growing doubts that the Fed's going to cut rates next month, with Governor Neil Kashkari saying that he's still undecided. Kashkari didn't support the last rate cut, remember, but he says it could go either way at the next meeting.
We have inflation that's still too high, running at about 3%. Some sectors of the U.S. economy look like they're doing great. Some sectors of the labor market look like they're under pressure. How do we make sense of these mixed signals?
Let's bring in Bloomberg's managing editor for US economy and government, Mario Parker, for more. Mario, so good to have you with us. We've heard from Neil Kashkari, we've heard from Austin Goolsbee, we're going to hear from Jeff Schmidt, we'll hear from Beth Hammock, and we've got Laurie Logan on the docket for later today. All of them have been weighing against a December rate cut. Where are the doves?
No, I mean, and then you got Mary Daly now signaling some type of wavering as well. You've got Susan Collins doing the same, speaking about a high bar also. And some of this was telegraphed by Jay Powell during his more recent remarks, where he hinted at some of the debates that were taking place within the Federal Reserve Board. I mean, this is night and day from where we were a few months ago, but it speaks to this difficult position that the Fed finds itself in, as it has this 2% target that continues to be elusive, but then there's really hard to read data in terms of the economic health of the U.S. right now.
But of course, what's going on with the US data is crucial. The lack of it's been clouding the outlook. Do we know yet what we're going to get?
And to that point, the Fed's job just got that much harder by this government shutdown, right? We know that we'll get September data pretty quickly, but that's so backward looking. The White House has signaled, that the administration has signaled that some of the key October data, CPI, BLS data as well, we may not even get some of that data. We've been, obviously, and our clients have as well, been very reliant on some of the private data, and even that looks shaky. But the Fed doesn't have some of the tools that it's used to having with the government.
All right, Bloomberg's managing editor for US economy and government, Mario Parker. Such a treat to have you with us in London. I want to get your take on this, Mohit. Mohit Kumar still with us, Chief Europe Economist and Strategist at Jefferies. I think you think that they are going to cut in December. So really, if they don't, will they be behind the curve?
I would say December is looking more like a 50-50.
Right.
And to your point earlier, Lizzie, and what Mario was saying, it's the lack of data. They don't have enough data to justify a rate cut.
Does the lack of data back the hawks, basically?
I would say yes, because inflation is still high. If the Fed doesn't have data, the best thing to do is do nothing, wait for more data. That is the default action for the Fed. And a lot of people within the FOMC, and we heard Kashkari, we had Muslim, Hammock, all arguing for a bit of caution. Caution, to me, interprets as we need to see more data, particularly on the employment side weakening. If you don't have data, might as well wait another meeting.
Somewhat ironic for those in the White House calling for rate cuts. But look, what sort of data, similar question with the BOE, do you think would stop the Fed cutting rates in December?
Unfortunately, we rely on one key data point, and only one key data point, which is the payroll that comes on 5th of December. And that's just before the Fed meeting. So let's say, as an assumption, we get payrolls which are 70, 80K instead of a zero or a minus number.
Is that what you see?
Well, it's too early to make expectations. We need to see more data to firm up our numbers. But in that scenario, it is very difficult for the Fed to cut rates. So that, to me, is the biggest risk right now for markets. We have valuations a bit extended, positioning a bit long, and you get a bit of a hawkish Fed. We could be in for a bit of volatility.
Okay, well, you are bullish equities, though, aren't
Absolutely.
you? I mean, the numbers this morning, when we look at the futures picture, NASDAQ futures down 0.4%. It feels like this question of when the AI bubble is going to burst is back on the table. When is it?
In my mind, if there is a bubble, and I'm not saying there is a bubble, I would say at least 2 years away. And 2 years is, in the financial market, like another lifetime. It's very difficult to trade what happens 2 years later. So I'm not in the bubble camp now. And that's why we remain bullish, with the acceptance that we could see some volatility over the coming weeks. But that, to me, is by the dip opportunity, is not start for sell-off.
Okay, interesting. And then when you put the macro lens on that, how long is it going to take for all of this CapEx spending to translate into productivity gains, not just in the US, but here as well?
So the question to me is, when I look at CapEx and valuation, I mean, these are the two big concerns of AI. If you look at CapEx, the big difference versus a bubble territory or the dot-com territory is, in the dot-com era, CapEx was leveraged. Now, CapEx is coming from companies who are cash-rich. So the leverage concern is not there. So to me, what is important to watch is when we move to that leverage. And we have already seen, we had a few companies raising a lot of debt over the last few weeks. We are moving towards that leverage territory. But to me, that's a year, 2 years away. So that's why on your answer on when does CapEx translate into productivity concerns, it's all about leverage. Are we going to that stage? We are not there today. We could be there in 24 months' time.
But does it come with layoffs as well?
If the productivity gains are not there, absolutely. But then again, let's look at CapEx for next year. CapEx expectations for next year are even higher than this year. So if we get layoffs, potentially to me, it's a 27 story, it's not a 26 story.
Okay, Mohit, thank you so much. Mohit Kumar, Chief Europe Economist and Strategist at Jefferies. Really good to get your take both on the US and on the UK this morning. Coming up, the Greek Finance Minister. I'll be speaking to the Greek Finance Minister in just a moment. This after Greece has delivered one of Europe's most striking fiscal turnarounds. That's next. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
November 26th, Chancellor of the Exchequer, Rachel Reeves, delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg, context changes everything.
Excess regulation, excess taxation actually is a tax on the economy and growth. At some point, people don't invest. And so this is the balance we need to find. And Europe is getting further apart from the United States, not coming closer.
Santander Executive Chair Anna Botín there speaking to David Weston on Wall Street Week and what she thinks is limiting Europe's growth potential. Well, speaking of which, Greece has delivered one of Europe's most striking fiscal turnarounds, moving from a debt crisis that nearly forced it out of the currency bloc a decade ago to successfully becoming an outperformer. Set to submit its 2026 final budget and medium-term fiscal plan next week, it's now recognised as one of the peripheral economies reshaping investor expectations for the region, outpacing on growth and market performance. I'm delighted to welcome the Greek Minister of Economy and Finance, Kyriakos Pierrakakis. So good to have you. Thank you so much for stopping by, Minister.
Good morning. It's great to be here.
So, as I say, next week you're going to submit your 2026 final budget and Greece's medium-term fiscal plan. What are your forecasts when it comes to growth, the budget surplus, and your target for debt for the end of the period?
Well, as you very well know, as you mentioned before, we're a turnaround story and effectively a renewal story. And the projection, we already delivered the draft budget. We will be delivering the final budget next week. The projection is that we will be growing by 2.4% in 2026, much higher than the EU average. We will continue producing primary surpluses, 2.8%. And we have the most rapid de-escalation of debt. Remember, debt used to be 210% after COVID. Our plan, well, for next year, for 2026, is for 137.6%, but our plan is, before the decade is out, for the Greek debt to GDP ratio to be below 120%.
But on that debt, what's your borrowing plan for 2026? Are you going to front-load issuance?
In reality, we have a light borrowing plan, and we have a light borrowing plan because it's a good problem to have in a sense. We produce primary surpluses right now. We're mostly focusing on the liquidity of the secondary market in terms of our debt management agency. But overall, the goal is early repayments. We already announced that we plan to repay the debt from the first bailout package of the first memorandum 10 years earlier, by 2031. We will even be exploring to front-load that if that's possible. But overall, our plan is to be quite aggressive in terms of debt reduction because this produces social costs. And we plan not to repeat the mistake of the previous generation, which was to pass the bill to the next one. We won't do that.
But you've got elections coming 12 to 18 months before, in 12 to 18 months. What are your priorities between now and then? Because usually politicians like to do a bit of spending in the run-up.
In reality, the way we're growing in a positive feedback loop where unemployment is limited. We have reached the low unemployment numbers of before the crisis. Growth is much higher than the EU average. So this allows us to have fiscal space while also having growth and fiscal surpluses at the same time. And in a recent program announced by the Prime Minister, we delivered the biggest tax cut in our history. We lowered income taxes across the board for all Greek citizens, primarily for families with kids, primarily for young Greeks. And overall, this is a very positive policy to have, which the Greek economy allows us for.
Okay. You've just come back from a Eurogroup meeting in Brussels. I've got to ask, who are you going to be backing to be the next Vice President of the ECB? Should it be a Greek name?
I cannot publicly comment on this, but what I can tell you right now is that we would like to have many Greek names overall in European institutions because we believe that this would also symbolize the success of the Greek economy in the last years. We're a stability story, we're a growth story. This should be manifested by the participation of the people who made that story possible.
Okay, so you want many Greek names on there, but there are 3 ECB posts up for grabs. You've got the chief economist, the president, and a board member, but we've also got French elections coming coming, of course, in spring 2027. Would it make sense to announce all of those three in one go, in one package, at the start of 2027?
I would say that this is amongst the things that we will be discussing in the future. Those are future discussions to be had about how to staff the European institutions. We're mostly interested in policy, and this was one of the things that we discussed in the last couple of days at the ECOFIN and Eurogroup meetings, where many decisions were made about the future of the European Union and the future of the European Monetary Union, customs reform, amongst other things, energy taxation. And on all of those things right now, we need to collectively make decisions fast. So because your question entails speed, speed should be of essence in the delivery of the policies primarily. And the number one policy that we need to deliver as Europeans is the Savings and Investment Union. We need more cross-border M&As, as the Draghi report mandates. And Greece is actually following the advice of William Faulkner to young writers. Show, don't tell. We're showing. We're pro cross-border M&As, and we're delivering.
Well, you'll be pleased to hear we're going to discuss that cross-border M&A with Jackie Inniker later in the programme. But I have to ask you about the policy on frozen Russian assets. Is it going to get over the line?
I can tell you that we fully support Ukraine. President Zelensky is going to be in Athens on Sunday. This support is manifested and has been manifested in the last years. On the specific policy, we're examining it. We believe that it needs to be legally sound. It needs to be further examined. We hope that it can manifest itself more at the European level rather than at the national level with regards to the mutualization of assets. But overall, I think that we will have a decision quite soon.
What's it going to take to get Belgium over the line?
Well, actually, this is, in my view, the KPI. Belgium needs to be over the line, and Belgium needs to be protected.
And if you can't get it, what's the fallback plan?
Well, currently we're discussing the other plan, so we're not yet there.
Okay, back to Greece, Minister. We're approaching the deadline for Euronext's public offer for Athex, the Athens Stock Exchange. It ends on Monday. Are you optimistic that the offering is going to succeed?
I am optimistic. We fully support the specific deal. I mentioned before, we're pro-cross-border M&As. I heard Chancellor Merz recently saying that we should ideally have one European stock exchange. Well, Greece needs access to this broader liquidity pool, and this is why we supported the Euronext deal. And we really hope that it can materialize. But it's not only Euronext. We had UniCredit increasing its equity share in Alpha Bank and a Greek bank. Overall, we want to see more FDI, more investment happening in Greece. And Euronext's proposal for the Greek stock exchange is actually quite significant for us.
So participation is going to be high enough?
We're hoping that it will be positive. It's a private deal. It's a private business deal. On a political level, it has our full backing.
Okay, really, really great to have you with us here in London. That's the Greek Minister of Economy and Finance, Kyriakos Pierakakis. Thank you so much for joining me round the desk. Well, just checking back in on these markets, because we've been seeing some incredible moves when it comes to the UK picture. We've got the FTSE 100 weak at 1.1% now. The broader stock 600 down 0.9%. So it's still lagging the benchmark index. But you're also seeing the Swiss index down only 0.3%. That's thanks to the earnings out of Richemont. We're going to dive into those in just a moment. Nasdaq futures down 0.4%. This, as we were discussing with Mohit, partly due to the questioning of the AI bubble, also because of the rockiness now around that December Fed rate cut. But if we look at the gilt picture here in the UK, we've got the 10-year gilt yield now up 7 basis points, still significantly more than the rest of the continent at the long end of the curve. For example, the 10-year Bund yield only up 2 basis points, but we have significantly paired the gilt yield gains since the start of the session. They opened up 13 basis points, and this comes down to what we've been hearing from the UK Chancellor, lines crossing just at the start of this programme, and we should recap those. Rachel Reeves still expected to deliver headroom of £15 to £20 billion, this according to sources. We have the latest UK fiscal forecast putting the gap at £20 billion, and we have UK forecasts leading Reeves to drop the income tax hike. Again, according to sources, but putting a reason on why the Chancellor would be making a U-turn from what she seemed to be hinting at in that speech on Tuesday, that she was going to break the Labour manifesto. The market did not like the idea of a U-turn on income tax earlier on. We seem to be reversing some of those moves, and we're looking at the pound against the dollar now still down, but only by 0.3% at $1.31. Coming up, Richemont sales climbing on better than expected demand from the US and China. We'll unpack those earnings next. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London, and these are your top stories. The pound and gilts paring losses after sources say that improved economic forecasts were behind government moves to scrap plans for income tax rises. The sell-off in US stocks deepens into Friday as mounting fears of a hawkish pivot by the Fed fuels a retreat from risky assets. And Richemont shares jumped the most since March as shoppers from the US to China snapped up the luxury group's expensive Cartier and Van Cleef jewellery. Well, diving into what's happening in UK assets, we have the 10-year gilt yield still up 7 basis points, but nowhere near as much as it was up at the start of the session. That was 13 basis points. The market not keen on the idea that Rachel Reeves was going to scrap an income tax rise that she rolled the pitch for last week, of course. Now we're told that better forecasts mean she can change her mind on all of this, and that actually we're still going to have headroom of 15 to 20 billion pounds. This according to sources, the latest UK fiscal forecast putting the gap at 20 billion pounds. And so we're also seeing the pound fluctuating here, but now weaker 0.3% at $1.31. It had gained significantly off the back of that U-turn, and then it's gone down again. So we're still in the red at the moment, and the FTSE 250 still the underperformer across the European continent when we look at indices, because domestic stocks not happy about all of this political back and forth coming out of Westminster. But you're looking at the Swiss market index, the outperformer this morning, as indeed is luxury as a sector across the stock 600, and this comes down to Richemont. Sales climbing on better than expected demand in both the Americas and China. Sales at the Swiss luxury group's jewellery division, which includes brands, of course, like Cartier and Van Cleef, beating analyst expectations. Is the latest sign that the luxury industry is emerging from its slump. And we can bring in Bloomberg's Angelina Raskoway for more on all of this. Angelina, just talk us through what stood out in these results for you.
Absolutely. Hi, Lizzie. As you say, Richemont posted double-digit growth rates in all regions in the second quarter. Interestingly, the region that includes China returned to growth. So that's a country that has been suffering for the past almost 3 years amid a downturn because of a property crisis, because of youth unemployment. Chairman Johan Rupert in the call this morning, he said it's probably too early to talk about green shoots, about a recovery, but still that's very interesting. The strength, obviously, of Richemont is its jewelry maisons, as they call it. That's Cartier and Van Cleef. You know, gold in these uncertain times, hard luxury, as the sector calls it, is seen as a store of value. It's seen as extremely resilient, and probably much more than, you know, handbags or ready to wear. For instance, where LVMH is one of its big rivals, is much more exposed to. So, you know, year to date, the shares now are up 30%. Just today, the market cap went back above 100 billion, close to the March record. So really stellar results. And even though the specialist watchmakers returned to growth, that's a division that had been struggling a lot.
Angelina, to the geopolitics, a Trump official yesterday cast the trade talks with Switzerland as positive. What did the Richemont CEO have to say about tariffs?
I mean, today he said that he thinks there's going to be a sort of a clarification when it comes to the tariffs. I mean, Switzerland, again, it was hit with a 39% duty from the U.S. In August. That was the highest levy on a developed country. And so there are signs, you know, a bunch of Swiss executives and billionaires like Johann Rupert went to the Oval Office last week. Basically, they're trying to make a deal with President Trump. He loves making deals. And it sounds like we're on the right track for Switzerland to get probably a 15% duty on a par with European peers. But what's very interesting is that the Americas in the second quarter actually was the strongest geography for Richemont. Growth there was 20%. So it shows you that, and you know, they applied some price increases, but it shows you that Richemont still has pricing power. And Rupert is, you know, he reminds us of this on a regular basis, because peers in the rest of the industry really, when they really carried out heavy price increases following the pandemic, and Richemont has been more reasonable. So now they're still left with a little bit of margin of maneuver.
So, Angelina, can we conclude that luxury is back? We've already had earnings from LVMH and Burberry. Now we can add Richemont on the top.
I mean, what we saw in this earnings season is that tentative improvement in China. However, all the executives were very careful to say, you know, let's not get ahead of ourselves because it's early days. And, you know, earlier this week, our colleagues in China wrote a massive piece about the deflationary environment in China. So we have to see if this is a one-off or if this continues in the coming quarters. Q4 LVMH, for instance, for the last quarter of this year, LVMH warned last month that the comparables will be tough. For Richemont, I think it'll be, you know, the Christmas shopping season is crucial. They launched a new, at Cartier, they launched a new bracelet. The campaign has been out already, and we'll see. But when you create new products, typically this is very good, because you can bring in old and new customers, returning and new customers.
Okay, Bloomberg's Angelina Rascoway, we thank you so much. As we look at luxury as part of consumer products and services, of course, one of the only two sectors across Europe this morning managing to eke out gains, that alongside energy. Well, the Citi chair and CEO Jane Fraser says that she's keeping an eye on the US labour market as well as private credit, but she adds she isn't worried right now. Let's take a listen.
I don't think we're out of the woods yet, and there's a sense that there may be another shoe to drop. It could be in tariffs or in the labor market. It could be in the asset prices that are quite high in the States. But all of that said, we're quite optimistic about 26. The challenge for the Fed right now is with the government shutdown. You know, we all have a dearth of up-to-date data, which we could do with. It's hard to make these calls of exactly what's going on whilst we're waiting for the information. But as we look further out into next year, I think the resiliency of the corporate balance sheets, the strength, companies leaning in to innovation, investing in AI, you know, there is, I think the doomsdayers will be proven wrong.
We're a couple months out now from when we had concerns rise about, I think there was one at Tricolor, the subprime auto lender. There were failures. There was concerns about non-performing loans. What does your balance sheet look like as far as that, and where is your worries lie?
Our balance sheet is pristine, but I think part of that is because it's very heavily investment grade on the corporate side. We're over 80% investment grade globally, and when we look at the consumer side, it's about 86% prime. So we tend to see the most resilient, healthiest parts of the economy on the balance sheet. All of that said, we haven't seen a thing that is concerning us. The consumer in the States is being fiscally responsible. Companies have been building up some more cash, either for a rainy day if it proves necessary, but most of them for investment. And they're acting from a position of strength. We'll keep an eye on the labor market. We'll keep an eye on some of the areas of mid-tier players in private credit and the like. But as far as we're concerned, that second, third order effects, the bank's not seeing anything that we're worried about.
So that was Jane Fraser, CEO and chair of Citi, speaking to Bloomberg's Stephen Engel. Well, let's focus on Europe's banking scene now. Jackie Inniker, Chief Investment Officer at Spring Investments, joins me. Jackie, we've heard Jane there. She says she's not so worried about cockroaches in credit just yet. Should we be worried here in Europe?
Absolutely not. I don't think so at all. I think the European banks' balance sheets are extremely strong. I think where you're starting to see these cockroaches, as we call them, or alarm bells, as Andrew Bailey has talked about,
much more,
is in the US. Yeah, it's a nicer term, very British. Is very much in the US. And actually, I'm quite surprised that we haven't had more of these alarm bells ringing. There certainly will be more to come, but as long as it stays at this kind of level, one or two every few months, then that's absolutely manageable. And no, I'm not concerned.
Well, where do you think more are to come? Because we've had the Tricolour and First Bank episodes. Where else are we going to expect more alarm bells?
Yeah, honestly, I've absolutely no idea. I really don't know. I mean, but I think it's going to be quite granular. That's the thing, and you'll see them popping up all over in the US, like you should.
Yeah, I suppose the bigger question is how you see regulators dealing with it, because surely they don't want to trigger fire sales by making banks hold more capital.
Yeah, and I think when you're looking at these...
private credit firms.
Exactly, yeah. So it really is the private credit firms that have almost taken the banks out of this sector to the small and, let's say, medium-sized companies. Now, I think, was it Barclays and HSBC earlier this week talking at the House of Lords Financial Services Committee about it's not fair. There's no level playing field here. The banks, it costs them 5 times more to lend to a small company than it does to lend to a private credit firm lending to that small company. And I get that. Banks are heavily regulated. Private credit firms are not. Now, to answer your question, should we start regulating private credit firms? Will that help? I don't think so. First of all, you need politicians to want to do that. Then you need agreement. And you don't need agreement in Europe. You need it globally. Certainly you need it in the US.
Yeah.
And if you're going to start regulating them in Europe, you're handing the business even more to the US than it is now. So I just don't think there's any incentive to do that. I think a better way forward would be more on the information front, getting more information on what is in these private credit firms.
Well, because there's specifically the concern about insurance regulators and whether they're competent to oversee the risk involved in private credit. That's something that Com Kelleher at UBS has flagged.
Yeah, you can try and regulate this sector. Are they competent? Well, they need some regulations to start with. You need politicians to agree regulations. And ultimately, like you said earlier, we're kind of afraid that if you start regulating these companies, number one, are you cutting off a source of cheapish credit to the companies that need it? And secondly, would you trigger some fire sales at these private credit firms? So there's all these difficult consequences of regulations in this sector, even if the politicians wanted to put them in. And I don't think they do, certainly not in the US.
The other big line out of the UBS chairman was that Switzerland's having an identity crisis. This, of course, his comments on the Swiss government's proposals on new capital rules. Do you agree with him?
Yeah, I'm not sure I would call it identity crisis, but I do agree that, asking them to take another 26 billion of equity You know, it's too much. For me, I'm a credit analyst. I'd love UBS to have a load more capital, but it makes them anti-competitive. It's just, it doesn't make sense from that perspective.
Well, yeah, if UBS does move its HQ out of Switzerland, what does that mean for investors? What does it mean for the broader Swiss banking system?
Well, if you're assuming that they do, and I don't think they will, I think we'll get to a nice negotiation. And I'm Swiss, so I'll probably vote in a referendum on that in a couple of years. And I don't think I want them to hold a lot more capital. But if they do go out of the country, what will it mean for Switzerland? Well, the Swiss private bank, the Swiss banking operations will still be in Switzerland, but you're taking the HQ out, you're taking a substantial load of staff and operations out. It's not good for the Swiss economy, certainly not for tax revenues as well. So for staff, tax, it's not good. And they better be sure that wherever they go, that regulator is going to say, we're not going to put any more capital charges in there.
Yeah, well, look, Jackie, I know you don't think it's likely, but play it out with me. Where would the HQ move to potentially?
Right, so what you need, you've got a huge global wealth manager. You need to go to a country that has a very high credit rating, you know, so you have that comfort behind it. So it kind of rules out quite a few countries in Europe. But you could go to the US, you could go to Asia. These are where UBS has a huge amount of operations already, so there'll be a cultural fit. But, you know, high credit rating. Secondly, you have to have a regulator that says, we want an enormous GSIB. We want them to be here that we're in charge of and we can regulate. So, I don't know, maybe that makes it Singapore, maybe it makes it the US. Again, I don't think they'll go, but you would have to have those kind of characteristics.
Just finally, we had the news this week that ABN AMRO is going to buy NIBC from Blackstone. You've written this week that there's a number of sleeping giants in Europe, like ABN. Who do you mean?
Yeah, well, you won't ever see these in the equity reports because there are other banks like Belfius in Belgium. You know, you probably won't have heard of that, but it's government-owned. It failed in the crisis. Like ABN was government-owned and is just coming out of government ownership. Yeah. And that's why I think, you know, you can see, you know, all bets are off in terms of where they're going to go now, who they're going to buy. It's the same for someone like Belfius. They're about to start getting privatised. New CEO coming in, new strategy. You know, at Spring, we own a lot of these acquisition targets. And I think you're getting to this perfect storm with European banks. They're overcapitalized. Regulations are pretty much at an end. We're in fact going the other way. So you know your share count. Share prices have done better than the NASDAQ over the last few years for the European banks. So you've got some currency to buy. And the ECB wants consolidation to happen. Some national governments don't, and that's a different story. But you've got all these things together, and overcapitalized banks, they can go and they can buy smaller banks, they can get more fee income. It makes a huge amount of sense, and that's how we're playing it, by owning the smaller banks, the acquisition targets.
Well, the Greek finance minister was certainly in support when I spoke to him earlier. Jackie, always good to have you on. Jackie Inniker, Chief Investment Officer at Spring Investments. Thank you. Well, Wall Street has been shaken in recent weeks by the collapse of an auto parts supplier that filed for bankruptcy with more than $10 billion in debt, as we were just discussing. Franklin Templeton CEO Jenny Johnson has been speaking to Bloomberg's Francine Lacqua about how she manages the risk in credit markets.
Any credit can be very risky or not. Silicon Valley Bank showed that the U.S. Treasuries were risky because duration is an important component of risk in fixed income. And so that's what I mean by thinking about risk as you and how you align that risk with whatever those clients' needs are. So as you look to democratize access to private markets, we have to be really cognizant. And I always say that it's the most important thing is the tip of the spear. We're big believers in the financial advisor being the person who's making that decision along with their client. People ask me, because we've done 10 acquisitions since I've become CEO, and they say, well, how do you make sure that the culture fits? And so I often say, well, if you're evaluating a company, clients first. My dad always says, take care of the client and the business takes care of itself. The second is, do they show that they're collaborative amongst each other, right? Do they seem to get along? Are they open and willing? Because what can go wrong in an acquisition is that there's an attitude of, we're separate, we're not going to participate. So you need people who will collaborate.
And you can watch that full interview with the CEO of Franklin Templeton, Jenny Johnson, on Leaders with Francine Lacqua. That's at 5:30 p.m. in the UK today, or 7 p.m. Eastern Time stateside, or stream it tonight at 8 p.m. Eastern Time on the Bloomberg Originals stream. This is Bloomberg.
The most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
For more than 4 decades, Richard Moore worked in total secrecy as a career officer inside Britain's MI6. His identity became public only when he was appointed chief in 2020. And in his first interview since stepping down in September, he spoke to Bloomberg's Michal Hussain. They discussed China, Putin's mindset, and the realities of a job that isn't built for recognition.
Our voice is one that is listened to in Washington. So, things change, move around a bit. That's the style of the current administration. But we are always there, and it's our responsibility to use that to convey exactly what the intelligence is telling us. And it's telling us, for example, that Putin has no intention of doing a deal, that this is not an issue for him purely of territory. This is about dominating Ukraine and turning Ukraine into something that looks rather like its neighbor, Belarus. So all of that stuff we talk to the Americans about all the time.
So
and I think you can see sometimes the impact of
doing
that.
A deal, Vladimir Putin, if he has no intention of doing a deal, then how do you see this ending? This
at the moment. So I don't think under current conditions that Putin. Well, I mean, I'm basing this on access as I had a few weeks ago to our understanding of the intelligence on it, and that is that he's not ready to do a deal. So for me, the answer to that is he needs to be put under more pressure. So he is prepared to do a deal. The president of Ukraine is clearly ready to do a deal. He's remarkably, in the pursuit of peace, prepared to give away up to 20% of his country de facto, and yet Putin is not. So what's going to change that? More pressure on the battlefield. Ukrainians have an undercapitalized defense industry. They have spare capacity that cash would solve. There is more that we can give them. There is more that we can give them in terms of permission to use long-range weaponry, for example. There's all of that, as well as giving them the sort of, the basics of air defense and all that. And there's an opportunity to put a lot more pressure on Putin at home. And I don't pretend that that is going to give immediate results. One of the things I would say in this space is we have to be patient. We have to be prepared to see this off.
And you can listen to that full conversation between Michelle Hussein and the real-life M, Richard Moore, by searching The Michelle Hussein Show wherever you get your podcasts. Now, the Ukrainian capital has come under attack by Russian drones and missiles. The mayor of Kyiv has described it as a massive enemy attack and says at least 25 people have been wounded. Meanwhile, Ukraine has carried out a major drone attack, causing damage to a Russian oil depot in the Black Sea. That news sending oil higher this morning. Elsewhere, German lawmakers have approved several big-ticket military procurement deals worth 3.9 billion euros as part of Chancellor Friedrich Merz's plans to massively ramp up the country's armed forces. The list of defence contracts include 20 light combat helicopters from Airbus. They also cover 100,000 night vision devices from Hensoldt and Theon under a contract worth roughly 1 billion euros. And the BBC has issued a formal apology to US President Donald Trump for a misleading edit of his January 6th speech. But the corporation has rejected his billion-dollar compensation demand, saying there is no basis for a defamation claim. It follows accusations from Trump's lawyers that the clip was deliberately altered to influence the US presidential election. Well, those are some of your top stories from around the world this morning. I want to stay in the UK because it's certainly been a rocky end to the week for UK markets. Speculation about the budget highlighting the uncertainty over the nation's fiscal position. Kit Rees, our co-editor of Bloomberg's Markets Today blog, joins me now for analysis. Kit, these moves pretty serious, but we have to put them in historical context. I'm thinking about when the Chancellor cried. Of course, I'm thinking about the ultimate benchmark, Liz Truss, the Liz Truss moment. How bad were they and how much have we paired?
So we're definitely seeing a bout of volatility for UK assets. So we had the report in the early hours that the Chancellor is planning not to increase the income taxes, and this has really pressured the pound. Gilt yields also spiked at the open. So they've been pretty dramatic moves, but we're not quite there yet in terms of something like a Liz Truss moment. And it kind of signifies the volatility to come in the weeks ahead of the budget. We've also had a report since then that was actually improved OBR forecasts that were behind the Chancellor's plans to drop the income tax hikes. So overall, lots of reports, there's lots going on. It looks like we're going to have to kind of strap in for a rocky ride over the next few weeks. But the moves, even though they've paired, they're still notable, they're still standing out in the European context. But all it shows is there's a lot of uncertainty, lots of worries over fiscal headroom, what measures we can expect, and the volatility is likely to persist.
Yeah, the idea that it comes down to a forecast doesn't seem to have quite soothed the 10-year yield. We're still up 7 basis points at the long end. I also want to talk about the moves in Bitcoin because they've been pretty substantial. We're now at $96,840 a token, down nearly 2%. Is that a harbinger of the end of the AI bubble? What's going on here?
So I think it's more a characteristic of showing what Bitcoin is really. So it's got over the summer, it got this sort of characteristic as a bit of a safe haven asset alongside things like gold. But actually, it is quite volatile. It is a cryptocurrency at the end of the day. So it's down about 20% from a June peak. And, perhaps this is a little bit of a healthy correction given the big rally, the record highs. But in terms of whether it's a harbinger of the AI bubble, that's a huge debate in markets right now. So tech stocks have, lofty valuations, but the argument I hear often is that it's underpinned by earnings growth, by big spending. But in terms of a little bit of a pullback, it is possible in order to keep things in check, and it wouldn't be completely surprising at this point.
All right, Kit, love the blog. Thanks for joining us. Kit Rees, co-editor of Bloomberg's Markets Today. Hope you have a good weekend. You were looking at NASDAQ futures down 0.6%, S&P E-mini futures down 0.3%. That does it for the Pulse. We pass the baton to New York. Bloomberg Brief coming up next with Bonnie Quinn. This is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Based on the data that you've seen, do you think it's a good idea now for the Federal Reserve to lower interest rates?
The Fed doesn't want to lower rates and appear to be kowtowing, if you will, to President Trump's language. On the other hand, I think there's actually room for them to lower rates. If you look at the Fed's beige book, which the Fed reacted to last year when they started lowering rates, I think there's room for them to take action now. And if I were the Fed, I'd start thinking about going ahead and lowering rates. Real rates are very high right now relative to history, and of course we have a pretty significant term premium built into the term structure of interest rates right now.
So let's talk about the Fed's goal, which is 2%. Is that too low a rate to really get to at this point? And does it have to be at 2% or in sight of 2% before the Fed should lower?
They have a credibility issue right now. The Fed has to get to 2% because that was the target that they set. Although they've already started to project that they're willing now to target a range of inflation, which I think is the approach they should have taken all along. But they're going to get to 2%, and I think the trajectory is still in favor of the Fed's 2% target. And what we're seeing on a shorter-term basis is that's where rates are actually going to in terms of the inflation level, and I think the trajectory is their friend.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. December cut in question. Fed officials show uncertainty, perhaps, over rates, bolstering the Hawks case for standing pat next month. Schmidt, Logan, and Bostic on deck today. Tumbling those rate cut doubts, putting risk assets down. Crude oil rising on mounting worries over Russian flows. And a tariff rethink. President Trump set to lower levies on food items from beef to bananas to address voter concerns. He's also going to be expecting a visit from MBS at the White House next week. Now, let's take a look at these markets because we are pointed lower on futures. Once again today, we had a rough day yesterday, it must be said. 1.66% lower on the S&P 500, more than 2% lower on the NASDAQ. But it was a sell everything day, and the last time we've seen that was actually August, so it's been quite a while. Let's take a look at the bond universe because we're definitely seeing a hawkish repricing of the curve, and that potentially speaks to what I was just mentioning, how perhaps the balance is now in favor of the hawks, or at the very least, pricing odds are coming down for a December rate cut, so we're just above 50% now, basically 50-50. We're at 358 on the 2-year yield, 412 on the 10-year yield. I also want to point to the UK 10-year yield. So we are off our lows, but gilts plunged at the open on this idea that Rachel Reeves might be doing a U-turn on some tax increase ideas. Again, pairing those gains for the yield, the 10-year yield at 450. And let's take a look at some commodities because we continue to see gold and silver rising. It's a 10% move for silver. We didn't quite hit that record even intraday yet, but we are still on record watch, although we've pulled away from that $54 mark. Gold just below 4,200. Bitcoin just falling off a cliff. Apparently, it's still, though, above $96,000. And crude putting on about 2% on the idea that that glut might be met with less input, if you like, because of rougher sanctions and also those strikes from Ukraine on Russian ports. All right, well, let's get to some individual stocks to watch now. Over to London and Kriti Gupta. Good morning, Kriti.
Good morning, Bonnie. We'll start off with the biggest mover to the downside. That's Applied Materials. They came out with their earnings yesterday. They said they had a rough quarter in the past, and they're going to have a rough quarter right now. They're putting the blame when it comes to trade restrictions with China. Those shares down about 5%, and really creating a not-so-fun and rosy picture for tech here in Europe and, of course, in the United States. Applied Materials down about 5%. It's not all gloomy, though. Warner Brothers is one stock that's moving to the upside. They came out with a report after the bell yesterday, so 5% rally post-market on a Wall Street Journal report that Paramount, Comcast, and Netflix are starting to prepare bids to take over Warner Brothers. The deadline has previously been reported as November 20th. You've also seen the CEO of Warner Bros. Discovery, David Zaslav, get a tweak in his contract to keep some of that pay. So a little bit more sincerity that a bid, a buyout is actually coming. Those shares higher by almost 4% in the pre-market. I'll end with Siemens Energy delivering a very incredible, impressive earnings report in today's session here in Europe. They're really being rewarded. Turbines, data centers helping their bottom line, Vonnie. Those shares higher by 10%.
All right, Kriti, thank you so much. Kriti Gupta there in London. And later this hour, we'll speak about all of this with Max Kettner of HSBC. Now, the Trump administration pushing the affordability message.
I think that one of the things that people have been talking about just the last few days is, thinking about changing tariffs for foodstuffs and things. So tariff policy is very complicated, and there are a lot of things that we're studying carefully right now in this kind of space.
So President Trump now preparing tariff cuts and a series of new trade deals as he seeks to address voter concerns over the cost of goods. Joining us is Bloomberg Managing Editor for the U.S. Economy and Government, Mario Parker. So Mario, Paul Donovan, UBS economist, pointing today to these Mercosur trade pact agreements and saying that, what can be negotiated is limited. What do we know about these frameworks?
Yeah, so far what we know is that the administration is looking to carve out some type of framework with 4 countries, Argentina, Ecuador, El Salvador, and Guatemala. A lot of that revolves around commodities, foodstuffs. In particular, we're talking about beef, coffee beans, bananas, vanilla beans as well. Some of those things that Americans typically buy at the grocery store, and as you mentioned, Vonnie, expressed quite a bit of pain at the voting rolls this time a week ago.
Yeah, exactly. And the administration certainly took notice. Now, separately, Mohammed bin Salman is headed to the White House on Tuesday. We all remember that big meeting in Riyadh where he welcomed President Trump earlier this year. What will the Crown Prince want to get out of this White House meeting?
Well, given the Israeli strike on Qatar earlier this year, one of the things that MBS will be looking to get is a more definitive type of defense agreement or understanding with the U.S., something similar to what Qatar was able to emerge with an executive order. Not necessarily a defense treaty or pact, but something that lays the breadcrumbs for that as well. He'll also want the U.S.'s vaunted F-35 planes. That's a source of contention there because Israel is the only country within the Middle East region that has those stealth fighter jets as well. President Trump has hinted at an openness toward that, but that remains uncertain. And then there continues to be just some consternation over chips. And on the U.S. side, there's just worries about some of the controls that could make their way toward China. But on the Saudi side, the Saudis want to see the follow-through on chip deliveries from the likes of NVIDIA as well. One of the things that you kind of hinted at it is that we'll expect a lot of pomp and circumstance. President Trump quite likes MBS. He's signaled that throughout both his first and second terms as well. So he will be feted as he arrives in Washington early next week.
Yeah, and a big history between the two. Back to the domestic arena and economic data. Mario, what do we know about what we can expect and when we might be able to expect it?
Well, there's a lot of uncertainty, and that's clouding so much from Federal Reserve decisions to just more clarity from other bodies as well. We expect to have some September data for sure, but the October data, the White House is saying we just may not get some of that data on the likes of CPI and such as well. We'll be very reliant on some of that private data that we've leaned on over the last couple of weeks as we've endured this shutdown, but so much is just uncertain right now. And that's not even to mention the impact as the government gets restarted in light of some of the DOGE cuts and the staffing cuts that occurred earlier this year as well. Oh,
gosh, that's all to come. Finally, on trade, Korea says we now have a fact sheet with the United States on trade and security. What do we know about the deal with South Korea?
Well, one of the things we know about the deal with South Korea is both that it revolves around this $350 billion commitment to invest in key U.S. industries, whether that's U.S. shipbuilding, chips as well, some submarines. There's some talk about whether or not the two countries will work together on some type of nuclear-powered submarines, either in South Korea or in Philadelphia in the U.S. as well, and what that means going forward. Again, we need a little bit more clarity there, but that was flicked upon in the MOU, and then we also had some reporting that that was a source of discussion as well between the two countries.
Yeah,
a lot of it is this fund just to invest in the U.S. as well.
Mario, thank you so much. Great
Thank you.
Set of context there for us going into the Friday trading session, and that is Bloomberg's Mario Parker. UK markets plunged into fresh volatility as speculation about the budget heightened uncertainty over the nation's fiscal position. The pound and gilts have bounced off earlier lows, but there were reports that Chancellor Rachel Reeves is rolling back some income tax increase ideas ahead of the UK budget due to perhaps better economic forecasts from the country's fiscal watchdog. So for more now, and maybe some clarity, let's bring in Bloomberg's Lizzie Burden. So Lizzie, what do we know now that the market didn't know at the open when we saw gilts plunge and the pound was already weaker?
Well, let me take you back, Vonnie, because at first we thought it was a case of Reeves always chickens out. She couldn't get the spending cuts past the left of her party, and she couldn't get breaking the manifesto and raising income tax past the left of her party. It seemed like she was chickening out because of all of this speculation around the leadership, the challenge from the Health Secretary, Wes Streeting, that we had reported, which he denied, by the way. But then we had this clarification. So sources saying that she is dropping the income tax rise, but not because of political pressure, because, as you say, of this forecast expected to be better. And those sources telling us that actually she's still going to be able to deliver more headroom than she did at the spring statement and the last autumn budget. That was £9.9 billion. We know that it's left the markets speculating all the way to the next fiscal event of what she would do next. Actually, these sources saying that she's going to deliver £15 to £20 billion. Look, the original U-turn headlines, the market didn't like one bit. We have seen gilt yields retracing some of the earlier gains, but not all the way. We're still up about 7 basis points on the 10-year yield.
Right, and it's got to be concerning, right? Because that market reaction is certainly something you can't ignore, and it seems like up to now the market was, awaiting the budget with a little trepidation, but not too much. I mean, is the Liz Truss moment being invoked here?
I feel like we talk about the Liz Truss moment every time there's a sell-off in gilts, Vonnie. It is the benchmark now here in the UK. This is not that sort of move, but I know from speaking to the Chancellor, she is incredibly wary of the bond vigilantes. She saw what happened to Liz Truss. I think that is why last week we saw her making this speech, rolling the pitch for that income tax rise, and perhaps she is showing the left wing of her party just how important it is to keep the bond vigilantes on side to create that fiscal headroom. So the line about the forecast seeming to tie this up, but we still don't know what's going to be in that budget. So much speculation. And actually our team on the UK government team say that there's still dozens of policy options under consideration here. Never has the Chancellor left it so last minute to decide what she's going to do, we hear. And Bloomberg reporting on Wednesday that Reeves hasn't been able to make final decisions here because of all of the ongoing arguments inside the Labour cabinet.
And 12 more days to go, Lizzie. Thank you so much. Can't wait to see what happens. That is Lizzie Burden there in London. Now to other top stories trending on the terminal this morning. Minneapolis Fed President Neil Kashkari joining other Fed officials who have expressed skepticism over the need for another cut in December. Kashkari said he didn't support the last interest rate cut. Some Fed officials are arguing for holding rates steady to balance inflation and weaker hiring in the labour markets. Ukrainian drones attacked Russia's giant Black Sea port of Novorossiysk last night, prompting a state of emergency. The attacks came as Russia has been ramping up strikes on power facilities across Ukraine, aiming to disrupt the country's energy system ahead of winter. And a bunch of data out of China is showing cooling economic activity at the start of the fourth quarter. Investments slumped at a record pace for the period. Industrial output saw its smallest gain since the start of the year, and retail sales also slowed for the fifth straight month. Coming up, Citi Chair and CEO Jane Fraser discusses the outlook for 2026 in a conversation with Bloomberg TV on the sidelines of the Citi China conference in Shanghai. More on that next. This is Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Earnings season is here.
Earnings season begins once again.
So much going on.
Bloomberg is first to break the numbers.
From Snowflake, from Pure Storage, from Urban Outfitters, and yeah, from NVIDIA.
Coming up, we'll talk about some of the other earnings that are coming out.
With the smartest insights.
Third quarter numbers are going to be really important. The commentary is going to be important. It's all going to be about margins because margins lead to earnings. And if earnings come down, we have a problem.
You have to come back again soon. This is really excellent.
Continuing coverage on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Citi Chair and CEO Jane Fraser says the bank is growing rapidly in China with reviving interest from investors and companies in the world's second largest economy. Fraser spoke with Bloomberg TV's Stephen Engel earlier today in Shanghai.
The recent truce has brought some much needed and welcome stability here. I think we're in a position now for both sides that wanted to have a period now where we can move ahead and have a more stable relationship between both of them. It's transactional, but it's in both sides' interests, and we see our client base navigating this well.
Yeah. What's your vision for the China market as it folds into your overall restructuring plan as well? You're now chair and CEO. First time that those two roles have been joined in a couple of decades. Clear mandate to carry out your vision going forward. What does that look like when you did exit your consumer banking business here, like you did in many markets around the world? You also sold your retail wealth management portfolio to HSBC. You got out of an investment bank JV with Orient Securities, I believe, and you have an outstanding license application for your wholly owned JV in securities.
So Citi has been in China for 124 years. We have a landmark building here in Shanghai. And what we have done is focus our strategy and grown. We are following our international clients around the world. We're seeing them with renewed interest and focus in China, as we talked about. And then we're seeing the Chinese companies innovating at pace and also looking at expanding internationally. So we've been growing rapidly here with a more focused strategy.
What is your outlook for Fed action going into the new year and the specter of inflation rising?
Look, I don't think we're out of the woods yet, and there's a sense that there may be another shoe to drop. It could be in tariffs or in the labor market. It could be in the asset prices that are quite high in the States. But all of that said, we're quite optimistic about 26. The challenge for the Fed right now is with the government shutdown. We all have a dearth of up-to-date data, which we could do with. It's hard to make these calls of exactly what's going on whilst we're waiting for the information. But as we look further out into next year, I think the resiliency of the corporate balance sheets, the strength, companies leaning in to innovation, investing in AI, there is, I think the doomsdayers will be proven wrong.
We're a couple months out now from when we had concerns rise about, I think there was one at Tricolor, the subprime auto lender. There were failures. There was concerns about non-performing loans. What does your balance sheet look like as far as that, and where is your worries lie?
Our balance sheet is pristine, but I think part of that is because it's very heavily investment grade on the corporate side. We're over 80% investment grade globally, and when we look at the consumer side, it's about 86% prime. So we tend to see the most resilient, healthiest parts of the economy on the balance sheet. All of that said, we haven't seen a thing that is concerning us. The consumer in the States is being fiscally responsible. Companies have been building up some more cash, either for a rainy day if it proves necessary, but most of them for investment. And they're acting from a position of strength. We'll keep an eye on the labor market. We'll keep an eye on some of the areas of mid-tier players in private credit and the like. But as far as we're concerned, that second, third order effects, the bank's not seeing anything that we're worried about.
Are you concerned by what some say maybe bubble forming in AI? We talked about the advantages of AI, but how much of a bubble or overheating?
I'm not sure if we're just in with a lot of our tech clients on the West Coast. I don't think anyone was ready to say that it's a full-on AI bubble, but no one is saying that there aren't some real pockets of let's call it the British understatement, frothiness in the market. It's more around the edges. What I found interesting is we can see a lot of the demand for the infrastructure build that's going in AI and the energy for the next couple of years. Where you saw some opinions diverge was in the 3 to 5 year period, could we be in danger of overbuilding? But no one's feeling that for the big investments that are going on at the moment for the next couple of years. So I think on that one, certainly some pockets of frothiness there on the valuations, but the core infrastructure investments are important. And as we're seeing in our own bank, and I think many companies are, we'll start getting some of the productivity benefits coming through. But the scale and the pace of investment is unprecedented, that is for sure.
That was Citi's Jane Fraser speaking with Bloomberg's Stephen Engel. This is Bloomberg.
belief for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Time now for your front page news. First up, the New York Times reporting that yesterday's strike in the Caribbean that killed 4 brings the death toll in the Trump administration's campaign against what it identifies as seaborne drug traffickers to 80 since early September. Officials told the Times that Defense Secretary Pete Hegseth was waiting for video of what would be the 20th known strike since Trump authorized military action against drug cartels. Next up, the Financial Times, leading with Oracle getting hit harder than its big tech competitors in the latest sell-off. The FT saying Oracle's vast borrowing to fund a pivot to AI unnerved Wall Street. Oracle shares down almost 30% in the past month. That's nearly twice the fall of the next worst performing hyperscaler, Meta. And finally, the Wall Street Journal reporting that Amazon and Microsoft are lining up against NVIDIA, the two companies supporting legislation that would require chip companies to satisfy U.S. demand before sending products to China and other countries subject to arms embargoes. NVIDIA is fighting the legislation. Coming up, fears of an AI bubble are overblown. That's the view from HSBC's Max Kettner, who'll join us next.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. December cut in question. Fed officials are showing uncertainty over rates, bolstering the Hawks case, potentially for standing pat next month. On deck today, Schmidt, Logan and Bostic. Tumbling. Those rate cut doubts pulling risk assets down. Crude oil rising on mounting worries over Russian flows. And a tariff rethink. President Trump set to lower levies on food items from beef to bananas to address voter concerns. So let's look at that messy board because it was a down day yesterday and it looks to be a down day once again today, at least for equities. Yesterday, though, is a sell everything day. Stocks, bonds and the dollar weakening. The last time that happened was August. We had the S&P down 1.6%, the NASDAQ 100 down more than 2%. Obviously, comments from those Fed officials not helping. Let's take a look at the bond universe because there was definitely a hawkish repricing. As you can see, the 2-year yield at 3.58, the 10-year yield at 4.12. Oh, look at that. The 30-year yield at 4.72. Now, we did have a huge movement in gilts. That was on the board earlier. We did see gilts plunge at the open when it looked like Rachel Reeves was going to do a U-turn on some of those tax increases that she's going to propose in the budget. That move has pared back. I do want to point to some other asset classes. We have gold and silver higher. Once again, well, gold just off now, but it was above $4,200 earlier. Silver is up 10% so far this week, but we still haven't hit a fresh record. And gold is rising above $60 a barrel now. Concerns mounting about Russian supply. The VIX above 21 as well today. Let's get to some individual stocks to watch now. Over to London and Kriti Gupta. Kriti.
Good morning, Vonnie. We'll start off with one of your biggest downside movers this morning, and that's Applied Materials. Shares down about 5%. The stock trading at $212 a share. They're saying that their last quarter was a big pain point. They weren't really able to meet estimates. They're saying this quarter won't be a good one either. They're really pointing the blame at some of those trade restrictions with China, and you're seeing the market punish them for it. Those shares down by about 5%. And bleeding into the broader tech sector on both sides of the Atlantic, I should say. We are, however, seeing some green on the screen, and this is a little bit in the M&A space. Warner Brothers up for sale. Shares higher by 3.5% after a Wall Street Journal report yesterday said that Paramount, Comcast, and Netflix were all preparing their bids. In the meantime, the CEO, David Zaslav's contract also getting tweaked to keep his equity share should a deal take place. Basically, all indications are the buyout may be coming, an acquisition may be coming. Those shares higher by 3.5%. I'll end with one on this side of the Atlantic, Vonnie, and that is Siemens Energy. Those shares off the charts this morning after turbines and data centers helping their bottom line. Those shares higher by 10%.
All right, Kriti, thank you so much. That's Kriti Gupta there in London. Well, the team over at HSBC talking about concerns over a possible AI bubble. The team writing this: despite the drop in tech stocks lately, we remain positive. There's little value in identifying a potential bubble too early. What we see is that there is a potential cliff from 2026 to 2027 as some of the One Big Beautiful Bill incentives fade, but it's far too early to position for that. Joining us now is Max Kettner, Chief Multi-Asset Strategist at HSBC. So Max, what then do we expect between now and when that bubble may pop later on next year? Are we going to see new highs one more time?
Yeah, good morning, and thanks for having me as always. Look, I think so. When we look at What's driving the S&P earnings, it once again has been tech, but it's actually been also the sort of broad-based surprises. So we, of course, in the Q3 reporting season have seen once again a really, really good beat rate on the earnings side. We've seen once again a beat rate that was the best one since COVID. So it's not just tech, it's not just AI, but when we look at AI in particular and this question around a possible AI bubble, I do think that people are still underestimating somewhat going into next year and those incentives for CapEx through the One Big Beautiful Bill, through the ability to expense CapEx and R&D expenses straight away. I do think that is mega bullish really for AI CapEx, particularly in the first half of the year. What I do remind myself then always is what we are doing at the end of the day is we're probably pulling growth forward ahead of the midterms, right? And that probably is creating some sort of threat of a cliff event in terms of fiscal and in terms of CapEx from 26 to 27. But just like you were saying, that is possibly 3 to 4 quarters away, minimum 3 quarters, possibly maybe 4 quarters away to position for that. The next leg, the next sort of 6 to 8 months is much more playing the still sequentially really low earnings growth forecasts. When we think Q4 versus Q3, the market once again says earnings in the S&P won't grow, and actually 8 of the 11 S&P sectors are expected to see earnings declines quarter over quarter, and it's only really tech growing. So against these pretty bearish sequential earnings and growth forecasts, I do think there is quite a bit of positive surprises still in store.
Yeah, so Max, what would you do? Would you, take money off the table, wait for an opportunity like perhaps the last couple of days? And bear in mind, it looks bad, but we're still within 3% of our S&P record, so it's not that we've had this huge sell-off.
Yeah, no, I absolutely wouldn't take money off the table. I would do the opposite. You'd have to lean back in. I think it is really going into year end, we most likely are probably going to get a bit more liquidity, whether that is through a drawdown on the Treasury General account, perhaps even getting a little bit more liquidity from the Fed to avoid some sort of funding rate squeeze into year end. That is positive. We've had the earnings just now. We might be seeing perhaps another upside surprise from Nvidia. Let's see about that. But then obviously also any kind of activity data related to the government shutdown, I do think that is pretty asymmetric on the positive side. If we do see some negative surprises relative to consensus expectations in the next 1 or 2 months, I do think the market probably discounts that as, well, it's driven by the shutdown and the shutdown is over. Whereas on the other hand, if we are seeing data either in line or even beating expectations on the activity side, I do think the market will then say, well, hold on, we've had the government shutdown, and despite that, the data are in line or even beating expectations, then that means the underlying growth is perhaps even stronger than we thought. And bear in mind, top down, when we look at consensus expectations, consensus still believes that Q4 is only going to grow about 1% annualized, and Q1 also only about 1.3, 1.4%, the US. So again, it's not just the earnings forecast, it's also top down, where there is still quite a bit of pessimism in expectations.
Max, these new trade deals or frameworks that we're seeing on, individual commodities, individual foodstuffs, first of all, if it happens, will it make any kind of a dent on inflation in the future?
I don't think so. When we look at food inflation, food inflation is running year over year around 3% in the US. And in fact, even in the last 2-3 months, if we annualize it, that is also about 3%. So food inflation has been pretty stable. It's not like, for example, goods inflation that has, of course, been picking up due to tariffs in the last couple of months. So that's not really been the case with food inflation. And of course, also from a weighting perspective, probably food inflation is not as important as other subcomponents, such as, for example, rents and shelter.
Max, what is the Fed going to do? Because we're seeing more and more of these Fed speakers come out with, I wouldn't want to say necessarily hawkish comments, but they are definitely siding more with the standing pat, which then puts them in the hawkish camp. And now it seems like there's only 3 people who might want a cut, or potentially with Myron, more than 1 cut at the December meeting. So, is the market right to be pricing in a more than 50% chance of a cut?
Yeah, so we've still got a December cut in our base case. And I do think, over the next month, if we get a bit of disappointing activity data, the bond market is probably going to lean into that, particularly on the labor market side. So if we continue to see perhaps, a bit of alternative data on the labor market disappointing, and perhaps even with the October and the November payrolls, that probably reopens the door for a December cut. Beyond that, in 2026, I really have my issues with the terminal rate pricing and sort of March, April 27 around 3%. I think that probably should be much closer to around 3.5%. And that, of course, does raise then some questions. When does that hurt equities? When does that hurt credit spreads? So when does it hurt risk asset valuations overall? I think the first step is a little bit similar to what we've seen at the beginning of 2024, when the initial repricing was actually taken as a positive, because the initial repricing, if that is driven by better than expected activity, better than expected earnings, the initial move higher in front-end rate expectations, I don't think ought to be negative for valuations. But I think once we go above sort of 3.5% on terminal rate expectations, that then is starting to put a dent on risk asset valuations. But as I said, that is still a long way off.
All right, Max, thank you so much, giving us some hope even if we see a down day this Friday. That is Max Kettner of HSBC. Now to other top stories trending on the terminal this morning. Franklin Resources CEO Jenny Johnson says artificial intelligence is moving quicker than she expected to improve efficiency across the finance industry. Franklin has been expanding its technology efforts, including partnering with Microsoft to build an AI platform. You can catch the full interview on Leaders with Francine Lacroix on Bloomberg Television tonight at 7 p.m. New York time or on Bloomberg.com. Google has offered to tweak its ad tech products to settle a European Union order after a nearly $3.4 billion antitrust penalty. The company will give publishers options to set different minimum prices for bidders on Google's Ad Manager platform and boost interoperability across its ad tech services. NBA star Steph Curry is leaving Under Armour, the sportswear company that has partnered with him for more than a decade. The final Curry shoe for Under Armour will release in February as planned, with the last products from the partnership set to be released through October. Coming up, addressing affordability, President Trump is preparing tariff cuts and trade deals to help concerns on the higher cost of goods. We'll discuss next. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
I think that one of the things that people have been talking about just the last few days is, thinking about changing tariffs for foodstuffs and things. So tariff policy is very complicated, and there are a lot of things that we're studying carefully right now in this kind of space.
President Trump now taking those steps to address affordability issues by preparing tariff cuts and a series of new trade deals. Joining us now is Bloomberg's Brendan Murray. So first, Brendan, what do we know about what is getting sorted out here with these frameworks?
Yeah, it sounds like they're getting ready to provide some exclusions for food and other kinds of day-to-day necessities that Americans are paying higher costs for. And this is important because it's really the first time that we've heard the White House at least tacitly acknowledge that Americans pay tariffs. President Trump there's been a drumbeat out of the White House that he puts tariffs on China, he puts tariffs on Brazil, but really these are taxes on the American people, and importers have largely absorbed a lot of those costs up until now, but they can only do that for so long until they have to start raising prices. And the Democrats really took advantage of this in the election earlier last week. This whole issue of affordability is really starting to resonate with Republicans in Congress. President Trump, in his inaugural address, said, "I am going to dismantle the things that are causing inflation." And if he's now dealing with an inflationary pushback from the public, then he's seen as out of touch if he doesn't do something about it. So this is what we're seeing is these.
Sorry, didn't mean to interrupt. I'm just curious, how does he get around the Mercosur Pact, right? Because there'd be some overlap here, no?
Yeah, exactly. I mean, this is you heard Kevin Hassett say, trade policy is complicated, and what they've done is they've rolled out these big, broad reciprocal tariffs, hit a lot of U.S. imports with these tariffs, and what they're finding is that they're hurting some of the same people that they're trying to help by reshoring manufacturing. But when you have tariffs on coffee or avocados or mangoes, those just aren't grown in the U.S., and so those can't be reshored. And so what they're trying to do now is to address the things that are hitting the electorate, especially heading into the holidays now when people are hitting the shopping malls and grocery stores.
All right, Brendan, thank you so much. That is Bloomberg's Brendan Murray, our trade czar there in London. And sticking with this topic, the deals unveiled will see tariffs reduced in the U.S. on common grocery items, beef, bananas, coffee beans. The White House spokesperson said in a statement, the Trump administration is committed to pursuing a nimble, nuanced and multifaceted strategy on trade and tariffs. Joining us now is Jonathan Tamari of Bloomberg Government. So we heard Brendan there, the Trump administration obviously hearing voter concerns and definitely seeing, approval ratings plummet. Is that what's behind this sudden sort of U-turn on tariffs and how they are a tax on U.S. consumers?
Yeah, I mean, there's really no other clear line to connect other than the Democrats won significant election victories last week, and then a week later, the president is suddenly reversing course on some of these tariffs after, for months, insisting that tariffs benefit Americans and that the costs are not paid by Americans, which any economist would dispute. So I think that there's a clear connection between these things and Republicans and the president trying to get on the other side of the cost issue that powered him back to office last year.
Will it read through to the public? Will the public start seeing the prices come down in grocery stores immediately? Is it for sure that any kind of deals that will be negotiated will be passed on and that the Trump administration will be able to get that message out, Jonathan?
Yeah, I mean, I think that's going to be the challenge. Are these cost reductions, if there are any, are they passed on? I don't think we know that for sure. The president has not been shy about pressuring businesses to do that, but they don't always listen to what he says. And, we're talking about a small number of goods. So certainly if you buy those things, you'll be happy to see lower prices if it happens. But how that affects the overall picture of prices when, you're talking about housing being in a crisis and other significant cost increases, I'm not sure if that's going to make the dent that necessarily they want, although maybe it's a first step among others.
Jonathan, let's move to this meeting on Tuesday between MBS coming to the White House and obviously the President, Donald Trump. They have a long-standing relationship. There is a little bit of tension now, though. So what would both sides want out of this meeting?
Yeah, so, this is MBS's first visit to the United States since the killing of Jamal Khashoggi. So it's his first visit to Washington, at least. So that's a really notable moment. Saudi is looking for a number of things around the security space, around technology. They're looking for assurances around, they potentially would like to purchase more advanced AI chips. They would like to purchase F-35 jets. They're looking to develop nuclear energy. And the White House on the other side is the president wants to have normalized relations with Israel. He, as we know, is looking to pursue peace. He wants this Nobel Peace Prize very badly, and I think is going to press Saudi to take steps towards Israel, especially now that the war in Gaza has at least come to a halt. So both sides have things that they're asking for here, and as you noted, these two men have a closer relationship often than MBS has had with previous presidents.
All right, Jonathan, thank you so much. That meeting set for Tuesday. Jonathan Tamari of Bloomberg Government there. In the commodity space, gold continues to rise. It's heading for its best week in a month, on track for a weekly gain of about 5% and wiping out losses from the previous session. Joining us now is Bloomberg metals and mining reporter Jack Ryan. And it's not just gold, we have the silver rally as well, Jack. So what exactly are these commodities trying to tell us in the last few sessions?
Well, it's been a really interesting period of time. We've had this kind of crazy rally throughout this whole year, in particularly gold the earlier part of the year and then silver later on. They kind of both hit a high in October and pulled back from there. And then the last week, they both chalked up gains. Silver in particular has risen more than 9% throughout this week. And there's a lot of reasons for that. It's quite hard to read the market at the moment, but you could definitely say that the backdrop of very little economic data for such a prolonged period of time, you can understand why some investors are looking towards safe havens and looking towards maybe hedging some fears they have in the equity markets. Obviously, there are some big earnings coming up, NVIDIA, all these kind of massive companies that dominate the indexes. And so probably there are some investors looking to hedge that. And then there's some of the kind of broader themes we've seen throughout. People looking at the risk of inflation, currency debasement, the so-called debasement trade. I think that is still alive as a theme, and that's motivating some investors.
Now, we keep hearing that, gold is one thing, silver is quite another, because it has much more usefulness in some ways, at least, in industrial America, let's say. So why haven't we seen a record on silver yet?
Well, it's a good question. I mean, yes, silver is very different. A lot of the demand for silver is industrial. Ultimately, it's not as an investment product. And the fundamental picture is quite positive there for silver. We have in mind enough each year to deliver into the demand, essentially. So we're whittling down each year that passes some of the stockpiles, even though those are quite significant stockpiles. And so investors are looking at that, but then I think more recently it's actually been the investment demand. You can see it through ETFs, exchange-traded funds that are basically backed by a big pool of silver. Investors have been looking at the relationship between gold prices and silver prices. So earlier this year, gold was historically expensive relative to silver. And so there's a lot of people who bet on that ratio kind of reverting, and so they move into silver. And that's probably why silver outperformed gold to the extent that it did through the kind of second half of this year.
Yeah, 10% move this week. Our thanks to you. That is Bloomberg's Jack Ryan. Coming up, we're going to get you set up for your trading day, your Friday trading session. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Now a look at what's ahead for your Friday trading session. Lots of Fed speak on deck once again today. Kansas City Fed President Jeff Schmidt, Dallas Fed President Lori Logan, they speak at an energy conference at 10 a.m. and 2:30 p.m. Eastern, respectively. Then Atlanta Fed President Raphael Bostic, who we now know is leaving, speaks at 3 p.m. And it is the filing deadline for third quarter 13Fs. Let's take a look at some movers in the pre-market. So we have Applied Materials down 5%. It's extending its post-earnings decline. Forecast to drop, obviously, in current quarter sales after suffering a decline last quarter. Warner Brothers Discovery up 3.6%. The Wall Street Journal reporting that Paramount, Comcast, and Netflix all preparing bids as the deadline approaches. And Cidara Therapeutics, well, it is on a run. Let's just put it that way. The FT is reporting Merck is nearing a deal to acquire the biotech company developing a treatment for influenza. Now, after yesterday's rough day, this is how we're shaping up today. A lot of red on the screen as well. Not so for the VIX. The VIX is above 21. There's a little green for you. S&P futures, though, pointing to a decline of 0.33%. The 10-year yield, roughly unchanged, but we did have a hawkish move across that yield curve yesterday. And gold, just barely unchanged, below 4,200. That's it for Bloomberg Brief. Surveillance is next.
Estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
The volatility in the rotation that we're seeing among single names is healthy.
The breadth picture under the surface for the S&P 500 is actually starting to improve.
The Mag 7, they just have to sort of behave, right, in order for the market not to have, kind of one of these major scares.
I think equities are still going up 15 to 20% from where they are over the next year.
This bull market deserves the benefit of the doubt.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday with markets on edge. Investor jitters around mega cap tech, taking stock markets lower as a chorus of Fed hawks is leaving a December rate cut firmly in doubt. The doves get a data point. Verizon discussing plans to make some major job cuts, up to 20,000 jobs on the chopping block.
And that's a significant part of their overall staff, which is about 100,000, just to give you a sense. And it comes after a leadership change at that company that happened a couple of months ago. This goes to the ultimate question, though. Verizon is cutting jobs as it tries to compete on price. It can no longer pass along price increases to consumers. How much does this highlight how much companies are grappling with the fact that they're reaching the limits of consumer tolerance of higher prices and have to make efficiency changes that are hitting the job market?
We keep getting these contradictory headlines in the labour market as well. It's really confusing. You take a big headline like that, super flashy, very concerning, then you compare it to something boring like state jobless claims. State jobless claims say everything is okay in the labour market right now, and that's some fuel for the hawks into next month.
Most labor creation comes from smaller businesses. That is the reason why this is so complicated. You can get some high-profile large businesses that are making efficiency pushes, but this is what they always do. And this can be idiosyncratic. It is not where the most of the labor market growth really happens. It's the reason why so many people say, watch for the vibes, but really listen to the data. The fact that we haven't gotten data, we may not get data that we're looking for, really muddies the picture that much more.
And the vibe shifting around the Federal Reserve, let's talk about it. The hawks making lots of noise in the last 24 hours. At the end of August, the start of September, the Fed starts talking about risk management interest rate cuts. The market gets excited about a cutting cycle. Here we are facing the prospect of a prolonged pause, and maybe for the duration of Chair Powell's term as the chair of the Federal Reserve.
So I was looking at Fed funds futures back just before the last Fed meeting about a month ago, and it was above 100% chance that there would be a Fed rate cut in December. You take a look now, it is less than 50% for the first time since that meeting. Suddenly, people are saying there is a greater chance of the Fed not cutting rates next month than actually cutting rates because of the pushback that we got from Cleveland Fed President Beth Hammack or St. Louis Fed President Alberto Musalem. And there's a real question here about how much they really do have the upper hand as inflation does remain above that 2% goal.
Do you think that was the objective? I'm pleased you've gone back to that news conference. Wasn't that the objective of Chairman Powell, to make this a coin flip? A 50-50 bet for December, and a market that didn't really fully internalize the message in that news conference. And it's taken a flood of hawkish Fed speak in the last day or so to really get us back to maybe where he wanted us to be.
This is what a lot of people are speculating, which is the reason why they're saying bet against this. They're still going to cut rates because this is just wonderful messaging to try to take some of the froth out of the market. That said, it does seem like this Federal Reserve wants to go slower without the government data, and it looks like we're not going to get the government data. The idea that we could get the jobless, the overall job creation from the non-farm payrolls, but not the employment rate, the unemployment rate, raises a question about what kind of value this data actually will have.
Before we get into it, here stateside, let's just spend a moment, a couple of beats on what's happening in the UK. This is the price of chaos. The price of chaos and uncertainty is volatility, and it's been a very volatile session for sterling assets over the last 24 hours, both for sterling against the US dollar and for the bond market as well. Back and forth over what policy is going to look like in the budget in the coming weeks. This has been a problem that's been building for months now.
Yeah, so they're between a rock and a hard place when it comes to Rachel Reeves, the UK Chancellor of the Exchequer, and she was expected to raise taxes yet again, I think the third time in 3 years, even after pledging she wouldn't do so. Now she's trying to back away from that potentially. That's some of the news this morning that's coming out, and it's raising questions. Is this a good thing or a bad thing for the fiscal backdrop, given that there aren't credible means to cut spending? At this point, they're in a bad position, and the market's getting whipsawed by, frankly, just fiscal instability, a lack of any kind of fiscal structure of exactly how they're going to maneuver.
This is one of the most disruptive budgets I've ever seen, and we haven't even seen it yet. That's how ridiculous things are in the UK at the moment. Sterling all over the place. Coming up this hour, George Concalves of MUFG as the equity market pulls back. Francisco Blanch of Bank of America on the energy risk for AI data centers, and the former BLS commissioner, Bill Beach, on a month of missing economic data. We begin this hour with stocks already steady, heading lower after notching their worst day in more than a month. George Concalves of MUFG writing, market internals are starting to look exhausted and ripe for at least a correction. We think many of the positive catalysts are priced in, whereas the weak consumer and credit concerns are not. George joins us now for more. George, good morning, sir.
Good morning.
Have you ever seen such a freak out about a 2 to 3% pullback on the S&P 500?
It seems worse because it's been easy sledding all year long after Liberation Day, right? It's been up and to the right. And I think this is a critical time point. We're coming towards the end of the year. There's been a lot of gains had in many different asset classes. I think this is when investors start to discern, do they take chips off the table? I think that the last couple of days is reminding them. I mean, the last week and a half, to be honest.
What do you think's changing? What do you think's changing? Lisa and I were talking about this. The chairman clearly had a message in the news conference at the last meeting. Do you think the market failed to fully internalize what that message meant?
I do think there's an element of the Fed at play as well. I mean, like the rates market, the bond market has been pricing in cuts for quite some time, and now we're at this kind of 50-50 injunction. I do think that if the Fed does not deliver on the easing that's been promised or at least expected, the markets are going to reprice, all markets.
Do you think this is a Fed story, or do you think this is more a change in the AI story from a pure play on the potential hopes and dreams to one that is more debt-fueled and more speculative with leverage put on top of it?
Even if that's the case, and I have my concerns around that as well, I do think that the cost of funding, the time of the year, all these great P&L all throughout the year, that we're getting to this point where, if the Fed doesn't deliver cuts, I think it's probably weighing on the psychology.
Okay, so why aren't we seeing the biggest drawdowns in some of the more cyclical plays? Why are we seeing the big tech names hit hardest? Which is the reason why I'm pushing back. I'm trying to understand exactly, do we need to have a narrative for this, or is this just basically some people taking the chips off the table?
Yeah, so I mean, look, the narrative always shifts, as you know, and the narrative and the reality as well, technology is a long duration play, always was. And if they went from using free cash flow to using debt, and interest rates will start to matter at some point, and so will spreads. And there's been actually a widening of spreads within that category. So I do think there's a fixed income component, not purely Fed and fundamentals, but I do think that if they're becoming long duration assets, they're going to swing with rates.
Do all of these forces, the forces I'm talking about, Lisa's talking about, do they put the year-end rally in jeopardy? Is that year-end melt-up now at risk?
Well, look, we're going to go through many mini cycles before we get towards the typical year-end seasonal type rally, which typically kicks off closer to Thanksgiving into the end of the year. I think it comes down to the data. And we're going to, at least now, finally, with the government reopening, we're going to get the data.
Some data.
Some data.
Not all of it.
Not all of it. But I do think the burden will be there, that the burden of proof is there, that, you have to have really strong jobs data to turn off the Fed. Even though they're talking tough, I think they're still going to cut, is our view.
Can we just get into the data and why we're not getting the household survey? What is it about that particular survey that makes it difficult to produce?
Well, I mean, I think it's the actual collection process. And let's also take a step back and realize that BLS has been, has had staffing issues all throughout the year, getting people back in place, collecting the surveys, doing the household. It's much easier to do the establishment NFP.
What's your sense that this data would come in stronger than expected or weaker than expected based on some of the peripheral information that we have been getting?
Yeah, I think that the alternative data that we've gotten throughout the last 6 weeks still points to a weaker labor market. So I think that once that's clear and you see it, it's going to be hard for the Fed to back down.
So if the Fed does cut rates, where is the outperformance going to actually come from if it really is in response to a real problem, right? It's sort of this idea that be careful what you wish for when the Fed actually does cut rates because they could be responding to a real issue.
True. I think if it lingers into Q1. So if the Fed cuts rates because we've been kind of in this lull of no data, vol's been very low, there's uncertainty about what the outlook is. If they're cutting because there's the persistent weakness is one thing. If it's an accelerated weakness, I think that probably shows up more in Q1 than at the end of the year.
Oh, you don't buy the pickup in Q1 next year? Because that's what this market's priced for. That's what Fed President Muslim's talking about, a re-acceleration in Q1 26. Why don't you buy it?
Well, I mean, as both of you in your opening intro, I mean, yes, small businesses should be leading the charge. But if you look at the NFIB surveys, you're not seeing that pick up yet. And they're the most rate sensitive. So you need to get rates much lower to get them to actually start to hire and not just, be reacting to the fiscal policy that's been put in place. And look, let's not ignore the layoffs have been huge and they keep coming through even heading into the holiday season. And the seasonal sort of hiring plans aren't there. So the jobs market, in our view, still gets worse before it gets better.
They're real. That headline for Verizon was super concerning. The initial report, I think, came from the Wall Street Journal and said up to 15,000, and 4, 5, 6 hours later, that number went up 5K. That's super concerning.
Especially given the fact that it's trying to compete on price. This is because Verizon has fallen behind when it comes to attracting new consumers because they've tried to just raise prices on the ones that they're keeping. They can't do that anymore, which highlights really the state of some of the weakening that we're seeing.
Hiring intentions elsewhere aren't exactly robust for that 20,000 job cut pool to go and find a job immediately afterwards anyway. That's the problem. In a low churn labor market, to have those kind of layoffs, where's the pickup going to come from?
The real question, though, going forward is how much will Fed rate cuts change that, right? How much is this something that is structural or cyclical? This has been the big debate on the Fed, and frankly, this is the big debate in markets. How much are we seeing a new efficiency ploy that's going to somehow reduce the need for human labor that's going to really skew the numbers in a material way?
The S&P this morning, session lows now. We're down by 0.5% on the S&P 500. George Concalves of MUFG is going to be sticking with us. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. President Donald Trump is preparing substantial tariff cuts to address high food prices. The president unveiled framework agreements with Argentina, Guatemala, El Salvador, and Ecuador to reduce tariffs on common grocery items. The deals will reduce tariff and barriers on items like beef, bananas, and coffee beans in a push to lower costs. Meanwhile, new data out of China showed cooling economic activity at the start of the fourth quarter. Investment slumped at a record pace for the period, while industrial output saw its smallest gain since the start of the year, and retail sales slowed for the 5th straight month. And UK bond yields are paring losses after Chancellor Rachel Reeves dropped plans to raise income taxes. The change came in response to an improved fiscal forecast from the UK's budget watchdog. The country's fiscal hole was found to be closer to £20 billion, while expectations were as high as $35 billion, which still may require major tax rises to tackle in the future. That's Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, fixing affordability.
I want to address the affordability issue.
So we understand that people still feel the pain.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again.
That conversation up next with Bloomberg's Mika Sona, live from New York City this morning. Good morning.
politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Stocks are down. We're down by 0.5% on the S&P 500. On the Nasdaq, check this out, down again by 0.9%. And check out what isn't happening. There's no bond market rally. Check out fixed income, 2s, 10s, 30s, yields up by a single basis point, and 10s 412.89. That's something new. We've talked about bonds doing what bonds are meant to do recently. Not happening in the last 24 hours.
And part of this could be, you could say this is part of the Fed move, the idea that the risk-off mood stems from the Fed being more reluctant to cut rates as a given in December. There also has been a different tone under this particular sell-off, which is you're seeing a commensurate sell-off in some of the corporate credit tied to some of the big tech names. That's new. Real pushback suddenly from debt investors who are saying, hold on a second, what are we paying for?
Everything that was doing so well is facing pushback across the board, and I'll throw in crypto as well. Bitcoin's had a terrible go of it too. If you've had a good year, you've had a bad few days. That seems to be the story at the moment.
Momentum has really struggled, and I think that raises this question. Is that the beginning of something deeper? Are we starting to see that rotation that Mike Wilson of Morgan Stanley was talking about? Interesting that the NASDAQ is underperforming the Russell 2000. You're seeing the equal weight actually outperform for a consistent stretch of a number of days. So it raises this question, is this the beginning of the new stretch, which is a positive, or is this the beginning of a downturn that reflects a weakening that's a negative?
Equity futures this morning down by 0.6%. Under surveillance this morning, fixing affordability.
I want to address the affordability issue. The Trump administration has taken aggressive action to fix the Biden-created cost of living issues.
So we understand that people still feel the pain. We see really high wage growth, and inflation is much more under control.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again.
So here's the latest this morning. President Donald Trump preparing new trade deals and substantial cuts to tariffs as the administration looks to ease affordability concerns. Joining us now is Bloomberg's Mika Sona. Mika, this is a bit of a pivot coming from the White House over the last week or so. What's behind it, and what are the steps they're willing to take?
Yeah, absolutely. After the results of the election earlier this month, I think the White House is really looking to hammer the affordability, cost of living message that Democrats have done so well on. President Trump has essentially blamed any kind of economic downturn on his predecessor, Joe Biden. But right now, I think the circumstances that millions of Americans are feeling when it comes to their pocketbook is really catching up to them. So the administration is really trying to scramble here and find some ways to make that their winning issue.
Mika, how did they massage the messaging? Because the takeaway for a lot of people is going to be, you're focused on affordability and your first move is to drop tariffs. Aren't you acknowledging that tariffs are damaging affordability?
Well, one way that the White House is really trying to mitigate that is the idea of a potential tariff stimulus or surplus, checks going to Americans with an income threshold that would qualify for that, similar to the COVID stimulus bill. Other areas that the president is looking to is potentially a 50-year mortgage, and there's other avenues I think that the White House is still exploring when it comes to trying to message and play up the message of affordability.
Mika, I appreciate the update. Mika Sona in Washington, D.C. It's a problem, isn't it? It's a real problem.
You can't say that you want to remove some of the tariffs to address cost of living issues while also saying that tariffs don't cause inflation and have no impact on the price of goods. This is a conundrum for them, and it raises issues, frankly, for the Supreme Court case. How do they argue this is a national security concern if they can remove the tariffs, because of an affordability issue. There are a lot of questions here, and it raises a real issue longer term for how they deploy this in a strategic way.
George Calvas of MBFG is still with us. George, this is a challenge for the economic marketing wing of the White House. Kevin Hassett has to dance around this carefully, but what's your conclusion based on the past few days?
Look, a few things. One, the tariffs do matter because not everyone's consumption basket is the same. So there's an acknowledgement if the food component for some cohorts matter more than others, then clearly that's obviously the way you address it. Number two, the tariffs haven't fully been implemented. I mean, we've obviously benefited with some price rigidities throughout the year. There was a lot of inventory pull-through and hoarding of goods. We're going to see we still believe that the tariffs are going to still filter through over the next 3 to 6 months. And the saving grace for the U.S. is that we consume only 20% of goods, and most of it is still services, right? So we're still getting the disinflationary from the rent side, from wages not going up. But I think it's going to come through, and I think it's clearly an issue. And then the second point, which the bond market, you have to be careful here because the bond market the saving grace for the bond market has been the tariffs. Ironically enough, it's been a revenue source.
Right.
So if you're going to then shift to a sort of stimulus using tariffs, the bond market will then reprice, and then there goes all your benefit.
People are have sympathy for the national security objectives of the tariff push. I think people are sympathetic with that issue, one. But two, I don't mean to be flippant about this or snarky, but don't go after people's coffee. This is the pitfall of doing everything all at once on everyone without a nuanced approach to the kind of things that, you don't make here in America, you don't develop enough, you don't grow. That's the problem.
Yeah, avocados, bananas, coffee. Every morning, everyone goes and gets their coffee. That's sort of a barometer for how much prices are going up. But again, this goes to the idea of how much the recognition of the public opinion and how much it's declined on some of these cost of living increases, how much it's affecting the politics. How much are we underestimating how much that's going to really affect policy going forward?
The Supreme Court's another issue as well. They might strike down a lot of this by the end of the year. You throw in the fact that the Federal Reserve isn't going to be cutting or hiking anytime soon. They're just going to stand pat. You've got an administration backing away from tariffs. You look at this bond market now, George. What are the risks around fixed income for the new year?
So that's the challenge, right? That's why I was making this point that it's been a good year for most asset classes. Even treasuries rallied, right?
Yields have fallen.
Look, and that's been our view, by the way. We were out of consensus. We were pretty much bullish duration. But the fact that we keep stalling at that 4% level, it's going to be hard for rates to rally if we're seeing these sort of, indecision either from the Fed or what's going on the fiscal front. The bond market, I think, is in this sort of impasse that could, see a backup in rates, easily 25 basis points.
Well, this is what a lot of people have been debating on this show. Whether we're going to see some sort of stimulus next year, early next year, that's going to cause yields to go up in anticipation of inflation, anticipation of stronger growth, or if that stimulus extends to monetary stimulus and the use of the balance sheet to suppress yields, even if that is the potential ramifications. How are you playing that out?
Yeah, it's a timing issue ultimately, right? And of course you can throw in there, Chair Powell's in play until at least May, and then what happens after that? There's going to be a big timing issue. So, like for us, it's more about the forward curve and how the forward curve is signaling that rates are actually going to head higher in like 26, 27. Slightly, the lower sort of terminal rate has been shifting up above 3%. And if you look at the forward curve in 27, 28 is already at 325. So you're already starting to see the market saying, hey, it's going to be hard to pin rates down.
At the same time, yesterday we saw something new, at least versus the past couple of months, which is the return of the Sell America trade. We saw it with respect to bonds. We saw it with respect to AI. We saw it with respect to the dollar. And I'm just wondering, do you think this is going to come back, or do you think this is a momentary blip until people realize that everywhere else it's not so much better?
I'm not sure if all the asset classes will stay in unison like that, because if we do go into a more an actual slowdown that's more visible and present in the labor market to us is so critical that eventually the bond market would catch a bid. But in this period of indecision where it's very ambiguous, you don't know where you are, and you have this fiscal uncertainty, I think that all asset classes can go down.
What's your assessment of where the labor market is right now? What's a good jobs number? What is a bad jobs number? What is the break-even rate? What's the range of estimates for you and the team?
No, look, and that's a moving target, and it depends on a number of factors. We're still, and of course, we may not get the unemployment rate, so we're more focused on the unemployment rate and the lack of, there's a lot of entrants that are not coming into the jobs market. I mean, if you look at the youth unemployment, that is a shadow unemployment rate that's, really not filtering through to claims data. Claims data, if you don't have a job, you can't go and actually get the claims, right? So, all these things have been altered, and so you're not really getting a good sense. I think that, anything like around 50,000+ NFP.
50 plus gets it done, keeps the lid on unemployment.
For the most part.
Yeah?
Yeah.
The problem is that we're not going to get unemployment.
Right.
Has the Federal Reserve put out where they think the break-even rate is and what they think is a good number? I'm trying to work out what the guide's going to be for December 10th. We will get payrolls. We won't get unemployment. What's a good number? What's a bad number? What leads this Fed to cut interest rates?
I mean, the federal work numbers are going to work through there as well. So we're probably going to get a really weak NFP, at least for October. And September could be pretty weak as well.
What's your highest conviction trade heading into the end of the year?
So, I mean, we like being underweight credit at this point because how much of it's been priced in. Even mortgages have performed, so even mortgage spreads are too tight. Basically, staying very defensive down the curve, and anything beyond the 7-year point on the Treasury curve, I think, is at risk, which will then amplify IG losses as well as mortgages.
So what do you like?
Just short-term securities.
Short-term securities and just cash. Essentially, you're packing cash into your mattress and expecting for the worst. Is that right?
Well, sort of. But I mean, it's more of that. It's defensive in anticipation of if we get the sort of weakness in the macro front, then you can redeploy. So I think it's more about just trying to look for a setup for next year.
A super bearish, George Goncalves of MUFG. Thank you, sir. Good to see you, George. Sure. George didn't say that, but that's my conclusion for anyone sat at the front end of the curve, parked in cash, waiting for bad things to happen.
Yeah, so that you can come in and buy. I guess that's the one silver lining, is that potentially there could be better valuations that come down the pike. But there is this feeling that right now there's a dichotomy between those people who say, look, this can't continue. There's too much froth that potentially needs to come out of the market before we can get in. And those people who say it's a Santa Claus rally. People are going to feel like they missed out after 20+% earnings in the NASDAQ overall. They've missed the rally. The FOMO is going to get everyone back in. And ultimately, that's the debate heading into year end.
There's nothing festive about this move so far this morning. We're down by 0.6% on the S&P, and it's not coming with a rally in the bond market. Yields on 10-year treasuries are just about unchanged now on the session. Coming up on the program, in the next segment, we'll catch up with Francisco Blanch of Bank of America on the limitations threatening the AI data center build-out. Plus, Yohira has some of the morning movers for you. StubHub plummeting after its first earnings report since going public. That stock is down by 19%. Live from New York City, you're watching Bloomberg TV.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
The losses continue. We're down by 0.6% on the S&P, on the Nasdaq 100 down by 1%. Session lows. We snapped a 4-day streak without losses on the benchmark stateside in yesterday's session. The biggest one-day loss going back to October, so the biggest one-day decline in about a month. On the Nasdaq, session lows and down another 1% so far. Turn to the bond market. Look what's not happening. No Treasury market rally this morning. 10-year bond yields just about unchanged at 4.1250. 2-year bond yields at 358.49.
You can say this is because of the Fed. I'll bring another aspect to this. Yesterday, we got that 30-year auction. I was saying that it was going to be exciting. It was exciting. There was actual pushback, and it led a sell-off in the long end of the yield curve that moved into the corporate debt market, where there has been some longer-term debt that's been sold. So how much is this what's at play versus actually a Fed rate bait?
I'd throw in the hawkish chorus as well in the last 24 hours. I think it's material. And clearly there's an objective here. To get the odds for December back to a coin flip. Because I don't think this market fully internalized the message coming from the chairman in the last news conference.
And you can see from Fed funds futures that it went from more than 100% chance of a December rate cut right before the October news conference to now below 50%, to that coin flip that you're talking about, as we hear this churn of different Fed officials coming out and saying inflation still is a real problem, and that is our priority.
That's the story, the front end of the curve, as Lisa pointed out, the very long end of the curve. Check out 30s this morning, up another 2 basis points, 4.73. That's the cross-asset setup so far this Friday morning as we count you down to the open in about 3 hours away. Let's get you some morning movers with Yahira. Hey, Yahira.
Hi, John. We start with Warner Brothers Discovery. Shares are rising 3% in the pre-market on growing conviction a buyout could materialize. That's because the Wall Street Journal is reporting Paramount, Comcast, and Netflix are all preparing bids ahead of a November 20th deadline, with Paramount eyeing the whole company while Comcast and Netflix are eyeing the studios, HBO Max, but not its cable studios. And we move on to Applied Materials. Those shares are falling 5.5% in the pre-market after reporting another quarter of falling sales. This is a company that makes the machines that make semiconductors, and they say that U.S. export curbs to China are weighing on sales. It expects that drag to continue into the current quarter and doesn't expect a pickup in demand until the latter part of next year. And we end on a big mover to the downside, and that is StubHub. Shares are falling 18% after delivering a much bigger loss than Wall Street expected in its first earnings report since becoming a public company. Revenue and ticket volume did come in solid, but shares started to plunge yesterday on the earnings call when the CEO said that they would not give a 2026 outlook just yet, despite him insisting that demand for live ticket events remains phenomenal. John?
Brutal move. Yahira, thanks for the update. Appreciate it. On our radar this morning, the White House readying substantial tariff cuts to everyday items as it ramps up messaging on affordability. The cuts coming through trade deals with Latin American countries that export items like beef, bananas, and coffee beans. Elsewhere, Fed officials casting doubt on a December interest rate cut. Minneapolis Fed President Neil Kashkari saying he didn't support the central bank's latest interest rate cut. Plus, Cleveland Fed President Beth Hammack sharing a similar take.
I think we need to remain somewhat restrictive to continue putting pressure to bring inflation down towards our target.
The comments highlighting a growing divide among policymakers.
Ultimately, they're hamstrung between the idea of a labor market that does seem to be slowing and inflation that still is above target. What Beth Hammack of the Cleveland Fed said, though, I think is really interesting. She pointed to Fed credibility. She said, how can the Fed maintain its credibility if it doesn't prioritize getting inflation down to 2%? That ultimately may end up being the quagmire. How much does the Fed look at the dollar for a tell on exactly how much this is a Fed credibility issue versus maybe just a usual monetary policy decision? But that seems to be preeminent in some of their discussions.
It's funny, isn't it? Because those comments from Beth Hammack make the process appear to be more credible, even if they do decide to cut interest rates with inflation closer to 3 than 2.
Oh, what a skeptic. I love it. This is actually what a lot of people are saying. You're absolutely not wrong. And I think that a lot of people are saying the same thing. It sounds so good. Doesn't this actually do exactly the job that people were expecting the Fed to do, which is they're still going to cut rates, don't worry, but they're going to try to make it seem like it is a very deliberative process that really is coming towards.
I don't think the division is contrived. I think it's real. I just think that the optics are valuable right now because the inflation story, look, you'd look at markets and you'd still say that inflation expectations are still well anchored. Well, thank goodness we have people like Beth Hammack on the committee to make sure that we just pull back the individuals that would like to go 50, 50, 50 every single meeting and get us down to 2 point something almost immediately with inflation closer to 3 than to 2.
I'll add to that Stephen Myron, who is the Fed governor, who's thought to be the uber dove, who wants to cut by 50 basis points, came out yesterday and was talking about how he's concerned about overuse of the balance sheet. So if you want to take a look at even the uber doves coming out and really expressing some concern about overly interventionist policy, he's not alone. He's actually joining the chorus.
He's not running to be Fed chair. Just throw that out there. Equity futures this morning, session lows were down by 0.6%. Big focus on the labour market, of course, and this headline that came yesterday, Verizon discussing cutting as many as 20,000 jobs, downsizing the workforce by as much as 20%. People familiar with the matter telling Bloomberg the cuts could come at every level of the business. That one could hurt.
Yeah, and this one comes after a leadership change. Dan Schulman coming in as CEO, and one thing that he said was that they're going to take bold and fiscally responsible actions. He said, these will not be incremental changes. We will aggressively transform our culture, our cost structure, and the financial profile of Verizon in order to put our customers first. They are dealing with the fact that T-Mobile and AT&T have been eating their lunch. They have been lowering prices, and they have been getting a lot of new customers. They have not. So now they have to compete on price. Is this a telecom story, or is this a broader question of competing on price and making efficiency cuts in the process in order to deal with the fact consumers just don't want to pay up?
That is the argument of the doves right now in the committee. Essentially, everything you just said about Verizon is the argument of the doves on the Federal Reserve at the moment.
Which is the reason why they think that inflation is not going to pick up and that ultimately you have to prioritize the labor market. And this is a structural shift where they can be more efficient. That is the key. They can be more efficient and do more with less because of some of the technological advancements.
Verizon this morning in the pre-market higher by just about 0.2%. Let's turn to energy. The White House pushing for affordability while AI electricity demands remain poised to raise costs. Francisco Blanch of Bank of America writing, we are concerned that retail electricity affordability might cause politicians and regulators to slow down data center development. Francisco joins us now for more. Francisco, good morning, sir.
Good morning.
This is timely and very important. It's good to see you. Let's take a step back. What's happened to electricity prices in places like Virginia, where you've seen this massive data center build-out?
They're going up. No surprise. Remember, ever since the beginning of mankind, we've tried to use more energy to reduce the labor input into any process, right? I mean, whether it's inventing fire or just electricity itself. And I mean, everything is about energy, right? Energy and technology are the main drivers of productivity. And we are in the midst of a major technological transformation that sure requires a lot of chips and requires a lot of data and data centers, but also requires a lot of energy. So the technology and the energy are combining in a way that's, to your earlier comment, we're seeing job reductions, but at the same time, we're going to see a massive increase in power bills.
AI is winning the PR fight on Wall Street. It's losing on Main Street. How do you convince people it's good for them when you build a data center like this in their area and you sit there and you say, look, this is what's happening. My job's under threat and my electricity bill's going up. What's AI doing for me?
Well, I mean, hopefully it's allowing you to repolish your skills and potentially facilitate a lot of the processes in your life. But you're right. I mean, where we're seeing the shortages in the skill base, it's really in more manual labor, and that's what CEOs are telling us, right? That's where the gap is people able to do things with their hands. One key example people bring up all the time is, well, it's not easy to apple pick, right? I mean, you actually need a lot of computing power to replicate apple picking, but yet for a human, apple picking comes just naturally.
How much does this muddy the investment process? As an investor, how difficult does this make it to say, look, I want to invest in electricity. I want to invest in building these plants. Right. If there is this policy uncertainty of how politicians are going to respond to rising prices.
So there's definitely going to be a concern, right, with prices rising, but also remember, it's not just about the power centers themselves. It's also about the transmission lines, the connection, the grid, the substations. There's so many things that go into the electricity network. They're very, very expensive to upgrade. And I think the key point people need to remember is that for the last 15, 20 years, average electricity demand has grown at 0.2, 0.3% a year. Now it's growing at 2 to 3% a year, 10 times the rate. So in order to accommodate that kind of demand growth, you need to invest very, very heavily. Or you can do what Texas is doing, which is deregulate and just go very fast. I mean, Texas power demand is growing at 5% per annum. You won't even find an emerging market that's growing that fast. But they've taken the view of like anything goes, right? So you can be highly deregulatory, like just super fast, or alternatively, you got to find a way to accommodate these data centers. But utilities have long-term contracts. They can't give away them. Otherwise, the lights would just go off. We wouldn't be able to talk right now.
This is fascinating because there is a potential deregulatory impulse coming from the United States, and you're seeing this pretty broadly. Right. You're not seeing that in Europe. And right now, you're seeing a lot of pressures coming on the electricity side, not only from data center usage, but also just from some of the heating costs from potentially a cold winter. Why is it a better bet to expect energy prices in the UK and, frankly, in mainland Europe to go up much faster than those in the United States?
So one advantage, if you can call it that way, that Europe has over the US is that Europe destroyed its demand for power in 22 and 23 with the Russia-Ukraine crisis and the big increase in gas and power prices that came on the back of the Russian invasion of Ukraine. So as Europe lost access to all that Russian energy, and of course, we also had an issue with French nuclear reactors that year. We ended up with a massive spike in prices, gas and power. So that hurt demand for industry. So Europe has plenty of spare capacity to ramp up electricity supply. And in fact, utilization rates for gas-fired power stations in Europe are 23% on average. I mean, so that means that 3/4 of the time, these gas plants aren't running in Europe. So they could bring those back. And of course, the other thing that Europe has going for it is that in the next 12 to 18 months, America is going to export a lot of liquid natural gas, a lot of LNG. And that's part of the trade deal with President Trump and President von der Leyen. Europe is going to be buying a lot more gas from the U.S. and it's going to hopefully become cheaper after extremely high prices for the last 5 years. So that's one tailwind for Europe. Now, of course, it's a tailwind that comes on the back of a major industrial compression and 4 years of recession or quasi-recession in Germany. So it's not something that they were necessarily building, but something that Europe ended up with.
Throw in the issue that are also gripped by climate doom. Climate doomerism across the continent. I don't think it's surprising that Bill Gates came out recently and backed away from climate doom because he's got a big stake in building out a massive AI push across this country as well. And that's the issue. You've got a generation that has been indoctrinated by climate doom in Europe, and I don't see them backing away from that anytime soon. Do you? Look at the UK, great example of that.
Right. And Europe has been trying to pull back also from nuclear power. Many countries continue to try to shut down nuclear reactors. There's a couple projects in between. People, we are a little bit over-reliant on gas and power, on wind and solar, and in the power sector. And I think the build-out in the last 4 or 5 years has created some vulnerabilities because there's been little investment in the grid in Europe, but very importantly, very little investment in what's called battery storage for power. So in California and in Texas, they've kind of figured this one out already, so they've invested very heavily in those areas. So you've seen, as a result, a better behaved power market in Texas. California is a bit of a different story because it's got other issues, but Europe needs to really step up on the investment in battery battery storage.
You've given us tons to think about.
Yeah.
What's the trade? What are you advocating for at the moment?
So we are generally bearish on European natural gas prices because we think all this wave of U.S. natural gas is going to push things lower. That's on the gas side. We are still constructive on things that you need to build those data centers, like copper. Medium term, we think copper is going to go to $15,000 a ton. Medium term, we still like silver. Silver is the best electricity conductor. Of course, it's already expensive. We think we'll go to $65 an ounce. And so again, more bearish on the gas, still bullish on the metals that are significantly supply constrained. And then I think on the oil side, we are maybe more on the bearish side here, although geopolitics are very complicated there, right? So,
final question. It's an important one for viewers waking up this morning. Is our coffee going to get cheaper or not?
Well, I mean, that's a trade situation, right? I think eventually, Brazil is the biggest exporter of coffee, of beef, and biggest in the world. So, I mean, obviously, tariffs on Brazil don't help. But hopefully, the answer is yes. We'll, agricultural commodities are beautiful in the sense that they tend to mean revert a lot faster, for the most part, with the exception of cattle. They tend to mean revert a lot faster than, for example, metals, which can trend on forever because it takes 10 years to build a mine.
We hope you're right. Thank you, sir. We appreciate it. As always, thank you very much. Francisco Blanch there of Bank of America. The AI build-out, the data center build-out, and the political pushback we're about to see in this country, I think could be quite severe based on what happens with electricity prices in the not-too-distant future.
Yeah, and one of the key questions is, what do they do about it? Is it with respect to putting a stop to some of the data center proliferation? Is it sort of capping some of the build-out, or is it just mass deregulation akin to what we've seen in Texas that allows a very rapid build-out of a lot of different electricity grids?
Equity futures this morning, session lows right now. We're down by 0.7% with an update on stories worldwide with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Ukrainian drones attacked a giant Russian Black Sea oil port overnight, prompting a state of emergency. The attacks come as Russia has been ramping up strikes on power facilities across Ukraine, aiming to disrupt the country's energy system ahead of winter. Meanwhile, Amazon and Microsoft are lining up against NVIDIA. The Wall Street Journal reporting the two companies are supporting legislation that would require chip companies to satisfy U.S. demand before sending products to China and other countries subject to arms embargoes. NVIDIA is fighting the legislation. And the shutdown is over and paychecks are finally flowing with a bit of extra cash given to some federal workers. Homeland Security Secretary Kristi Noem announced TSA officers who worked without pay during the shutdown will be getting $10,000 bonus checks, calling the payments a reward for exemplary service under strain. That's your Bloomberg Brief. John?
I hope that happens. Yahira, thank you. Thanks for the update. We appreciate it. Up next on the program, waiting for delayed data.
The October employment report for the payroll side will be able to be calculated, but the household survey wasn't completed. So we will never know what the unemployment rate was in October.
That conversation up next with the former BLS Commissioner, Bill Beach from New York City. This is Bloomberg.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top of the bottom, make the sushi shape more beautiful. 3. Then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Stocks are lower, negative by 0.75% on the S&P. We're down by more than 1% now on the Nasdaq 100. On the Russell, we're down by 0.85. If you turn to fixed income quickly, I just want to give you a snapshot of what's not happening in treasuries. Yields are up at the long end of the curve on 10s and on 30s, at least for the 10-year back to about 4.13. As a level, 4.13 is nothing to be concerned about, but it's just the move relative to what's happening with risk assets that catches you around a morning like this one.
Yeah, there are a couple of different narratives. On one hand, this is yield curve steepening that's coming with the expectation that maybe the Fed will be more aggressive earlier next year, despite the fact that we are in something of a data desert and the fact that there has been this pushback. On the other hand, you are seeing supply concerns. And you're seeing that in a very real way, both on the corporate side as well as on the U.S. government debt side. And we saw that yesterday. How much is that percolating into some of the price action?
We'd like some data under surveillance this morning, waiting for delayed data.
The September jobs report has already been cooked, and we expect we might get that next week. The October employment report for the payroll side will be able to be calculated, but the household survey wasn't completed, so we'll get sort of half the jobs report. Most everything else, I think, we'll be able to concoct the correct number after we look back, but we will never know what the unemployment rate was in October because there wasn't a household survey.
So here's the latest this morning. Official economic data set to return after the record-long government shutdown, delayed releases for more than a month. Joining us now, the former BLS Commissioner, Bill Beach. Bill, welcome back to the program. Can you give us some insight into how the BLS will be operating at the moment after a month-plus-long government shutdown? What the first order of business actually is?
Well, I think they turned the data systems on yesterday to sort of end that data desert that you just referred to. And so hopefully everything rebooted well. That's always a question. And then they have to ask about the field staff, how many people are coming back to work. You know, some of those people probably took early retirement or retirement. It's kind of an older staff anyway. We might want to talk about the CPI. But back to the jobs report that Dr. Hassett mentioned, yeah, it is true. The jobs number, which is acquired from firms through an electronic survey, now BLS will prompt those firms to send their survey in electronically to Chicago or Fort Walton Beach, where those forms are collected, and we will probably have a jobs number for October. But the household survey, which is collected largely by calling people on the telephone and asking them a series of questions, quite a lot of questions. We may never have those data, and that includes not only the unemployment rate, but all of the breakout by race, by region, labor force participation, all those things that are really important for policymakers to follow. I'm also concerned about the CPI, but I think on the labor side, that'll be the biggest hole. I do expect the jobs report to come out for September, which was fully collected, but not quite written up yet. I expect that next week. I think they're right about that.
Bill, you mentioned inflation a few times. Just describe the CPI process, the data collection, how that survey's put together, and why it's so difficult to produce that number.
So the CPI is collected from the first of the month to the end of the month. They put as many working days in there as possible. And it's largely collected, I'd say about 70% of all of the observations or goods, services, are collected by people going into stores. These are BLS employees, and literally going down the aisles and marking down the price and seeing how many, potato chips are in the bag. So it's a labor-intensive thing. Now we're starting that process probably next Monday. That only gives us 2 weeks to collect 4 weeks of data. Now, it is true that a lot of that data comes in electronically. The housing stuff, the gasoline, automobile prices, those are electronically produced data from private sources. So 30%, fine, no problem. But you can't have a CPI with only 30% of the data. So I'm worried about the CPI. I'm worried about the quality of the October CPI. So that's an issue, and we'll see how that works. The November numbers are also at risk because we're going to be collecting those November numbers as well as collecting as many of the data on the October side as we possibly can. That's going to be really dicey, but I think the staff is probably up to it. So let me just say, bottom line, no unemployment rate, no labor force data that shows the demographics, and I think people should be concerned about the CPI. The PPI is collected largely electronically, and of course the import-export indexes are entirely collected from administrative data from the Commerce Department.
Bill, just quickly here, how much are you seeing the reduction in staff for the Bureau of Labor Statistics just generally presenting a problem in both ramping up but also going forward presenting the same kind of accurate data?
Well, at the beginning of the shutdown, we had a really firm number. It was about 1 out of every 5 employees at BLS had quit. But there are 2 areas of really great concern. First off, the field, and I've mentioned that several times. So many of our data from the Employment Cost Index, which is field collected, the CPI, the household survey that does the unemployment rate, these are it's labor intensive. So you have to be really concerned for the 1,000 people basically who work in the field. We don't know how many of those people are coming back to work, honestly. They're largely an older staff, and that means they may have choices in whether they work or not work. And then the other area that I'm very concerned about is the senior leadership of BLS, about 31 positions that are absolutely crucial. And about 13 of those we think are now vacant. That's the largest vacancy rate ever. And so this is expert knowledge that just can't be replaced quickly by going out to Indeed.com and finding some good resume. Those 2 areas I'm very concerned about.
Bill, thank you, sir. I leave this interview with way more concern than I had going into it. The former BLS Commissioner Bill Beach there on the difficulty of putting together this economic data.
Yeah, and going forward, what it means for the staffing levels at this key economic statistics agency.
The second hour of Bloomberg Surveillance coming up next with equity futures near session lows.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what when we first, I'll give you a really prime example, the film cameras. when you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Have the payroll number, but you don't have the unemployment rate, we don't really understand what the supply situation is looking like.
It's not a foregone conclusion that the labor market is in balance.
I think we still have enough information to say that the economy is still kind of muddling along.
There is enough evidence here for the Fed to continue to cut rates, at least one more time.
It's just this gradual ongoing softening that's keeping the Fed on edge.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores don't look good this morning. We're down by 0.7% on the S&P 500, negative on the NASDAQ by more than 1 percentage point. In the bond market, 2s, 10s, 30s. This bond market is not rallying. Yields are higher by a basis point on 10s, up by almost 2 on 30s. Over the next week, a big focus on the earnings. Nvidia, top of mind, but a major focus on the consumer. We should get some jobless claims next Thursday. And in the mix, numbers from Home Depot, from Target, from Walmart.
This is the perfect encapsulation of the K-shaped economy through some of the earnings reports that we're going to get next week. A real question for Walmart and Target of how much they're able to pass along their price increases to consumers, whether people are downshifting into lower priced items, other types of elements of concern that you would see at a point of some sort of inflection, particularly to the weaker side. On the flip side, we can get a gut check from NVIDIA. How much is the AI hopes and dreams of 2025 continuing to power all of the earnings that we're seeing in the AI sphere and can continue to deliver some sort of upswing to markets, even in the face of potentially softer consumer spending?
Just every day when you see this kind of drawdown, there's one stock I check. How's Apple doing? Apple just seeing some relative outperformance here and there when you have these kind of aggressive drawdowns. They were criticized about a month, 2 months ago for sitting out the massive CapEx spend, not leaning hard enough into AI. All of a sudden, some jitters around that story, and Apple's talking about a better iPhone sales story going into year-end and the holiday season. And it looks like a relatively better picture now for that company.
Apple is oddly the uncorrelated tech stock because they didn't necessarily go all in on artificial intelligence the same kind of way. So for people who are worried about the overbuild in data center land or potentially the overspend in Oracle and OpenAI land, well, Apple is not necessarily part of that because they're not Apple AI.
NASDAQ Futures this morning down by 1.2%. Session lows right now, the S&P as well. We're down by 0.8%. Coming up this hour, we'll catch up with Victoria Fernandez of Crossmark as valuation jitters rattle investors. Sarah Bianchi of Evercore as the White House pivots to affordability. And Alejandra Grindle of Ned Davis Research as Verizon moves to cut perhaps up to 20,000 jobs. We begin this hour with stocks losing ground. Victoria Fernandez of Crossmark warning against chasing this market. She writes, we have seen this story before. Breadth deterioration coupled with bullish sentiment can lead to 5 to 10% pullbacks, and we wouldn't be surprised if the story repeated itself here. Victoria joins us now for more. Victoria, welcome. I'm going to kick things off with the same question that I asked George Concalves about an hour ago. Have you ever seen a freak out like this one over a 2 to 3% pullback on the S&P 500?
Yeah, I mean, yes, we have seen these pullbacks before, and it was what you were just talking about. When we have that breadth deterioration in this market, when you have this internal weakness kind of bubbling under the surface, but at the same time, you have this, for lack of a better word, you have this exuberance, you have this sentiment that is extremely bullish. At some point, those two worlds start to collide, and you see this pullback. But look, Jonathan, we are still not that far below all-time highs, really, when we look at the markets as a whole. So I still think there's probably some room to see more pullback, especially when you're seeing small caps down as much as they are. We know the tech stocks kind of led this rally. We see them leading the pullback we're having here. But I do think some of the internal weakness is driving this. And the fact that the government shutdown is now over, I think investors are starting to look and go, wait a minute, we've been ignoring some of these facts that have been out here, some of these warning signs. Now they're starting to pay attention to it, and we're getting a little bit of a consolidation of a correction here.
This is going to sound slightly cliche, but I'm going to run with it. Just how strong are the hands in this market right now, Victoria? I was listening to Amy Wu Silverman of RBC earlier on this morning. She tuned into Bloomberg Radio, and she phoned in and she said something like, I would describe people at the moment as fully invested bears. How fragile has the buying actually been?
I think that's a great description of where a lot of investors are. It's where a lot of our clients, I think, feel like they are, because we tell them you want to be invested in this market. The pull down that we've seen so far has not changed the trends. The trends are still higher. Until we see the trends change, we see negative relative performance coming out of some of these leadership sectors, and staples start to perform a lot better, then I think you continue to see the market, although it will churn, you will continue to see it move higher. And that's why you want to be invested in the market. But there are these warning signals. We haven't been getting the data. We're about to get it. What is it going to tell us? Is it going to say we're weaker than what we thought some of the private data was actually telling us? If so, then yes, you will continue to have some spaces where you want to put some defensive components in your portfolio. So it does make sense. It is fully invested, but a little bit of a bearish outlook.
Victoria, just to build on what John was asking about, it does seem like institutional investors are fully invested, especially if they missed out on the rally earlier this year. It does seem, though, like there is retail selling. And when you take a look at some of the high momentum sides of the market, that's what's led the drawdown. It raises this question. Earlier this year, retail and buying actually led to the upside, and investors chased that. Is this going to be the reverse of that? Retail selling, and then eventually institutions chasing that as well? Or are they stepping in to actually pick this up?
Yeah, unfortunately, I think you do see a lot of the retail investors chasing that market. And like you said, the reverse right now. Institutional investors tend to take a little bit of a longer term approach. And so they are slower to move on some of these changes. They look and say, what are we looking at 3, 6, 9, 12 months out? Retail investors tend to be a little bit more emotional investors. And so you see things change more quickly and more turnover in some of those portfolios. We have said all along, don't chase this market. Let it come to you. There's going to be an opportunity here because of the weakness that we saw in breadth and internally, that the market's going to come to you. And that's what it's doing right now. So I would actually take this as an opportunity to add to some of the names that you've liked, some of the sectors that you're starting to see troughs, and see uptrends. We've talked about them before. You look at healthcare, you look at the big banks, you look at some of the materials components and the metals that are there, and even energy. We saw about 40% of the S&P energy sector actually make 3-month highs earlier this week. So I think there's some places you can play. Institutional investors will start stepping into that, but retail investors tend to be a little bit more emotional and move with what they're seeing in the headlines.
You didn't mention tech, Victoria, and I do think that we have to focus on that, given the fact that not only has the tone shifted, but there's been a shift in the fundamentals of some of these companies. Not that they're not earning tons of money, but it does seem like the debt issuance of the past few months has really caused some concern. You are seeing bond markets start to push back. You're seeing concessions in some of the new issue market. You are seeing some bonds lose a ton of value, particularly from Oracle. I'm just wondering if this is a warning shot to you that there has been a material shift in the tech sector and greater risk going forward.
It's definitely a warning signal, Lisa. You know, we watch spreads very closely in the bond market. They are a warning signal, that canary in the coal mine to tell you what's happening. And we've seen the widening over the last month and even over the last quarter. Year to date, we're about equal at this point in time. We had been extremely tight. We've seen spreads widen out. And yes, when it comes to tech, you're seeing large issuance come out. And it's been a question for a while. How are a lot of these companies going to pay for what they're saying they're going to do? And how is that going to affect free cash flow? How is that going to affect their debt ratios? And we're seeing some of that come to fruition now. We're seeing some concerns about what that means longer term, especially if we're not getting the revenue generation that a lot of these companies say they're going to. So definitely something to watch and to be careful on when you're looking at the debt market.
These companies, Victoria, seem absolutely determined to spend. They've said that repeatedly. They are determined not to underinvest, and they don't mind taking the risk of over-investing. Do you really see this market in a position, at the moment at least, to inflict discipline on those hyperscalers who are absolutely determined to spend hundreds of billions of dollars on this effort?
Yeah, discipline is an interesting word, Jonathan. I'm not sure that they are. These investors right now look at these companies and they believe what they're telling them. They're saying, okay, even though we saw free cash flow take NVIDIA out of the equation down almost 20% year over year for a lot of these companies, and now we're seeing debt issuance move higher, investors still say they're going to be able to do what they're doing. You heard Lisa Su this week talk about 80% revenues from data centers for the next 3 to 5 years, year over year. That's a lot of positivity coming from these companies, but yet at the same time, we're hearing builders can't deliver on data centers. There's not enough energy and power for some of these data centers. So I would be a little more skeptical than maybe the average investor is. But, you know, I'm a bond girl at heart, so that makes sense that I would be a little more cautious. But I do think for now, they are taking these companies at their word because their earnings are supporting it. The minute we don't see earnings supportive, that's when I think you'll see it all flip.
Victoria, so how are you handling this? Are you selling tech stocks and selling the bonds as well? Are you buying the stocks, selling the credit? How are you playing it?
Yeah, so we're trimming on some of our big tech names, but also we want to stay within, you know, we have parameters within the benchmark of where we need to be on these. And because there's such strong holdings in the benchmark, we can't just eliminate these holdings completely. You have to have exposure to them. But we are taking the opportunity to put it to work in other areas, both on the equity side and on debt. And looking at that debt, like 7 to 10 years out, we're starting to see the yield curve steepen. That 2 to 30 spread was like sub 100, and now we're about 115. So we're starting to steepen a little bit. It's good for financials. That's our main area of where we're looking, but we're also looking at healthcare, buying some bonds and some equity there. And then, like I said, looking at materials a little bit as well. I think those areas on both sides of the equation you can have in your portfolio.
Victoria, thank you. Appreciate your take. As always, Victoria Fernandez, a bond girl, her own words. Victoria Fernandez of Crossmark. If you are a bond person, you'll be looking at this situation and it'll get your radar up, that's for sure.
Well, you took a look yesterday at Oracle's, say, 30-year bonds, and they plummeted. They're 92 cents. They were at 100 cents about a month ago on the dollar. And it raises this question of how much pushback has there actually been? And going forward, will this reduce some of the hopes and dreams of some of the more speculative players? There was another one, Applied Data Technologies, that came out and had to sell bonds at a huge discount in order to get some of the investor appetite up. So again, you are seeing pushback, and that is a different tone in markets.
Keep going back to that Sam Altman interview. I know I keep going back to this. I just found it so awkward. Just asked a very direct, simple, reasonable question. Your revenue's here. Your spending commitments are right out there, and they're really, really big. How do you get from here to here? How does one inform and support the other? Just a non-answer. Sell your stock if you want to. Like, I found that really uncomfortable. For a moment we're in, with the valuations we have, that's not the right answer.
Faith-based investing may work for certain asset classes, in particular tied to equity. They do not work for bonds. And that is what you're seeing when it comes to Oracle. Even people are worried about Microsoft and how much they're tied to OpenAI and how much their valuations highlight the losses that OpenAI is expecting to have going to 2030. They're not expecting to turn a profit until then. So again, it highlights exactly what you're talking about. A sort of gap in balance sheet logic.
Losses picking up this morning. We're down by 0.9% on the S&P 500, down lower even more on the Nasdaq 100 so far this morning. Let's get you an update on stories worldwide with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Verizon is discussing plans to announce job cuts that could downsize the company by as much as 20%. The planned cuts could impact up to 20,000 workers and are part of an aggressive strategy to reclaim market share, the Wall Street Journal reporting. The company is also planning to convert 200 company-owned stores to franchises. Meanwhile, Minneapolis Fed President Neil Kashkari joins other Fed officials who have expressed skepticism over the need for another cut in December. Kashkari said he didn't support the last interest rate cut. Some Fed officials are arguing for holding rates steady to balance inflation and weaker hiring in the labor market. And Blue Origin launched its New Glenn rocket to space and successfully deployed 2 Mars-bound NASA spacecraft yesterday. The rocket's booster separated from its upper stage, descended back to Earth, and landed on a barge in the Atlantic Ocean after firing engines to slow itself down. The successful mission puts Blue Origin on track to challenge SpaceX's grip on the launch industry. That's your Bloomberg Brief. John?
Yahara, thank you. Very cool. I will always be impressed by that. Thank you. More from Yahara in about 30 minutes' time. Up next on the program, Making America Affordable.
Affordability, they call it, was a con job by the Democrats. My administration and our partners in Congress will continue our work to lower the cost of living, grow our economy, and make America affordable again.
Up next, Sarah Bianchi of Evercore, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jemana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Session lows right now. We're down by 0.9% on the S&P 500, down by more than that on the Nasdaq 100, negative by 1.3. A snapshot of some of the tech players in the pre-market. Nvidia not having a good morning, down by about 3%. Palantir down by something like 4%. Lisa, these losses are building.
Yeah, and we're building more aggressively, and some of them more speculative and highly levered to the AI trade. As you go and you see some of the ones that are the most speculative in terms of how much they're borrowing and how much they plan to invest in the future, this is the pushback that people have been talking about. So now the question is, how much is this just simply vibes, and how much is this real with respect to a changing structure of the entire tech stack, given the fact that their hopes and dreams have a price tag?
It's fair to say this morning the vibes aren't good as the losses pick up, just teasing out a bond market rally, just a little bit of one. At the front end of the curve, we're down by 2 basis points on 2s. On 10s, now down by 2 to about 410.18. That's a fresh development in the last 20 minutes or so.
Yeah, right now people still looking for a haven and some kind of income. This is the conundrum. How much can U.S. government bonds continue to provide a haven, given the fact that 30-year bonds still are priced at giving you a 4.7% yield? So some people might say, well, clip your coupon and be happy.
The 10-year and 30-year yield just falling just at the moment, coming back in off the back of those losses in the equity market. Under surveillance this morning, making America affordable.
Affordability, they call it, was a con job by the Democrats. We did a great job on groceries and affordability. The only problem is the fake news. You people don't want to report it. My administration and our partners in Congress will continue our work to lower the cost of living, restore public safety, grow our economy, and make America affordable again.
So here's the latest this morning. President Donald Trump pivoting to affordability after boasting about his administration's economic accomplishments. The White House now making a push for a tariff deal, announcing new deals with countries in Latin America and potentially elsewhere. Bloomberg's Mika Solner joins us now for more. Mika, welcome to the program. Welcome back, I should say. Can you describe the agreements that have been struck over the last day or so?
Yeah, absolutely. I mean, the White House is really looking to push new tariff deals in order to collect some of the revenue that they think is going to basically explode from their deals from all around the world. And with that, they are pitching the idea of sending $2,000 dividend checks to Americans. That's very much in line with the idea to distract from cost of living, give people hope, while Democrats continue to hammer the message of, quote unquote, affordability to people.
Mika, we're talking about coffee and food stuff coming from places like Brazil, Colombia, Vietnam. Have we heard from the administration about how much they're willing to do to bring tariffs down on some of those goods?
You know, the White House has been very guarded on this issue, and I think that they're still hammering out the details. But I do know that one thing that they're really trying to do is ensure that looking at the long-term effects of tariffs rather than potentially the short-term economic pain that Americans might feel when it comes to the uptick of cost of living. But I know that they're looking for solutions long-term and saying that this is overall going to be better for the country. So that's the message we're hearing right now, with details still hammering out.
Look for the details into the weekend. Mika, thank you. Mika Solner down in Washington, D.C. Let's build on the conversation. Sarah Bianchi of Evercore writing this. A White House pivot back to the issue of affordability won't be perfectly disciplined or linear, and some things will run counter as tariffs remain a favorite policy tool. Sarah joins us now for more. Sarah, Lisa and I were talking about the messaging of all of this. How do you massage the message of all of this? That you talk about affordability, and the first thing you consider is to bring down tariffs, which you also simultaneously don't believe push up costs.
Well, it's complicated. Look, this is complicated. President Biden had some of the same challenges. It's just really hard to reduce costs in a lot of ways. But obviously, this administration has a tool that he didn't have, which is to bring down some of their own tariffs. I do think the deals with some of the Latin American countries give you a signal of somewhere where they're going. They did put, not to get too wonky, but Annex 3, a list of food goods that were supposed to be eligible to be tariff-free for countries that had a final trade arrangement with the administration. Obviously, they're just kind of lowering the standards of who gets that deal and really trying to put some relief in the food space. Again, an area where a lot of Americans notice when things aren't as cheap as they want.
Sarah, a lot of the rhetoric seems to push back against a number of the policy prescriptions that we heard from President Trump earlier this year. And I just wonder, it sounds like you're skeptical that this truly is a wholesale pivot point. Nonetheless, how much are you looking for different types of policies, whether it's reducing some of the tariffs or potentially a $2,000 check at the beginning of next year? How much are you expecting these types of policy prescriptions in the face of midterm elections?
Oh, I think it's very serious. I think he's very serious about a rebate check. I think, we saw at first Secretary Bessent push back pretty hard on the concept on Sunday, and since then he's kind of softened his tone a little bit. I think it's very much a space where they will look. They're going to have to, size it, get it through the Congress and reconciliation, a lot of steps to happen, and then, try to figure out, are they really going to spend all, particularly in the wake of what might be an unhelpful court case on tariffs. But I think on the tariff rates themselves, I think they're going to find places for relief, like we're seeing in food. I don't expect them to say, oh, forget it, sorry about the steel tariffs, we didn't mean to do that, or something like that. I think they're going to look for relief valves in particularly sensitive areas.
Just to underscore the point, how much was an inflection point with the elections that we just saw, the sort of midterm elections that did point to pretty big Democratic wins? How much does this really mark a change in the president's policies going forward?
I think it was very real. It's not that these first year after elections they were blue states, et cetera, but the scope and the size of the win and the voters who Trump just won 12 months ago in, New Jersey was an undercovered story in how close it was in 2024. So these voters coming back clearly and so central, even at a time when the Democratic Party is having its own historic set of challenges, still voters were willing to vote for these candidates. So I think you've watched the president kind of, all over the place a little bit rhetorically, saying it's fake news, but also exploring, a lot of ideas. I think it's a very big pivot moment for the White House.
So there are a number of different inputs to CPI, and one of them, and has been a good contributor to the disinflation that we've seen, has been energy prices. How much do you expect some of the policies around the data center build out in the United States to start shifting or potentially encourage deregulation of the energy sector even further in order to cushion some of the price increases that we're seeing in certain areas that are closer in proximity to data centers?
It's a huge issue. The president, you're right, has always been focused on low energy costs, but he's always really been about gas and oil. And this is a different issue. This is electricity. And it's a very hard issue to get at. It's largely state regulated. FERC does have some oversight, but it's going to have to be sorted with the states. And there are ways to solve it. We've seen places where, some of these data center builders have pretty deep pockets, and so they can actually help fund rather than passing on costs. But we saw this as an issue in Virginia. We saw it in New Jersey, and I expect you're going to see it even more around the country. For the president, it's a little bit challenging because the policy tools are a bit more long dated, but and they do come, part of the solutions or one of the pieces is more wind and solar, never a favorite topic of his, but I expect they'll pivot in this space as well.
Sarah, thank you. Sarah Bianchi of Evercore. That's a lot of pivots. With these kind of things, you can see into the future, and you can already see that we're already behind. You can see into the future because there is a duration mismatch. You can dig a hole and build the building very, very quickly to get the energy that supports it. You need to have built that a long time ago, or at least started to build it. We're already behind.
Yeah, which really goes to the question of who's going to bear the brunt of this. We are seeing certain sectors, certain regions in the United States where people are paying higher costs for electricity. Will some of the hyperscalers be forced to bear the brunt of this and actually pick up the bill? And that point that Sarah Bianchi made, I think, is a really important one.
We can, of course, change the future. There's a lot of work to do. Let's put it that way. Up next on the program, Alejandra Grindle of Ned Davis Research as Verizon weighs up to 20,000 job cuts. That's next.
coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Stocks are down across the board. We're negative by 0.8% on the S&P. On the Nasdaq 100, we're down by 1.3%. The losses are building up. It includes the small caps, the Russell, down by 0.88%. So a risk-off posture so far this morning, now backed up by developments in the bond market. Yields starting to fall across the curve. 2s out to 30s, 2s, 10s, 30s, now down by about 4 basis points at the front end and on the 10-year as well. Let's call this a break of 4.1%. in about the last 10 minutes.
Yeah, and you could say that this is just showing how much the risk aversion is broadening, and the knee-jerk response to buy bonds is prevalent. At the same time, the Verizon news that you cited earlier, to me, highlights how much we see a disinflationary tilt from some of the efficiencies from companies. They'd rather cut jobs than try to raise prices substantially and lose customers. That is a Fed story, and that is a bond story.
So that takes the temperature of the US story and maybe the global backdrop for risk this morning. Let's take the temperature of the UK right now. We've talked about the price of chaos, volatility. This market's been wild so far today. Yields are up on a 10-year gilt by 9 basis points. We're up by double digits at 1 point. Sterling, you want the range on sterling today? The low, 131. The high, 132. This morning, 131.52, somewhere in between.
Honestly, this is such a tricky story because at what point will the UK have to raise taxes as gilt yields go up? Essentially, the higher yields go, the more they're going to have to try to plug the gap that they have imposed on themselves with certain fiscal caps. So it raises this question, and Geeta Gopinath, formerly of the IMF, currently of Harvard, I keep going back to this op-ed she wrote in the Financial Times where she said, this fiscal instability has created a crisis of its own making. The fact that investors don't understand the fiscal response mechanism to any kind of increase in bond yields. You know, it just creates this real cycle of doom, and that seems to be what's taking place in the UK.
Really, really bad communication. The marketing from this Labour government has been absolutely abysmal. Every step of the way, it's just scaring people. When they came in, first of all, and said there's this massive black hole, and then they started spending loads of money on public sector pay rises, and then had to increase taxes aggressively, and then said, we won't do that again. And we've spent the whole summer. Think about the message you're sending to the British consumer over the summer. We spent the whole summer coming right into the fall, telling people that this tax might go up, that tax might go up. Oh, if you're super wealthy, there might be an exit tax. That tax is going to go up. This tax is going to go up. What are you going to do in between? I've got a good idea. I'm going to invest lots of money in the British economy. I'm going to make a 5-year, 10-year, 15, 20-year trade on the UK right now. Who, in their right mind, would make that kind of decision if this is your backdrop for taking risk in the UK?
No, what they're doing is they're buying real estate in other countries, and that's actually what's happening in a broader specter. At the same time, the fact that they're benchmarking a lot of their projections to the market and to bond yields and how much that increases their fiscal gap highlights how much they're in this sort of cycle where they have to plug a gap at some point because they're going to have to raise taxes to pay for the bond yields that are going up in respect to their fiscal discussion.
Sterling right now, 131.53. We're down by about a third of 1%. As we count you down to the opening bell, about 2 hours away, let's get you some morning movers with Yahira. Hey, Yahira.
Hi, John. We start with Warner Brothers Discovery. Shares are rising 2.8% on growing conviction of buyout. is coming. That's because the Wall Street Journal is reporting that Paramount, Skydance, Comcast, and Netflix are all preparing bids ahead of a November 20th deadline. Meanwhile, here are the stocks getting hit this morning, the tech stocks getting hit this morning as markets remain on edge. Tesla, Nvidia, and Alphabet are the biggest decliners among the Mag 7. This is coming as hopes fader for a December rate cut, and without that, it's tough to justify these tech stocks' high valuations. But Nvidia could report spectacular results this next week, and then we're off to the races once again. And we end on some M&A action. We are seeing Cidara Therapeutics shares rising 100%. Merck is buying the company in a $9.2 billion deal. And we've seen a lot of deals like this in the pharma space as these companies look to refill their pipelines. For Merck, the issue is that its blockbuster key cancer drug, Keytruda, will soon face competition from generics. So it was willing to pay up for Cidara, paying double what it closed at yesterday. That's what you're seeing, shares up more than 100%. John?
Yahara, thank you. Massive move. Absolutely massive move. Appreciate it. Thank you very much. On our radar this morning, our top story, the White House unveiling framework agreements with Argentina, Guatemala, El Salvador, and Ecuador to reduce tariffs on common grocery items. The trade deals will see tariff reductions on beef, bananas, and on coffee beans. That's where Paramount, Comcast, and Netflix preparing bids for Warner Brothers Discovery. The Wall Street Journal reporting the deadline to submit non-binding bids is November 20th. Warner Brothers hoping to complete the auction process by the end of the year. And finally, Oracle, taking a hit in the recent sell-off as fears grow over its mounting AI debt. The software giant's shares are down nearly 30% over the past month, the slide reversing more than $250 billion in gains since disclosing deals with OpenAI in September.
Let's talk about the debt. So right now, Oracle has about $96 billion of long-term debt. That is up from $75 billion a year ago. Morgan Stanley predicts that this amount of debt will go to $290 billion by 2028, right? So that's 3 years away that we could see that kind of tripling in their overall debt load. What is it going toward? That is the key question. How much do they hinge to OpenAI on the story that has been deeply unsatisfying for people? That, yes, they're not going to turn a profit to 2030, but they expect to spend hundreds of billions of dollars in some of the outgrowth of data centers. This is the difficulty, and Oracle is almost the leveraged play on how much people have a sentiment for OpenAI and how much tolerance they have to really issuing a lot of debt.
So I've seen the same moves, and I was thinking, is this code red? So I reached out to Robert Schiffman of Bloomberg Intelligence, who covers the credit story. You know him well, fantastic guy. He said, yes, we've seen a massive move in CDS, but he thinks it's more about technicals on hedging all this new debt versus fundamental concerns that credit is going to junk. So I said to him, keep me in check. When we get to code red, let me know. He doesn't think we're there just yet.
Well, certainly not code red, but certainly maybe a little bit of the sheen has come off the bloom.
Absolutely.
The bloom has come off the rose. There is a feeling right now. I mean, if you take a look at the Oracle debt long term, it's been affected by the fact that duration has sold off. So it's not just a question of the credit worthiness. Nonetheless, there is more skepticism. And I keep going back to Applied Digital, which is a high yield rated company that tried to come to market yesterday with some notes, with some bonds, and they had to offer a 10% yield in order to sell it. They provide some of the data center products to CoreWeave, also a high yield rated company that provides some of their services to OpenAI. You start looking at how circular this becomes, and you start wondering at what point are we going to see a lot of weak players? And that, I think, is what the market's trying to suss out.
There's some pushback, Lisa. I'm totally there with you in the credit market, and it's spilling over to equity as well. Equity futures down this morning by about 1% on the S&P 500. Let's turn to the labour market. Verizon discussing plans to cut about 20% of its workforce, potentially impacting up to 20,000 workers. People familiar with the matter telling Bloomberg cuts could come at every level of the business. Alejandro Gundel of Ned Davis Research joins us now for more. Alejandro, welcome to the program. Let's get into some of this. So I see these big flashy headlines from the likes of Verizon. It looks awful. And then I see the state level jobless claims, and they look okay. What's the state of the labor market from your vantage point?
Oh, thanks for having me again. So, obviously we're not getting the non-farm payrolls data, so we're not getting the clear number that we're used to, but we're able to sort of cobble together a lot of data, including layoffs. I know the Challenger layoff announcements really freaked a lot of people out because it was an unusually high number. But on balance, when we sort of put the numbers together for the month of October, we're looking at very modest gains in payrolls. So not quite as dire as the numbers some of these headlines suggest, but very much in line with what we've been seeing in the prior months, that we're just not seeing the job creation that we had before.
there is a problem going forward, at least briefly, Alejandra. Going forward, when we get the economic data, we won't get unemployment, we will get payrolls. And payrolls has been the concerning thing. And if you can take some comfort from anything in the labour market, it's still a relatively low unemployment rate. How will you digest the incoming data in the next few weeks with that in mind?
Just overall that there's going to be some data missing?
Yeah.
Well, at least, and I think I mentioned this last time I spoke to you guys, is we haven't been completely in the dark. Within the United States, there's still a fair share of private sector data, Fed data that we've been able to work with. I think we're going to look at that number, but when you compare it to other data that we've been getting in recent months, I think we're still not getting that bad of a picture. And as I mentioned before, I think it's consistent with, maybe not this enormous decline of the labor market, but definitely weakness that I think still, pushes the Fed to maybe consider cutting in December.
How much does the weakness that we've seen in the labor market encourage you to downplay any kind of inflationary risk? And I'm pointing to the likes of Verizon, the idea that why are they cutting people? They are cutting people so they can compete on price, so that they can lower prices or keep them steady for consumers, because they are losing consumers because of price. How much is this a theme versus an idiosyncratic incident?
Well, there's a broad array of risks to look at that the Fed has to deal with, obviously inflation being one of them. But with respect to the economy, I mentioned, obviously they started cutting because they started cutting rates to begin with because the job market's not as strong as it was before. And we're still seeing signs of that with this other data we've been able to put together. I think another key takeaway too is Main Street is hurting. So even though we can often look at financial conditions and they look okay, Main Street, the average American just isn't doing as well. And they're very sensitive to Fed interest rates. They're sensitive to mortgage rates. They're sensitive to housing prices, credit conditions. We're seeing delinquency rates rise. So that's sort of that underlying issue that the Fed has to address. In terms of the inflation story, I mean, yes, we do expect inflation to stay at least above what the Fed's target is anticipating, say over the next 6 months at least. Some of it obviously reflects the tariff side of things, some of the deportations, but long-term inflation expectations remain anchored. And I think it's also really important to keep in mind that the Fed funds rate is still, contractionary, right? So it's still above neutral. So I still think there's some room for the Fed to cut policy and, so sort of help that Main Street, help that labor market get in a better position over the next few months.
Over the past few days, we've seen a bit of a wobble in the tech sector. This has been the sector of support for the overall economy and for GDP more broadly. And I just wonder how difficult it would be for this economy to keep expanding if you see this wobble continue to expand, both on stock prices, but also on some of the dynamism expected from these names.
Oh, absolutely. I mean, that's really what's holding us, right? So the consumer on aggregate continues to spend, but this is the higher end consumer. The higher end consumer is tied to the stock market. Stock market has been doing well, obviously not the past couple of days, but has been doing well because of the tech sector. So there's definitely this feedback loop. And I would even, using a technical term within the economy, very weak breath. So it makes you vulnerable to a potential downside. On the other hand, there still could be a lot of huge benefits from artificial intelligence and technology. We're seeing it ourselves in our firm, and especially as not just the United States, but other developed markets are sort of facing this future of a waning labor force. We need this productivity, which could be boosted by AI, to ultimately increase our growth potential at the end of the day. So, there's definitely an upside coming from it. And as I said, I think we're seeing it. A lot of other people are seeing it as well, but it does make the market and households very, very vulnerable if things were to tip over.
It's making them nervous already. Alejandra Grandal of Ned Davis Research. Alejandra, thank you. It's good to see you, as always. It's making people very nervous. I keep going back to that line from Luke Cower. Luke making the point that it's regressive up front. And that's the problem right now for consumers, for Americans, and of course for the politicians who are going to have to really wrestle with this going into next year.
Yeah, and as long as there is patience in the investing world, where people are willing to finance it, both in the equity side of things as well as the debt side of things, then the regressiveness of it can be masked by high valuations and some of the dynamism in the build out. If that softens, how much is that going to be a painful year or two in order to right-size the economy to some of the technological promise?
It's softening this morning. The Nasdaq's down by 1.6%. The S&P lower by more than 1 percentage point. With an update on stories worldwide, with your Bloomberg Brief, here's Yahira. Hey, Yahira.
Hi, John. The BBC has apologized to President Trump for the way it edited his January 6, 2021 speech for a documentary after the president's lawyers called it defamatory. The news organization said it strongly disagrees there is a basis for a defamation claim. The Trump team has threatened a $1 billion lawsuit. Meanwhile, unionized Starbucks baristas launched a wave of walkouts yesterday. The strike, involving more than 1,000 baristas at 65 cafes, was tied to Starbucks' annual Red Cup Day promotion and is the latest escalation in the union's efforts to ramp up pressure on the coffee chain. The union accuses Starbucks of refusing to fairly negotiate, while Starbucks has denied wrongdoing. And Apple unveiled its new digital ID system, which allows users to add a copy of their passport on their device. Travelers can scan their Apple Wallet at airport readers and use the copy if they don't have a real ID. The company warned that this does not replace a physical passport and can't be used for international travel or crossing borders. That's your Bloomberg Brief. John?
Yahara, thank you. That's quite cool. That's a big win for Apple, that is, on the security front.
Oh, I would completely agree. I mean, how nice is it? Think about waiting on the line, and you have a phone in your hand because you're looking at news.
And it's always in your hand.
It's always in your hand.
Too big
that's
for
what you
anywhere
do.
else.
Exactly. So you're looking at your phone, and all of a sudden you get up to the counter, and you have to take out your bag, and you have to pull out your ID. You've got to hand it to them. This way you could just say, boop, and then you can keep just getting addicted to your phone.
How long before we do that on the international front?
I don't know. That's a tricky thing.
Hopefully we get there soon on that front too. Up next on the programme, negotiating new deals.
We're seeing new corridors opening up, and the scale of ambitions, not just in China, are higher than we see really in many other parts of the world.
They want you to have like 20 pages so they can stamp them all, you know?
On the inbound and the outbound. Why did the outbound? What is this? The passport control? I don't understand.
Why do you care so much about who's leaving?
Why do you want to keep in the criminals? I don't get it.
Let them go.
Exactly.
Someone else's problem.
100%. I don't get it.
Yeah. I'm right there with you. It's tighter on the way out sometimes than it is on the way in.
It's worse, 100%. And it's sort of like, what is this, job security?
Experienced that in Italy. This was a good rant. Enjoyed that. All right. Up next, the former senior White House trade advisor Kellyanne Shaw joins us in just a moment from a beautiful New York City. You're watching Bloomberg TV.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Stuart Kaiser of Citi pointing this out, just published, saying flash flood of poor news. In the last 24 hours, it's dragging this equity market down. We're down by 1% on the S&P. On the Nasdaq, we're down by 1.5. I have to say, to take a step back from some of this, the poor news is just that the market's moved lower. And it seems to be price shaping the narrative, because I can't really point to one single thing that says, you know what, that's the reason this equity market was down hard yesterday and down again this morning.
Is it a vibes issue? Is this something where people are suddenly just concerned about the debt outgrowth of some of the tech names, and that's sort of leading everything into a spiral, in addition to job cuts and in addition to some softer than expected economic news? I don't know. That's really to be seen. Can this market tolerate a couple of high-profile blow-ups? That is what I want to know, if there are weaker hands that do ultimately suffer real pain.
It took a while for this bond market to start rallying. You're starting to see it now at the front end of the curve and through the belly. On 5s, we're down about 5 basis points. On 10s, we're down about 4. Down 4 basis points also at the front end of the curve at 3.55. Look, the one thing holding up the aggregate numbers in the economy right now is the high-income consumer, and based on a sentiment survey, the only reason the high-income consumer is happy right now is because of the equity market. So, to some extent, the stock market move will shape perceptions of what the Fed might do in the coming months.
This economy is profoundly leveraged the AI bet and the optimism that it's fueled both in equity markets and beyond.
The equity market story pulling lower by about 1% on the S&P, and the bond market yields down by 4 basis points. Under surveillance this morning, negotiating new deals.
We're seeing new corridors opening up. And the scale of ambitions, not just in China, are higher than we see really in many other parts of the world. I think the recent truce has brought some much needed and welcome stability. We're in a position now for both sides that wanted to have a period now where we can move ahead.
So here's the latest this morning. Wall Street watching for fresh trade deals from the White House. The Trump administration announcing new framework agreements with Latin American countries as talks continue with China. The former White House senior trade advisor Kellyanne Shaw writing, one thing is clear, despite the shutdown, USTR has been extremely busy negotiating. Kellyanne joins us now for more. Kellyanne, welcome back. We've been tracking this together since it started back in early April. In fact, since the election took place more than 12 months ago. Are you seeing this administration and White House start to change course a little bit?
Yeah, good morning. Thanks so much for having me back on. I see directionally the White House continuing the strategy that it started with, which is we are going to impose these very high tariff rates and then negotiate with trading partners to try to land them at a place that's a bit more reasonable. And so they're continuing to do so, notwithstanding the White House's concern, which is clearly focused on the issue of affordability, consumer confidence, how much you're paying at the grocery store. Now, on top of this, on top of those 4 deals that were announced, plus we had South Korea, that framework which was released last night, a potential upcoming deal with Switzerland, an interim deal potentially with Brazil. You're seeing the White House tease a more significant tariff relief package, which would really hit Americans at the grocery store. Now, this would be a departure from where they've been going, but I do think directionally all along, they've anticipated that they would need to course correct, that there would be recalibrations where there had been overcorrection. So I think we're starting to see the first part of this.
There's some contradictory messaging here. You're well aware of that. On the one hand, you're saying that tariffs don't lead to higher prices. On the other hand, you're saying we need to do more on affordability. We're going to drop tariffs. How do you massage the messaging?
Yeah, there was always a little bit of dissonance between these two messages. And this was always the White House's case to make to the American people, that if we impose an average 15 to 20% tariff on all goods coming from all countries, that's not going to lead to higher prices at the grocery store. It's not going to make your vacations more expensive. I think the American people have always been a little bit skeptical of this argument, and this is something the White House is going to have to continue to message moving forward. Now, that said, what they'll point to is the fact that we impose hundreds of billions of dollars of tariffs in Trump 1.0, and that did not lead to inflation. And if you look at countries like India or South Korea, which nationally have very high tariff rates, they're not concerned about that leading to inflation on a day-to-day basis. So why would that pattern hold in the United States? But I do think voters are not quite there yet, and this is something the White House is going to have to navigate.
Kellyanne, how much is this argument a liability for the White House when it comes to the Supreme Court case? The idea that they're arguing that this is a national security issue while also talking about reducing tariffs for cost of living concerns.
Well, I think we've got a bunch of different types of tariffs, some of which are being challenged right now at the Supreme Court, others which aren't. And we've always had carve-outs since the beginning of certain product categories like your iPhone, your laptops, some of the pharmaceutical products and aircraft and airplane parts have always had different tariff treatment. So shifting some of that around or targeting certain food products, I don't really think is going to make that much of a difference in terms of how the Supreme Court is looking at this.
Do you think, though, that, Kellyanne, when you talk to some of your clients, there is a feeling that maybe we've seen the peak in terms of the tit-for-tat trade war type of behavior, just simply because the cost of living concerns are starting to trump the concern about national security and the concern about getting leverage internationally?
Well, I think regardless of how voters are viewing cost of living, that we effectively had reached sort of the peak of this trade war to begin with. The president was always going to come out swinging at the beginning to make this huge move to try to negotiate with every country on earth and then land the plane at a lower rate. And that's what we saw him do in August. I think we're beginning to see more and more tariff reductions as part of these deals being negotiated. But I wasn't expecting these like huge swings moving forward. I think this is effectively where the president wants to land things and have the tariff rate be on average at the end of his 4 years. Now, I do think that consumer confidence and affordability is a significant issue for the White House, which is why you're seeing them take this head on, as opposed to the prior messaging, which was more about, don't worry, the economy's doing great, kind of ignore how you feel. They're not there now. They're head on addressing this. And I think that these recalibrations on tariffs are a reflection of that.
Kellyanne, thanks for joining us. Kellyanne Shaw there, the former senior White House trade advisor, going through some of the previous tariff relief. I always felt that the relief for Apple, the carve-out, was for Apple. And some of the relief we've seen over the last year or so, a lot of the relief, if any, has been for Wall Street. This is a change. This is relief directed right at Main Street. And that's the change that I think you've got to track going into next year in the midterms.
Especially because it's a complicated thing to do. This is not as easy as just saying, okay, we'll reduce the tariffs and then prices go down. This is an issue of an entire ecosystem that needs to get back into some sort of order, and there are price increases that are not tied to tariffs. So if things start to get tied to tariffs that are not necessarily sensitive to that, you have lost control over both the message as well as some of the inflation. So this is going to be a much more difficult thing to nuance than, say, a carve-out for Apple or questions around NVIDIA's chips.
We've got to keep tracking this equity market as well. The Nasdaq 100's down by 1.5%, just off session lows. On the S&P 500, we're negative by 0.9%. Coming up, we'll catch up with Daryl Cronk of Wells Fargo, Jay Goldberg of Seaport, Michelle Meyer of MasterCard, and Mona Mahajan of Edward Jones.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates, complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
The volatility in the rotation that we're seeing among single names is healthy.
The breadth picture under the surface for the S&P 500 is actually starting to improve.
The Mag 7, they just have to sort of behave, right, in order for the market not to have, kind of one of these major scares.
I think equities are still going up 15 to 20% from where they are over the next year.
This bull market deserves the benefit of the doubt.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
This stock market is not behaving. Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures down across the board. On the S&P, down by almost 1%. On the Nasdaq 100, we're down by 1.4. The Russell, negative by more than 1%. In the bond market, 2s, 10s, 30s. Yields down across the board. We're down by 4 on 10s, down by 3 on 2s. I, like many, made the observation earlier on in the session that we weren't getting the bond market offset to the equity market drawdown. That changed about an hour ago.
Yeah, as the risk aversion in stocks started to grow, you saw people who start to revert back to that long-term bond bet with this idea that maybe we would ultimately get a slowdown in the overall economy that would lead to lower bond yields. Look, right now, this is notable. It does feel a little bit different, even though it's not that big of a drawdown. You can't exactly say this is a correction. We just saw the worst day for the Nasdaq and the S&P going back to October 10th. You see more selling, and it is not just in the stock market. It is also in the credit markets, which until now have been rock solid.
Tracking the latest from Cameron Christ this morning, this is what he wrote in the last 30 minutes or so. Some 135K of 10-year contracts traded in a 10-minute window, 10-minute span, a little bit earlier this morning in the last hour, the largest volume cluster of the week. He didn't see any particular catalyst, neither did I, but evidently, in his words, somebody came in and said, mine.
Yeah, and I just keep going back to what Bob Michael said of JP Morgan Asset Management. There's so much cash. All you have to do is have a little bit of yield, and people will flood into it, and that seems to be what we saw earlier this morning.
Looking ahead to next week, lots of earnings. On deck, on the calendar, we'll see some retailers, Home Depot, Target, Walmart, the tech monster, the giant Nvidia. They get earnings on Wednesday, so look out for that. This morning, we're talking about Verizon. Let's talk about that company. The message coming from Verizon, the way you framed it, Lisa, I think you framed it so well so far this morning. The message coming from Verizon is buy bonds. Ultimately, there's going to be damage to the job market, and we can't pass on higher costs.
This is a company that has 100,000 employees. They're talking about potentially cutting about 20% or 20,000 employees, and it comes after losing market share, after seeing some of their customers defect to the likes of T-Mobile or AT&T because there were lower prices there. How are they going to compete? They are going to compete on price. How are they going to do that? They're going to become more efficient. How much is this a Verizon story, and how much is this an economic story?
I mentioned some numbers next week, of course, Walmart in the mix next week on Thursday. This just crossed in. There's a headline for you, Bramo. New leadership at Walmart.
This is actually really surprising. Walmart CEO Doug McMillon is planning to retire. Walmart, the company, just named John Furner the new chief executive officer, and this comes at a time of a lot of transformation at Walmart. Walmart has gone from catering to the low-end consumer, the box stores that everyone has relied on, to increasingly e-commerce, catering to a higher-end consumer, and really deploying tech in a mass way. This is a fascinating shift. I'm really curious to see exactly what was behind it.
He will retire from his position as president and CEO, effective on the close of business on January 31, 2026, on February 1st, 2026. Mr. McMillan will continue in his capacity as an executive officer of the company. He will report to the chairman of the board of directors, and he will continue to be employed as an associate of the company through January 31, 2027.
This is fascinating. Again, we have to just emphasize, Walmart is one of the biggest employers, if not the biggest employer, private employer in the United States. They are the biggest retailer in the United States. They are setting contracts and prices across the world, frankly. They have been a real question mark when it comes to what is their strategy going to be, what is their read-through in the economy. And at this moment, to be having new leadership, again, this is really interesting. I'm very curious to hear more color as it comes out.
Walmart this morning down by about 2.5% in the pre-market. Ahead of earnings next week, some leadership changes at the top of that company. Coming up this hour, Darryl Cronk of Wells Fargo joins us as stocks hit a tech-fueled sell-off. Jay Goldberg of Seaport seeing signs of an AI bubble. And Michelle Meyer of the MasterCard Economics Institute as consumer spending outpaces sentiment. We begin this hour with equities pulling back as traders digest hawkish signals from the Federal Reserve. Darryl Cronk of Wells Fargo highlighting the three I's that matter: inflation, interest rates, and illiquidity. Writing the recent sell-off is more about positioning and sentiment extremes and weak hands that have changed the underlying fundamentals. Darryl joins us now for more. Darryl, good morning.
Good morning, John.
Just build on that a little bit.
Okay.
The fundamentals are strong, are they?
The fundamentals are still strong. I don't think that there's a lot of debate about that. What I would say, the two things maybe in yesterday's sell-off that people missed, right? Number one, you had all the Fed speakers out being hawkish, right? So for a moment in time, Fed funds futures for a December cut dipped below 50%, right? The prior day, just to put that in reference, they were at 69%. A month prior to that, they were 95%, right? So that's a pretty big move. That's the spark that lit this thing yesterday afternoon that we started the sell-off, right? What I found was interesting yesterday was, obviously decent breadth on the equity sell-off, but if you looked at yesterday, treasuries were negative, Bitcoin was negative, gold was negative, the dollar was negative, right, which is everything. So going back to the point about weak hands and stuff, when positioning and sentiment gets out over their skis or offsides, and people have to cover margin calls and other things, you sell what you can, not what you want, right? And so you're forced to sell strong assets, treasuries, right, gold, things that you would normally hang on to meet some of those extremes in markets. So I think that's what you saw yesterday.
Everything that's done well in the last year or so, year to date, did poorly yesterday. Got that. The equity market, is that a stronger story to get hold of? When you look at the equity market right now and people are talking about 5 to 10% pullbacks, is that a pullback people ultimately want to buy or a pullback people run away from?
So we have a lot of conviction around this. We've been, like a lot of people, waiting for that kind of intra-bull equity correction. 5, 10%, you usually get 2 a year, 10%, 1 a year in a calendar year. We think this is absolutely viable, right? We like the fundamentals going out into 2026. So if you get a 5, 7, 10% pullback, I would be using it as an opportunistic way to add capital in. Now, what we did do is we downgraded technology on October 30th from favorable back to neutral. Neutral still a sizable weighting, obviously, in a portfolio. Ironically, the NASDAQ hit its high on October 29th, so sometimes better to be lucky than good, right, on those type of things. But where we would put capital is in places like financials, industrials, utilities, places where you're getting some of the benefit of the horizontal expansion of AI without having to buy the valuations of the tech.
Okay, I love this. You're the second person this morning who said, yes, buy the dip, not in tech, but in everything else. Buy the dip in financials, buy the dip in healthcare. At what point are we hearing an increasing aversion to buying tech at these valuations, even in a 5 to 10% drawdown, just simply because the structure of some of these companies has changed?
Yeah, I think it's a good point, Lisa. I mean, the point I made about being neutral, right, with the market cap weightings of the index, you still have to have a meaningful position, obviously, in technology. But let's just admit, like, things got out a little bit over their skis here. They got a little white hot. We saw the same thing happen in mid-October. Remember, the catalyst at that point was when President Trump came out and said he was going to put 100% tariffs on China and that he and Xi weren't going to meet. And all of a sudden, the VIX spikes to 28, right? This morning, we're at 22, right? So that kind of what I'd call sticky volatility that's been with us for the last 30 to 45 days, I think is emblematic of what's happening as we transition in this tech world. To us, just valuations just got to extremes through the summer months and the early fall, and we just said, time to take some profit, right? Pull that back. I don't think you abandon tech by any means, but we find better risk-reward trade-off in places like financials, industrials, and utilities.
Does the move that we're seeing this morning in bonds in particular make you like treasuries once again as a hedge? And I'm talking about long-term treasuries.
Yes. I mean, I think you can still buy treasuries here. You know, what people forget is if you look at the Bloomberg, you know, U.S. Bond aggregate, it's up 7.5% year to date, right? I mean, we haven't had positive bond returns for probably 4 years post-pandemic, right? It's finally accretive again to portfolios, right? And so I think you can still use those bonds as a traditional way to play that sector, right? What people also forget is U.S. households own $61 trillion worth of U.S. equities, right? So if you do get that 10% correction, it's meaningful. In fact, if you do the math, it means probably about 0.75 to 1% of GDP that it can shave off if you get a 10% correction, or vice versa, can be additive. So part of the economic growth story has just been the wealth effect of what's happening if you just simply do the math.
How supportive is tariff revenue for this bond market? And if it started to go away or was spent elsewhere, what would it mean for the Treasury market?
It would put upward pressure, no doubt, on Treasury yields, particularly the long side of the
developing?
curve.
Is that happening right now?
Maybe not quite yet. I mean, obviously concerns about IEEPA, but you know, to me, John, the tariff story is not about whether tariffs will be applied, it's how they'll be applied, right? Because if they're not done by IEEPA, they'll be done by Section 122, Section 301, Section 232. It'll take longer to do it.
They'll keep raising the money.
Right, they'll keep raising the money.
And are they going to keep spending it too? Because we've heard about
Correct.
$2,000 rebate checks this week, and it doesn't feel like that story's losing steam.
Yeah, if you take what they've raised already and just projected tariffs and freeze them at this moment, it's about $410 billion, right? That's almost 20 to 25% of the $1.8 trillion budget deficit, right? So it's meaningful to apply back, you know, against that if you can do it. If for some reason you're going to refund all that money back to whence it came, guess what happens to corporate margins and earnings, right? Because all that money was pulled in. If it goes back to the companies where it came from, all of a sudden it's a monumental lift in margins and earnings.
These are all potential negatives for the bond market, potentially for the Treasury market. The credit market supporting massive AI spend now as well. So the bigger question, I think, across Treasuries and credit, will Treasuries and credit continue to support the big dreams of the equity market, given how it's priced at the moment going into a new year?
So let me put it this way. Our year-end 2026 target for interest rates on the 10-year and the 30-year are in the 4.25 to 4.50 kind of range, right? So higher from today's levels, right? Probably the highest conviction that we have in the Treasury markets right now is the curve steepener. We still think no matter how you play it, the curve has to steepen, whether that's short-term rates coming down and long-term rates staying somewhat stable, or long-term rates going up, which is your story, right, about concerns about fiscal, concerns about tariff.
Someone asked this story. I'm just articulating it for them, of course. Carry on, please.
No, that's right. I mean, but I think the right normal level for long-term Treasury yields, right, are in that 4.25 to 4.50. Remember, the long side of the Treasury curve is a term premium, a growth premium, and an inflation premium, right? And growth premiums and inflation premiums have been coming down. Term premiums have actually also been coming down lately, but we think we'll expand it next year.
Darryl, good to see you.
You too, John. Thanks.
Thanks for being here. Thank you, sir. Darryl Cronk there of Wells Fargo. Yields are lower this morning, at least. We're down 5 basis points across the belly of the curve, down by almost 5 now on 10s, 4.07% on a 10-year bond yield. The equity market near session lows. Let's give you an update on stories worldwide with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. Walmart announcing a change in leadership ahead of earnings next week. The company announcing CEO Doug McMillon will retire at the end of January next year. John Furner will take over as CEO on February 1st after serving as the company's executive vice president and CEO for Walmart US. Furner first joined the company as an hourly associate back in 1993. Meanwhile, President Donald Trump is readying substantial tariff cuts to address high food prices. The president unveiled frameworks with Argentina, Guatemala, El Salvador, and Ecuador to reduce tariffs on common grocery items. The deals will reduce tariffs and barriers on items like beef, bananas, and coffee beans in a push for affordability. And StubHub shares are plunging down 18% after the ticketing platform failed to provide guidance for its current quarter in its latest earnings report. Its CEO said the company plans to offer an outlook for 2026 when it reports fourth quarter results. This was the company's first earnings report after going public in September. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira later this hour. Up next, the morning calls, plus Jay Goldberg of Seaport with the loan sell rating on NVIDIA following mounting AI bubble fears. Jay's going to join us in just a moment. Live from New York City this morning. Good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
We are in the midst of a major technological transformation that sure requires a lot of chips and requires a lot of data and data centers, but also requires a lot of energy. So the technology and the energy are combining in a way that we're seeing job reductions, but at the same time, we're going to see a massive increase in power bills.
Will we see some pushback to the AI story? We're starting to see it in the equity market. We're down 1% on the S&P. We're down by 1.45% on the NASDAQ 100. If you're just joining us this morning, this is better than it was about an hour ago. In the bond market, a bit of an offset coming from fixed income now. Bond yields are lower across the curve. 2s are down by 4. Likewise on 10s, we're down by 4 or 5 basis points this morning to 4.0. 7%.
Yeah, you are seeing buyers come in, given the fact that there is this risk aversion. There's so many cross currents this morning. On one hand, you've got the tech story, a question of how much you really are seeing, some sort of gut check about the build out of tech. And then you have this Walmart story heading into earnings next week, which really is fascinating. The idea that the CEO, Doug McMillon, is stepping down and he's going to be replaced by the former head of Walmart US. So he's going to be the new CEO. And it raises a question, why do this now before earnings, right? The timing of it's raising questions, the nature of it's raising questions, which is the reason why maybe you're seeing the shares add to the sell-off and add to questions about the state of the consumer and how much this has to do with anything going forward on that front.
Stock is down by 2.7% in early trading. Numbers from Walmart coming next Thursday. Look out for that later next week. Let's get you some morning calls. First up, Wells Fargo raising its price target on Applied Materials to $255, remaining positive despite current weakness. Your second call from Baird initiating Microsoft coverage with an outperform, highlighting double-digit revenue growth potential. And finally, Morgan Stanley raising its price target on Nvidia to $220 ahead of earnings, citing strong demand signals. That name this morning down about 3%. Let's stick with tech. The Nasdaq 100 on track for back-to-back weekly declines as valuation concerns grip Wall Street. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, we've been spoiled. It's up and to the right pretty consistently over the last several months. What do you make of this move lower in the past 2 days? I think Mandeep Singh's got a problem with his microphone. Mandeep, you're going to unmute. You're going to make it happen?
Yeah, so look,
there we go, buddy. You're the tech analyst, Mandeep. Get the tech right. Come on.
Yeah, the unmute
Come on. There's a credibility
yeah, so,
gap there, sir. Carry on, Mandeep, please.
Look, when it comes to the CapEx spend, you've seen, these hyperscalers go from $50 billion in CapEx to over $100 billion, and now we are talking about over $150 billion in CapEx per quarter. So when you see numbers like this go up, the ROI question will constantly be asked. And then in that case, you have to look at the quality of the backlog that these companies are generating. And a Microsoft backlog will look far better than an Oracle backlog, for example. And that's where, you will see these kind of stock moves where investors will react because they are anxious about the ROI. But there is no doubt that the demand is there. It's just a question of who will do better in terms of realizing it sooner. I think Microsoft is an example that will realize it sooner, but Oracle, it may take longer. At the same time, the demand constraints, the supply constraints are there. And so from that perspective, the semiconductor infrastructure players still look pretty good.
At this point, the demand for some of the AI services is certainly very high, and there isn't enough supply to meet it. Is the demand for the debt tied to some of these companies, for the ability, the privilege of being able to pay for this, is that still as strong as it has been?
Well, so when it comes to the debt side, look, the neoclouds like CoreWeave, Nebius, and all these companies, they are the ones that have, a rental business where they're buying chips from NVIDIA. They don't have their cash. They have to raise money. And so the fact that they're able to do it and then translate that into a backlog, in fact, CoreWeave's backlog grew 3x this quarter. So from that perspective, again, as long as the demand is there, you will see these companies sign up long duration contracts. And when you see, an equilibrium reach in terms of the market dynamics, that's when the backlog growth will slow down. And I think that maybe at that point of time, the market will start to just kind of slow down in terms of new issuance. But there is no doubt that right now, power, infrastructure, these are real constraints. And so that's where you are finding all the financing you need.
Mandeep, thank you. Mandeep Singh there of Bloomberg Intelligence. Mandeep, thanks so much. Jay Goldberg of Seaport remaining cautious, writing, we think we're in a bubble. The level of exaggerated rhetoric around AI is steadily getting louder, and when the spending contracts, it will ripple across the broader US economy. Jay joins us now for more. Jay, welcome. I wanted to talk to you about this all week. That very odd, awkward question to Sam Altman about your revenues here, your spending commitments are right up there, and he turns around and just says, if you don't like the stock, sell it, someone will buy it. Jay, I just wonder if you saw that exchange, how uncomfortable it made you feel, and what it means for the broader ecosystem.
I did see that exchange. It did make me, it raised a lot of questions for me, right? I'm not as optimistic about near-term demand for services, about near-term demand for AI. Like again, I love the technology. AI is going to be important someday. It's just going to take a while. And my industry, semiconductors, are cyclical. They go up and for a long time, but they can also come down. And I think there are a lot of warning signs. There's a lot of froth in the system, and I think it's reasonable to be a little prudent here.
Jay, what's the number one warning sign for you? What's the big flashing red light that gets your attention, that you keep calling people up and saying, look at this, look at this?
I think it is these increasingly elaborate Byzantine financings around these neoclouds. Those are getting to be some pretty complex structures. CoreWeave and Nebius, yeah, they both have big backlogs that's growing, but like, what is the quality of that revenue that's coming in? How do we value that? I think there are a lot of questions around that.
Jay, is this a valuation story, or is this an existential story for some of the less solid players?
I think right now there are probably 200 neoclouds. I mean, the number I hear keeps growing. That's just a big number, right? So I'm worried about the sustainability of all of those. There will eventually be consolidation there. The debt markets will force that. I don't know exactly when that's going to happen, but I do think that it is unsustainable at this current structure.
Given the fact that there is a significant build out of debt and these elaborate financial structures, as you've said, how much will this reach into the echelons of NVIDIA and Microsoft and Alphabet, and how much do you expect this to stay relegated to the CoreWeaves of the world, the Applied Digitals?
So I think ultimately it gets felt all the way up. I think the problem I have with the current cycle is that it is so narrowly concentrated. If you look at all these deals that are taking place in the neoclouds, in the broader ecosystem, it all comes back to spending from the same 6 companies, right? Google's and the Microsoft, Amazon, Oracle, OpenAI, right? That's a very, very narrow base for this huge cycle. And I think ultimately what will change is at some point, some of those players will start to rethink their spending or shift it elsewhere. And that will sort of ripple. That's where I see the rippling taking place, is as those 6 spenders change their behavior. They can't keep spending like this forever.
Yeah.
And at some point that will alter the way this trade is taking place.
Jay, I've got about 30 left. I wanted to squeeze in this name, Apple. Jay, Apple has sat a lot of this out. Do you like that name for that reason?
I like Apple in the near term. I think their cycle is doing well. I think they have some good phones on the market right now. But that's to me a fairly short-term trade. Longer term, the AI questions for Apple are pretty serious. I just think they have time to address it. They still have a year or two to sort it all out, but they need to eventually get working on that.
Jay, thank you, sir. It's good to hear from you. Thanks for checking in. Jay Goldberg there of Seaport. Apple also down this morning by around 0.7%. The bigger hits, though, going to NVIDIA down by something like 3%.
Yeah, I think you raise a great point, though. This is sort of the bastion of stability at a time where there are questions around the debt structure tied to artificial intelligence. The bug was for Apple that they hadn't invested enough in artificial intelligence, and now, evidently, that's the feature.
That's what happens when you pull back by 2 to 3%.
Exactly.
The S&P 500. Story changes quickly. Bears celebrate 2 to 3% move after everything's gone up and to the right all year.
They've already all capitulated. They don't even exist anymore.
The opening bell is about an hour and 5 minutes away. We'll be catching up with Michelle Meyer of MasterCard on how plunging consumer sentiment has hit spending. Plus, the latest on Walmart. That name is down 2.7%.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Some weakness on the screen this morning. The opening bell about 60 minutes away. Equities down across the board. On the S&P, we're down by more than 1%. On the Nasdaq 100, negative by 1.5. In the bond market, 2s, 10s, 30s rallying this morning. That rally picking up in the last 90 minutes. We're down 5 basis points on 10s. We're down 4 on 2s to 354.94. Some pushback from Fed officials in the last 24 hours and some pushback from Andrew Honhorst of Citi just moments ago, Lisa. Yeah. Fed cuts are underpriced.
Yeah, and it seems like that's actually consensus right now for a lot of different investors who are saying they might talk a big game about being hawkish, but in reality, they are going to cut rates. And I have to say that the news over the past couple of days and building right now would actually edify that, because the stock market's not the economy. However, when the stock market goes down, that might reduce some of the fervor in the high-income earners that have actually been feeling pretty good because of their stock gains and spending a lot and supporting this economy.
CPI is difficult to collect. Got that. Okay. We're not going to have unemployment. Got that. We're going to get payrolls. Payrolls has been dreadful all year and keeps getting revised lower. So by the time they get to their meeting on December 9th, decide on December 10th, if all they've got to go on are these bad payrolls figures, who's got a stronger hand at that meeting?
Yeah, especially if you see any kind of wobble like what we're seeing right now continue. I will just say, what happened to when payrolls without the unemployment rate was useless? Remember when people would say that? They'd say, even Jay Powell was saying he was focused more on the unemployment rate because it was so hard to gauge the actual supply of workers at any given time. Now we're going to get the absolute number, and that's going to matter because that's all we have. I'm sorry, bear with me.
We don't know what the break-even rate is, so no one really knows what a good or bad number actually is on payrolls.
Moving target, so pick your poison, take a dart, throw it, and most people are saying it will equal Fed rate cuts.
It's going to be fun when we finally get that economic data from BLS. Equities down by more than 1% with your movers into the opening bell. Here's Yahara with more. Hey, Yahara.
Hi, John. What a morning. We start with Walmart shares. They are falling 2.5% in the pre-market on a leadership shakeup. Doug McMillon, the CEO, will be stepping down. He's been in the role for more than a decade, and John Furner, the CEO of Walmart US, will be taking the helm. This, of course, the timing is raising questions as it comes just ahead of their earnings report next week, plus this idea that Doug McMillon really brought this company into the digital age, transforming it into an e-commerce and digital powerhouse. So what will happen when he leaves? Meanwhile, we are tracking the deepening sell-off. We are seeing shares of Tesla, NVIDIA, and Alphabet all lower in the pre-market. It is these tech names, these AI darlings that are leading us lower as investors get hit by a perfect storm, whether it's skepticism around whether these AI investments will be paying off, plus uncertainty over the Fed and a lack of data that we've had. So we are on track to pile onto yesterday's losses. And not helping sentiment is Applied Materials and their earnings. Their shares are falling 7% in the pre-market after reporting another quarter of falling sales. This is a company that builds the machines that build semiconductors, and it says export curbs to China are hurting demand, and it expects that drag to continue this quarter as well. John?
Yahara, thank you. Thanks for the update. More from Yahara a little bit later this hour. Let's turn to the Federal Reserve. Hawkish comments from Fed Presidents Neil Kashkari, Beth Hammer casting down over the central bank's December meeting.
I think we need to remain somewhat restrictive to continue putting pressure to bring inflation down towards our target.
Joining us now is Bloomberg's Mike McKee. Mike McKee, that's a chorus of Fed hawks in the past day or so.
I don't know how much of a real dispute it is. It is people staking out different feelings about what the economy needs, as you guys were talking about. But there's still a month to go. And I wouldn't say necessarily that we're not going to get at least part of the jobs report and at least part of the CPI report. It is certainly possible. Plus, we should get the PPI, and that should give the Fed a pretty good idea of where we are. But this is what happened this week. The only person saying we're going to definitely cut rates is Stephen Myron, and we knew that. Mary Daly taking a middle route, but as you noted, Neil Kashkari switched from saying 3 cuts this year to maybe just the one that has passed and we won't do anymore. And that scared people in the market. You got 3 people who came out speaking this week who said we shouldn't cut at all. And so markets have at the moment priced out December, but as you know, we're going to have a whole lot of economic data released by the BLS and BEA in the next couple of weeks, and who knows what it's going to tell us and what these people are going to be thinking by the time we get to December 10th.
Mike, I kind of understand what it means to get part of the jobs report because one survey goes into one data point and another survey goes into one more. What does it mean to get part of the CPI report? What does that mean?
Well, there are a number of categories where most of the data would come in, and a good one is housing because the BLS can call home builders and find out what prices are. They can call realtors and find out what homes sold for. So they can get that data. They can get car data from automobile companies and automobile dealers. It's the consumer products that you find a lot of places that people are buying that they won't have. But the majority, well, not the majority, 38% is what I'm told, is data that they could get very easily or already would have in hand. So they could put out some sectoral CPIs if they wanted, and that might be something that they want to do in order to keep the series going, not break the series, as well as help the Fed.
Mike, thank you, sir. Mike McKee with the update on what we might get from the BLS and when exactly we're going to get it. This is complicated. You know how much? Like, just think about real life. How difficult it is to change someone's mind, okay? How difficult it's going to be to change someone's mind at the Federal Reserve when we're not going to have much economic data to do it.
Yeah, well, this, I think we found out that they don't really have an opinion on anything right now. So it seems like the mind aren't made up except for on a couple of corners of the Federal Reserve, the FOMC. So that's ultimately the question. But you're right. Is there a bias here? And if there is it going to pervade? And this is the bias that people think will pervade, which is it's going to be a Fed rate cut.
A Fed rate cut on December 10th.
And that's what Andrew Hollenhorst is saying, and that's what a lot of people in markets are saying, especially if you see what we have seen over the past couple of hours continue over the next couple of weeks.
I take the view that this is exactly where Chairman Powell wants us to be. Coin flip, two-way risk. And that was the intention of what we heard in the news conference at the last meeting.
Evidently, Operation Success, the Fed speak allowed people to really get around the idea that maybe there really is uncertainty and it really will be a coin flip.
It is far from a foregone conclusion, and that's exactly where he wanted it to be. Let's turn to the consumer. Wall Street preparing for retail earnings next week. Michelle Maher of the MasterCard Economics Institute writing, hiring has slowed, but firing remains low. Weaker consumer sentiment doesn't seem to be showing up in aggregate spending. Michelle joins us now for more. Michelle, good morning.
Good morning.
Some of the spending behind the Kashkari switch in the last couple of weeks, the last several months. Are you seeing robust spending just continuing at a steady level, or is it picking up?
So it's been quite interesting to monitor consumer in real time, especially in the absence of the Census Bureau data as well, talking about the lack of data. So for us, we've been really, really squarely focused on what we're seeing in terms of real-time spending metrics. And it's been robust. So when we look at October, our spending pulse measure, which represents payments, spending across all different payment types, so it's comprehensive, is at 3.5% on a year-over-year basis for October. So it's strong. It's actually an acceleration from September. When we dig even deeper and look at the weekly data, the month started off a little bit softer, but the second half of October was this really, really meaningful acceleration across a number of categories. So it is hard for me to see an economy that is not continuing to move forward in a world where the consumer is still so engaged.
How much do you get a sense that the increase in spending is tied to more goods that people are buying versus increased prices of those goods?
So it seems like it's probably a little bit of both. So we are seeing, particularly in October, there was quite a lot of strength in apparel spending. That was one of the categories that really stood out with strength, and that could be partly pricing. We know that there's a heavy import share there. Tariffs are being passed on to some degree, presumably modestly. We'll know more once we eventually get some CPI data. But so I think it's a little bit of a pricing story, especially relative to last year when it was a heavily disinflationary, even deflationary economy for a lot of these goods.
I'm just wondering whether there also has been this concentration in the upper income sphere, if that continues to be driving all of the increases in the strength that you're seeing, and how much that's been on the heels of what's happened in the stock market. I mean, could you draw a direct correlation between spending at the high end and what we've seen in AI stocks?
Yeah, I mean, so look, I mean, the upper income consumer always has a greater cushion. Right, they're relying on what's happening in the labor market, of course, in terms of their income, but they have this buffer from their balance sheet, and their balance sheet has been very supportive when you look at the move in the stock market, you look at the appreciation of housing assets as well. So they have a positive wealth effect that they can realize. I don't think day-to-day fluctuations are going to make much of a difference, right? The literature shows that consumers respond over a period of time of wealth accumulation, and that's when they start to adjust their behavior, when they feel like they have a persistent wealth gain. But it can impact confidence on the margin, perhaps.
On occasion, we've seen company after company come out and say they're struggling to pass on higher costs to the consumer. We saw that from some fast casual restaurants. I think Chipotle is a great example of that.
Right.
Tried to put up prices like 1% in California, and there was pushback. Are you seeing signs of the same thing?
I'm seeing signs that this is a consumer that is very, very savvy right now. Right, the consumer knows that they have the decision to make as to whether or not they want to absorb those higher prices, because there's so much price discovery that's happening right now, especially in a world where there's so much technology, there's so much e-commerce, and there's so much information out there. So it's no longer the case that the consumer walks into a store and says, this is the price, I must buy this if I want this good. They can search, they can figure out how to optimize their purchasing power. And I think we're seeing that in a significant way right now, especially after we're coming off of the pandemic-induced price increases, which took them for a shock because there was such a long period of low inflation. All of a sudden, prices jumped up in the pandemic. They've responded to that, they've reacted to that, and they remember that. And I think that is influencing how much consumers are willing to accept pricing now.
How difficult is it to speak about the consumer in aggregate, given the fact that you're seeing dispersions in income, but also in regions?
Yeah.
Different regions, different political groups. There just seems to be these massive divergences that create a real noise underneath the averages.
For sure. That's always the case. I think because we have this unique data where we can cut the economy in a quite a granular way, I think it does provide additional perspective for us, and that's quite helpful. So on a regional basis, the Southeast has been outperforming for some time. So if I look specifically at October, we are seeing particular strength in Tennessee, in the Carolinas, in Florida, the fastest acceleration of spending across a variety of categories. And that's consistent with what we've seen in terms of job creation as well. Whereas in other parts of the country, certainly it's a bit softer. Parts of the Midwest over the last few years has been a bit softer as well.
Can we do Fed guesses with you still?
Yeah. I mean, what economist doesn't like that game?
Of course, lean in. Best guess for next month.
I think more likely than not, they'll likely lean in the direction of cutting. But to me, it's the characterization of the cut that I think ultimately is going to get them around to moving and have that consensus on the Fed. And what I mean by that is that it will not be described, and frankly shouldn't be described, as an easing of monetary policy, an economy that needs lower interest rates because there's something really problematic in the economy. I think it will be discussed as the fact that we are still removing the restrictive policy that was put in place when we had a much different economy. And now the economy has changed. We've learned a lot about pricing. We've learned that the concern over tariff-induced shock to prices didn't play out, that it's going to be slower, that it's going to be more measured. And in the interim, we've seen a labor market that has slowed down in terms of the churn, which also means you don't need as restrictive policy.
Michelle, good to see you, as always.
Always good to see you.
Thank you. Spending looks good, apparently, over at MasterCard. Michelle Ma of the MasterCard Economic Institute sharing some of that data with you. On tariffs and the pass-through, Ambassador Greer speaking to the American press today. Time to take off some tariffs on products not made here. Banana, coffee, cocoa. Those tariffs and that relief is mutually beneficial.
Yeah, and I'm actually really interested in some of the relationships on the back of that. We just heard that Argentina and the U.S. are normalizing relations, are creating some easier ties there. I wonder what other kinds of agreements there are to try to lock in some additional kind of geopolitical issues, in addition to lowering the tariffs on banana, coffee, and cocoa, which will be welcome to anyone who is waking up this morning.
A lot of people have been complaining about the price of coffee.
Yeah, well, I mean, you've got to be awake to really keep track of this all.
Very expensive. Equity session lows were down 1.2% on the S&P 500. With an update on stories worldwide with your Bloomberg Brief, here's Yahara. Hey, Yahara.
Hi, John. Verizon is discussing plans to announce job cuts that could downsize the company by as much as 20%. The planned cuts could impact up to 20,000 workers and are part of an aggressive strategy to reclaim market share. The Wall Street Journal also reporting the company is planning to convert 200 company-owned stores to franchises. Meanwhile, Amazon and Microsoft are lining up against NVIDIA. The Wall Street Journal reporting the two companies are supporting legislation that would require chip companies to satisfy U.S. demand before sending products to China and other countries subject to arms embargoes. NVIDIA is fighting the legislation. And baseball's most valuable players have been crowned. In the National League, LA Dodgers phenom Shohei Ohtani won his 4th MVP award and 3rd in a row, winning in a unanimous vote. In the AL, Yankees slugger Aaron Judge won his 3rd MVP, beating out Mariners catcher Cal Raleigh. It's the first time in history that both MVPs repeated in back-to-back years. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead, plus Mana Mahajan of Edward Jones on why the equity pullback could be a healthy sign from New York City. You're watching Bloomberg TV.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
When it comes to tech, you're seeing large issuance come out. Investors still say they're going to be able to do what they're doing. That's a lot of positivity coming from these companies, but yet at the same time, we're hearing builders can't deliver on data centers. There's not enough energy and power for some of these data centers. So I would be a little more skeptical than maybe the average investor.
What do they say? Price sets narrative. A lot of bearish takes this morning. Given this tape right here, we're down 1% on the S&P, we're down by 1.6 on the Nasdaq, on the Russell. Small caps down by 1.4. As we count you down to the opening bout with this sell-off in mind, look ahead to today and next week. Some Fed speak today, Schmidt, Logan, Bostic. Tuesday, this is when earnings start to pick up. Home Depot. Wednesday, you're going to hear from Target. You'll also hear from Nvidia later on in the afternoon. And on Thursday, Walmart. Walmart in focus now with a change to leadership as well. That is one to watch.
Yeah, especially because this morning Walmart announced that Doug McMillon, the CEO, who's 59 years old, is retiring. The head of Walmart U.S., John Furner, is named as a successor coming into force. We do expect Walmart CEO Doug McMillon, who is stepping down, to remain on the board and stay there until 2026, raising a question of the timing of why now, especially given the fact that Doug McMillon was widely considered to be quite successful in terms of turning around some of the strategy at the U.S. biggest retailer.
So look for Walmart on Thursday, and I'd also say this on that calendar. Going to fill some gaps on that calendar in the next few days when we find out when that payrolls report for September is going to drop. So watch this space. Let's turn back to the equity market sell-off. Concerns about tech valuations putting a dent on equity futures. Mona Mahajan of Edward Jones writing, the fundamentals of the AI story, in our view, remain intact. And after a powerful rally since April, we believe a reset for these names could be healthy. Mona joins us now for more. Mona, welcome. What's healthy about this move?
Yeah, thanks, Sean. Look, after a 55% rally in the NASDAQ since those April lows, we went up almost in a straight line without a 5% or higher correction. So in our view, could we be due for a period of profit taking, a little bit of consolidation, especially as we're headed into year end and investors are thinking about where are their gains? They're also thinking about positioning for 2026. Now, all that being said, healthy reset, yes. Is the story over? We don't think so. But the case for diversification, we think, does become even stronger in the year ahead.
Mona, what is a healthy reset? So this is a 3% pullback on the S&P. What's a healthy reset?
Yeah, look, we know in any given year, corrections in the 5, 10, 15% plus range for those higher beta parts of the market are the norm. And in fact, this year we got one pretty severe, almost 20% downturn in the S&P 500 earlier in April. We haven't gotten another one yet. But what gives us some confidence that a pullback or correction doesn't turn into a deep or prolonged bear market? Well, a couple things. One, usually those occur historically when the Fed is aggressively raising rates. And in fact, during the dot-com bubble in the late 1990s, that's what kind of killed the tech rally in those years, of Fed aggressively raising rates, or you're heading into a recession or a deep downturn. And we don't see either of those scenarios on the horizon. So it gives us some comfort that these pullbacks and corrections won't turn into something more nefarious and maybe provide some opportunities.
Mona, this maybe is in the stock space. Do you think that it's a different story this time in the credit space, given that suddenly we're seeing a different tone, particularly when it comes into financing some of the AI build-out?
Yeah, it's a great call out. And look, that has been part of what has been weighing on these stocks over the last few days. Certainly, we are seeing companies like Oracle, which, by the way, were not part of the Mag 7, were not as cash rich as the Mag 7 were, and in fact, were more debt burdened heading into this cycle. They have taken on more debt, and their leverage ratios are not looking as attractive. And you can see that in some of the CDS reaction for that name in particular. But more broadly, we are seeing companies like Meta, like Google, take on more debt to finance some of this tremendous CapEx spending that they've projected for 2026. Over time, could that weigh on margins and free cash flow? Potentially, yes. And so I think that is part of the new narrative that has been emerging. Companies raising debt, companies going from being asset light to asset heavy. And I think that shift may weigh on some of the valuations we've been seeing.
How does that affect your investment strategy when it comes to corporate credit, when it comes to the debt equity mix in your portfolios?
Yeah, certainly from an equity perspective, what we are saying is it is important to have exposure in the U.S. to both the large cap space and the mid cap space, which we think does have more scope for valuation expansion potentially and some catch up. From a sector perspective, we like both growth and value parts of the market. So if you are adding new money, putting new money to work, sectors to complement or alongside some of the tech and AI. And to your point on credit, we continue to favor parts of the investment grade market. We are not really extending duration at this point, given some of the moves lower in yields. And we continue to see neutral on credit quality. In fact, a little bit cautious on the high yield space here. So broadly, we still like equities versus fixed income. Within equities, we want to be diversified and probably shorter duration on the credit side as well.
Mona, appreciate the update. Thank you. Mona Mahajan there of Edward Jones. Going into the opening bell with equity futures down across the board here. The S&P 500 down by close to 1%. Lots changed this week. Fair bit of pushback from the Federal Reserve on market pricing for interest rate cuts in December, and a bit of a pivot I think we've got to track from this administration as well. On tariff relief, on tax rebates, there's a change in tone coming from the White House, and it started over the weekend and it's picked up through the trading week.
Yeah, there are a number of different strains here, and it's hard to put them all together. On one hand, you've got the Fed pushback, the idea that maybe a rate cut isn't warranted based on, guess what, inflation. Then comes the response from the administration on, guess what, inflation, cost of living, this concern that the administration really is emphasizing after the midterm elections that really highlighted that as an issue. And then you've got the tech overlay, this question of, is this time different, with debt financing really in the forefront of some of the wobble that you are seeing in some of the big tech names, a question of how much tolerance there is by credit markets to finance this.
That's one to watch going into the opening bell. These headlines just crossing from the U.S. Trade Representative, Ambassador Greer. Ambassador Greer saying the U.S. to lower the tariff rate on Swiss goods to 15%. Switzerland agreeing to invest $200 billion in the United States economy.
So this comes after a lot of disagreement, and I'm sure it was welcome for Switzerland. I want to understand more about some of these investments in the United States that we're hearing from a lot of different companies, so countries. So let's wait for more details on that.
It's been a long week, hasn't it? Hey.
Can you tell?
For you and I both. Coming up on Monday, Russ Kostrick of BlackRock, Torsten Slock of Apollo, Henrietta Trace of Veda Partners, Abigail Watt of UBS. Have a wonderful weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Day 5 at the NITO ATP Finals. Carlos Alcaraz clinched the year-end world #1 ranking with a comfortable win over home favorite Lorenzo Musetti. The victory was his 70th so far this season. That's a career high for the 6-time major champion. Earlier, Alex de Minaur secured his spot in the semis with a crucial win over Taylor Fritz. He'll face Yannick Sinner for a spot in Sunday's final.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top of the bottom, make the sushi shape more beautiful. 3. Then, you know, I mean, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is the 1 to 6.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
We have a sell-off underway, 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, stocks sliding into the weekend. NASDAQ futures leading the decline as mounting Fed fears fuel a retreat from risky assets.
And that risk aversion sweeps across markets, hitting crypto too. Bitcoin falling below $95,000 for the first time in 6 months.
Plus, the end of an era for the world's largest retailer. Doug McMillon is stepping down as the CEO of Walmart.
It's already kicking off to be an ugly day, as you pointed out, especially in tech. But I'm looking at one specific chip maker this morning, Applied Materials, because they have their own thing going on. It's not just the macro that's making them sell off 6.6% in the pre-market. They saw sales that declined last quarter. They predicted another drop in the current period, though the company says that demand will improve in the second half of 2026. But that's not enough to save them this morning.
No, off almost 7% in the pre-market. Walmart CEO Doug McMillon will retire in February. The board has elected John Furner, who's been at the company for over 30 years, to succeed McMillon. And the shares are down in the pre-market, just 2.5%, of course, in a market that's falling itself.
And let's get more on that story itself, Matt. Bloomberg's Emily Cohn covers retail and joins us for more on Walmart. Emily, do we know why this transition is happening now?
Thanks, Danny. This isn't really a surprise. I think most people who know have been following Walmart. Furner has been the natural successor to Doug. The timing of it, not so much of a surprise, and the fact that it's Furner, also not a surprise. He's sort of been Doug 2.0, waiting in the wings for a while.
So in terms of performance, the shares have more than doubled in the past 5 years. I like to look at them compared to Amazon, which has only done half as well. McMillon has put this company in a good place.
Yeah, shares have quadrupled under McMillon. So some things that he's done in the past 10 years, he's transformed the stores, made them much nicer places to shop. He's taken Walmart into the internet age, become an e-commerce giant, to your point, to compete with Walmart, and they're very competitive with Walmart on e-commerce. He's raised pay for employees. He's made it a much more competitive place to work. And he's overseen the company through a lot of ups and downs. There have been labor fights. He's seen it through the pandemic. He's had a wild ride.
And I mean, just to that point, they were also one of the first companies to come out and say, look what we're doing with AI. We found use cases for it. It's also a moment where a lot of these big companies have started to announce layoffs. What does the future look like for John Furner, especially as regards to this? Is this a turning point for Walmart?
I think that's a really good point. I think Doug said it in the statement this morning. You know, Doug's very much credited with bringing Walmart to the internet age, and he calls out Furner taking it into the next era, the AI era. We've already heard the company. Doug has said that AI will impact every job. We've seen it in the past couple of reorgs, and I think that's a good point. This is likely a turning point for the company.
All right, well, I'm sure 2.1 million employees are going to be watching this very closely. Emily Cohn covers Walmart for us on the Bloomberg News side. Now, Warner Brothers is climbing pre-market the shares as the Wall Street Journal reports that Paramount, Netflix, and Comcast are preparing bids for the company. Bloomberg Tech's co-host Caroline Hyde joins us here at the desk, and this is a company that we're kind of on jobs watch, right? Because any kind of deal will result in still a great payout for David Zaslav. He's made that his priority, but maybe it cuts for thousands and thousands of jobs.
Look, this is November the 20th that we're eyeing. This is when the bids need to be in. Already we've had 1, 2, 3 bids coming from Paramount, Skydance, and they're up to $58 billion, which is more than where we're currently trading in terms of Warner Brothers Discovery. And boy, it's leapt since that first talk of being purchased was announced back in September and reported. But I think you're right, we are on a lot of watch as to how this all shakes out. For the second time, we see a rearrangement with David Zaslav's payout. Now, initially, there was going to be a spin. We knew that they were going to be separated. You're going to have the streaming, you're going to have the movies on one side, that would be Warner Brothers, and then on the other side, you'd have Discovery Global, which would be all the TV, basically, CNN, Food Network, and initially, it was going to be that stayed, and Warner Brothers that was spun off. Now they reversed that. Warner Brothers is one that stays. David Zaslav was always going to stay there and lead it up until all the way to potentially 2030 now, is this new pay arrangement. But what if we get the auction really showing good clout? What if the auction sees that Comcast, Netflix, they want really the streaming, the movie side of the business? Paramount Skydance wants the whole darn thing, but as we know, Paramount Skydance is already laying off people. So a lot of this is going to come at the expense of jobs. I think you're entirely right.
Just in how these different things are being cut up or not cut up, I mean, does Paramount feel then more like a more natural buyer for Warner Brothers Discovery if they want the whole enchilada? They're not just looking at taking its streaming business, for example.
I suppose it's where you think the value lies, and whether 58 billion or a little bit higher than that is what you should get for the whole amount, or whether actually by slicing and dicing it, you could get an even more rich valuation coming from a Netflix, coming from a Comcast that just wants the stuff that's doing well. That's the bit that David Zaslav, of course, unsurprisingly wanted to stay and run. It's about the movies, it's about the history. That's why they were going back to the name of Warner Brothers, because that's sort of really where you think about the iconic days of cinema in its first iteration. But then, of course, streaming has been doing well. They have been adding more people. HBO Max has been doing well. Look, Disney Plus, we just saw yesterday, has been doing well on its streaming business too. So they're the sort of firing on all cylinders. By chopping it up, you're actually going to get more bang for your buck. Who knows whether someone wants to buy the entirety of TV? Maybe someone wants to pluck away at CNN. Maybe someone wants to take some other parts of the business. It's really interesting as to what this auction is going to shake out.
And the saga continues. Caroline, thank you so much. Bloomberg's Caroline Hyde. Now, elsewhere, Applied Materials, we mentioned at the top of the show, they are falling after seeing their sales decline, despite the fact that they are predicting a turnaround next year. Shares down nearly 7%. Bloomberg Tech co-host Ed Ludlow joins us now. And Ed, I guess it might be a little bit hard to distinguish because all of tech is selling off in a big way today. So just how negative were these results that, again, are resulting in the reaction we're looking at pre-market?
Negative, well, there's no good news to reward them, right? Applied Materials has a China problem. If you look at an SPLC on the Bloomberg, 20% of the revenue is coming from TSMC and almost 20% coming from Samsung. And they cannot send their chip-making equipment into China in particular. Gary Dixon, the CEO, told us in an interview, that's the issue here. Those fabs are a Taiwanese company and a Korean company, but they still have a footprint in China. And that overhang is still there. So they'll have 2 consecutive quarters of sales declines with improving picture next year. And it makes you realize, if you run a wafer through a fab, it has many stages. Applied Materials is at the first stage where you layer the wafer, and it's at the end when you polish it. They are needed. They are essential. No one questions the big picture of what's happening in chip manufacturing at the cutting edge and the supply constraints that are there. It's just a China market issue.
Well, this is, to me, and this reminds me a little bit of what we had yesterday with the memory chip makers, right? It's a commoditized piece of the process, and you had bad earnings out of, I believe, a Japanese company, and that brought down the entire, but we're gonna need these commodities, especially if we continue to refresh products at the pace that NVIDIA has been.
Well, in that specific instance with Koisha, which impacted some of the American names like SanDisk, for example, we're distinguishing between highly commoditized cyclical markets in legacy memory separate from high bandwidth memory that goes into data centers. And actually, that probably makes it a more interesting economic indicator. You know, before all this AI stuff, we used to track the memory markets because they were cyclical and highly commoditized. It gave us a lens into all sorts of end markets and the health of the global economy. So that was an interesting warning signal to track.
I mean, I made that point because I've learned all about this from you, Ed, so I appreciate the education in high bandwidth memory over the years, as well as NAND and DRAM. In terms of the refresh cycle, though, it's been pretty quick, right? NVIDIA goes from Hopper to Blackwell to whatever's next. And this is an interesting argument that Michael Burry has been making. If the cycle is so fast, this refresh cycle, why are big companies like Meta lengthening out the accounting standards that they have for useful life from these products?
Yeah, I'll go with NVIDIA's answer to that question, which is NVIDIA commits to an annual cadence of a new GPU. So every year they have a new one. But they will tell their partners and customers 5 years in advance what their plan is. That gives the Meta, in whatever example, time to plan that data center capacity, and also know that if they build a data center, 12 months from it starting to operate, the design of the technology allows you to pull out the tray, swap out Blackwell, the prior generation, put in the new generation. To NVIDIA's mind, that's what's happening. At the end of the day, next Wednesday, when they report earnings and they give a forecast for the current period and maybe beyond that, either they're right or they're wrong, because it will show up in their sales if people are willing to upgrade from prior generations of accelerator to a new one.
All right, Ed, thank you so much for that. That is Bloomberg Tech co-host Ed Ludlow on a very bad day for tech. Let's look at the overall market at the moment, because we're on track for 2 weeks of consecutive losses. For the S&P, that would be the first time it's done so since March. We're down just under 1% for the futures session. NASDAQ 100 futures, those are down 1.4%. For the NASDAQ, it would be the fourth consecutive day of losses. So it's tech that's been underperforming, whether it's the Fed, whether it's been AI fears, lots of bearish narratives swirling around markets.
Yeah, there is a lot going on. Let's take a look at some of the individual movers on our radar. We have NVIDIA down, we have Tesla down, we have Palantir down. So you can see the tech trade, as you pointed out, is really weighing on it. And of course, some of these are incredibly heavy companies,
yes,
really weighing on the index.
Yeah, man, Palantir, difficult run since their earnings. One of the rare gainers today, though, Gap, it raised to a buy at Jefferies. They said that there were encouraging trends that should help top and bottom line growth.
Merck & Co., American Merck, agreed to acquire the biotech company Cidara Therapeutics, which is developing a flu treatment. And as a result, Cidara shares, the whole company's market cap has more than doubled.
Coming up on the show, Bitcoin on the verge of gains for the year. We're going to talk crypto. That's coming up next. You're watching Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Let's get now to high interest. Look what's making headlines around the world. Iranian forces have seized an oil tanker sailing in the Gulf of Oman, steering the vessel towards Iranian waters after it passed the Strait of Hormuz. The ship lost contact with its manager, and U.S. officials say the seizure violates international law. It's the latest sign of rising tensions and adds to concerns that Iran is once again targeting merchant ships as it becomes increasingly isolated by its conflicts with the U.S. and Israel. President Trump is moving to slash food tariffs and strike new trade deals with Argentina, Guatemala, El Salvador, and Ecuador, all aimed at bringing down grocery prices. The White House says the cuts will target everyday staples like beef, bananas, and coffee. The push comes after Democratic wins in key local races that focused on the lack of affordability. Meanwhile, U.S. Trade Representative Jamieson Greer says the U.S. and Switzerland have essentially reached a trade agreement to lower tariffs on Swiss goods to 15%. The White House plans to reveal details on that today. And Brandon and Kyle Lutnick are putting their stamp on Wall Street. The sons of Commerce Secretary Howard Lutnick now run Cantor Fitzgerald, and they're on pace for a record $2.5 billion in revenue this year. The bank has surged to the top of IPO and crypto deal rankings and has expanded across the U.S. from New York to Abu Dhabi. The brothers dismiss talk of Washington favoritism, saying Cantor's surge stems from smart bets on tech, renewables, and digital assets, not, Danny, not closeness of their father to President Trump.
Okay, that's according to the Lutnick brothers. Let's move something else that is closely associated with Wall Street, but some of the crypto-related stocks this morning, they have been plunging as Bitcoin falls on this Risk-Off Friday. Joining us now on this and other stories is Bloomberg finance and crypto reporter Emily Mason. Emily, it's a feeling that cash is king once again today. So what's behind some of the deterioration in sentiment that we've seen for some of these companies that are now trading below the levels that they were post-Liberation Day?
Yeah, I mean, I think with the crypto markets, especially Bitcoin and Ethereum and the altcoins, sentiment changes can show up more dramatically just because there aren't as many institutional players involved, and that kind of shows up as dramatic swings, and then that bleeds over into equities that are linked to the crypto markets.
I started out covering Bitcoin as not a joke, but as kind of a cultural exercise 12 or 13 years ago by only using Bitcoins instead of dollars for my daily transactions over a couple of weeks. It was pretty fun. But back then, the whole culture, we would meet in bars downtown, and everything was, libertarian or kind of a revolutionary kind of feeling. A lot of it was offline. That has shifted so much to the sort of corporate-based, Washington-centered, we want to be regulated ethos in crypto. Everything has flipped 100%.
Yeah, I mean, Bitcoin, people who really believe in it, Bitcoin maxis want it to be used for everyday transactions, but one of the issues is like the price is volatile, so you don't want to pay for something today and then, the Bitcoin is worth a lot more and you overpaid for it. So that's kind of where like stable coins came into play, because they're going to be worth today what they are tomorrow, so you can kind of trust it as an everyday currency.
Well, how much of that is exemplified by Jack Dorsey, that's starting to steer Block more towards stable coins and away from Bitcoin, who he was the evangelist for Bitcoin, and exactly kind of what Matt was talking about.
He was the guy that we were hanging out with in bars downtown,
No, and he still is like a huge Bitcoin believer, and I think their end goal is still that like Bitcoin is a currency that people are using every day. It's still something that they're investing in, but I think this is them recognizing that the momentum in the market right now is around stablecoin, and that's what people want to use, so they kind of need to support it, and that's kind of a big break. Like Jack's X bio is still no state is the best state, and like that's still the world that he's kind of working towards.
No state is the best state. There's no government like no government. Used to be the bumper sticker on my old Volvo. But crypto has moved from like rage against the machine to just a big piece of the machine, right?
I mean, that's kind of the direction it's had to head in. Like the stablecoin issuers are applying for national trust bank charters. They're trying to comply with the Genius Act. Like they're really trying to like move under the regulatory umbrella. And that's kind of stands in contrast to the original ethos of Bitcoin, which is sort of decentralization. Like, we don't really need to trust each other. We can rely on code. And that's very much Jack's personal philosophy. And so I think they probably see adding stablecoin support as potentially a stepping stone. And they've said that Cash App and Square are going to stay Bitcoin first by design.
Hey, Emily, thanks for joining us this morning, and a fantastic story on Jack Dorsey. Really recommend everyone go and read it. That's Emily Mason from the Bloomberg Crypto team. And Bitcoin is falling this morning, trading at its lowest since May, reflecting what we're seeing in markets elsewhere. For the NASDAQ, this would be the fourth consecutive decline. Matt, it is this feeling that dip buying, which has worked so well this year, kind of has had its first real test, that buying the dip this week so far hasn't paid off.
What is it? The first back-to-back weekly losses since June, right?
Since March for the S&P 500.
All right, since March, so going back even further. Coming up, Morgan Stanley's Jim Caron says 2026 will bring a stock rebound driven by tax boosts, corporate investment, and AI-fueled productivity. We'll ask him about the depreciation schedules. This is Bloomberg Open Interest.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China? When they wanted to poke holes in the relevance of something. Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Famed Big Short investor Michael Burry is questioning whether big tech's profits are overstated. He alleges that lengthening depreciation schedules from big AI spenders is, quote, one of the more common frauds of the modern era. He estimates that hyperscalers will understate depreciation by $176 billion through 2028. Joining us now is Morgan Stanley Investment Management CIO of Cross Asset Solutions, Jim Caron. Jim, maybe it's telling that he thinks this, but he had to close his hedge fund. Even so, tech used to be these magical unicorns where investors didn't even need to think about the balance sheet except to say, hey, your cash is piling up nicely. We would like some of that. Is that era permanently over?
Well, first of all, good morning, and thank you for having me on your show. I don't think the era is permanently over, but I do think that we're moving into a later cycle of this where you're seeing debt become a bigger part of the equation. It's not just funding things and investment out of cash perpetually. Now I think debt is playing this. This is a natural part of the cycle. But what we also have to recognize is that when some of these big tech companies, like we've seen over the past few weeks, raise money, they are going to spend that money. They are going to continue with the business investment, with the CapEx. So that they're not raising this money just to save it, right? So essentially, if we think that GDP growth was driven by, in many ways, CapEx and business investment from these large tech companies, I still think that's on the table for 2026.
It is telling, though, that these companies, like Meta, are saying, hey, these chips and servers that we thought previously would be only useful for 4.5 years, now maybe they're going to be useful for 5 or 6 years. And it just doesn't jibe with the way I think of the modern technology refresh cycle, right? I'm not going to buy an iPhone as a tech company and then use the same one as 5 more come out. I'm going to buy a new iPhone every single cycle.
Right. So I think what you're saying is that we're violating Moore's law by saying that essentially that things do become more efficient over time. And I think that's somewhat speculative. People talk about the shelf life of some of these technologies, and I think they always tend to overestimate what these things are. New innovations come up all the time, and I think that what people are betting on, what investors are betting on, is that many of these tech companies and even the end line users of these are always going to want to have that technology efficiency and want to stay in front of it. And I think that the stock market will penalize the companies that aren't really doing that. So I think the investment's going to be there. I don't see that going away anytime soon.
All right, Jim, you're going to stick with us. More to discuss, especially as this entire sector sells off this morning, but a lot of narratives all pushing us in the bearish direction, though. A check on futures this morning ahead of the opening bell, only under 5 minutes to go until then. Still a tough session, a tough way to end the week. We're down nearly 1% for the S&P. The NASDAQ, Matt, falls 1.4%. It's not just the questioning of the AI, it's also how loud hawks are right now at the FOMC. Yeah. That's really punishing the market.
Absolutely. Those who are counting on rate cuts are counting on them less and less. If you take a look at WIRP Go, or if you take a look at how much the market is pricing in, it's far fewer than 25 basis points at the December meeting. We come back, we're going to have the opening bell from the NYSE and the NASDAQ. This is Bloomberg Open Interest.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Moments away from the start of trading, and we are prepared for a sell-off again today. A drop for the week. 2 weeks down back-to-back. It's the worst that we've had in terms of consecutive weekly drops since at least the beginning of the summer. S&P futures down 1%. NASDAQ futures down 1.5%. The small caps, as the Fed gets increasingly hawkish, also getting hit down 1.5%. It's like power day when it comes to ringing the bell. We got a couple of power operators here. Vertiv ringing the bell at the New York Stock Exchange. I'm pretty sure based in the great state of Ohio, because we had that CEO on before, and I think he was out of Dublin. And then you've got Terrestrial Energy, which the ticker is IMSR for an integral molten salt reactor, which sounds like awesome power technology. The AI power trade, Danny, the AI industrials trade all took a huge hit yesterday, and that looks to be continued today.
Yeah, it absolutely does. And we have some weak earnings that have really just fed into that. Applied Materials being among them, shares down here at the open more than 7%. They saw sales decline last quarter. They also predicted another drop in the current quarter. They did say that demand will improve in the second half of 2026, but there's just so much skepticism right now, Matt, that that's not enough to revive these shares.
All right, we also have news in, I guess, the old economy, although CEO Doug McMillon at Walmart has quadrupled the value of this company under his leadership by bringing it into the new economy, bringing it online using AI and such. He is going to retire now that he's approaching the ripe old age of 60. He steps down in February. The board has elected young John Furner, only 51, who has been at the company, though, for over 30 years to succeed McMillon. So right now, Walmart shares down 2.8%, but it's a down market. I'm not sure how much you can read into that. Let's bring back in Morgan Stanley Investment Management CIO of Cross Asset Solutions, Jim Caron. And Jim, we touched on the depreciation schedule, and I'm sure what you can get back to AI, but I just want to ask quickly your view on the Fed. It seems in a little bit of disarray, speaking of the FOMC, right? It doesn't seem as though Chair Powell really has control of the committee right now. What do you expect in December?
So I expect them to cut 25 basis points. And quite frankly, I think the market's getting this wrong. And I know that some of the statistics for a rate cut are starting to fall in, for the December meeting. But my view on this is that when the government reopens, which it's reopened, and the data starts to come out, it is only going to bolster the argument for a rate cut. If the Fed has been cutting rates in the past when the data wasn't as weak, when I think the data does come out, I think it's going to show substantial weakness, particularly in the labor sector. I mean, we've seen all these announcements for layoffs and things like that. So how do you sit on the Fed in the face of all that, knowing now that the labor market is absolutely deteriorating? And inflation doesn't seem to be running out of control. In fact, the latest data print that we've gotten, has been a bit softer. How do you not, if your dual mandate is labor market stability and price stability in inflation, how do you not continue to cut interest rates in this environment? So I'm really pushing back hard against this view that there will not be a Fed rate cut in December. I absolutely think that there will be.
Maybe the way that you don't cut, Jim, is because you're trying to show that you won't cave into a Trump appointment who will be pushing for cuts come 2026. That's not necessarily my view. Krishna Guha at Evercore has been writing about this, some very strong words, saying the debate in and around the Fed has taken a worrying turn, that usually the process of building consensus has broken down, and says this feels like a dress rehearsal for 2026 with officials digging in against a default to cut under a Trump-appointed chair. Jim, could that be behind some of the hawkishness we've heard from Fed officials, and what would that mean for next year?
So I mean, this calls for speculation, right? I think that there might be some posturing with some Fed officials around this before the December meeting. But at the end of the day, the Fed is framework driven. Their primary framework that they look at is something called the Phillips curve, which is the relationship between the unemployment rate and wage inflation. If the unemployment rate is going higher and there's more supply of labor coming into the markets and wage inflation is coming down, then therefore goods inflation will also come down, then that is a signal for them to cut. Their framework will be flashing red for them to cut interest rates. So whatever the posturing is, they would have to really bring a very good argument as to why they're going to abandon that previous framework. So I don't quite see it. Maybe it's just talking rhetoric, but I don't quite see it, and that's why I'm very confident about a rate cut in December.
What's your take on the broader economy, Jim, and credit right now? Because we've seen some blow-ups, cockroaches. I'm pretty sure Jamie Dimon was referring to them as, although the private credit guys that Danny has been talking to are all saying, like, we're so good at
We're not the cockroach,
risk.
you're the cockroach.
There's no cockroaches here.
Yeah.
But the consumer has had a really tough time. More than 40 million on food stamps. A lot of them didn't get all of that food support through the shutdown, which was the longest in history, and we're starting to see more auto delinquencies than ever before since record keeping began. Isn't this a concern?
That's absolutely a concern, and it's why the Fed should be cutting interest rates. So the way that I would think about this is effectively we are in a soft patch for the economy right now. We have, by the way, been in a soft patch for the last several months. And Danny and I have spoken about this. The market's not the economy's not the market. So essentially the markets had powered ahead despite some of the weakness that was already existing in the markets, in the economy. So sometimes the markets and the economy do overlap and intersect, and that's what's happening today. As we get the data releases, people are jittery, people are nervous, prices and valuations have moved very aggressively higher, particularly in the third and fourth quarter, which means that the markets are fragile to any bad news. And that fragility is what's being seen right now. Now, the question is, does that change the trend going into 2026? And no, I don't think it does. Because most economists are still forecasting higher GDP growth in 26 versus 2025. And I think that's going to support earnings. Also higher productivity. So a lot of the onboarding of this CapEx and technology and everything else is bringing higher levels of productivity into the markets. This labor force now that seems a bit more abundant should mean that you can get labor at a reasonable price, which means that companies, in terms of their expense on labor, should be, relatively stable and essentially allow profit margins to continue to widen. So I think the markets will be supported. I think this is a buying opportunity. I don't think this is a change in trend, but it is turbulent right now, and we expected that for the fourth quarter.
Can we just talk about exactly what that turbulence will look like over the next 2-3 weeks, Jim? Bloomberg Intelligence puts it as thus. Bond trader hell is coming. 17 days and the mother of all data dumps, because we'll get the September PPI, retail sales, October CPI, September and October payrolls report, although maybe not the complete picture. Oh, and by the way, NVIDIA earnings too next week. Just what are you bracing for, Jim?
So I think everything that you just mentioned is very well anticipated by the markets. I'm anticipating that the data releases are going to be not very good. I think the data is going to show significant weakness. And I think that's what the markets are pricing in right now. So the question is will the data be weaker than what market participants are currently pricing in at the moment? Or might they be a little bit better? And then that's where the surprise is going to be. But I'm firmly in the camp that fourth quarter is really the trough of the soft patch. And this is where we're going to get that data dump. Let's rip that Band-Aid off quickly. Let's get through this, and then let's start to focus into 2026. But we have to get through this data dump first, and that's what's causing the markets to have a lot of jitters.
We'll hold hands and jump together into the data dump fog. Jim, thank you so much. Morgan Stanley Investment Management's Jim Caron. Let's get a check on this equity market, headed for another down day. It is the fourth down day in a row for the NASDAQ, for the S&P, the second consecutive down week that we're looking at. We're down about 0.8%, so not as bad as we were in the future session. Some of the energy companies, GE Vernovia doing better, Micron doing better, Berkshire Hathaway. Warner Brothers Discovery is on the plus side because there's reporting that the takeover interest has really started to come to a head with Comcast, Netflix, and Paramount. Now, on the downside, the more important one this morning, because this is what's dragging the overall market down, it is a Mag 7 tech flavor. NVIDIA, Broadcom, Tesla, Alphabet, Amazon, Apple, Meta. It's one, are we going to get those Fed cuts? Jim Caron says yes. But two, is the AI trade, are we really starting to question it? And the amount of spend that's coming from these companies and the depreciation costs racking up, for the words of Michael Burry. Let's look at what we've had so far this week in terms of sectors. Actually, this is, 5 days. Consumer discretionary, one of the worst ones. I guess we've had some earnings there that haven't been great. Infotech, no surprise, that's down 1.2%. Healthcare, so real safety play up at the top. Healthcare up 3.7% rather, followed by materials and energy, Matt.
All right, so that's the setup for a down day. Walmart also falling after announcing a new CEO, maybe because the outgoing CEO did so much for shareholders. We'll talk about what the new CEO can deliver with Telsey Group's Joe Feldman. This is Bloomberg.
At what point do you say, we made a mistake and we're getting out? How long do you give it before you say, this isn't working?
That's one of the most critical differentiators between great investors and just mediocre investors. Because on one hand, you have to have confidence and conviction in all the work you've done, the decision you've made, that if you have a little stumble here and there, if you immediately are selling out, you're never really going to fully realize the depth of potential long-term success. And yet, on the other hand, if you're stubborn and you refuse to admit I'm wrong, you continue to think the market's wrong and I'm always right, then you'll get caught in some very, very difficult positions over time. So that ability to have a fresh perspective, take in the new information, even when things aren't going the way that you'd expect or to hope, and to really understand from this price point today, is this still going to be one of the most compelling investments or not?
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
A tough morning this morning with markets down across the board. Let's see what the analysts are saying. Some of your top calls this morning. First up, StubHub failed to issue a fourth quarter forecast in its first earnings report since going public in September. Bank of America cut its rating on the ticketing platform. Analysts at JP Morgan and Evercore also say that that decision to hold off on guidance plus softer ticket sales is fueling concern. Concerns big this morning, down 24%. Next up, Home Depot, that gets downgraded at Stifel. The analysts say that the home improvement demand looks stagnant. It may even be weakening, and they see a delayed recovery for the sector. Home Depot will hear from them on their earnings next Tuesday. Those shares down 1.5%. Finally, the Gap gets upgraded to a buy at Jefferies. Jefferies says that management has driven a strong turnaround at both Gap and Old Navy. They see significant upside in beauty at Gap and say that Wall Street underestimates this opportunity. Shares are unchanged, but in today's market, that's probably a good thing, Matt.
Yeah, unchanged is better than dropping with the rest of, I guess, with the tide. Walmart shares are doing that after announcing a successor to CEO Doug McMillon. Telsey senior analyst Joe Feldman has an outperform rating on the stock and says the incoming CEO, John Furner, is the logical choice to run Walmart. So, Joe, I wonder if I can first ask you, these shares, the share reaction that we have, is that disappointment that Doug is leaving, since he's done so much for shareholders, really, and employees at Walmart during his tenure, or is this, the boat sinking with the tide?
No, I think it's the first thing you said. Doug has done an amazing job, Doug McMillon, that is, as CEO of Walmart. The stock's up like 400% since he took over in February of 2014. So you could see, investors really liked him. He's turned around that business. He's transformed it. He's modernized the supply chain. He's, there's brought a lot of digital and technological innovation to the company. And that's really what's propelling it right now. In addition to obviously being the lowest price provider for retail goods to consumers. So like you add that all up and people, why would anybody want that to change? So I do think the transition to John Furner is going to be relatively smooth. He's a lifer at Walmart, very much like Doug McMillon was. And I think he's really ready. He's been running the Walmart US business for the past several years, and it's done phenomenally well under his stewardship.
And what a year it's been for McMillon after getting Walmart to the place it is. I mean, now he's someone who had to deal with President Trump directly lashing out at him for saying that Walmart would be raising prices because of tariffs. In John Furner, how much is this a man who not only is going to have to continue to carry the torch from what he's been doing at the U.S. group of Walmart, but also needs to become a diplomat of sorts, needs to become a figure that can handle President Trump, just given the prominence of Walmart in American society?
Yeah, I think John Furner is really ready and up to the task. He's been groomed really to become the CEO. Walmart does a very good job of leadership and transition planning. This wasn't a very quick thing. This is something that's been in the works for a while. He's been mentored by Doug McMillon for years. And, so I think that that's going to really help him go forward. He's got a great board that's around him to help advise him. And I think John, he does a very good job. He's very diplomatic, and I think that he's the right guy to bring Walmart into the next decade, really, because that seems to be what they do with their CEOs. And, that's what we're going to be looking at, is to see how he can help really fuel this continued transformation of the business and really embracing the technology. I think he's up to the task of dealing with leaders of foreign countries and our own country.
I wonder about the 2.1 million employees at Walmart. They've arguably done better under Doug McMillon's leadership, right? He's raised the pay that they get, but they've got to be fearful that, at least in some cases, AI could replace their jobs, right? You're never going to not need greeters, I hope, at the door, but a lot of the other jobs there can be done by AI. How fearful do you think they need to be of layoffs under this new CEO, Joe?
Well, I'm not so sure we're going to see layoffs, but we could see, the labor pool stagnate around this 2.1 million, where you don't see a lot of new additional labor. And I do think the role that people play at Walmart will transition and change. Doug McMillon has talked about that quite a bit, that he feels like we don't necessarily need to reduce the labor force. It's much more about just transitioning the labor force to embrace new roles and the technology that's coming to be more efficient. They're already starting to do that. I think John Furner is probably going to take that same approach. I think that, they've done a really good job with both John Furner and Doug McMillon, both starting at the company as young men right out of school, hourly employees, rising all the way to the top. I think that's a great example for others at Walmart, and to show that Walmart really does like to promote from within. And people are immensely important, especially in retail, as you said, to greet customers, to make sure that there's good customer engagement and that you're doing the right thing for the consumer.
Joe, really great to get you on this morning. That's Telsey Group's Joe Feldman. Just to check on markets, because we were speaking with Jim Karen in the last 10 minutes, and he said this is a dip he would buy, and buying we are doing. NVIDIA surging at the open, erasing its losses. It's now positive. Just moments ago, I was looking at the stock, and it was down nearly 1%. S&P 500 now is trading down only about 0.5%. The NASDAQ down 0.7%. Matt, it also looks like a lot of these memory chip stocks like Micron is surging too. It's up 5% after it initially opened down. So people are rushing to buy this dip at the very
I was going to say, so much for questioning the buy the dip narrative.
I should have known. I shouldn't have questioned it.
You spoke too soon.
I did speak too soon.
Danny, although I think it's still interesting, and we'll continue to pose these questions about the depreciation schedule, because Michael Ball from the MLive team writes that the growing importance of power efficiency and data centers really changes the depreciation story, right? If you make chips that are twice as efficient as the previous version, everyone's going to have to go into these data centers and change out those chips, open up the servers and replace the millions and millions of microchips that are going to be put in the, tens of thousands of data centers being built across the planet.
It does speak to this overall story. Tech used to be asset light, and that's why people used to love it. And that just speaks to a facet that has completely changed, and the business model is very different now.
There's so much to talk about on this Friday. Coming up, Vanguard is on pace to set a new all-time record for ETF inflows this year, surpassing the record that it also set back in 2021. We'll look back at the year that was on ETF Friday. Next, this is Bloomberg Open Interest.
bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
In what's been a wild year for markets and ETFs, one firm stands above the rest. It is Vanguard, that is on pace for an all-time high in ETF inflows, even as a new generation of high-octane launches gains traction. Joining us now is Athanasios Saravegas, ETF analyst for Bloomberg Intelligence. Athanasios, on one hand, okay, it's not surprising. Vanguard is like the company. It offers cheap ETFs. It's been the leader in this. But as I mentioned, there have been a lot of challengers coming in and putting different types of funds into the markets. What's allowed Vanguard to retain its crown?
Yeah, I think, it's very easy to get sucked into these new launches, right? There's crypto and leverage. And so I think how issuers are learning to sort of position themselves is we can't go head to head with Vanguard. Their value proposition is way too strong. They're cheap. They offer plain vanilla exposure. So we're going to learn to live alongside them. And if you kind of see how flows are going, the middle of the road is very difficult. It's on one end, you have your cheap core holdings. And on the other end, you have more of your speculative bets like the crypto, like ARK and things like that. So it's also like a nice sign that see yes, there's all these crazy launches, but most of the money does tend to still go to these plain vanilla type ETFs. So I think that sort of keeps at bay some of these fears that, the market's gonna get sort of off the rails, or there's gonna be issues with products, but just below the surface, it's still nice to see that most of the stuff does go to pretty traditional investments.
So plain vanilla ETFs, what, like just straight up passive index trackers? Because I thought from my days a few years ago of co-hosting ETF IQ that we were going to see a huge wave of active ETFs almost push those passives out of the market.
Yeah, I mean, there's definitely been, most of the stuff that comes out now is active, and even Vanguard, to be fair, is looking at active now, but it's been a really tough proposition to get money away from Vanguard, only because the S&P's also been really great too. So if you've just been putting money in the Vanguard S&P fund, you've had a great couple of years. So that also helps too. Maybe if the market conditions change and does active start to do better in maybe more difficult markets, like maybe we can see that change. But again, I just think the value prop is way too strong to be able to dislodge those assets from them. And that's why they keep growing. You have on one end, launches are taking off. We have almost 1,000 ETFs this year, but Vanguard still is kind of just doing its thing, and they're going to, again, set a new record for any issuer in terms of assets coming in.
All right, Athanasios, thanks so much for joining us. Athanasios Saravegas of Bloomberg Intelligence, part of the triumvirate that runs our ETF coverage on the print side. We've got Eric Balchunas, obviously James Seyfert and Athanasios. Tune into ETF IQ with Scarlett Fu Mondays at 12 noon New York time to get more on this ever-growing asset class. Coming up in the next hour, Paisley Nardini of Simplify Asset Management explains what catalysts aside from AI and the Fed are needed to keep stocks afloat. Plus, Churchill's Ken Sell on their year-to-date performance in the middle market business, and the CEO of Bentley is in the studio to unveil its newest model, the Super Sports.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open the restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know what he doing. Because I never watched the movies, you know, I was traveling the business. But of course, after, you know, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's for me, and a great partner. He understands to my concept. He support me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So, example, Nobu Hotels idea come from him. He said, "Hey Nobu, so we have a lot of new restaurants coming in somebody's hotel." For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up to the minute news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. We begin in Washington, where the Trump administration may be close to a decision on confronting Venezuela head-on. Correspondent Charlie Daggett has new details.
As F-35 stealth fighter jets fly missions from a reopened naval base in Puerto Rico and Marines practice beach landings, sources tell CBS News the Pentagon is preparing for military action in Venezuela. Defense Secretary Pete Hegseth and Joint Chiefs Chairman Dan Kane presented President Trump with options for the coming days, including strikes inside the country.
The president is calling the new release of Jeffrey Epstein emails a hoax pushed by Democrats to try to implicate him in the late sex offender's crimes. Georgia Congresswoman Marjorie Taylor Greene, one of only 4 Republicans who voted to release them, tells CBS Mornings.
It's a very interesting view into a world that most of us have never seen, kind of like a web of global affairs, business connections, very high and powerful people.
Rain is falling in Southern California, and it's expected to intensify in areas devastated by the Palisades and Eaton fires earlier this year. These men in Malibu learned some lessons.
So important to always be prepared and always just be ready, because you never know what Mother Nature is going to throw at you.
Every few years, things happen. I think I'm more prepared today than I ever have been.
CBS News meteorologist Rob Marciano on the possibilities ahead.
Street flooding, mudslides, rising creeks and rivers from Santa Barbara to Los Angeles down into parts of Orange County. So we're concerned about that through tomorrow.
Russia staged a massive attack on Ukraine overnight that killed at least 6 people.
I'm Vicki Barker at the Foreign Desk in London. The biggest attacks on the Ukrainian capital Kyiv in nearly 3 weeks. More than 400 drones and 18 missiles slammed into houses, schools, apartment buildings, and medical facilities. Odessa and Kharkiv were hit too. President Zelensky says apartment buildings appeared to be the prime targets, something the Russians deny.
Researchers have confirmed the first death from a red meat allergy allergy triggered by ticks.
The 47-year-old New Jersey man had suffered a severe reaction after eating beef last year. His cause of death had been a mystery until a special blood test showed he died from alpha-gal syndrome. He had been bitten by Lone Star ticks, whose saliva triggered a deadly allergic response to the alpha-gal sugar found in red meat. The CDC's Dr. Johanna Salzer.
This is not treatable with antibiotics. A lot of patients do have to live with and for the rest of their lives.
She says a lot of cases go undiagnosed because many doctors aren't even aware of alpha-gal. Michael Wallace, CBS News.
The Dow is down 549 points. This is CBS News. A major renovation at the Motown Museum in Detroit is almost done.
Robin Carey is Motown Museum chairwoman.
It's one of the most visited tourist attractions in the state of Michigan.
At the Motown Record Studios in Detroit, also called Hitsville, USA, the museum's 50,000-foot expansion will be ready next summer, dedicated to the artists and their music.
We've really committed this new space to telling a lot of those stories.
Golem Maya grew up near Hitsville as it was producing the soundtrack for America, starting in the early 1960s.
This is one of the greatest things about Detroit is Motown, so we need to remember it and we need to pass it down.
Michael Toscano, CBS News.
Not many are apparently forgiving and forgetting in Spain. Former Spanish soccer president Luis Rubiales, convicted of sex assault after kissing a player, was egged as he launched a PR campaign for his new book in Madrid. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube, so you can head over to youtube.com, search Bloomberg Podcast. That's where you'll find us. We have a sell-off in the marketplace today, but we are off the lows, and we'll get to that in just a moment. Coming up on the Bloomberg Intelligence program, Scarlett Fu and Paul Sweeney. We're going to have Brendan Murray, Bloomberg News Global Trade Editor. It looks like President Trump is starting to maybe focus a little bit more on affordability, and maybe backing off some of these tariffs can help him out there, so we'll talk about that. Ed Mills, Washington policy analyst and managing director at Raymond James, on what to expect now that our U.S. government is reopened. Where does the government go from here? Where does Congress go from here in terms of policy? Kujan Sobhani, he's Bloomberg Intelligence senior semiconductor analyst. Finally, we're going to get NVIDIA numbers next week. I think it's Wednesday after the close. We get a little preview there. All right. You want an analyst that thinks outside the box. You talk to Laura Martin. She's a senior analyst at Needham & Company on the latest in the media space. She covers the media industry, and she has always got some really compelling ideas, so we'll chat with her. So a lot going on here over the next couple of hours. Scarlett Fu and Paul Sweeney will be with you. Right now, let's go to Lisa Mateo for a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by IBKR. Will the U.S. economy enter a recession by the end of Q4 2025? At IBKR forecast trader, the yes recently at 6%. Start predicting today. IBKR.com/forecast. The last trading day for this contract, March 26th, 2026. Well, we have some more Fed speak, kind of voicing some skepticism about the need for a third straight rate cut. Traders slash the odds of a reduction to below 50%. So we have stocks lower. The Dow leading the losses, down more than 1%, 549 points. The S&P 500 falling about 0.5%, 37 points. And the NASDAQ down just under 0.5%, 109 points. In the yield space, we have the 2-year, 3.58%. That's little changed. And the yield on the 10-year, 4.11%. And that is little change. UK market sliding. The pound, the worst performer among major currencies against the dollar. Some speculation about the budget heightens uncertainty over the nation's finances. We go to the Bloomberg Dollar Spot Index. That is little change. Bitcoin slipping further below 100,000. Investors pulled almost $900 million from funds investing in the token right now. It's just above 96,000. Checking in with Mag 7 stocks right now leading the losses. Tesla, it's down more than 2%. And a few stocks on the move. StubHub falling this morning. Their shares down 24%. The company didn't provide a forecast for the current quarter. It was its first quarterly report since going public in September. Then we go to biotech companies. Cidara Therapeutics, it's soaring up 105%. Merck agreed to buy the flu treatment startup for just over $221 per share in cash. That's a total transaction value of approximately $9.2 billion. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett, Phil, and Paul Sweeney. We're live here in the Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well, so head over there and search Bloomberg Podcast, and that's where you'll find us. Market Drivers today is brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms. With a partner dedicated to your success, go to Commonwealth.com to learn more. We've done a bunch of remote broadcasts with Commonwealth, some really nice folks, so that's some good stuff there. All right, let's take a look at some of the stocks on the move today. Again, we got a sell-off here in the marketplace. I'm Paul Sweeney alongside Scarlett Fu, and we're joined by Bloomberg's Christine Aquino. Christine, what are you looking at?
Well, Paul, we got to take a look at NVIDIA, of course, because it's not moving a lot today, actually. So ticker NVDA, those shares just down 0.1%, but because it is such a massive stock, it is one of the top contributors still in terms of what's dragging the S&P 500 down, which remains in the green. It's been flip-flopping a lot this morning. A lot of kind of questions around what the earnings picture is going to look like next week. As you mentioned, it is reporting on Wednesday. And so we have found, that NVIDIA earnings have tended to be a catalyst for traders to sell, particularly in that period 3 to 5 days after the results, right? And so this time around, Bloomberg Intelligence expecting NVIDIA to once again beat estimates, both for fiscal third quarter and their fourth quarter guidance. And they're looking specifically at demand for their GB300 chip and more focus on their hyperscaler capital spending. We know that was $27 billion higher in the second half and also $90 billion for 2026. So we're going to be focusing on those figures next week.
And that's Wednesday after the closing bell.
Exactly.
Okay, what's next on your list?
We're going to take a look at M&A Friday with Merck here. So this deal, so those shares now in the green. So ticker MRK shares are now in the green, as I mentioned, just like slightly 0.1%. It was down earlier as investors trying to parse what this means for Merck specifically. We know that they have agreed to acquire Cidara Therapeutics, $9.2 billion. They're going to be paying $221.50 per share in that offer, which is more than twice Cidara's Thursday closing price. And I think the focus here is the fact that Merck is trying to position for flu treatment specifically, because they did suffer that loss of their patent in the cancer space, but maybe something that they can make up for in the flu treatment space. And our Bloomberg Intelligence analysts also pointing out that, listen, this is like a first-in-class product in the space in terms of flu solutions, and also perhaps reflecting that, there's still a little bit of malaise over vaccines in the U.S., so maybe something that Merck can capitalize on.
All right. MA go on the terminal to see who's getting paid here. The investment banker for Merck, BofA Securities, the investment bankers for Cidara Therapeutics, Evercore, and Goldman Sachs. So people getting paid there. What's next?
Let's take a look at Walmart. Big news there. So those shares, ticker WMT, and shares are down 1.6% at the moment. The big news, of course, is that CEO Doug McMillon will retire in February, and he's going to be replaced by John Furner, which is, as expected. Furner has long been viewed as McMillon's heir apparent. And, he's going to be, the expectation is that he's going to be a continuity sort of a successor, right? Like there's not really a lot of change expected here. I think the focus is still whether they're going to be able to maintain those market share gains that they've enjoyed recently and the consistency in their performance. And question really for Furner is he going to be able to extend the technology first sort of focus that his successor pioneered, right? So McMillon went from he was an hourly worker at Walmart, and then he was credited for their digital transformation. So whether Furner is going to be able to continue that or evolve that beyond what his successor has done is going to be the question.
And that story is pretty consistent because I believe Furner is also a Walmart lifer who started out as an hourly associate. So
it pays to be a lifer.
Apparently it does. All right, Christina Aquino, thank you so much, managing editor for our Bloomberg equities team. And she, of course, you can find her on Bloomberg Radio and on Bloomberg.com. For more conversations like this, be sure to subscribe to our Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. So, Paul, the off-cycle election was kind of a big tell to the White House that people really care about inflation. They care about affordability, and they're wondering what the White House is going to do about it.
Yep, and I think one of the things is President Trump seems to have gotten that message because he's talking now about affordability, maybe a 50-year mortgage to help home buyers. That is an idea, and also dialing back some of these tariff discussions, perhaps.
Yeah, the U.S. is going to unveil some tariff exclusions here, and this is what U.S. Trade Representative Jameson Greer has said. So they're going to look into making costs a little bit easier and lower for U.S. consumers. Let's bring in Brendan Murray. He is Bloomberg News global trade editor. He's kind of our trade czar, joining us from London. Brendan, talk to us a little bit about what would be first on the list if the U.S. is going to start reducing food costs for consumers.
Yeah, so the products that they're talking about are things like coffee and bananas and sort of produce that isn't grown or made here in the U.S. And so, of course, Brazil is a big producer of coffee. It's also a big exporter of beef, which the prices of which have also gone through the roof. So the president has apparently gotten this message from voters that this affordability issue is one that's could come back to bite him if he doesn't do something about it. The key thing here, and this is why it's important, is that the president and his administration have been saying tariffs aren't inflationary, tariff costs don't get passed on to consumers. This is essentially an acknowledgement that that's exactly what happens. A lot of companies who have been hit, manufacturers who were hit with tariffs, were able to stockpile the raw materials or the components that go into the products that they make, that they buy from abroad. But you can't really, stockpile a mango or things like that. And so those costs are being passed on to consumers, and the White House has finally gotten the message.
And we got another deal, this time apparently with Switzerland. The U.S. and Switzerland have, quote, essentially reached a trade agreement to lower tariffs on Swiss goods to 15%. And I guess we'll hear about it from the White House today. Mr. Jameson Greer, the U.S. Trade Representative, is saying. And I guess Switzerland's going to make an investment in the U.S. So it seems like this administration is willing to do deals, and I think the rest of the world seems to have kind of gotten the message how to play the game, Brendan.
Yeah, exactly. This one has been months and months in the making. We thought it was going to happen a couple of months ago. Switzerland sent their officials to Washington for the ceremony, and then Trump said, "No, go back to Switzerland and give me a better deal." So they apparently have gone back to the drawing board, offered more concessions to the White House, and apparently it's enough to get that deal over the line. It will bring the tariff on Swiss exports to the U.S. down to 15%. They're currently very high at 39%, and Switzerland is going to see to it that there's something like $200 billion of foreign direct investment from Switzerland if it flows into the U.S., presumably to increase production for things like pharmaceuticals, sort of high-precision machinery, and those sorts of things.
Okay, so when we're talking about Swiss exports, Swiss watches, Swiss machinery, Swiss chocolate maybe, speaking of food, not an essential food category, but maybe for some. Brendan, when you look at the countries that the U.S. has been in discussions with over trade but has yet to sign a deal, who's left? Who are the outstanding countries that everyone's really looking at to make sure that something gets pinned down?
Well, the key one at that's next, kind of most imminent after Switzerland, is India. That's another difficult one where India is very protectionist about its domestic agriculture industry, and the U.S. wants to break into the market there, and so that one has been difficult to get over the finish line. There's also the biggest ones are Canada and Mexico. They need to renegotiate the USMCA. And that's going to come up next year, and that could be a very heated negotiation. All
right, Brendan Murray, really appreciate your joining us. Bloomberg News Global Trade Editor, our trade czar, joining us from London on the latest on President Trump's tariffs. From New York, this is Bloomberg Intelligence on Bloomberg Radio. S&P down 0.5%. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. Well, the relief for Alibaba by the end of the longest shutdown in American history, that's given way to some volatility. We have the Dow leading the losses down about 0.8%, 403 points. The S&P 500 and the NASDAQ down about 0.5%. Over to the yield space, we have the 2-year 3.58%. That's little changed. And the yield on the 10-year 4.11%. And that is little change. Checking with commodities, we have COMEX gold down more than 2.5% at $4,079 an ounce. Brent crude right now up 2% at $64 a barrel. WTI crude about $60 a barrel. The Bloomberg Dollar Spot Index is little change. Bitcoin on the verge of wiping out its gains for the year. It's right now just above 96,000, down about 2.5%. Over to company news. Walmart CEO Doug McMillon is retiring after more than 15 years with the company. He's being replaced by John Furner. That's effective February 1st. Furner has served as president and CEO of Walmart U.S. since 2019. And Verizon reportedly discussing plans to cut as much as 20% of its workforce. Sources say the layoffs could affect up to 20,000 workers. And Boeing factory workers in the St. Louis area, well, they voted to end the strike under the terms of the agreement. Average wages will increase by a total of 24% and give workers a $6,000 signing bonus. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We are streaming live on that YouTube thing. I think that's the internet. Check that out. You can search Bloomberg Podcast, and that's where you'll find us here.
A lot of stuff happens there.
It does. I understand. That's a big thing. I'm going to check it out. All right, we got the government open. Now what do we do? What does the government do now? What's the to-do list? So let's check in with Ed Mills, Managing Director, Washington Policy Analyst with Raymond James. Raymond James, by the way, folks, is a really high-quality regional investment bank down there in the Southeast. I competed against them a lot. I worked with them a lot. Some good people doing some good stuff down there. Ed, all right, we got the government open here. Is there a to-do list for this Congress here as they start focusing on midterm elections next year?
Yeah, Paul. So we have appropriation bills to pass. As you could go back and look at, there is a CR through basically the end of January. So Congress has passed 3 of the appropriations bills. We still have a handful of them that they need to get done. A question about what will be done with the enhanced subsidies on the Affordable Care Act exchanges. Democrats have forced a vote in December in the Senate, but will that actually get a deal? I think it's an uphill battle. And then for the end of the year, getting the defense authorization bill done. And there's a lot of policy stuff in there. And then going home. Looking to next year, surface transportation, a couple of other cats and dogs, but those are the big to-do items at this point, Paul.
What happened to the crypto market structures bill? There was some hope that that could get done by, I mean, at one point people said before Thanksgiving, but that's clearly unlikely. But is there any chance it could get done before the end of the year?
Yeah, Scarlett, there's a lot of ongoing conversation. So the crypto industry's had a lot of wins in D.C. this year. They've passed the Genius Act, which allows banks to issue stable coins. They've been working on this market structure bill. The Clarity Act is what passed the House of Representatives, trying to say who actually gets the regulatory authority. If you go to the Supreme Court, they've said to regulators, unless Congress has given you specific authority, you can't do things. So the market structure bill is trying to get a lot of digital asset regulation out of the CFTC. President Trump has appointed a new CFTC kind of chair. His confirmation hearing is coming up, so we'll get a little bit more update there. I still am optimistic that bill gets done before the midterm elections. Getting it done this year is probably a little bit tough because it's pitting the digital industry against the banks. There's a deposit insurance conversation where the big banks don't want to expand out deposit insurance because they don't want to pay more. That has slowed this down a little bit. Still gets done, but we're still negotiating that here in D.C.
Hey, Ed, with a couple of days hindsight here, what's the feeling in D.C. as to, did one party emerge from this whole thing stronger, weaker, or is it just kind of status quo Washington, D.C.?
Yeah, Paul, I think it's it's probably who you ask. Republicans come out of this government shutdown and say, look, Democrats really didn't get anything. They got what was offered up basically at the beginning. They got a chance to vote in December on the enhanced subsidies. Democrats will come out of the shutdown saying, in 2018, Democrats made the midterm elections about health care. This elevated the conversation about the enhanced subsidies on the Obamacare exchange plans. And Democrats swept in the elections last week. So they feel that there's momentum. They feel as if this has shifted a lot of the burden onto Republicans to fix the increased cost on these insurance plans or suffer at the ballot box next November. I think we have to wait to really figure out exactly who has won this battle politically. So it's not as clear cut this time as I think you look at this in the past.
What's your sense, Ed, of how prepared the White House is if the Supreme Court rules that the Liberation Day tariffs under IEEPA were something that the president cannot move forward with? Do they have a plan B ready to go?
Yeah, so Scarlett, what we've been telling folks at Raymond James is that no matter what the Supreme Court does, if they strike down all of these tariffs, the process might change. The outcome is unlikely to change. We look at other authorities that the president has. He's been aggressively doing these 232 tariff investigations. That's for national security. He's been doing 301 investigations. Those are countrywide investigations. And he's been doing bilateral deals with those countries. If IEEPA gets struck down, none of those change. If there are some things that would change, he would go to like Section 122, which is allowing him to do a 15% tariff immediately for up to 150 days while he implements that plan B of doing other investigations to get those tariffs up to speed. So what we've told clients at Raymond James is, expect these tariffs to remain. This is an important decision, but because he's gotten so many of these bilateral deals done and so many of these other investigations off kind of the ground, probably the Supreme Court can strike this down with a much lower impact on the market and the actual tariffs being paid than if they had done it earlier this year. He's gotten a big reprieve by the fact that they've allowed these tariffs to exist while the litigation has made its way through the courts.
All right, Ed, a lot of issues out there. Appreciate getting a few minutes of your time. Ed Mills, he's a managing director and Washington policy analyst at Raymond James. He's based in D.C. All right, let's switch gears to earnings. Tech earnings, particularly the chips. We're going to hear from NVIDIA next week, I think Wednesday after the close. AMD had a big investor meeting here in New York earlier this week, so there's a lot to talk about, which is good news because we got Kunjan Sobhani here. He's Bloomberg Intelligence Senior Semiconductor Analyst. He's based out there in our D.C. office, out there in Pier 3 office. Just awesome. Have you been to those offices out there?
No.
Oh, awesome. Pier 3, out into San Francisco Bay.
Actually, you know what? I stopped by there, but I didn't work out of there. Okay, and I stopped by there to enjoy the snacks. I think they have organic snacks.
Yeah, they got some good stuff there. So he's based out there, but we got him in New York today because I think he was here for the AMD conference, Investor Day. That's why. Kunjan, thanks so much for joining us here. First of all, let's preview NVIDIA. What are we looking for from NVIDIA? It's been a couple years since they blew the world away with their sales forecast, and we all became, oh my God, this AI thing is a thing. What are you looking for?
Yeah, for context, last 2 quarters were the only quarters after beating and raising for the past 10 consecutive quarters that they did not do a big beat and raise. Okay. That was primarily because consensus did have China revenues, and China revenues didn't materialize. Coming into 3Q, consensus is clean, so we are again looking them to go back to the same cadence of beating and raising. Okay. We think mid-single digit, but anything above that would be really good for a sentiment.
And in terms of the sentiment and how that has changed, it's really turned on a dime over the past 2 weeks. Whereas people before were all gung-ho for spending on the AI build-out, now it's like, oh, wait a minute, when's the return on investment on this? And are these things going to be profitable? How does that change the way people interpret whatever Jensen Huang says?
Well, when we look at the data speaks otherwise. If you look at just in the last month, its largest customer base, which is hyperscalers and cloud service providers, have raised their capex for second half 25 by 20 billion and 2026 by 100 billion. Jensen last month at GTC shared he has a pipeline of 500 billion through now to 2026 end from its Blackwell and Rubin products. I mean, now it's about just them executing and supplying to that.
I mean, I'm looking at the FA function, gives you the consensus kind of revenue forecast for their, it's kind of for their calendar year 26, it's their fiscal year 27. 40% revenue growth. All right, that's down from like 60% last year, but that's on $200 billion of revenue. That's crazy. And what's even crazier, gross profit margin of 75%.
I know, that's bananas.
Unbelievable. So what are the conversations you're having with your institutional investor and clients? You feel like everybody's invested in NVIDIA and now they're maybe looking for other ways to get exposure? What are the conversations like?
Definitely. I mean, and that's been true for almost now a year.
Yeah.
Everyone has significant exposure in NVIDIA. They're trying to find other NVIDIAs. We have a couple of other names that we really like that could have the potential of showing the growth. One being Broadcom, which is one of our focus idea. And we'll talk about AMD because we heard some really good stuff at AMD Investor Day.
I want to get your take, Kunjan, on this whole idea that the depreciation expense schedule that Michael Burry raised is kind of a problem. NVIDIA is releasing next-gen chips at a pretty fast clip, but some of these hyperscalers are using a longer schedule when it comes to depreciation expenses, and perhaps in the process, not manipulating, but impacting their profitability, their reported profitability. How do you think about this?
I think it's too soon to make that statement. In our view, remember, AI is just nascent. Is like, what, 2 or 3 years old, especially when you look at the hardware that has been deployed for training models and inferences. So at the onset of it, everyone making guess how much of a useful life will be. Because the models are advancing so fast, the use cases are coming in so fast, they are figuring out, what a better, and remember, the limitation is not dollars, not space, power. So the newer generations are giving much more better power efficiency. So yes, the depreciation schedule that you thought when you bought the chips will be different 2-3 years down the road. We don't see enough data points right now that suggest there is manipulation going on here.
Kunjan, you went to AMD's Investor Day in New York City this week. What were your takeaways?
Yeah, really few takeaways. One, they raised their revenue growth and market share targets for the next 3 to 5 years across the board. The GPU, which is the AI revenue, came in line with what the street was, so it was not bad. I mean, any upside would have been really great. But one thing we believe investors are missing out, that the CPU business remains very underappreciated. With the advent of AI, yes, we are selling a lot more GPUs, but that is driving a lot more demand for their server CPUs, which is where AMD has been capturing share. So this is an area we think investors need to pay attention to because that will drive significant growth. Second key point is, 6 months ago at their event in Bay Area, they gave a TAM of the AI accelerator, which is the chip TAM, which is the GPU TAM for them, and ASICs of about $500 billion.
Total addressable market.
Total addressable market, yes. Yesterday, they gave an overall data center silicon TAM of $1 trillion. Wow. So not apples to apples, but we estimate out of that same GPU's TAM became $750 to $900 billion. So almost 80% growth in 6 months.
These are big numbers.
These are massive numbers.
That's the world these guys live in.
So being number 2 is just fine. They're not losing out.
Just fine. All right, Kunjan, thank you so much for joining. Kunjan Sobhani, senior analyst on the semiconductor space for Bloomberg Intelligence. He's based out there in Silicon Valley, so he's plugged in with those people. A good buddy of mine, young fella. He worked at a software company, got acquired by AMD. He's very happy about
so he knows quite a bit about this.
He's very happy about that now, so he pings me all the time about AMD. So good stuff there. S&P off 22 points. That's 0.3%. Again, well off the lows of the day. The NASDAQ, boy, was off almost 2%. Now it's off 0.2%. So trying to work a little bit higher here. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. The sell-off extends into another day. Stocks slipping right now. The S&P 500 is down about 0.1%. The Dow, that's down more than 0.5%, 324 points. The Nasdaq just ticking up right now. It is little change, up about 22 points. The two-year yield, 3.59%. That's little change. The yield on the 10-year, 4.12%, and that is little changed. Over to currencies, we have the Bloomberg Dollar Spot Index. Not much movement there. We go over to the British Pound. That's weakening by about 0.5% at 131.27 against the dollar. Over to Bitcoin, it's just above 196,000, down about 2%. Shares of Richemont, they're up this morning. They're up about 4.5%. That's in Zurich. Shoppers from the U.S. to China snapping up its pricey Cartier jewelry. In other news, Warner Brothers Discovery, well, they amended the contract of CEO David Zaslav to ensure stock options remain eligible to vest even if the media company is sold. We look at Warner Brothers Discovery, their shares up more than 2.5%. And finally, Charter Communications, they're making this big offer to attract new mobile phone customers. If you sign up for 4 wireless lines for $120 a month, you get free home internet service for life. There is a cap on data use. Just want to put that out there. It only applies to people who transfer lines from a competing carrier. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett, Phil, and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube, so check that out. That's the internet. Explaining that to John Tucker as we go along here. All right, as Lisa Mateo was saying, Warner Brothers Discovery, this thing is in play. There's an auction going on. There's lots of bidders potentially around this thing. So let's check in with an expert. We do that with Laura Martin, senior analyst at Needham & Company. And folks, Laura Martin, this is the way I describe her. She's a great analyst, one of the top analysts covering the media space on the street. But to me, her real value added is she thinks out of the box. She thinks non-consensus. And it makes her research really, really important. So we appreciate getting a few minutes of her time. Laurie, you're based out there in LA. You live this stuff. Warner Brothers Discovery, it's in play. Who do you think should buy it, and who do you think will buy it?
So probably who should buy it, Paul, is Netflix, because they could really use some IP with an entrenched audience base like that Harry Potter franchise, where when you make the next one, you're going to put 2 million people in seats across all of its revenue streams, across all the distribution windows. Probably, unfortunately, I'm very worried with this administration and the White House that the only person that can get regulatory approval is that Ellison family, who's such good friends with Donald Trump. Because as we know, the FCC has to approve. So I think, unfortunately, probably David Ellison and his father funding him is the one that is most likely to be able to get regulatory approval.
So from what we understand, Paramount Skydance wants to buy all of Warner Brothers Discovery with a cash offer, but Warner's is still moving forward with this plan to split the business up into the fast-growing part of it and then the slow legacy assets. Is that what Zaslav wants, to get rid of the whole thing?
Yes, he does. I mean, he wants the biggest payout possible. You saw he just changed his contract today.
Yeah.
He
So it
wants
doesn't
the
matter
biggest
what
payout
form
possible. Right. He wants to be sure to get paid for all of his efforts and his negotiating skills. So he wants to get rid of it all. I mean, if they sold, so the press reports are saying that Comcast and Netflix are only going to bid for the studio. That's going to leave the linear TV networks, which we just saw at the Walt Disney Company yesterday, are down like 36% in EBITDA and down 6% in total revenue. So that is going to be an entity that no public shareholder really wants to buy. I'm not sure there's value other than as a sort of milking it as a cash cow and paying it out in dividends. So it's my point of view that the better overall money, in my opinion, is to sell the whole thing to somebody and not make it the public shareholder's problem.
So, Laura, I'm looking at the stock of Warner Brothers Discovery, $22.80. It's up 115% this year. Where do you think a good takeout price is for this company? Where do you think the Ellisons or whoever may end up paying?
Well, so I think fundamental value here as an ongoing concern is 12, Paul, which is where I've traded for like a year. And then somebody leaked the rumor that Ellison was in play and all of Zaslav's stock options vested at 17. So then you knew 17 was going to be the minimum price because he doesn't get paid unless it hits 17. And then he said there were other bidders in play. You know, my opinion, fundamentally, it's worth less than $22. But if you have 3 bidders, it is what the market will bear. And you're going to buy these assets forever. It's like a Rembrandt. You take it off the wall, there's only one of them. And if you don't buy it, it's not there next time. You know, probably 22 or 23 is what they'll get. I don't think it's worth that, in my opinion.
Okay, so you think regulatory concerns will mean that Paramount Skydance is the only buyer, and David Zaslav wants to get paid, but what could trip things up? What could kind of become a factor that we're not considering right now? If it all comes down to price and who's going to approve it, what else could muddy the waters?
Well, I will tell you, every single day we get a generative AI announcement, and that adds risk to everything in media because of all of this creative capabilities that generative AI is bringing to the market. Absolutely, you could see a headline in generative AI that makes it look like these traditional studio companies who, because of their union contracts, are not allowed to use generative AI tools to create, because the employees are trying to protect themselves, makes these companies sort of more dinosaurs, higher cost per content hour, and they're not allowed to use any of these really amazing tools. So I can absolutely see a generative AI headline. The meltdown happening on the linear TV side is happening faster, which is undermining the fundamentals faster. And it's going to take like a year to get regulatory approval no matter who buys it. So I think there are several things that could derail this.
Laura, you know, you came out with a piece on Disney. You just mentioned Disney. They reported yesterday, weak numbers, stock traded down. What do you think the Walt Disney Company should do with the ABC television network?
So we've argued that they should spin off ABC, and specifically that was in reaction to the FCC chairman saying that that they wanted to, they didn't like something Disney had done, and so they should pull the ABC licenses. And we made the point in that piece that they would take a one-time hit of about $10 billion. And then it wouldn't matter to them at all.
By shutting it down?
Network, what's that? By just shutting it down, not even selling it, because that requires FCC approval. But $10 billion out of their $200 billion market cap. My point was that the FCC doesn't threaten Wall Street. They can pull those licenses. Disney can shut it down. It's a one-time write-off of $10 billion out of a $200 billion asset. The broadcast business is just not that important to this entity anymore. And on that point, Paul, experiences here grew 6% and grew the operating income or profit line 35%. So this is really, to invest in the Walt Disney Company today, you must invest it as a sort of theme park company and cruise ship company, because its entertainment assets, which you and I have long followed, Paul, are shrinking. So you can't invest in it as a media company. You have to invest in it as sort of a provider, a collector of data in 360 degrees, virtual and in the physical world, that then can be sold to LLMs. That's an interesting revenue stream for the Walt Disney Company. They are best in class in collecting data on wealthy consumer behavior globally.
So having said all that, and I just want to bring the whole discussion to a close and come full circle, if Paramount Skydance ends up buying Warner Brothers Discovery, it sounds like it's not going to have that much of an impact on a company like Disney, which is not even in the running for buying any of these assets, because Disney's media and entertainment business is really not a key driver anymore.
I would say that in the short term. I mean, we're basically, you can own Disney today for its theme parks and experiences growth, while you're waiting for streaming to get big enough to offset linear TV declines, which are accelerating. And, you know, they need movies is an important engine at Disney, and their movies have, you know, they're going to have an amazing slate next year. So you can wait for movie upside. Like we have another Avatar coming out at the Christmas season, so this year. So that should be good. So you sort of have an option on this awesome movie business they have. Right. But meanwhile, you can own it because of experiences or protecting your downside as an investor.
Laura, great stuff. Really appreciate getting a few minutes of your time. That's Laura Martin. She's a senior analyst at Needham & Company. Read her research. Shutting down the ABC network. I'd never heard of that.
That is outside the box.
I never would have thought of that.
I know.
But, so when that note hit my desk, I was like, wow, I never would have thought of that.
And the FCC, not a concern there.
Not a concern anymore for the company, so we'll see about that. And Warner Brothers Discovery, that's kind of the next big news item coming out of the global media space, because it looks like Warner Brothers Discovery, it's a $90 billion enterprise value.
What happens to David Zaslav in Hollywood, though? That was his big thing.
He cashes out, and he's happy as a clam. He's just fine with that. This is Bloomberg.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
TGIF, this is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu, and every Friday at this time, we check in with Randall Williams, our Bloomberg Business of Sports reporter, for the latest news in the business of sports. And there's a big one this week, Randall. Under Armour and Steph Curry are parting ways, and it's kind of unimaginable because the two of them were so tightly twined together, and certainly Under Armour needed a big star, a jolt, and Steph Curry gave it to them. What do we know about how this fell apart?
Well, what I remember is that they were here last year, and Kevin Plank was talking literally on our 7th floor with Steph Curry about the ways that they were going to revitalize Under Armour's business. And less than a year, maybe a little over a year later, they're done. And I mean, the interesting thing is that Curry is going to retain all of his business. He's going to retain the brand. He can shop it around. As soon as this deal is done, which is next year, they'll produce the last and final Under Armour Curry shoe, and then he'll be able to hit free agency. But how it fell apart, I think Under Armour's in a bad place right now. The sales aren't great. Outside of Stephen Curry, their superstar athletes are Justin Jefferson of the Minnesota Vikings, and I'm sure none of us can name a product from him right now, which goes both to say about football and about the business that Under Armour is doing.
Stock down 2.3% today, off about 45% year to date. So that tells you all you need to know there. All right, the NFL in London, I get. Maybe broader UK, I get. But now we're doing Germany, we're doing Spain. What is the strategy of the NFL as it relates to Europe?
So I asked Roger Goodell at the Super Bowl, what is your goal in doing this? And the idea is to eventually build out a 16-game international media package. He hasn't said that outright, but if they do, they'd like to sell it to a partner because, of course, this is how the NFL makes their money, is media rights. And so if they can get to enough countries, I'm not sure what the math would be if there would be 6 games in London, 4 games in Germany. They're having a game in Australia next year. And so that's the idea, is to get this sport in as many places as you can and then hopefully build a media package around it.
Does that mean fewer games in the U.S.? Because how many games can these players handle per week?
So I believe right now it's 8 or 9 games that's collectively bargained. They'd have to go back to the bargaining table to get the 16 that I think the NFL wants, but it's not being negotiated right now. Roger has also talked to Bloomberg about, adding 1 more game to the NFL season, so getting to 18, that would allow them to get 16 international games. And so we'll have to see if they're able to get it done. The NFLPA, of course, is going to have to negotiate this. They're not in the best spot to be able to do that with all the things that went on this summer, but we'll see.
So we'll probably get that extra game, because that would put the Super Bowl on the weekend of, what is it? What holiday?
It's President's Day.
President's Day. So you would have a national holiday.
An official national holiday, by the way, because it's an unofficial national holiday.
Selfishly speaking, I don't think it's a bad idea, in large part because the Super Bowl and All-Star Weekend, NBA All-Star Weekend are back-to-back weekends, and NBA All-Star Weekend is also on Valentine's Day. And so there's no time for me and my lady. So hopefully, they come to an agreement. The players get exactly what they want, and the owners get what they want, which is another game.
Well, what they're going to have to do, if I were a player, I'd be like, I don't want to play more, so I'm already getting banged up as it is.
Yeah.
But the upside is you got to expand the rosters.
That's the
which
other
means
thing.
more jobs for these guys.
That's the thing. There is a price to pay for that 18th game, and it's really about what is the price going to be. Is it going to be a second bye week? Is it going to be an extra roster spot? Is it going to be the opportunity for certain players to get equity? They're not negotiating right now. Roger made that clear in September, or maybe it was October. But when they do go to the negotiating table, whoever is at the helm of the NFLPA is going to have to be a strong negotiator. Otherwise, the league's going to topple them.
All right. We're also looking at, risky assets sell off this week in equities and in cryptocurrencies. Sports is not a risky asset, but it certainly has become its own asset class. And the San Diego Padres the owners of the San Diego Padres are looking to sell the club at a record valuation. So some assets have retained their value.
Yeah, absolutely. I think the Padres going for more than the Mets would be unimaginable if you think about a market size, but they have the second highest attendance, trailing only the Dodgers, which is crazy, right? Has that always
been the case?
I don't think so, but they had a great ownership group who's looking to pass it on to the next. Hopefully they find a pursuer and an owner who's able to continue the legacy that they've built there.
So you're talking about a potential sale valuation north of $2.75 billion.
Correct. Correct. That's what they're targeting. Who knows if they're going to be able to get it? I believe the Mets was 2-4, so anything above the Mets would still be shocking just from a market perspective.
Market size, yeah.
New York versus San Diego, you think about all the teams that have left San Diego in recent years. For them to get this would be incredible.
And what I don't really have an answer to yet is for these regional sports like hockey and baseball and basketball, the regional sports networks were the big rights payers. They don't have a national contract like the NFL does. Now with the regional sports networks really in trouble because of cord cutting, I would have thought that would have impacted the value of these franchises.
Me too, but when you have a superstar ownership group, superstar fans who support a team that way, you think about the Dallas Cowboys, for example. Their market isn't the biggest in the world, but their ownership group has expanded in real estate and invested in real estate and all of the things surrounding the stadium. It's not exactly the same math with the Padres, but because they have invested in that and the fans have received it well, they might be able to pass the Mets, which, I mean...
Dallas Cowboys brand equity is incredible.
We haven't seen a down round in anything sports-related, have we?
I don't think so.
Well, in some regard, there are teams who have said, we're going to try to sell, and then they've pulled their team off the market. I don't know if that's going to happen with this case because the Padres are the second highest in attendance and all these other things that they have, but I think that whoever buys them is in for a treat.
Can PE buy baseball?
They can get some stakes.
Okay.
I believe it's similar rules to the NBA, which are more expansive than the NFL. So whoever buys them could have those areas, whoever else is part of it.
All right, Randall Williams, always appreciate you coming by. He is our Bloomberg Business of Sports reporter. And for our listeners in the U.S., a reminder, just listen to us via satellite radio on Sirius XM Channel 121, access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research because Bloomberg Intelligence, the second hour, begins right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Friday morning, and thank God it's Friday. From Paul Sweeney and Scarlett Fu, this is the second hour of Bloomberg Intelligence. We are, of course, live in our Bloomberg Interactive Broker studio in Midtown Manhattan, and we are streaming live on YouTube as well. A jam-packed second hour here coming up, starting with Jen Bartashis, who is our Bloomberg Intelligence senior analyst on retail staples and packaged food. There's a CEO change over at Walmart. Doug McMillon is retiring. Another Walmart lifer succeeds him as the next CEO. We're also going to talk to Madison Muller. She is Bloomberg's healthcare reporter on Merck buying Cidara Therapeutics. It's a $9.2 billion deal. Eric Kazatsky, a familiar name to those of us here at Bloomberg. He is managing director and client portfolio manager at Mackay Municipal Managers, will join us to give us the latest on Paul's favorite asset class, the muni market. And then after that, we've got Bill Keenan. He is a writer and producer of the newest film called Bull Run. He is the author of Discussion Materials, which got turned into the latest Wall Street movie. We're going to talk about this idea of turning Wall Street memoirs into movies and why it's having a moment right now. But first, let's go to Lisa Mateo for our Bloomberg Business Flash. Lisa.
Bloomberg Business Flash brought to you by VanEck. VanEck marking its 70th anniversary this year with a legacy defined by forward-thinking strategies, resilience through market cycles, and an enduring commitment to clients. Visit VanEck.com. Yesterday's stock sell-off extended into today somewhat. Fears of a hawkish pivot by the Fed, raising some fresh jitters about stretched valuations. Victoria Fernandez, chief market strategist at Crossmark Global Investments.
We are still not that far below all-time highs, really, when we look at the markets as a whole. So I still think there's probably some room to see more pullback, especially when you're seeing small caps down as much as they are.
Crossmark's Victoria Fernandez was a guest on Bloomberg Surveillance, but now check it out. Stocks starting to get a bit of a lift. We do check markets for you all day long here at Bloomberg. The S&P 500 pretty much flat. NASDAQ now 0.2% higher. The Dow is down 0.7%. The 10-year Treasury yield at 4.11. 1%, the two-year yield at 3.59%. And U.S. Trade Representative Jamieson Greer says the U.S. and Switzerland have essentially reached a trade agreement. He says tariffs on products from Switzerland will drop from 39% to 15%, and that Switzerland has committed to investing $200 billion in the U.S., and he says the White House will release more information on that new deal with Switzerland later today. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
That is Amy Morris.
Yeah, I can't, that's all on me. It's Friday and my brain is kind of fried.
It's all right. It's the Amy Morris. That's how I do it. And the pride of the University of South Carolina. She's down there in D.C. She has to deal with Nathan Hager every day. That's a tough duty, I think. But she does it well. We appreciate helping out here. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu. And we're joined by Bloomberg's Lisa Mateo. Lisa, what are you looking at?
All right, so we're starting with Cidara Therapeutics, ticker CDTX. Their shares have been up more than 100%. This is basically a biotech company developing a flu treatment. The big news behind it, though, Merck agreed to buy it. It's going to pay about $221.50 a share in cash. Total transaction value of about $9.2 billion. But the thing is, Merck, they've been trying to kind of make up for these upcoming patent losses they have, especially its cancer drug Keytruda. That's their best-selling drug in pharmaceutical history. Accounted for almost half of the company's revenue last year. So this is a big thing for them. It's preparing for patent losses, expected to erode its sales by $18 billion over the next 5 years. So that's a big number. And it's really looking to expand the portfolio. Because you remember back in July, Merck agreed to buy respiratory drug maker Verona Pharma for about $10 billion. So it's just this trend of competitive deals in the pharma industry. We're seeing it more and more.
All right, number 2 on your list?
StubHub, S-T-U-B, down as much as 25%. So they beat Wall Street's expectations for a second quarter revenue, but the CEO, here's where things went wrong. He's also the founder, Eric Baker. He said it's not giving guidance for the current quarter. He said the company kind of takes a long-term approach. He said the timing of when tickets go on sale can vary, so it makes it a little hard to predict consumer demand. The company does plan to offer the outlook for 2026 when it reports fourth quarter results, so I guess we'll have to wait till then. But this is the first time it reported quarterly results since its IPO in September, so I guess investors were not happy with this news.
This is unheard of. I've done 1 billion IPOs in a day. Never has this happened, because what you do is you go to the company and say, I want to know exactly what your earnings are going to be at least 1, if not 2 quarters after the IPO.
Right.
So my analyst can come in there and not do something, put an estimate that you guys can meet or beat. To have this happen is just inexcusable. I mean, oh my goodness.
Yeah, they're not having.
No wonder the stock's selling
down
out. All right, what else?
25%. And finally, yes, Warner Brothers Discovery, WBD. They're up as much as 3%. So there were a few things, right? You had the Wall Street Journal saying Paramount, Comcast, Netflix, they're preparing their bids. Initial cutoff to submit those non-binding first round bids by November 20th. So that's the first part of it. They say Warner Brothers hopes to have it all wrapped up by the end of the year. And then you had the Bloomberg report, too, that Warner Brothers Discovery, they amended the contract of its CEO, David Zaslav, to kind of make sure his stock options remain eligible to vest, even if the company is sold. His employment term also extended to December 2030 under certain conditions. Before that, it ran through 2027. So, I mean, you have the companies in the battle for Warner Brothers Discovery. Paramount reportedly wants, the whole shebang, the whole entire company. Comcast, Netflix, they're interested in, the movie, TV studios, HBO Max. Not the cable, though, network holding.
No,
they're not interested.
That's a declining business.
No?
Yeah.
Oh, wait, there you
It
go.
still generates a lot of cash.
Yeah. So you just have PE own it, or you just use
You just manage it for the cash flow.
Yeah, and lever up. Put all the debt on that thing. What's interesting is Laura Martin from Needham, her comment, like, hey, man, you got to take into President Trump into account here.
Yeah.
He's got to bless this deal through the Federal Trade Commission.
And he likes the Ellisons.
Yeah, and not so much the Roberts family at Comcast. So that plays into it. Politics, baby. Politics.
All right, Lisa Mateo, thank you so much. Lisa Mateo with our Market Movers. And of course, for more conversations like this, subscribe to our Stock Movers reports. You can get 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, there's been a lot of CEO changes in the telecom space lately, Paul, but now we're getting one in the retail space. The biggest retailer, Walmart, announcing CEO Doug McMillon will retire in February, and he will be replaced by the current head of Walmart U.S. Jen Bartashes covers retail staples and packaged foods for us here at Bloomberg Intelligence. Jen, was this a surprise, or was this a finely planned succession plan?
Good morning. So the surprise is really only in the timing, not in the selection of who is actually going to succeed Doug McMillon. So John Furner's been in a position for the last 6 years as CEO of Walmart US. Everyone has presumed that he would be the heir apparent to the CEO role. So it's really just a matter of the timing of it that has caught people a little bit by surprise today.
I'm looking at this guy, Mr. McMillon. He's only 59 years old. Now what? I mean, that's kind of young, right?
It is reasonably young. He's been at the helm since 2014. And I will say to his credit, he's really implemented a cultural change at Walmart. If you think back to the early noughts, Walmart had a bit of a reputation as maybe a bully with some of their suppliers and partners. And that culture has really evolved to where it's much more of a technology-led company. They're willing to experiment. They try, they fail, they move on. They've tried different strategies, and they're not afraid to back away when they're not panning out and to delve into something new. And that cultural shift really is attributed to Doug McMillon. And as for the timing, it just may be he feels that it's his time to have left his mark on the company and move on.
What does this mean for a company like Target or anyone else that competes with Walmart? Does this present an opportunity, or are things just going to go exactly as they were at Walmart, where the strategy remains consistent and there's no real entry point for someone who has maybe been an also-ran to kind of close the gap?
I think that's a great question. And when it comes to tactics, we're not expecting any major pivot in strategy by John Furner when he takes over as CEO. But to be fair, I mean, Walmart is firing on all cylinders at the moment, and they're gaining market share. They're growing their top line, growing their profit, so they're doing quite well. That said, at Target, we also had a new CEO announced not long ago. And for Michael Fidelke, who's moving into the CEO role, it's much more about the focus on Target's transformation and a turnaround plan. Now, whether that presents an opportunity with a change at Walmart as well, that's a little hard to say, because I think first Target's got to get their house in order before they go after other people's houses as well.
All right. So stepping back here, what's the play for Walmart? If you're an investor in Walmart today, why are you an investor in Walmart today?
Well, Walmart has done an admirable job of increasing the breadth of their business while simultaneously becoming more focused. If you think over the last several years, they've exited some of their international markets where they weren't performing well. They've really focused on technology, the implementation of things like AI to support their business. Their digital sales growth is growing. The marketplace for online sales is growing. So, when you look at it from an investor perspective, there are a lot of things that are happening at Walmart that should lead to consistent future growth. And, that also includes, a lot of the, it includes the efforts that they're making to bring higher income households into their group. And if they're able to successfully retain those households going forward, that just sets up a whole new wave of potential growth for Walmart in the long run, with a much more robust core customer. And so those are the kinds of things where you look at them and you look at them relative to competitors and how those peers are valued. And although, from a valuation perspective, Walmart is, more expensive than it had been, there's still a lot of opportunity to grow.
Interesting. I didn't think about that part of it, how it's more expensive than it had been, but still it's seen as the value play for, consumers overall. All right, Jen, thank you so much. Jen Bartashis, she is our Bloomberg Intelligence senior analyst who covers retail staples and packaged foods on this Walmart CEO change. Let's move now to the pharmaceutical sector with a big purchase here by Merck, a $9.2 billion purchase of Cidara Therapeutics for $221.50 a share in cash. Madison Muller is our Bloomberg News healthcare reporter, and she joins us now. And Madison, this is all about filling the pipeline because Merck is losing patent protection on one of its blockbuster drugs.
Exactly. And this is sort of the perpetual problem for pharmaceutical companies, is that they face these patents for huge blockbusters that end up accounting for a large majority of their sales. I mean, in Merck's case, almost half the company's revenue last year came from Keytruda, which is facing a patent expiration in 2028. This is a cancer drug, one of the best-selling pharmaceutical products of all time. And so Merck has been looking for other products to replenish its pipeline. Like you said, this is one of them. They did another deal earlier this year. And so looking to flu treatments, which flu, even though we have vaccines, antivirals for, the vaccines are effective, but for a long time, scientists, researchers, drug makers have been hunting for more effective and different products to help prevent the flu, which lots of Americans die from still each year.
So where would Merck like to be in terms of, I mean, I guess when you're thinking back, having half your sales tied to one drug, while it's a great drug and it's all good, that's probably not what you want from a diversification standpoint. What does Merck say about what they'd like to be?
Yeah, I mean, it's interesting because a lot of pharma companies end up facing this problem. I mean, we look at Novo Nordisk, and they're facing a similar issue. I mean, they're not necessarily looking at patent expirations, but they're looking at government price negotiations and cuts for their best-selling drugs, Ozempic and Wegovy. The majority of their sales come from those products. And so a lot of times pharmaceutical companies end up in this situation where they have one product accounting for the majority of sales. And so, you know, Merck is not taking this approach to like looking to just one company, you know, big deal, one company to get another blockbuster to replace Keytruda. They're looking to have sort of one analyst, which we have in the story, called it a string of pearls M&A approach, you know, looking to more like bite-sized deals to sort of diversify its pipeline and look to a couple different products to hopefully you know, replenish that. AbbVie was in a similar situation with its best-selling drug, Humira, and they now have, and that was an arthritis drug, they now have 2 arthritis treatments that are sort of accounting for like half and half of what Humira was bringing in. So it's interesting, and all the pharmaceutical companies are sort of taking different approaches to how they're doing it, but it seems like sort of doing this string of pearls approach, having a couple of different products, is the way that they're thinking about it right now.
I feel like I remember that once upon a time, a lot of these companies that were losing patent protection on their drugs would come out with like a tweak to the drug. You know, maybe it's in gel capsule form as opposed to tablet form, and that would, you know, extend the patent for a little bit longer. Is that something that they still do?
Yeah, I mean, it's definitely something that they still do. There are lots of ways to extend a patent, you know, getting a new indication for pediatrics or different formulations or combinations. But again, it sort of only gives you a couple more years. It doesn't extend the product's lifeline by like another 10 years, which that's what we're looking at. These companies have to think decades, you know, maybe a decade or more in advance about what's happening in terms of their pipeline. So while that's somewhat of a temporary solution or something that can be done earlier in a product's lifeline, it's like once you get to this point where it's sort of crunch time, they need to be thinking about what more can we bring in to make up for this.
Is the Trump administration and the regulators, are they okay with these deals? I mean, do they ever challenge any of these deals, or are they kind of under the radar?
So far, it's sort of under the radar. I mean, this one's interesting, actually. There was another analyst note this morning about how they don't think that the FTC, per se, will have a problem with this deal, but it's interesting to do a deal in the infectious disease space, given the Department of Health and Human Services stance on vaccines, infectious disease right now. And while this isn't a vaccine, it's just an interesting time in that space in general. So while there might not be additional FTC scrutiny, it might be something, and you know, again, this is sort of hypothetical, but just like given the climate right now, is something that HHS could potentially keep an eye on or look at.
Yeah, and this goes to the idea why people do buy biotech stocks, Paul, because any of these could be a lottery winner. You don't know which one is going to get picked up by a Merck or a Pfizer at any given point.
And it seems to me it's a binary result. It either hits and you get a double like you did today, or it doesn't. And then you're just
kind of dies off.
Kind of dies off, you know. But that's why the hedge funds love them, because they think if they can get an edge,
exactly,
which is kind of what their term, then they can generate.
And there's this whole sub-industry of experts, right, who are digging into each of these companies and what drugs they've got under development.
It's a whole thing.
Madison, thank you so much, as always.
you.
Madison Muller is Bloomberg News healthcare reporter talking to us about Merck and its latest acquisition, Cidara Therapeutics. It's a $9.2 billion deal in cash. And of course, in July, it announced a similar size purchase when it bought Verona Pharma for around $10 billion. This string of pearls approach to M&A. I love that
That's
phrasing.
why, me too, I love that. But that's why I always say in the next life, I'm coming back as a healthcare M&A banker. Get paid every single Monday. You get paid.
The consistent part of this is you're going to come back as a banker.
Sure. Yeah, absolutely.
This is Bloomberg Intelligence.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. I'm Amy Morris. This Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. Cidara shares now 106% higher after Merck agreed to acquire therapeutics company for about $9.2 billion. Merck is looking to expand its portfolio of treatments because the patents are now expiring for a lot of its drugs in the next few years, including its most popular drug, Keytruda. Walmart CEO Doug McMillon will retire in February and be replaced by the company's U.S. head, John Furner. McMillon's retirement marks the end of an era for Walmart. He'll stay on the board until June, and then remain an advisor to Furner through fiscal year 2027. Shares of Walmart now about 1% lower. Stocks paring back some of those losses, now off those session lows. We do check markets for you all day long here at Bloomberg. The S&P 500 up 0.2%. NASDAQ up about 0.5%. The Dow is down about 0.5%. The 10-year Treasury yield at 4.12%. The 2-year yield at 3.59%. And Wall Street's kind of getting sour on U.S. airlines after the longest government shutdown in the country's history and a chronic shortage of air traffic controllers clouding the outlook for the closing months of this year. That's ramped up pressure on an industry already suffering after that shutdown. Shares of Delta now down 4%, Southwest shares down about 0.5%, and United and American shares each down more than 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM Insured Municipal Bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. There you go. The good friends at BAM Mutual. We go to their offices once a year. Some good folks over there. Let's talk about this municipal bond market here. Eric Kazatsky joins us, Managing Director, Client Portfolio Manager at Mackay Municipal Managers. Oh, it's in Princeton, New Jersey. How convenient for Mr. Kazatsky. Eric, talk to us about the new issuance market. You guys were just ripping it last year in new issuance. How's 2025 looking?
Yeah, another banner year, right? I mean, we're going to probably finish the year close to $550 billion in issuance. But I think more importantly is the fact that it was pretty orderly. You know, look, if you asked me 5 years ago if I thought the muni market could handle 2 years of this level of issuance, I would have told you were crazy. I'm happy to be wrong. It's been quite orderly. Everything has been well digested. And next year, some of the forecasts I'm seeing are already even higher than that. So, you know, good stuff on the horizon.
You know, I was thinking about some of the big deals that we saw this week. Cornell is preparing a record $1 billion bond sale after striking a deal with the U.S. government. And of course, it's not going to be the last university to have to come up with a deal with the White House and perhaps raise funds for it. What kind of demand is there for this kind of paper?
Yeah, I mean, look, it's a taxable deal. It's huge in size, index eligible, with a marquee name in the higher ed space, right? So good credit quality, checks a lot of boxes, and it's going to be catnip for not only domestic investors, but also overseas investors. You know, we're getting a lot of inquiry, especially on the taxable muni side, for people who want U.S. dollar-denominated risk. They don't want exposure to equities. They don't want exposure to corporates. They see the cracks in their private credit, private equity side. So this is going to be an answer that's going to check a lot of boxes and be pretty successful.
So, Eric, what's the paper that people in your world want to own the most these days?
The ones that are going to have the best returns, Paul, right?
And where do you steer them?
Yeah, no, I mean, look, we spent the last year doing two things, right? Resetting book yields higher as rates sort of spiked up, and also stepping up in credit quality. We think that having that higher credit quality conviction, especially going into next year and seeing some cracks on the horizon in the economy, is certainly not going to do us wrong, and it's certainly going to provide a lot of ballast in portfolio returns going forward. Look, areas of concern, you know, that we've touched on in prior conversations, you know, especially in light of the passing of the OBBBA, really like spots in healthcare and higher ed. You know, you had some cuts to Medicaid from the federal level, but you know, when it comes to higher education, also probably like a wholesale rethink about the value proposition of a 4-year model. Like, what does that look like in 5 to 10 years? And sort of stepping up in credit quality and being more selective within that space.
Eric, I wonder what you see when you look at the credit market. You mentioned how maybe people are feeling a little bit concerned about the cracks in the private credit market. Maybe, you know, this week we've seen, for instance, DXC withdraw its investment grade offering, which is really unusual. And we've also seen Applied Digital selling, I think, $2.3 billion of junk bonds at a pretty steep discount, priced at 97 cents on the dollar with a yield of about 10%. How does that spill over into the muni market when it comes to sentiment and people's concern about emerging problems?
Yeah, I mean, I think this is where munis are going to play a key role if we see further cracks in spread widening, especially on the corporate side, right? Munis are an uncorrelated asset class, and they're going to behave a lot different in a slowing economy. You know, if we think the economy is rolling over and the Fed is becoming more active, they obviously see some things on the horizon they don't love. You know, I think that munis are going to play a nice role there to sort of help bring risk down in not only like, you know, tax-exempt portfolios, but also taxable portfolios as well. You know, the credit quality overall is still fairly strong. You look at the U.S. debt to GDP of 124% versus 13% debt to GDP for the muni side in the States. You know, it's hard to really sort of say they're equal footing.
Eric, thanks so much for joining us. Appreciate it. Eric Kazatsky, he's a managing director. He's a client portfolio manager at Mackay Municipal Managers. Looking at Bitcoin here, it's off of its lows. It's off about 1.8% right now. Had been off, you know, down, and we're sitting around $97,000 per token. We had been as low as $94,500 per token. Apparently, the ETFs, the retail folks, have been kind of pulling back a little bit.
Flows are driving a lot of the price action, and I feel like October 10th was really the turning point because you had this mass liquidation event. There was a lot of leverage bets that were unwound, and since then, Bitcoin has really struggled to maintain momentum, and it's losing momentum.
Let's see how it's faring from the perspective of the ETF world. James Seifert, he's the ETF research analyst for Bloomberg Intelligence down there in Princeton, New Jersey. What is it about Princeton? I mean, I don't get it. It's a nice town and everything.
Common thread.
Conti's Pizza, Hoagie Haven, I get it, but, you know, we'll have to see here. James, thanks so much for joining us here. What's the ETF world doing with gold these days?
With gold?
I mean, gold. With Bitcoin.
Paul is old school. He's thinking gold, but others think Bitcoin.
You're thinking gold. You want to know digital gold. I mean,
yeah, exactly.
Honestly, the gold ETFs, I know we're not supposed to talk about this, but they're on fire. Gold obviously has done very well. For a while, the Bitcoin ETFs were actually in spitting distance of catching the gold ETFs, but gold has absolutely pulled away as far as AUM inflows go.
All right, so why are people pulling out of Bitcoin ETFs? And what does that mean? Are these retail investors? Are these institutional investors? I mentioned that October 10th liquidation event, and there's a lot of reporting about how there's less conviction on the institutional side for Bitcoin right now.
Yeah, I mean, I would say two things. One, obviously, there was a massive outflow yesterday. It was nearly $1 billion that came out of the spot Bitcoin ETFs. No disregarding that, right? But the other part of it is like, up until basically October 10th, these ETFs had taken in over $62 billion in 19 months. They've now seen about $3.4 billion come out over that time period since that October 10th date that you guys keep pointing to, which was obviously pretty bad, tons of liquidations. But at the end of the day, it's like $3-ish billion that has come out compared to 62 that has come in.
Okay, fair.
So like the way these things tend to grow is they go 2 steps forward, 1 step back. Occasionally they go a couple more steps forward and a couple more steps back. This goes for Bitcoin price and Bitcoin ETF flows. The question is this one of those things where they're taking a step back right now? Or is this the beginning of like a giant leap backwards? Because Bitcoin, if anybody has listened to this over any period of time over the last decade, is subject to very typical 25 to 30% pullbacks, even in bull markets, and over longer time periods, 50 to 70% pullback. So if you're investing in this thing, you don't understand that you could be dealing with this type of volatility, you should probably take a good look at things again.
Paul, I feel like they should change the definition of a correction or bear market when you're talking about crypto.
Yeah.
Right? It's not 10% for a correction. It's something much larger. It's not 20% for a bear market. It's something massive.
Exactly. Hey, James, what's the flavor of the month? What's the new trend? Because I mean, it seems like your market there's so many new ways to invest and to look at the market. And what's new for you guys these days?
I mean, so sticking with the crypto theme real quick, I'll just say we just had the first XRP ETF launch yesterday, which was the biggest launch of the year. A couple weeks earlier, we had the Solana ETF launch, which is another crypto, which was before XRP was the largest ETF launch of the year. So crypto is big still, despite this massive pullback in these risk assets. And as Scarlett was hinting at, they are, they're leverage beta in a way to risk markets. But other than that, ironically, it's the single stock ETFs still going very strong as far as flows and launches go. The other thing is, like, there's a lot of these derivative income products, auto callables, which we don't have enough time to go into exactly what they are. But basically, a lot of people seem to like this. We're calling it manufactured yield, whether it's covered calls or doing a bunch of different things with derivatives to generate a specific outcome. That area of the ETF market is doing very well. But honestly, all of this is fascinating and interesting. It's growing very quickly. But at the end of the day, still the biggest growth driver your basic beta exposure, S&P 500, total market, total bond. Those are the types of things that still take in the bulk of the money. They're just not as fun to talk about.
Because it's such a consistent story, right? To what extent were Bitcoin, spot Bitcoin ETFs and all the derivative Bitcoin ETFs competition for the digital asset treasury companies that, really cropped up over the summer and are now not doing as well?
Yeah, so I was one of those people. I think most people kind of thought that once these spot ETFs come out and you don't have to use like a futures ETF that rolls those futures contracts to get exposure to different digital assets, I think DATs were a better option in many regards to get exposure to this space. And so I thought once these spot ETFs come out, we had a Bitcoin and Ethereum come out. I thought these DATs, as we call them, would get hit from the ETF launches. But ironically, it was more like a flywheel. They kind of compounded on each other. Flows came into the ETFs. The DATs were doing well, taking in tons of money, a lot of buying. They were buying a bunch of crypto. So right now, it kind of looks like that flywheel that was going in the right direction for price might be spinning in the opposite direction. It's weird. You would think they would compete, but they really don't. Like the DATs are kind of like doing this financialization side of things, and the ETFs are more like, do you want exposure to this asset? Do you want spot, basic, beta exposure to the underlying asset? We'll give it to you. The DATs are a little bit crazier, and I think they got a lot of the brunt of like the craziness that we typically see in the crypto market over the last year or so. And as you said, it's unwinding now. I don't know how many. There's so many of them. I would bet that a lot of them are going to run into trouble, but I don't think all of them are going to run into trouble. We'll see how it plays out.
The OG is still there, right? Strategy, formerly known as MicroStrategy.
Yes, exactly.
All right, very good. James, thanks so much for joining us. Appreciate it. As always, James Seifert, he is ETF research analyst for Bloomberg Intelligence. And what was that October liquidation you referenced? What happened there? I forget.
A lot of people pulled out of Bitcoin and the altcoins overall. And it was a lot of leverage products. So there was an unwinding of some big leverage positions because it was kind of the peak of the excitement into crypto and all the DATs, the digital asset treasury companies. Like every company was transforming itself into a digital asset treasury company.
Digital asset treasury company.
Yeah, DATs. Yeah, like strategy turned into, like I'm just going to hold Bitcoin and you're going to pay me a premium to hold my stock, which holds Bitcoin.
All right. It's a whole new world out there, kids. Proceed with caution. Bitcoin
Absolutely.
Off 1.6% today, 97,100. Again, just to put in context, a couple months ago, hit an all-time high of around $125,000 per token. So it's certainly a pullback there. S&P plus 18, the Dow minus 208, and the NASDAQ up 135. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. I'm Amy Morris. Walmart CEO Doug McMillon is retiring. U.S. Chief John Furner takes over in February. Jen Bartashis is a senior retail analyst at Bloomberg Intelligence.
I think everyone has expected that at some point he was going to retire. And John Furner does seem to be a logical next in line for Walmart. I wouldn't expect that this would in any meaningful way change Walmart's strategy.
Jen Bartashis with Bloomberg Intelligence. Walmart shares about 1.5% lower. A resurgence in tech shares has pushed stocks away from session lows. It is a cautious rebound. Traders cut the odds of a December rate cut to less than 50% after Fed officials voiced some skepticism about the need for a third straight reduction. We do check markets for you all day long here at Bloomberg. The S&P 500 now up 0.4%. NASDAQ up 0.75%. The Dow still down, though, only about 0.3%. The 10-year Treasury yield at 4.13%. The 2-year yield at 3.6%. U.S. Trade Representative Jamieson Greer says the U.S. and Switzerland have essentially reached a trade agreement. He says tariffs on products from Switzerland will drop from 39% to 15%, and that Switzerland has committed to investing $200 billion in the U.S. He says the White House is expected to release more information on this deal later today. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. We go back now to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Amy Morris, thank you so much for that Bloomberg Business Flash. Scarlett Fu and Paul Sweeney here on Bloomberg Intelligence. And it's Friday, Paul, so I don't know if you've got movies on your to-do list tonight.
Just about to download one right now for my 2-hour train ride home.
All right, and I know that you're kind of partial to movies about things that you know and very well, like Wall Street.
Yeah, and there's been some great Wall Street movies. My favorite is Wall Street, Bud Fox.
The original?
Yeah, the original.
Not Wall Street 2.
No, look at the phone bank that Bud Fox has there. That was my phone bank when I was on the trading desk.
All right, so Paul likes Wall Street movies. I got to confess that I do too. You can add another one to the canon of Wall Street movies. There's one coming out today called Bull Run, and we're here now with the author of the memoir that was adapted into Bull Run. His name is Bill Keenan. Bill Keenan was the author, or is the author, of Discussion Materials, which was turned into Bull Run. Bill, good to see you.
Good to see you. Thank you guys for having me.
So, a lot of movies in Paul Sweeney's canon of Wall Street movies, Big Short, Wolf of Wall Street, Boiler Room, Margin Call, his OG Wall Street. Where does Bull Run fit into this?
So, like all those movies, classics, right? Bull Run has an outsider as a protagonist. So we kind of have that journey of someone entering this world, trying to figure out what to do and where they fit in. I think the difference is a lot of those films follow that story of kind of there's this crazy excess, there's ultimately this corruption that happens, and then redemption. And the protagonist in Bull Run really retains this outsider's perspective, which is the way I experienced it. I kind of saw life through the eyes of a storyteller and tried to maintain this distance, and I think we tried to do that in this film. So it's not so much about the corruption as it is about just observing the absurdity that goes on in this world.
So you were on Wall Street. Tell us what you did in Wall Street and how that might have influenced kind of this project.
Yeah, what I did. Well, by title, I was an investment banking associate in the Industrials Group at Deutsche Bank. We parted ways after about 2 years. I think it was mutual. It wasn't for me, and it wasn't. They weren't sad to see me go, but it was. I mean, the beauty of Wall Street is that, again, as a storyteller, it's such a combustible environment. So everything is so urgent and is life and death. But then it's like, this is a specialty lubricants deal. And like, it's okay if it doesn't go through. But it's fun to be a part of. And I knew the second that I started, this would be so ripe with anecdotes and characters that it was, I needed to stay long enough that I could get enough material to write about it.
I kind of think of your book, Discussion Materials, as a 2020 version of Liar's Poker, except instead of bond traders, you're writing about investment bankers. So when you were there, I mean, it sounds like you decided early on that you were going to take notes and observe everything. What were you doing in meetings? Were you taking notes on what people were saying, or were you kind of engaging in, the lubricants deal?
Yeah, I mean, I think like this. I was always commended at the beginning by like the staffers and the senior bankers because they saw me with the notepads, and every day was a new notepad, and of course they didn't necessarily know that I wasn't taking notes on the content as much as like who was doing what and what would lend itself to a story, but. It was, it felt like it was a lot longer than 2 years, but I got enough out of those 2 years to,
And they packed a lot in 2 years because you're working round the clock, weekends.
You're working, yeah, and I'd like to kind of, the way that I try to capture what the experience was like. The first day that I showed up, I didn't even know where my desk was, and I'm kind of going around this maze of cubicles, and I get called over to the staffer, and he says, here's an address and here's 3 names. And ultimately what I was tasked with doing that first day was taking around these 3 energy executives through Midtown Manhattan. They were starting a new venture, and they were looking to raise like $200 million from these private equity firms. And so I said to the staffer, we just met, I don't know what's going on. And his response was, definitely don't tell that to these guys. Like, as far as they know, you're a full-timer and you've been here for a long time. And so, being thrown in the deep end, then ultimately meeting these guys and feeling that responsibility, it was, you feel accountable. Tuesday, I show up, I get staffed on a fertilizer deal, and I had 2 tasks that day. I do find my desk. I sit at my desk for 12 hours. And the first task is to chart the cow dung spot prices historically over time. And the second thing is the managing director in that sector, he had recently undergone gastric bypass surgery. He lost about 80 pounds. And so I had to change the photo of him in the team pages of all the decks. And I'm thinking Monday, Tuesday, what's Wednesday going to bring? But like,
Right.
this is gold.
It is gold, but this is why it's so great talking to you, and the book is so fantastic. You also chronicle participating in these odd meetings with managing directors, updating Excel spreadsheets at 2 in the morning, reformatting the font in pitch books. I think about all this and how OpenAI in 2025 is hiring former investment bankers to train its models and presumably replace the need to hire people like you to handle these mundane tasks. Is that a good thing?
I think all these things are going to need oversight, like we know, but I mean, the reality is we were sort of outsourcing, and not to AI, but to all these other companies and other countries, and they did a lot of my work, to be honest. I kind of took credit for most of it and changed the names and made sure everything appeared as though I had done the work. But anything that makes it more efficient and gets kind of people out of the way when they don't serve a purpose that's additive, I think is useful.
Yeah, I've been telling Scarlett, the first 2 or 3 years of I was an investment banking associate as well after business school. I felt like most of what I did can be outsourced to AI. Sorry to say, but I mean, do I need to be sitting at the printer at 2 o'clock in the morning on a Tuesday? I mean, can AI do this for me?
But totally. The fact is, though, to have that experience as a human and to pay your dues, there's huge value to that. And you hope that there's a way. I think the way humans are, they always find a way to go towards struggle.
That's what I tell my kids who are in the workforce now, and the whole work from home versus, I'm just like, go to the office. All my memories are sitting at the printer. And the guys I sat at the printer with at 2 o'clock in the morning on a Tuesday night, they're still my best friends. The guys that I can call up and they will, if I need anything, boom.
Yeah.
That's how it goes.
Band of brothers, really.
Yeah.
So, Bill, when you adapted this into a film, what was that process like? Was that, I'm sure you could write a book about that process too.
Yeah, there were practical issues. We shot it during the pandemic. So this was an independent film shot in one location. So we're all over each other. We got the masks on. We had to shut down production, in fact, for a couple days. So there was that. We got through it. As far as the story, so much of my experience was me versus Excel, me versus PowerPoint, me on the phone with somebody telling me the numbers didn't tie, I just screwed this up. And so there's a lot of internal drama that's great for a book, but does not lend itself to a visual medium. So the director did a great job of really retaining the spirit of the book and the humor and how I viewed that world, but then putting it in a visually compelling commercial sort of feel.
I went to Apple TV, just downloaded it on the phone. I'll be watching it on New Jersey Transit this afternoon.
Do you make a cameo appearance?
I do, but it got cut out.
Oh, no. Oh, my God. I can't believe that wasn't guaranteed or anything. You should have had that written into your contract.
Maybe the sequel.
Yeah, exactly.
I do better behind the camera.
Bull Run 2. All right. Bill, really appreciate your joining us. Bill Keenan, he is the author of Discussion Materials, also another book called Odd Man Rush. Both were made into movies, and of course the latest movie is called Bull Run, and it is available at selected theaters nationwide and available on Apple TV and Amazon Prime. All right. And that does it for Bloomberg Intelligence this hour.
No, I'm doing
for the weekend.
For you. See, I'm here. We got 11 minutes left, dude.
Oh,
So
yes.
I've got another
I move off to
segment.
TV. That's
You go
why
to
I think
TV,
that.
that's why.
Yeah. Okay. So pause back in just a bit.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast. That's where you'll find us. A lot of news in the telecom space today. We had a lot of change in the CEO suite. We've got a lot of stuff happening here. Verizon's out with a big story I want to get to about cutting costs there. John Butler joins us. He covers all the telecom stuff for Bloomberg Intelligence. Let's start with Verizon here. Planning to cut about 15,000 jobs. That's about 15% of the workforce. I mean, this is big. What's going on there?
That is a lot. So they have a new CEO, Dan Schulman. He's been on the board for a long time. So he's had a front row seat to what Hans Vestberg was doing. And his feeling was that Vestberg, who was leaning into a network first strategy, so he was out there telling everyone Verizon has the best network. It's the only reason to be with us. It's the best reason to be with us. And it just wasn't resonating. I think Schulman saw it and said, we need to be consumer first, not network first. So he took over, I think it was October 3rd, at the beginning of October. He's new at the company, but again, I'm sorry, he's new in the role, but he's not new at the company. And so I think my hope is at least that these cuts are carefully considered, because just as you say, with cutting 15 to 20% of the workforce out of telecom, risk cutting into bone, not just fat.
And he was at AT&T before. This is a telecom guy, right?
He was at Virgin Mobile too. He has telecom experience, and he also helped to sort of pull PayPal out of the dredges. I think they headed back there during his tenure as well. So it was a little bit of a controversial ride for him there. But I think he has the kind of telecom experience and board experience at Verizon to bring some changes to the organization. When I talked to the company about his naming as CEO, the answer was, we're bringing him in as a change agent. We really need shakeup here. So,
and that's an industry that could probably use it a little bit. I mean, like John Ledger at T-Mobile did such a great job as a change agent.
He did. So what he recognized is that consumer wireless is a consumer retail business, right? They have brand spokespeople. They advertise on the Super Bowl. They have free Tuesday, T-Mobile Tuesday giveaways. And Verizon just seems off base there. I don't think they really hit the ball well when it comes to being in the consumer retail business. And
my thing was they're an old Bell company, so they have some of that legacy.
It's in the culture there. And hopefully Schulman can sort of instill that excitement in the consumer. That's his big challenge.
But I mean, that's a business, the wireless business. That's a tough business. It's very competitive. Top line growth really not there in a large. So maybe cutting costs is a way to deliver cash and earnings.
It's part of it. I think they also need to move into adjacencies. So if you look in Canada at the carriers there, like Rogers owns the Toronto Blue Jays and Rogers Center Stadium. They're in media. They're tapping a lot of different adjacencies to make up for that slow growth in wireless.
All right, another story that is really front and center for me and for a lot of it kind of telecom equity investors and bond investors is satellite, SATs, EchoStar.
Yeah.
And finally, Charlie Ergen, the CEO and founder of EchoStar, finally selling the spectrum. Is that what's going on? Because he bought a lot of spectrum.
It has been a crazy ride. So EchoStar, as you know, their roots were in satellite delivered pay TV. That market is dying with a capital D. And his decision was, let me take the capital I have and get into the consumer wireless business and compete with AT&T, Verizon, and T-Mobile. And I think every analyst, including myself, asked, what are you doing? And he bought a treasure trove of spectrum, and he was sitting on it. He was beginning to deploy it. He was building his own wireless network, but they weren't getting any subscribers. And I think the FCC looked at it and said, we need more spectrum in the hands of people that can really fill the airwaves. And so they started to get pressured a lot by the FCC, and that prompted the sale of spectrum to Starlink and AT&T.
I guess the good news is he is selling the spectrum for a lot of money. Right. The stock's up. It's tripled this year. That's the good news. The bad news, it took him about 15 years, it seems like, to do what we all knew almost 15 years ago, which is you either build a network or you flip the spectrum and we make money either way. But boy, it took a long time for him.
Well, not only that, I always thought they were Dish as a pay TV provider. It's a strong brand name. I mean, become what's called a mobile virtual network operator, MVNO, where you basically have AT&T and Verizon run the network for you. You do the billing, customer care, and most importantly, the marketing. And so you're out there with a Dish Wireless brand. Yep. You don't have to worry about spectrum or network operations, and they just decided to do the network themselves. And
well, this is just an example of Charlie Ergen, who many investors on Wall Street, bond investors and equity investors, they'll do whatever this guy says. I mean, because he made so much money for so many investors for such a long period of time, which he did ultimately here again, but it just took a long time. And I think a lot of folks just got tired of waiting. John Butler, thanks so much for joining us. John Butler, he's a senior telecom analyst for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker studio. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius Channel 121, presented by Oracle. Stay tuned for the latest market news and industry research. Your top stories, global business headlines, are coming up in just a moment. S&P 500 up 26, the Dow minus 40, 140, and the NASDAQ up 160 points. This is Bloomberg. Good morning.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. Hours after again labeling the Jeffrey Epstein files a hoax, President Trump calls for an investigation of the late sex predator's ties to Democrats.
In a social media post, Trump says he's asking Attorney General Pam Bondi and the FBI to investigate Epstein's relationships with former President Bill Clinton, former Treasury Secretary Larry Summers, and LinkedIn co-founder Reid Hoffman. Next week, the House will vote on whether to compel the Justice Department to release all its Epstein files. Georgia Congresswoman Marjorie Taylor Greene told CBS Mornings Trump should not oppose the release.
I think it's a huge miscalculation.
She points out some of Epstein's victims have said Trump did nothing wrong. Michael Wallace, CBS News.
No decisions have been made, but officials are making it clear plans have been drawn up if the U.S. chooses military action in Venezuela. CBS's Ellie Watson covers the Defense Department.
Venezuela is going to do several days of exercises with around 200,000 troops. The stated mission is to be a response, to be a deterrent to the U.S.
Now to Illinois, where protesters clashed with police outside the Broadview ICE facility as a group of faith leaders was holding a demonstration. CBS News Chicago's Lauren Victory.
They were singing for a short amount of time before this little bit of chaos ensued about wanting to, let us in, let us in. They were going to try to be bringing some Holy Communion, I think, into the facility, even though in recent weeks they've been denied that opportunity several times.
Flooding and mudslides are feared as a strong storm system batters California. Gary Kelly lives in an area in Southern California where January's fires did major damage.
Anytime you have the fire that's spread through the hills and then you have rain, a lot of that mud can come down. So that's what I think everyone's worried about.
The firm Anthropic says its AI software was used in the first documented case of a worldwide cyber attack with minimal human involvement. CBS News tech contributor Chris Krebs.
I think that this is a sign of things to come. As security experts, we've been talking about events and attacks like this for close to a decade, and to see it actually come into life like this is pretty chilling, and there's a lot of work we have to do in the near future, I think, to stem the flow.
The U.S. and Switzerland reaching a deal today to sharply lower tariffs imposed by President Trump. U.S. Trade Rep Jamieson Greer says Switzerland is vowing to invest $200 billion in the U.S.
Switzerland on the industrial side already has fairly low tariffs, but they've agreed to remove all industrial tariffs. They've agreed to give us market access for things like poultry, which is really challenging for the U.S. and Europe.
And checking Wall Street, the Dow is down 152 points. This is CBS News. On his way to the Super Bowl halftime show, Bad Bunny had a big night last night at the Latin Grammys.
And the Grammy goes to Bad Bunny.
Puerto Rican superstar swept the Latin Grammys on Univision with 5 wins, including the biggest album of the year.
When you do things with love and passion, everything is easier.
Bad Bunny's called it a love letter to his island. Karol G won Song of the Year. Gloria Estefan gave all the credit to her husband and musical partner Emilio for her win for Best Traditional Tropical Album.
Baby, este disco no existiera si no fuera por ti.
Deborah Rodriguez, CBS News.
President Trump's granddaughter Kai, a high school senior and University of Florida recruit, shot a 13 over par round in her first LPGA tournament yesterday in Florida, placing her last in the 108-player field. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
It's Free Taco Friday. Welcome to Balance of Power as the White House prepares new exemptions on kitchen table tariffs. We can make tacos out of everything from bananas to beef today as food prices keep rising. We're going to get the view of Bloomberg's Laura Davison on what could be the next important leg in the tariff story coming up. Lawmakers are leaving town again after working 1.5 days to reopen the government. We'll talk about the agenda coming up with Democratic strategist Kristen Hahn from Rock Solutions. And with our panel, Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us for the hour, and it's all after a look at Wall Street. Let's get up to date right now on the Friday trade, see if there's a bid under these losses with Amy Morris in Washington. What do we have, Amy?
All right, you called it, Joe. Stocks pairing those losses now thanks to a resurgence in tech shares. That rebound, though, is kind of limited. Check the markets for you all day long here at Bloomberg. The S&P 500 is now up 0.4%. NASDAQ up 0.75%. The Dow, though, still down about 0.25%. The 10-year Treasury yield at 4.14% and the 2-year yield at 3.6%. And Walmart CEO Doug McMillon will retire in February and be replaced by the company's U.S. head, John Furner. Furner's going to take over as Walmart faces a shift toward AI, an uneven U.S. economy, and a changing global workforce. Shares of Walmart right now down a little more than 1%. U.S. Trade Representative Jameson Greer says the U.S. and Switzerland have essentially reached a trade agreement, saying that tariffs on products from Switzerland will drop from 39% to 15%, and that Switzerland has now committed to investing $200 billion in the U.S. Greer also says that the White House is set to unveil fresh tariff exemptions to address high food prices. Those exemptions are designed to remove reciprocal tariffs from those agriculture products that are not grown or produced in the U.S. And Topgolf is reportedly in talks to be sold. The Wall Street Journal reports Topgolf Callaway could be sold to private equity firm Leonard Green. Sources say the deal would value Topgolf, which operates recreational driving ranges, at about $1 billion. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That is a Bloomberg Business Flash. We go right back to Balance of Power now with Joe Matthew.
Thank you so much. Happy Friday. Welcome to the threshold of the weekend and the Friday edition of Balance of Power here on Bloomberg Radio. Streaming live on YouTube, search Bloomberg Business News Live, unless you're already watching us on Bloomberg Originals. If your satellite radio's working, clock us in channel 121. It's getting quiet around here again on Free Taco Friday. You know, I said that earlier, it's Free Taco Friday, because that's what they do at the National Press Club. That's how these 20-something-year-old journalists get to eat before the weekend, and it packs the club. But Cece just told me this is a whole thing. There's a tradition in Sweden. Taco Friday. Toppings include pineapples, peanuts, and cucumbers. The stuff that you learn on this program. Don't need me to remind you. So the President of the United States is getting ready to leave town. Lawmakers are already gone. The government is open, and still no one's in a very good mood. Certainly not when it comes to prices. The big conversation about affordability is getting louder. We sat down with Peter Navarro last evening, who referred to the pain that the MAGA base is feeling. And just this morning, we saw Jameson Greer in front of the White House, of course, USTR, talking about the potential now for exemptions. This is what's coming from the White House. preparing exemptions on tariffs for food. Starting with the stuff you can't really grow here, although I guess beef is part of that, and we're pretty good at that in the United States. But the Argentinian beef is coming in. We're looking at bananas. We're looking at coffee. We're looking at avocados. Here's Greer at the White House.
We've really reached that critical mass where we've started to reshape the global trade system in a way that we think is better for America, and so now is the right time to to release some of these items that the president said he was going to release. And I mean, when you look at Southeast Asia and South America, that's where we get a lot of this stuff. You know, the coffee, the cocoa, the bananas, those kinds of things. So this is a natural outgrowth of exactly what the president signaled, and that's what he's doing today.
Coffee, cocoa, bananas. That'd be an interesting taco. Now, the president on Truth Social, cost and inflation in all caps were far higher under the sleepy Joe Biden administration than they are now. In fact, costs under the Trump administration, he says, are tumbling down, helped greatly by gasoline and energy. Affordability, he says, is a lie when used by the Dems. It's a complete con job. He then goes on to say Thanksgiving costs are 25% lower this year than last under Crooked Joe, referring, of course, to this bundle at Walmart, which it's the annual Thanksgiving promotion, excluded a bunch of things that were in the package last year, which is why it's significantly cheaper. The president referred to that as a study yesterday. It's a coupon, essentially, at Walmart. So as the affordability conversation gets louder, the political stakes get higher. And Laura Davison joins us now on this Friday. At the desk here in Washington, our Deputy Washington Bureau Chief. Great to see you. You almost survived another week. Same issue that dogged President Biden. Same issue that got Mamdani elected in New York. Same issue that's dogging Donald Trump.
And the same response that Biden had to this issue, to sort of shrug it off and say,
Yeah.
oh, look, nothing to see here, no problems. And that's really what got Biden in a jam of he was saying, look, there's certain economic indicators that are, looking strong. That didn't resonate with people. People aren't feeling that the economy is strong, and particularly as prices continue to increase, we have a weaker labor market. People are uncertain about their jobs, and this is, causing a lot of angst within the White House. Because if you scroll back to the beginning of the administration, you had people like Scott Bessent and Howard Lutnick say, look, it'll be Trump's economy. Once we get to Thanksgiving, once we get about 10 months in, we're here now. Yeah. And so now they're having to sort of grapple with the fact that consumers aren't super jazzed about the economy. There's some warning signs ahead, and the tariffs, the White House's own policies are fueling some of that.
Which the administration is not acknowledging, right? Even though we have these exemptions, they're still pointing to Joe Biden as the person who caused the inflation that we're still trying to get out from under. But how do you reconcile that with these exemptions on food items that are clearly more expensive?
So this is, in speaking of tacos, Trump a little bit, here backing off of some of these tariff policies. Economists had warned for months that there are certain things that just cannot be made in the U.S. Because of climate or other issues. Sure. And so they're looking at they mentioned bananas and cocoa and some of these things, but Greer made an interesting point there on the White House lawn, saying that basically anything that isn't produced in the U.S. in quantities to meet demand. So that could mean during the winter months a lot of fruits and vegetables, even things that we do grow here, but so they're giving themselves a little bit of wiggle room to create potentially a very, very big loophole here if they want to, if we really see food prices start to spike.
Has anyone talked to you about wine? Are they going to finally bring the wine tariffs down? Laura Davison, let me know when you find this out. It's really expensive now. What happens though when you write, you're not going to delete this now, as he says, costs under the Trump administration are tumbling down. We don't have data that backs that up.
The data does not back that up. In fact, we've seen prices, continue to tick up in recent months. So you see the White House start to grapple with different issues here. Okay, could we do some sort of, $2,000 refund, check that goes out to households? The problem with that, economists have also warned, is that could fuel inflation. There's not a lot of great options when you're in, a scenario where you have rising prices, where you have, so this is kind of the issue that they're trying to solve. Meanwhile, there's still a little bit of chaos at the Fed, a new chair coming in, Trump really putting a lot of pressure on lower interest rates, and this is, and to boot, we don't have any economic data to give us a real clear picture of where we are right now.
Well, part of the reason why we've had some tough days in the market here is there is this impression now that maybe the Fed's not going to be cutting the way the market was betting or expecting even just a couple of weeks ago here. And you wonder, with the lack of data, and I know from your perch as Deputy Bureau Chief, you're looking at the econ team, you're looking at the political team, and they kind of meet here with a lack of data following the shutdown, a Fed that's partially blind and is also worried about inflation. Are we in for a big disappointment in December?
It's certainly possible, and Hassett admitted this, earlier this week. Said, look, it's going to be a very, very cloudy outlook.
Yeah.
And we've seen this Fed be pretty cautious under Jerome Powell. They're not going to move extremely quickly. You may see some dissents in this December meeting, like Stephen Myron and others who have kind of pushed for more cuts. But if they don't have the data, right now the indications are that they're not going to take a leap of faith here. That they're going to wait and see and move very ploddingly and slowly.
There's concern, too, about the cumulative effect economically of the shutdown. There's some economic inertia involved here, right? Just when you turn on the lights on Capitol Hill does not mean everything's popping back. And you've got hundreds of thousands of people who went without pay for a month and a half. A lot of them said they were paycheck to paycheck and had to start driving for DoorDash because they did not have more money. There's going to have to be an impact there. SNAP benefits that could take up to 10 days, they tell us, to be restored. So that's almost 2 months, or I guess a full month without having food assistance. What we've seen at the airports, for instance, still getting back to capacity. By the way, today could be worse than yesterday because they're still turning the screws on capacity. When will we know what the actual impact is? The Fed's got to be worried about that.
The Fed's very worried, and some of the economic hit economists are projecting will come back in Q1. That we'll see, sort of the economy rebound, and some of that, shaving off of GDP will be recovered. But some of it won't be. Just think on the consumer spending side, people, who maybe skipped a haircut this month are not going to go get 2 haircuts now that they're suddenly getting paid. Yeah. So there's some economic loss here, and we'll know that more in the coming weeks and months. But shutdowns, end up costing the government a lot of money because you have do a lot to but you're paying people for work that isn't done, and then you have to all the cost of starting things up again after what's been a very long shutdown. Plus it just adds to this greater sense of unease and concern that people have about the economy. They're not sure that Washington's going to work. We're set up for potentially another shutdown here in just a couple months. People may find themselves without paychecks. It's really just an overall bad situation for consumer sentiment.
What are the odds that happens, that we're shutting down at the end of January? And I'm assuming that this is really going to be based on whether Democrats and Republicans can strike a deal on health care. Let's just isolate that to Obamacare subsidies, tax credits in this case. If that's not done, we shut down. Is that the calculus here?
That looks like the case. I mean, Democrats are still kind of figuring out their strategy here, and I think this is going to cause a little bit of tension, if not a lot of tension, within the party as they try to figure out, do we try to fight again on this issue? One thing that notably won't be affected if there is a shutdown in January is SNAP benefits. That is funded for the full fiscal year, so that removes that one particular pain point from the table. Of course, we'll still see flights. You'll see federal workers go without pay. You could see
that's important, though. We shut down again. SNAP is not an issue next time.
And so Democrats care more about SNAP than Republicans, so that could remove at least one point that they care about. Republicans are very keyed in and focused on the flight issue. We're not going to be up against a big end of year holiday situation at the end of January, but again, this is going to that has a big effect on corporate America as well as individuals.
You flying for Thanksgiving? You're driving.
People are flying to me.
They're coming to you. That's the right answer. What about James? You flying home Thanksgiving or you driving? I don't know what to do. You're flying? The train. James always has the right answer. The problem is I couldn't get on a train. They were all sold out the other night when I was trying to get off the flight, and that's the way it goes here. The people have to go somewhere, Laura. Thank you, as always, for the insights. We're going to see a lot more of each other next week here on Balance of Power. The great Laura Davison, thank you, as always, helps to run the Bureau here as our Deputy Bureau Chief. I'm Joe Matthew in Washington. This is Balance of Power for Friday. My God, somehow we got to the end of this week. Kristen Hahn is going to join us next because when lawmakers left town, they weren't all celebrating that it was Friday. They were all angry, actually, because none of them are getting along and they don't have answers to the questions that we were just asking about the agenda following the holidays. We're going to get into this in the future of the Democratic Party with Kristen Hahn from Rock Solutions, our Democratic strategist, up next on the fastest show in politics. This is Bloomberg.
It's 12:21 on Wall Street. I'm Amy Morris. Now, after yesterday's sell-off, we're seeing more of a resurgence in tech shares. That spurred a bounce in the markets, but it is a cautious bounce, in part because investors are marking down the odds of a Fed rate cut in December, now down to 50%. We do check markets for you all day long here at Bloomberg. The S&P 500 up about 0.5%. NASDAQ up 0.75%. The Dow was down 0.25%. The 10-year Treasury yield at 4.14% and the 2-year yield at 3.61%. Bitcoin well below its $100,000 mark, now down nearly 2%, hovering around 96,800. Wall Street is souring on U.S. airlines after the longest government shutdown in the country's history. A chronic shortage of air traffic controllers is clouding the outlook for the closing months of 2025, ramping up pressure on an industry that's already suffering after the shutdown led to thousands of federally mandated flight cancellations. Delta, Southwest, American, and United shares all down around 0.5% to 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. We go back now to Balance of Power with Joe Matthew.
Amy, thank you so much. We'll check back in with Amy Morris in about 20 minutes on the Friday trade that seems to be improving by the minute. Boy, it felt kind of scary this morning, huh? We're going to do this again? But no, the dip buyers cannot resist, not even for 2 days. It's incredible. Be very curious to see where we are by 4 o'clock. Got Micron Technology up 7%. This thing's running wild again. Really interesting to hear from the White House as we were just talking to Laura Davison about affordability. Just kicked out a news release on this. Headline, we're making big progress on prices, and we'll keep working to make sure everyone benefits. President Donald J. Trump, it says, inherited an economic mess when he took office. Years of mismanagement under Biden, his incompetent administration. Democrats in Congress spent years insisting inflation was transitory while doling out trillions in new spending and dramatically upscaling government brought the country to the brink of economic ruin. It goes on to, through a series of bullets, talk about the efforts the administration is taking to lower prices, and that may well come in the form as well, not listed here, but in terms of tariff exceptions, coffee, cocoa, bananas, your taco on this Free Taco Friday. Democrats have their own conversation, their own family conversation that they're going to be having over the course of this weekend after coming back to Washington to reopen the government. A lot of Democrats were sore with Chuck Schumer, were sore with those who crossed the aisle in the Senate to break the logjam, sore about the message they thought might have been stepped on coming out of the elections. How about a new perspective from the newest member of Congress, Adelita Grijalva? The Democratic Congresswoman from Arizona waited 50 days to be sworn in. Now that we're back open, we spoke with her in her first 24 hours on the job, and she's got her eyes specifically on health care reform. Listen.
Republicans have had critical things to say about the Affordable Care Act since its inception in 2010. They have had 15 years to work on a better plan. All they do is throw stones at it, but don't actually come to the table with any real solutions. So I don't think it's the Democrats' responsibility to come up with a solution that they don't see a problem with. If we want to work to improve the ACA, I'm all for that. Universal health care, I think, should be the base of what the American people deserve.
Kristen Hahn is not a rock thrower, but she's had a few thrown at her and remembers quite distinctly the debate that was had in 2008 and 2009 over Obamacare. You fast forward 15 years, and it sure lately doesn't sound like anything has changed. We talk about this and what is the message, the unifying message out of the Democratic Party right now at a difficult time. With Kristen Hahn, partner at Rock Solutions, Democratic strategist, longtime fixture with the Blue Dog Democrats on Capitol Hill. Happy Friday, Kristen. It's the end of the week. I'm wondering your thoughts here. I don't know how old Adelita Grijalva was. I'd have to check when Obamacare first passed. But you could have played that. You could have played that in 2009, right?
You could have, and we went through it in 2009, and a lot of people lost their seats over it, but a lot of good things were accomplished. So you could have played that in 2009, and she speaks the truth. I mean, it is very difficult to do healthcare reform on either side of the aisle, and what we've seen is that the Republicans want to continue to tear down Obamacare, the ACA, without any real ideas about how to, to reform it. So it's been a long time. She actually speaks the truth here. So, it's interesting what's going on Capitol Hill right now. with the finger pointing among the Democratic Party on healthcare when we really should be pointing the fingers at the Republicans.
Well, so how did Democrats reconcile some of the inside inter-party anger here, with some calling for Chuck Schumer to resign? You've got progressives who are very upset with the moderates in the Senate who crossed over to vote for this because they didn't feel like they got anything for it, Kristen, and that a message coming out of the elections a couple of Tuesdays ago may have been squandered by what took place here in Washington. Is there a unifying message for Democrats right now?
I mean, I think so. At the end of the day, the Republicans are in charge of the House, the Senate, and they control the White House. So, pointing fingers at each other in the Democratic Party is not constructive. You are up against a party, and I consider myself very middle of the road, but the fact of the matter is you're up against a party in the Republican Party that is unified against providing these healthcare benefits for everyday Americans. And there's only so much you can do. And at the end of the day, it's always difficult when you're holding the federal government hostage. It's difficult when the Freedom Caucus would do this. At the end of the day, the government will reopen. There will be something that will happen. And people were hurting when the government was closed. So I think we need to look forward. I think that a lot of these Republicans in these tougher seats are going to potentially pay for it in the midterms next year.
Wow, interesting. You know who kind of crystallizes this is Seth Moulton, the Democrat from Massachusetts, running for Senate now to replace Ed Markey, or so he hopes. Sat down for an interview with Politico to have a conversation on The Conversation. This is exactly what we're talking about here, Kristen. Listen to Seth Moulton.
It means that Schumer just gave it. He just quit right when we actually look like we might be able to win. And it's tough right now to win in Washington when Republicans control the White House, the House, and the Senate. There's two problems here. One, Schumer has proven to all of us that he can't keep the team together. But two, Schumer has also proven to Trump that his strong arm tactics work.
That's a pretty tough combination for Democrats if that's true, Kristen. And you wonder, would it have been different with another leader? We had the longest shutdown in American history, and somebody like Jeanne Shaheen got tired of waiting around. Would a different leader have prevented the jailbreak?
This isn't a defense of Schumer, but I'm not sure that they would have. You have United States senators in the Democratic Party who have a mind of their own. And they got together, they had discussions, and they moved forward. So I'm not sure another leader would have made a difference here. There are certainly a ton of capable leaders that could take over for Chuck Schumer, from all over the country. But I'm not sure that would have made a difference. Certainly there are criticisms of any leader, of both parties, and they have to go through that. But at the end of the day, the government had to reopen. How and when that happened, that was up to those senators, and they made their decisions.
I'm not sure. It sounds like you agree they made the right decision, but either way, we're open. When lawmakers get back, there's going to be, I guess, a debate over extending health care reforms. There's no promised vote in the House, though, Kristen, and a lot of people like me are already asking if we're going to shut down in January. This doesn't sound like it's getting real better, does it?
It's not getting any better, and I think that if there is not a vote, and I agree with a lot of the members that just have no faith in the Republican leadership in the House to hold, to any type of word that they'll bring something to the floor, which I don't think they have. And you're going to have a lot of members who are really upset about this. So no, I think that we're in for a long haul between now and all the way through 2026, having these major fights over healthcare, because this is where Democrats win. Democrats win on healthcare. As you get closer to the elections, people want to see the members fighting. So I think there's a potential we go through all of this again.
Boy, it's sounding like it. I don't know how we get out of it at that point, too, because they've funded SNAP benefits for the year. You won't have to worry about that. I guess the airports won't get any better. But when it comes to Schumer, Kristen, is this it? Does he even run for re-election?
I don't know. I mean, I think that there's always room for a changing of the guard and new leadership and new blood. You've seen that in the House. And, Nancy Pelosi was just such a strong leader for so many years and provided guidance and leadership to other members of the party like Hakeem Jeffries, who leads the House Democrats now. So, You know, that is yet to be seen. Schumer seems to have the support of his caucus, but I think that there is room for a lot of talent in the Democratic Party and some new blood, you know, particularly in the Senate.
You know, we're going to come through the holidays in just about 5 minutes' time, right? And then all of a sudden, we're going to hear an invitation by the Speaker to the President to come deliver the State of the Union address. That's going to be a big moment. I suspect it's been late the last couple of years. Maybe it'll fall in February. We'll see about this. But you wonder what the state of affairs will be, or if the government, I guess, will be open when that takes place. And exactly, you know, 1 year after the president's address to Congress, what the feel in the room is going to be like, and how belligerent Democrats will be. What's this State of the Union going to be like next year?
I think unfortunately, I'm not sure I see anything different. And, you know, we talk about the Democrats being belligerent, but the president uses that stage, and we've all been through how many lies he's told, how many, you know, non-truths that he conveys from that podium. So, you know, it's a difficult decision that Democrats have to make, how to respond to this, how to fight back, when to fight back. But he certainly will use that stage, you know, to spin a lot of mistruths, which is really unfortunate because the decorum in the House that usually surrounds that event has been lost over the last couple of years. So it's really unfortunate, but I don't think it's going to change.
It's live at the Improv now. Who does the official response for the Democrats, if not Abigail Spanberger?
I think, you know, I would love to see Mikey Sherrill, Abigail Spanberger up there. I think they just embody what it means to be a Democrat and win and listen to your constituents and represent your state and district in the way that people want to see it represented. So those would be my top two picks for sure.
Okay. You didn't say Zoran Mamdani, I guess.
No, I did not. No.
Good to see you, Kristen, as always. Kristen Hahn is a partner at Rock Solutions, Democratic strategist and a friend of the program here. Interesting to take a minute here on a Friday just to get a sense of where the party is and what the vibes are going to be next week, because it doesn't sound like it's going to be any better than it was this week. But hey, the government's open, and this might be the worst of it. We may have been through the worst already when it comes to the air traffic capacity cuts, the delays and cancellations around the country, or so we like to think. One item that was in the bill that just passed to reopen the government is getting a lot of scrutiny all of a sudden. Some members of the House said they didn't even know it was in there. That's a provision that allows senators to sue the Department of Justice to the tune of $500,000 for scraping their telephone numbers and telephone records as part of the January 6th investigation. It looks like we have at least one taker. There's going to be a vote next week in the House to cancel this idea, but it may not be going anywhere. We'll talk about this with a panel, Rick Davis and Jeannie Shanzano. Should lawmakers be able to sue the government? We'll tackle that next on Balance of Power, available only on Bloomberg.
It's 12:40 on Wall Street. I'm Amy Morris. Walmart CEO Doug McMillon is retiring. U.S. Chief John Furner takes over in February. Jen Bartashis is a senior retail analyst at Bloomberg Intelligence.
I think everyone has expected that at some point he was going to retire. And John Furner does seem to be a logical next in line for Walmart. I wouldn't expect that this would in any meaningful way change Walmart's strategy.
Jen Bartashis with Bloomberg Intelligence. McMillon started at Walmart as a teen and became CEO in 2014. Walmart shares have quadrupled since then as he transformed the retail giant into an e-commerce powerhouse. Walmart shares now less than 1% lower. A resurgence in tech shares pushing stocks away from those session lows, but this is a cautious rebound. Traders cut the odds of a December rate cut to less than 50% after several Fed officials voiced skepticism about the need for a third straight cut. We check markets for you all day long here at Bloomberg. The S&P 500 up about 0.5%. NASDAQ up about 0.75%. The Dow is down about 0.25%. The 10-year Treasury yield at 4.15% and the 2-year yield at 3.61%. And U.S. Trade Representative Jamieson Greer says the U.S. and Switzerland have essentially reached a trade agreement on tariffs, or rather on products from Switzerland. The tariffs will drop from 39% to 15%. And Switzerland, he says, has committed to investing $200 billion in the U.S. He says the White House is releasing more information as we speak. We're going to bring that right to you. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. We go back to Balance of Power with Joe Matthew.
Okay, Amy, thank you. We'll have more on the markets from Amy Morris coming up at the top of the hour, 1 p.m. Eastern Time, as we keep track on the Friday trade that's looking significantly better than it was at the start of trading. We'll see if retail investors can lift this thing into the close. You know, lawmakers on Capitol Hill get to determine their own pay, which is interesting, knowing that they have not done so in about 15 years, given themselves a raise. I think 2009 was the last time that members of Congress actually voted to give themselves a raise. Even with the cost of inflation and prices, the whole thing rising as we discuss on a fairly regular basis. And the reason why is because they think it'll just look bad. It's a toxic headline. Members of Congress with approval ratings in the single digits are paying themselves more. Maybe from that same file is a new procedure, new program, if I can call it that, a provision in the Senate that was inside the continuing resolution that just passed that allows senators to sue the government for a lot of money, $500,000 or more, if they discover the government scooped up their electronic data, seized their records without notification. And that happened to a handful of senators during Jack Smith's January 6th probe. It's actually a pretty good number, 8 of them. Josh Hawley, Marsha Blackburn, there you see them all on YouTube, Dan Sullivan, Ron Johnson, Bill Hagerty, and yes, Lindsey Graham, who is the only one of this group who has decided to take advantage of the new provision, and it seems sue the Department of Justice. Josh Hawley didn't want anything to do with it. He said, I think the Senate provision is a bad idea. There needs to be accountability for Joe Biden's DOJ. But the right way to do that is through public hearings, tough oversight, including the complicity of telecom companies and prosecution where warranted. Wonder what the panel thinks about this, because I'm not sure congressional approval ratings could go any lower. Rick Davis and Jeannie Shanzano are here on the Friday edition, Bloomberg Politics contributors. Rick is our Republican strategist, partner Stone Court Capital, spent a lot of years working in the Senate, and Jeannie is Democracy Visiting Fellow at Harvard Kennedy School's Ash Center. I should note, by the way, and you guys know this, there's a standalone bill in the House because this is a Senate matter, and Republicans in the House hate this idea. They're going to try to knock it down next week in a floor vote. But Rick, that wouldn't, I'm assuming it wouldn't pass the Senate. What is John Thune thinking of putting this into a continuing resolution?
Yeah, this is pretty extraordinary, because the institution itself, the Senate, has lots of rights. They write the law. That's what people depend upon them, is they create these laws. And individual senators really don't have any success suing the federal government. They've tried it before because they tend to lack standing. I mean, what was the harm to the individual senator, that kind of thing. So in this case, they went to John Thune and said, hey, look, put a little law in this bill that gives us actually standing to sue the federal government, as if the entire Congress was affected by it. And That's pretty outrageous. That's self-dealing. But when it gets to the House of Representatives, they don't even know it's in there until almost after the fact. I mean, this is why you need to have these bills read before you vote on them. And by then it was too late. We need to open up the government. And Speaker Johnson has an absolute right to throw a fit over this because the Senate jammed him. They didn't tell it was coming. And it is totally an effort by the part of 8 senators to gouge the federal government for money. It's outrageous. And as Lindsey Graham said, forget this $500,000 that they're talking about. I'm going big money. He was a trial lawyer before he got elected to the Senate. He knows how to do this himself.
Wow. Big money, Jeannie. It's like we're on the Wheel of Fortune. In this case, nobody was watching the game show. Like Rick is saying, Tom Cole in a hearing just the other night said, wait a second, how the heck did this get in here? Are we just moving too fast? Or did John Thune pull a fast one?
I think both. I think 390 plus pages of a bill that they jammed through and had to get through quickly. And, you know, they both Democrats and Republicans in the House crying foul. Of course, they still sent the bill to the president under pressure, and now they're saying they're going to come back. But let's just take a step back. What is so not just morally and politically corrupt, but unjust about this entire endeavor is that they have given these 8 senators a right that is denied to all of the rest of us. The rest of us cannot, if the FBI or the DOJ are involved in legal, examining of our phone records, whatever else, cannot sue. And in fact, it wasn't that long ago that the Bivens Act was up. That didn't even make it through committee. And that act would have allowed people to sue the federal government and federal officials if their constitutional rights were violated. So we now have a Senate that is not even given the right to all Republican senators or all Democratic senators, only the 8 who were involved in some way or somehow on the phone with Donald Trump during the insurrection. And, you know, you look at the stories on the other side, people who have said that their rights were violated by ICE, but have been denied the right to sue. That's not how we do things in the United States or in a democracy. Whether you are a big, powerful senator, a Republican or Democrat, or just a little old person like the rest of us, we should all be able to sue. And so this has absolutely got to be pulled back. And it is shameful that it got through in the way it did.
Well, the House bill to kill this provision is expected to pass overwhelmingly, whether it's next week or not. It looks like that's the schedule here. Rick, what does John Thune do then? Do you just stay quiet or bring it to the floor?
Oh, I think he's going to have to take a vote on it, and he'll have to tell the caucus to vote their conscience. I mean, you can't have instructions from the leadership on this one because he got his hand caught in a cookie jar. I mean, that's what this is all about. He was hoping it would sail through, nobody would notice, nobody would complain, and make 8 of his members happy, and that's not what happened. And now everybody's talking about it, and Republicans and Democrats alike can be outraged by this because it really does set up a, totally different level of status within the legal system when you carve out and use an institution like Congress to give yourself a status that no other American is afforded by a special law that allows you to make money off of suing the federal government. I mean, I'm sorry, there's so much wrong with that it's not even a close call. So I don't think Thune wants in the middle of midterms with a third of his Senate up to have to defend this. He'll cave quick, and he should, because Johnson's right on this.
Wow, this panel is unified on this issue. Jeannie, what do you think about what Josh Hawley said? The right way to do this is, he says, is through public hearings, tough oversight, including the complicity of telecom companies. To what extent is that really what this story is all about?
Yeah, Yeah, I mean, absolutely. Congress has the right to engage in oversight. If there is complicity on the part of the telecom companies, absolutely. The problem here is that for a party that ran on and has consistently talked about a two-tier system of justice, that is exactly what they have created. And remember, when they engage in oversight, they don't then line their own personal and family coffers to the tune of $1 million per senator, right? So there's a vast difference between passing an amendment in this law that allows them to sue us and take $1 million from us because they have been wrong, deny us the right to do that, and engage in proper oversight. So absolutely proper oversight. But this thing has got to go. And I am not sure even how this thing got through. And talk about tone deaf in this environment when, to your point, Joe, the numbers for Congress can't get any lower. So maybe that's putting their hands up and saying, we give up. We're as low as we can go. We're just going to take $1 million more. I mean, it's absolutely outrageous from almost every perspective.
Should Congress be focused on telecom companies here in being complicit with the DOJ? Rick, do telecom companies have any choice?
Yeah, I don't think the telecom company is a serious issue. Look, these arrangements with the telecom companies and the federal government were made decades ago. They are protecting the U.S. From terrorists and people who want to inflict harm on us by being able to use these things like FISA warrants to identify them and gather intelligence. Last thing we want to do is cripple our intelligence community because of a reaction like this. I mean, you could go into hearings to talk about the bad judgment that was elicited, because why in the world would you be collecting data on United States senators, for one, especially without a notification process? But I think absolutely people should look into the conduct of decision makers around this. But the infrastructure is part of our national security apparatus. And I don't think we want to start pointing fingers at private companies who are supportive of the U.S. national security.
That's why I bring it up, and I think it's interesting to hear this coming from a Republican in Josh Hawley. Jeannie, if this passes the House, will John Thune have to take it up for a vote? Would it pass the Senate?
He absolutely should take it up, and God willing, it passes 100-0 and they get rid of it. Maybe it'll be like 92-8. I don't know, but it is absolutely outrageous. The reality is that when you are in the process of an investigation and you are looking at a target and you are the DOJ or the FBI and you legally get warrants to get phone records, we are all subject to that. If that is done unconstitutionally, then we need to make a decision as a country whether we allow for suing the federal government or federal officials over that. But you cannot carve out that these 8 people, because they happen to be U.S. senators and very powerful, can sue, and the rest of us, we are just going to have to languish in the land of the powerless. That is absolutely a two-tier system of justice. So, that is the problem here. They need to make a decision. And again, look at the Bivens Act. It was completely unable to get out of committee, would have allowed for this for all of us. If that's where they want to go, go there. But don't just go there for 4 Republican senators.
Lastly, Rick, in our remaining minute or two here, what does this mean for the relationship between Mike Johnson and John Thune? These two seem to be very much in sync throughout the whole shutdown. This is a kind of a weird way to end it, isn't it?
Yeah, I think they had their back on this, but they've grinded gears in other issues. It wasn't long ago we were talking about the Senate jamming them on the big beautiful bill. I mean, like that. So this is not unusual, right? I mean, like what the leader of the Senate does and the leader of the House does tends to be in conflict a good part of the time. And yet, in this case, this was not a policy issue that was putting them in conflict, but John Thune giving a gift to 8 senators, and nobody else in the Senate or House benefited from it. And I don't blame the speaker for being outraged by this. And kudos to him for bringing it up publicly and having a conversation about it, because I do think this is what keeps people honest.
Great panel. Lit up the panel with this topic. Rick Davis and Jeannie Shanzano, thank you so much. Both our Bloomberg Politics contributors will be back in our second hour as we welcome our global television audience to the conversation. Tyler Kendall will come in. We're going to be joined by former Congresswoman Barbara Comstock, the Republican from Virginia. And we'll take a look at the exemption of tariffs on some important food items that might make your life a little bit cheaper. Stuart Paul from Bloomberg Economics will join, so stay right here. Balance of Power, only available on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
The White House prepares to pull back the tariffs. Welcome to the Friday edition as the administration is set to lower tariffs with new exemptions on everything from bananas to beef as food prices continue to rise for consumers. I'm Joe Matthew alongside Tyler Kendall in for Kaylee Lines today live from Washington. Thank you for being with us on the Friday edition here on Bloomberg TV and radio. We're going to get the view from an economist here, Tyler, when we talk to Stuart Paul at Bloomberg Economics. who sees things a bit differently than the administration.
Right. Well, we're going to look into the data and see how potentially these tariffs are being passed through, because clearly the administration is trying to take steps to ease the high cost burden on Americans. And it's interesting because when you look at what the USTR is outlining, he's talking about these items that don't come so easily in the U.S.
Yes,
you can't grow them here. Bananas, cocoa, because the majority of this administration's tariffs, Joe, have to do with boosting domestic manufacturing, and you can't really quite do that with some of the things listed on.
How true. Don't mention the avocado toast. There's a lot more where that came from. I'm still waiting for them to get to the wine, but that's a whole different story here. We're going to look at what tariffs are being discussed, but also what's behind this move. Tyler, we talked to Peter Navarro last night, who, like the statement out today from the White House, says this is still Joe Biden inflation and nothing to do with tariffs.
Right, exactly. Though he did tell us that the White House understands that inflation is hitting the MAGA base, in his words. I pulled up the last CPI report for September, which showed that food prices are up 3.2% year over year. But of course, we've been without data for the last few weeks amid the government shutdown. So we'll have to see how this ultimately shakes out.
Well, this whole inflation talk is not helping expectations for the Fed, which are not helping Wall Street today.
Nope, that's definitely having an impact on the market. So for a look at the Friday trade, we head now to Amy Morris here with us in Washington for the latest. Hey, Amy.
Hey, Tyler, you're absolutely right. But Wall Street has erased some of those early losses with a tech share resurgence led by Tesla, which is up about 2%. We do check markets for you all day long here at Bloomberg. The S&P 500 now up about 0.2%. NASDAQ up about 0.4%. And the Dow is still down about 0.4%. The 10-year Treasury yield at 4.14%. And the 2-year yield at 3.6%. Bitcoin, check it out. It's still sliding below that $100,000 mark. Well below it at this point, now down more than 3%, hovering around 95,700. Sedara shares are 106% higher after Merck agreed to acquire the therapeutics company for about $9.2 billion. Merck is looking to expand its portfolio of treatments because the patents are expiring for a lot of its drugs in the next few years, including its most popular drug, Keytruda. Kansas City Fed President Jeff Schmidt says more rate cuts could actually drive inflation pressures. Schmidt said during an event in Denver that more cuts could have longer-lasting impact on inflation while not doing much to help shore up the labor market. That also sort of kept stocks lower. The U.S. and Switzerland have now reached a preliminary trade agreement to lower tariffs on many Swiss goods, including watches, Joe, from 39% to 15% in exchange for the tariff reduction. Switzerland has committed to investing in the U.S., including $200 billion during Trump's term, and will grant the U.S. duty-free bilateral tariff quotas on certain agricultural products. And Greer says the White House will unveil fresh tariff exemptions to address high food prices. That announcement coming later today. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. We go back to Balance of Power now with Joe Matthew and Tyler Kendall.
All right, Amy, thanks so much. As Amy mentioned, I'm Tyler Kendall here in Washington alongside Joe Matthew, and today is a big tariff day, as you just heard Amy outline. The USTR announcing that there's going to be a deal with Switzerland. This is a big deal because it is going to lower tariffs from 39% to 15%. We also saw the administration ink some framework agreements earlier today with Argentina, Guatemala, El Salvador, and Ecuador. And then we are expecting these other carve-outs, Joe, when it comes to key products that you can't make so easily here in the U.S., all part of the administration's bid to help lower prices. As we know, affordability is coming up time and time again with American voters.
Certainly at the grocery store, the president has talked about that. Food prices, specifically beef. That's why we're apparently importing Argentinian beef. But they're going to be carve-outs on everything from beef, cocoa, bananas, a lot of the stuff that you simply can't grow here. And I wonder if that extends at some point here, Tyler, to other products. What about cerveza? What about you can't make Mexican beer in the United States? There are different things that could pop up, and they've really tried to seize on the idea of flexibility. Greer talked about that this morning, that this was always part of the plan, that when pressure points arrived, the administration would take action, and we seem to be doing that now.
Right, and this actually stems from an executive order that we saw President Trump sign a few months ago, calling for the USTR and the Commerce Department to look into those areas where there could be these exemptions. But it's been really interesting to track all of the tariff policies from the beginning of the administration, because of course when these were all originally rolled out, we were told time and time again from officials that we weren't going to see carve-outs. But of course, this is a living, breathing policy as we know it, and it has shifted time and time again, and this is just the latest contour.
It's Taco Friday once again around here, Tyler. We talked about this with Peter Navarro, as a matter of fact. I don't know if that's something we can spin back, because it's interesting, Tyler, when we talk about tariffs, that's not the same conversation that the administration is having with the impact on prices. They say that's Joe Biden.
No, exactly. Actually, I think we do have that tape. We want to bring you a little bit of our conversation with Peter Navarro, asking him about the recent polling, the recent consumer sentiment numbers, that inflation is weighing on the American consumer.
President Trump viscerally understands the pain many Americans are going through because of the inflation issue, and a lot of that pain is centered on our MAGA base, and we understand that. What we have to do as an administration is first of all, be crystal clear about the sources of the inflation.
The sources of the inflation are up for debate still. That's why we turn to Stuart Paul for his insights. U.S. economist at Bloomberg Economics with us from World Headquarters in New York. We've identified the pain here, Stuart. It doesn't seem everybody agrees on why.
It doesn't seem like everybody agrees on why, but when we do our decomposition of some of the drivers of inflation, we find that about 25% of the cost of tariffs are being passed through to consumer prices as per the September CPI report. We're still waiting on October, of course, but with the latest data that we have, it does look like consumers are feeling some of the effects of tariffs. And so we can't say that this is all Biden inflation, as Peter Navarro suggested. I also do want to congratulate the two of you on an absolutely fabulous interview with Peter Navarro on the late edition of Balance of Power just last night, when he suggested that Chairman Powell should commit seppuku, the Japanese honor suicide, for failing to address inflation. Oh my goodness. And yes, all of our viewers and listeners around the world should go back and watch yesterday's late edition of Balance of Power.
I didn't pursue the Japan reference in that conversation.
No.
But maybe we should have.
Yeah, well, we thank you for that, Stuart. And actually, I get to give you a shout out now, because I always ask Stuart Paul questions off the air, and now I get to ask him questions on the air. But if we stick with tariffs, I'm wondering, Stuart, if you can give us any sort of idea on how quickly these tariff exemptions could actually work their way through the economy. When you hear the administration saying that they're going to issue these carve-outs, what sort of impact will Americans actually feel? How long will it take for those prices to come down?
Well, for certain imports that are very difficult for us to produce domestically, the items that are difficult for us to produce domestically, the effect should be relatively quick. It should be relatively easy for Argentina, for example, to direct some additional exports, goods that they're producing, to the United States. But when we look at the actual aggregates, the volumes that are coming from places like Argentina, El Salvador, Ecuador, Guatemala, it really doesn't matter very much. For example, about 1.5% of our beef imports come from Argentina. We get about 5 times that much from Brazil. We import about 20 times as much coffee from Brazil as we do from Argentina. So when we think about negotiating new trade deals, particularly with Latin America, and if the administration is trying to bring down the cost of everyday goods and services, goods and really agriculture goods in particular, the ball game is really negotiating a deal with Brazil, Argentina, Guatemala, El Salvador, Ecuador. It's not going to have much of a material impact. This is more a matter of politics and recognizing that addressing things like cost of living and affordability is a winning political issue, as we saw in the New York mayoral election.
Well, then I'm really confused here, Stuart. If it doesn't pull prices lower, because it's almost a tacit endorsement of the idea that tariffs are inflationary by acknowledging this and announcing the exception. If it doesn't pull prices lower, what's the point?
It's at least good optics, and I think that we are finally at the point where the administration is realizing that one of the primary issues that the administration was elected on was addressing inflation. With disinflation stalling out and headline CPI inflation remaining around 3%, they're going to need to get to a more tactical approach to addressing the inflation problem and really responding to the issues that they were elected to address. And so at this point, yes, there's going to need to be a little bit of a walk back on some of the promises around tariffs. And it's not the worst thing in the world to announce trade deals as we head into 2026 and the midterm elections.
All right. StartupPal, Bloomberg Economics, U.S. economist, thank you so much, as always, for joining us. And we want to stick on domestic politics, but shift over from the White House to Capitol Hill. Now, yesterday on Balance of Power, Joe and I spoke with the newly sworn-in Congresswoman Adelita Grijalva of Arizona. It had taken her, at that point, weeks to get sworn into office while the U.S. government was shut down. But one of the first things that she did when she was sworn in was she became the 218th signature on a discharge petition that could force a vote to release the Epstein files from the Department of Justice. We asked her about her signature on that petition and the timeline we could be looking at yesterday on Balance of Power.
I hope that it passes the House without any issue and that the pressure then goes to senators, because regardless of who is implicated, no one should want the label of protecting pedophiles. And, I talked to some survivors today, and I said, one of the things that I would do is go and target your senators, talk to them about why it's important for them to show unity in this, and then go and call some of their constituents and make sure that there's a connection there.
Adelita Grijalva, the new Congresswoman from Arizona, joining us yesterday on Balance of Power. And we want to extend the conversation and bring in Barbara Comstock, former Republican Congresswoman from Virginia. Congresswoman, thanks so much for joining us here. I'm just wondering what you make about what has been Republican strategy so far when it comes to the Epstein files. President Trump did campaign on releasing them, but at this point, that doesn't seem to be the White House's position now. How should have Republicans been playing this?
Well, it's been an absolute disaster for Republicans. I mean, to shut down the House of Representatives for all these weeks, the longest government shutdown, but the House being out of session all this time, has been a disaster for Republicans. So when they open up, they will have bipartisan support. Congressman Massey, a Republican, along with Ro Khanna, has led that discharge petition. So they now have the votes. And I do imagine there will be quite a few Republicans who will join on that. I know Congressman Don Bacon, a Republican, and others have already said that they will vote for that. And given that Republicans, including when I was in Congress, I worked on human trafficking legislation and passed bills, and there were a lot of Republicans who did. Many Republicans who supported legislation like that will look very hypocritical if they don't support this measure now to release the Epstein files, when so many of them already did support that. And given that the Epstein estate has these files, and certainly it seems that they are willing to put more and more of those files out. So it will be foolish if the congressman, after you saw what happened in Virginia and New Jersey and in all of these special elections, if after Republicans have been out there on the record all the way up to Donald Trump and J.D. Vance themselves have said, hey, why don't we release these files? What are they hiding? And we've already seen a lot of the information in those files. They need to get quickly down there to the floor and say they are for releasing these files.
Well, we understand we could see, Congresswoman, 40 to 50 Republicans vote in the House. But this is, at the moment at least, going nowhere in the Senate. Even if this does pass the House, what does John Thune do?
Well, if you're one of a third of those Republicans who are going to be up for election, again, many of those who have harped on this issue for years, you do not want to have ads run against you being a pedophile protector. That is not going to be a story to have Jeffrey Epstein, pictures in those ads against you. And you do not want to have these victims who are very strong advocates for themselves showing up in ads saying, here's what he said before the election, that they should be released. Now here's what they're saying after. And this is something that the MAGA base themselves are not sympathetic on keeping these files under wraps. You're seeing MAGA flags in neighborhoods coming down because they want these files released. You have White House battles between and among people like Pam Bondi and Dan Bongino and the FBI director Kash Patel, who himself was on the air saying, why don't they put these files out there? So there's really no recourse to not letting these files, become public.
So this is a debate that has come up now that the government is reopened. Something up that is coming up because the government's reopened is the policy fight ahead when it comes to health care. And both sides of the aisle have said that they are willing to negotiate and that something needs to be done when it comes to health care. From your time on the Hill, do you think it's viable that we could see a deal by January 30th, which is that next looming deadline, that we could get a potentially another government shutdown?
I certainly hope not. People have suffered. During this shutdown, that's why you should move on from things like the Epstein files, because they need to be focusing on good policy. And you've had a bipartisan coalition come together to say they do want to find a solution, because you have people right now, people who are cancer victims, people with Alzheimer's, people, who are farmers who are on these exchanges, people who are pregnant saying, hey, I'm 6 or 7 months pregnant. I'm not due until next year, but my, premiums are going from $500 a month to $2,000 or $3,000 a month. Congressman Bacon, again, a Republican, Congressman Jeff Van Drew, a Republican, has said, we are crazy if we don't come up with a solution for this. These frontline Republicans who are now, they've looked at the results in Virginia and New Jersey, and they realize if they don't pass some kind of solution, as Jeff Van Drew said, it's the moral right thing to do, but it's the politically right thing to do. If we don't pass a solution, we are going to get politically slaughtered next year. And they are right.
Well, great to have you back. Barbara Comstock, former Republican Congresswoman from Virginia. It's good to see you. Thanks for being part of our conversation today, as always, on Bloomberg TV and radio. I'm Joe Matthew alongside Tyler Kendall in Washington. With our eyes on Wall Street, Tyler, we've seen the markets pull well off their lows of the session, having had another dramatically lower start to trading following steep losses yesterday that saw the S&P 500 down over 1.5%, the NASDAQ down even more than that. The S&P has turned positive. It's up 0.25%. The NASDAQ has turned positive as well, up 0.5%. The Dow has trimmed losses significantly. There does seem to be a bout of bottom fishing here and buying the dip once again on Wall Street, Tyler.
Right, exactly. We also have our eyes on those Fed speakers appearing to perhaps urge caution when it comes to bets on further policy easing ahead of the next FOMC, which we will keep our eyes on.
We sure will. Bitcoin beginning to rebound from its lows as well, but still down just around $96,000. The VIX at 20. We'll assemble our panel next, only here on Bloomberg.
121 on Wall Street. I'm Amy Morris. A resurgence in tech shares spurred a rebound in stocks. It's a cautious rebound. The Bloomberg Magnificent 7 is up more than 0.5%, led by Tesla. Tesla has the biggest gain with more than 1%, followed by Nvidia, Microsoft, Apple, and Meta. Alphabet actually had the biggest drop, a little more than 0.25% lower. We do check markets for you all day long here at Bloomberg. The S&P 500 up 0.1%, NASDAQ up 0.3%. The Dow still about 0.5% lower. The 10-year Treasury yield at 4.14% and the 2-year yield at 3.6%. Bitcoin still sliding, now down nearly 3%, hovering around $96,000. It's right in there. Topgolf is reportedly in talks to be sold. The Wall Street Journal reporting that Topgolf Callaway could be sold to private equity firm Leonard Green. Sources say the deal would value Topgolf, which operates recreational driving ranges, at about $1 billion. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Balance of Power with Joe Matthew and Tyler Kendall.
All right, Amy, thanks so much. As Amy mentioned, I'm Tyler Kendall here alongside Joe Matthew here in Washington, and we got an announcement from the White House earlier today, the USTR saying that we could see some tariff exemptions when it comes to key food items that are hard to produce in the U.S., like cocoa and coffee. Joe, the headline on the Bloomberg terminal reading, U.S. to unveil tariff exclusions as voters rage over food costs.
Once again, back to the scenario in which we put on a really tight pair of shoes and feel really good when we take them off. Of course, if you talk to the White House, and we talked to Peter Navarro yesterday about this, he will tell you that the inflation is actually stemming from Biden economic policies. But there has to be some sort of acknowledgement here, a tacit acknowledgement at least, that tariffs are involved if they're being removed to lower prices, right?
Right. It feels like that. And we really have seen the White House refocus, I think is a fair way to put it, in the wake of last Tuesday's elections, where Republicans saw losses because of this focus on affordability. And then after that, we saw a lot of proposals from this White House, Joe, from the 50-year mortgage to $2,000 tariff refund rebate checks. It seems like there has been a refocusing here on those sorts of policies.
Yeah, that 50-year mortgage idea does not seem to be catching on. But it's where we start our conversation with our great panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us today. Jeannie is our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick is our Republican strategist, partner at Stone Court Capital. What do you make of this, Jeannie, and even the rhetoric that surrounds this? Now we're talking about affordability. During the Biden administration, it was just inflation. We just rip off the Band-Aid and hit them between the eyes. Now it's about affordability and costs, which are the terms that resonate in focus groups when you talk to consumers about this stuff and may not be economists. It's all the same issue, though. And if the White House is exempting certain products here when it comes to tariffs, is that not an acknowledgement that tariffs are inflationary?
Yeah, I mean, I think the administration, Donald Trump, everybody working for him, they read the Bloomberg Harris poll. They saw that he is, 18 points underwater on the economy. Only just a third of Americans say we're moving in the right direction on the economy. So they are seeing that religion. I think the big question here is, as much as people like Navarro and others may recognize that, does Donald Trump indeed follow suit? And I'm just looking, Joe and Tyler, at Truth Social, and his last post is about Jeffrey Epstein. And this has been a consistent problem with Donald Trump. We go right back to the election. We all remember his advisors were very anxious that he talk about costs. So they set up groceries and stuff on a table, and they told him to go out and talk about it. And if you guys recall, he literally went out and said, they want me to talk about this. It's incredibly boring. He went through and did it. And then he moved on to what he wanted to talk about. And we sort of see that over and over again. So while voters are absolutely raging, and we saw that on the election night about costs, the question is, can Trump stick to the narrative coming out of the White House now? And I think that's an open question.
Right, Rick, what's your take here? Is this a messaging problem? Because we've also heard from officials that it will take time for the administration's full policies to work their way through the economy and to, give it a little bit of patience. But I'm wondering how much patience American voters do have as we, of course, gear up to the midterms next year.
Yeah, I'd say there are sort of two components to this from the messaging I'm seeing from the Trump administration. One is a real pivot away from this idea that affordability is a joke or somehow it's a scam. They're now embracing affordability and want to talk about what they've done in that regard. And there are some stories they can tell that will resonate with consumers. And then the second half of that story is trying to recast tariffs not as weapons to secure our financial freedom, but ways to actually bring down costs to consumers. And we haven't heard that really from them before. I mean, these were all been sort of punitive measures on unfair trading partners or ways for Donald Trump to get negotiations, all of which he basically has to have the support of the American consumer in order to do all that stuff. Well, that kind of is starting to fall apart. We don't have to go far from the latest Michigan Consumer Sentiment Index, which is one of its lowest levels in history. And so they're losing that fight. In this way, they come out, in Peter Navarro interview with you, clearly he was trying to recast trade as something that will help bring down these high costs, in his case, borne by consumers because of the Biden inflation, but nonetheless, they are tools in the toolkit to try and make things cost less. We all laughed about banana tariffs when they were put on, thinking, what are we going to do? Go out and create a tropical zone in the United States to grow bananas? So it wasn't long before that taco trade was going to come through, and now we've got it.
Banana taco. Jeannie, Adam on the terminal reminds us of what Howard Lutnick said on March 21st, 2025. Said the fourth quarter for sure is Trump's and maybe shades of the third, referring to when this would become Trump's economy. Remember that we spent the first half of the year saying that's Biden data. But with that in mind, I look at the news release and the statement out today from the White House. It says President Donald J. Trump inherited an economic mess when he took office. Years of mismanagement under Biden, his incompetent administration, and Democrats in Congress brought the country to the brink of economic ruin. The message here is we'll keep working to make sure everyone benefits. Is this still Joe Biden's economy?
Adam is 1,000% right. Howard Lutnick said it. Also, Scott Bessent said it. If I remember correctly, it was in one of his early speeches. He said, by November, by Thanksgiving, essentially, this will be Trump's economy and we'll all be swinging Dixie. He didn't say that. I said that. But the idea was that they were going to blame Joe Biden for, 10 months, 11 months, and then Trump would own this thing. But now, of course, they need to push that back. And again, I do think we see a big split in the administration because they do recognize the signs that are, flashing red on this economy. Rick's favorite, consumer sentiment, the election, poll numbers like the Harris-Bloomberg poll, all of these things. And yet they are dealing with a president who is committed, to use your metaphor, Joe, to keeping those tight shoes on. And so how then do you handle that? So I think we see a White House almost at odds with itself. And again, just look at Truth Social. He wants to talk about Jeffrey Epstein. He wants the Nobel Peace Prize. He wants to do a lot of things, but he doesn't want to talk about this economy and costs because he knows it's a loser for him. And that's really where we find ourselves today. I think the administration is going to try to pull him along, but it's going to be tough.
We also wanted to turn to some other issues that are brewing in the House. Next week, lawmakers are going to tee up a discussion on a potential stock trading ban for themselves. Now, Joe, Matthew, earlier this week sat down with Congressman Brian Stile, a Republican from Wisconsin, and asked him about what this could actually look like. Take a listen.
We want to make sure that no members of Congress are profiting from insider information. I think that is imperative and incredibly important for the American people. We're going to be having a hearing looking at what is currently occurring and whether or not reforms are needed. But I think we have a huge opportunity to make sure that no member of Congress, no elected official, is leveraging inside information to their financial benefit.
Rick, you just heard the congressman there call this a huge opportunity. How much does this have to do with optics, restoring trust with the American people versus the tangible policy that we could see actually come out of a hearing such as this one?
Yeah, I think that this is a debate that's been going on for a long time and is long overdue. Typically, in order to get something like this passed through Congress, you have to have a scandal. You have to have an egregious effort on the part of a congressman or woman to, do insider training and then get caught. And they're like, oh my God, we've got to reform this process. So the fact that this is coming up in a relatively benign environment, yes, the American public is questioning, Congress and whether or not they're really doing their job. Longest government shutdown in history will actually add flame to that fire. But I think it's also one of these things that there is so much non-public information available to members of Congress and their staffs that they've got to start being very responsible about it. And the optics of trading off of that information, of having it in their possession and using it to make a trade is, I think, for most Americans, outrageous. And so maybe this just hits the outrageous factor finally, and something's going to get done about it.
Well, it seems like Rick Scott is outraged. The Republican senator from Florida was involved in a hearing on this back in the summer. This is Rick Scott in July 30th. Jeannie, listen to what the senator said about why this might be a bad idea.
Now, in this job, I don't trade stocks. I don't own operating businesses. But somehow, it's suspect because I made money. I don't know how many people in the audience, how many of you don't want to make money? Anybody want to be poor? I don't.
Jeannie, you want to be poor?
Please no, Joe Matthew, please no. What I don't want is for Americans to be waking up and looking at decisions made by their government and wondering if those decisions were made to benefit the individual congressperson or the president, or if they were made in the best interest of the American public. Rick is right, our Rick Davis, that this is an old problem. But I call them ours. But there are solutions, and one of those solutions is you can't trade individual stocks. You want in on the market, get on indexed funds, right? As long as you are in office. So there are answers to this, but the reality is we've seen on the Democrat and Republican side people who have been enriching themselves, and they have been doing so while in office. And that is incredibly problematic and not helped by the fact that we have a president who, if you buy his crypto, invest in his crypto company, then you maybe can go ask for a pardon or go ask for something you need. It is bad for democracy. It is bad for us. And again, we shouldn't have to wake up and wonder why decisions to go to war are being made. And I'm sorry, Rick Scott, but that's what you're doing there. You are making big decisions about our lives. You want in on the market, go in a safer way where you are as blind as all of us are who go in.
All right, our political panel today, both Bloomberg Politics contributors Rick Davis and Jeannie Shanzano. Thank you both, as always. And stick with us here on Balance of Power, because we're going to turn from domestic to foreign politics. Look at what's happening in Venezuela with Michael Allen, Managing Director of Beacon Global Strategies. I'm Tyler Kendall, here alongside Joe Matthew, and this is Bloomberg.
It's 1:40 on Wall Street. I'm Amy Morris. A White House national security memo reportedly claims Alibaba provides tech support for Chinese military operations against targets in the U.S. The Financial Times reporting the memo includes declassified top-secret intel on how Alibaba supplies the People's Liberation Army with capabilities that the White House believes threaten U.S. security. Several Wall Street heavyweights have struck deals with companies that could be eligible for reimbursement if the Supreme Court manages to strike down President Trump's tariffs. Even if the court decides Trump did not have the authority to impose the tariffs, there is still a chance importers might not get those refunds. And Trade Representative Jamieson Greer says the White House is ready to unveil fresh tariff exemptions to address high food prices. Those exemptions are designed to remove reciprocal tariffs from agricultural products not grown or produced in the U.S. Tech shares bouncing back after yesterday's sell-off. We do check markets for you all day long here at Bloomberg. The S&P 500 is flat. NASDAQ up 0.2%. The Dow down 0.6%. 10-year Treasury yield at 4.134%. The 2-year yield at 3.6%. Sedera shares jumped 106% after Merck agreed to acquire the therapeutics company for more than $9 billion. Merck is looking to expand its portfolio of treatments because the patents are expiring for a lot of its drugs in the next few years, including Keytruda, its most popular. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. We go back to Balance of Power now with Joe Matthew and Tyler Kendall.
Amy, thanks so much. That's the latest look at some of the top movers today for the markets on this Friday, as we saw relief brought by the end of the longest government shutdown in U.S. history, but then it quickly gave way to some volatility this week. But today we're now seeing a reversal of the slump we saw earlier in the session. So to get into all of it, we're going to bring in Bloomberg Television's markets correspondent Nora Melinda, who joins us now from World Headquarters in New York. Nora, what's driving this change?
Well, you're clearly seeing a lot of uncertainty in the market, Tyler, as you just called out, a lot of volatility. Traders are really trying to see what the Federal Reserve is going to do next. At first, we were thinking that there would be potentially a cut here in December, but now concepts about this and the thoughts on this are changing a tiny bit here. So you were seeing a lot of people selling off tech. That was the worst performing sector in the S&P 500. But now if you take a look, it's actually among the best performing sectors in the S&P 500. So you're really seeing a lot of investors trying to figure out where to be in this market. And clearly it seems as though people are still continuing to bet on tech, AI, and all the sort.
That didn't take long, Nora. What brings the buyers back so quickly? It was all doom and gloom when I woke up this morning.
Tell me about it. I mean, if we think about the NASDAQ 100, it fell more than 2% at yesterday's closing bell. So it is interesting to now see a lot of the tech shares and everything rising here. We're seeing investors coming back in the market. We're clearly seeing risk on being the mood once again today.
Is crypto the exception? What's going on with Bitcoin entering bear territory here? If you look at that chart, it slipped below all the important moving averages, and $100,000 seems like a long time ago.
Tell me about it. I mean, $100,000 was a level a lot of people were seeing as a key metric, but we are seeing some weakness there. We did see Bitcoin falling with a lot of the other riskier assets, especially if you look at tech and how it was pulling back earlier in the session. So you are seeing Bitcoin really being hit. Of course, this is really a speculative space to be, so it's not surprising that when you see a broad-based risk-off sentiment, that move there, you're also going to see Bitcoin falling off of that.
Nora, shares of Walmart are also in focus today. Can you just talk about what's playing out as we're seeing the trade progress?
Absolutely. So we are seeing Walmart in focus. We are seeing shares a bit lower right now, but this is after we did get news that the CEO is retiring. He will retire in February and be replaced by U.S. head John Furner here. So we are seeing a lot of people really trying to digest what this means for Walmart more broadly. But of course, it is interesting because if we look at Walmart, it's like the biggest employer here on the private space for U.S. consumers here. So it's going to be interesting, especially as we do get results out of Walmart next week, as we get a broader read here on the retailer.
Yeah, for sure. Interesting to see that stock fall off the lows as well, Nora. This is the man who's been running U.S. operations for Walmart, so it seems like he might know a little bit about the company. Nora Melinda in New York. Happy Friday, Nora, and thank you for the insights in this market that we're watching evolve before our eyes here. Pretty amazing. Music is playing loudly from the sound system in the Rose Garden Club. We just got a pool report from the White House. Haven't seen the president yet today. But it's blaring out of the Rose Garden and heard from the lower press office. Tunes from Phantom of the Opera, and other Trump favorites. Colleagues reporting as well, hearing It's a Man's World by James Brown. So something's cooking at the White House, and we haven't seen the Marine Guard in front of the West Wing yet. The president's been truthing from upstairs in the residence, and we wonder, Tyler, if there's much truth to the reporting here. CBS told us yesterday that the president has been presented with options for a strike against Venezuela as soon as this weekend.
Right, exactly. It's something that we're going to be watching closely, as we've actually seen Maduro, the leader there, take some of his own preemptive measures. He bolstered some of the country's defenses yesterday and was urging Venezuelans to actually spy on their neighbors in case they saw any activity related to the U.S. in the region.
Quite a development here, as we had already reported weeks ago, and the president acknowledged a CIA ground operation, a covert operation was underway in Venezuela. And just about 2 days ago, the USS Jerry Ford Carrier Strike Group arrived in the theater, leading many to wonder, appropriately, what's about to come next. And that's why we thought we'd sit down with Michael Allen, back with us here in studio, Managing Director of Beacon Global Strategies, and a veteran of the White House and former Special Assistant to President George W. Bush in the national security sector. Michael, welcome back. It's great to see you.
Thanks for having me.
Last time we spoke, this flotilla was being assembled, and we've been picking off now, I think, 20 different boats, alleged drug trafficking boats coming out of Venezuela and others out of Colombia. Are we about to go to war in the Caribbean?
It sure feels like it. We have set the theater with a lot of firepower, and I think the president probably is going through a range of options, everything from, at the very top, air plus ground, heavy air, and then maybe something that's lighter with sort of regime targets and or drug facilities. So I think he's probably got a range of targets here. I don't think he's going to go on the ground, but then that raises the question of, why do it? Because I don't think he's really going to achieve regime change by doing it, and there are not that many cartel targets.
That actually tracks exactly with what our analysts at Bloomberg Economics are tracking as well. They say that the U.S. would likely target government-operated air defenses at the beginning of a potential strike campaign to reduce any potential threat to American pilots operating in foreign airspace. What are some of those tactical challenges, part of that calculus that the administration has to make when it's thinking about how it could potentially strike a country like this?
Well, it reminds me of the Israeli action into Iran. The first thing they do is knock out enemy air defenses so that they can get air superiority all over the country to fly with complete impunity and go as long as they need to be able to go in order to hit all of the targets that they have. The issue here is that I don't think we've been staring at Venezuela like we do other countries and developing target sets for very long. This is a project that the intelligence community engages in. I really wonder how many targets we have to prosecute here and ultimately what happens. Of course, we all want to see Maduro go, but it's really hard to achieve those sort of aims by an air campaign alone.
Why Venezuela and not Colombia, if that's where the lion's share of cocaine is coming from in South America, or Mexico for that matter? Or should I ask a different question? Is this going to be a playbook for all of those?
Well, he's definitely had a lot of negative things to say about Colombia of late.
Sure has.
I think Venezuela is probably the easiest of the three because Maduro is such a rogue operator and he has deep relationships with all of our adversaries. The country is in absolute shambles. There's so many migration that's destabilized the region, and of course, many have come to the United States. So I think that's probably at the very, very top of what the president is worried about.
Energy comes into a lot of what this administration thinks about. Energy prices, the oil market. We know that there could be some pretty broad ranging consequences depending on how the U.S. depends to act towards Venezuela. How have we seen that issue, energy, actually provide leverage to either side as we're looking ahead to these potential consequences?
Well, I think the United States has proven, just like we did on Iran sanctions, that if we levy sanctions on Venezuela's oil sector, it is going to be impactful. It is going to continue to knock their oil capability offline. So I think we have them in a sanctions vice grip there, and I think people are very interested in, over time, having oil bring the Venezuelan economy back to sort of substantial levels, subsistence levels, but I think they believe they need to get past the Maduro regime before they're able to do that.
Talk to us about this platform that is the Carrier Strike Group that just arrived, because this is massive firepower, Michael. This is the biggest aircraft carrier in the world, and it brings with it an entire flotilla. Of course, all the fighter jets, the personnel. You've got 5,000 sailors that just steamed into the Caribbean here. It seems like we could have done this with a lot of cruise missiles, drone technology, assets we already have in theater, maybe a submarine. Why do we need all of this hardware?
So one thing they may be thinking of and discussing among their options is how do I intimidate Maduro into, and maybe there's an intermediary that's going to go there at some point and say, here's what we need out of you. We need you to step down. We'll make sure that you have protection in some other third-party location, and otherwise intimidate him and compel him to leave. And so that may be what we're doing here, which is using military force to back up our diplomacy.
So that's U.S. military force. Are we working at all with our allies on this? How does an operation like this, work when it could be such a significant escalation? What do those talks look like behind the scenes, those back channel talks?
Yeah, I think that we're probably talking to a lot of people in the region, but we don't have anybody, I think, that's going to pair up with us to prosecute this particular set of targets. There aren't a lot of military capabilities down there in the Western Hemisphere. We've read about certain of our intelligence cooperation partners not sharing intelligence with us because they don't want us to go after and blow up any more drug boats if it's unclear of their origin. So I think we're a little bit on our own here, but we have the firepower, and they really don't have any military to fight back to speak of.
You mentioned Israel and Iran, which is something we talked about a lot around the time of those strikes with you. There is reporting that Iran is very quietly rebuilding its nuclear capability. What are you hearing?
I think they are. I think it's inevitable. I think it's in the DNA of this particular regime. The big question, the big intelligence question after the strike is, where is the LEU? Was it destroyed in the strike? Was it buried? Was it diverted? Or are they digging it out? And I think that is of grave concern to the Israelis. It is us as well. I still think it was a success that we were able to knock out a lot of these different locations, but we're really wondering where this HEU is, and what if they're
highly enriched
uranium, and what if there are other sites that we were not aware of that'll either be centrifuge halls or maybe they were even storage of centrifuges that they would bring online one day. So there's a lot of intelligence work that's got to be done, and I have no doubt the Israelis and the United States are all over it.
Yeah, what do those efforts look like to actually try to determine this? At this point, it's been months. Yeah. How much longer does it take to uncover something like this?
Well, we could get some assistance from the IAEA. We, the United States, have sort of unmatched capability from space, and the Israelis, of course, send actual agents into Iran, and they demonstrated that throughout Operation Midnight Hammer, and I don't doubt that they've activated all the networks they have of opposition groups and ethnic groups who are not friendly to the Iranian regime, and they're checking things out inside the country. So I think because it's such an acute national security issue for the Israelis in particular, that they're going to be the leader on trying to figure out what new capability the Iranians might have.
It's a good time to be a missile maker. Yeah. We've heard so much from our own analysis here at Bloomberg Intelligence from Colonel Wayne Sanders that there is about to be a buying frenzy, a massive block of orders coming in from the Pentagon to replace interceptors that we have given to the likes of Israel and Ukraine now for several years, and our own offensive capabilities that need to be maintained. What's coming for the likes of Lockheed, RTX, General Dynamics, and the rest?
I think things are looking up. I mean, if there was one thing that we realized swiftly at the beginning of the Ukraine campaign was that we were dangerously low on all sorts of munitions.
Have we made the changes in the manufacturing chain that are required?
We have begun to. There are a number of facilities around the country that have double-timed and triple-timed. I know this is a big focus for the Trump administration. The Deputy Secretary in particular has an initiative to up the spending quickly on different types of munitions. But we need it for the China fight. We need it to transfer to Taiwan so that we can deter China from invading. We need to be able to send some to the Ukrainians. And as you mentioned, we still have big interests in the Middle East. We still want the Israelis to have a lot of capability as well. So I can't think of many topics other than maybe shipbuilding and the rest that are going to get Golden Dome, that'll get as much attention and funding in the short to medium term.
Well, it's great to have you back for a conversation. Michael Allen, with a number of hotspots brewing around the country. Do you think there's action this weekend, just to be clear, in Venezuela?
I don't No, it doesn't. It feels too soon. It feels like they're going to settle for some intelligence community work for a while, I think.
It's good to get your read on this. From Beacon Global Strategies, Michael Allen, we thank you, as always, being with us here on Balance of Power. I'm Joe Matthew alongside Tyler Kendall in Washington. We'll meet you back here 5 o'clock Eastern Time for the late edition of Balance of Power on Bloomberg TV and radio. With the president heading out of town soon, lawmakers, Tyler, are already gone.
Right. We're going to see if we get any late breaking news today. Be sure to check back in with us at 5 p.m. Eastern. Bloomberg Business Week Daily is up next. Stick with us.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Well, happy Friday, and Well, happy Friday and welcome to Bloomberg Business Week Daily Radio. This is Nora Melinda here with Scarlett Fu. We're in for Tim Stenovic and Carol Masser, of course, as we are really wrapping up the week. Still, of course, about 2 hours left in the trading day as we're really wrapping up the week here. But we did see a reversal. Of course, we did know yesterday we saw the NASDAQ 100 falling more than 2%. S&P 500 also pressured here, but we are seeing a bit of a reversal today. What was once a risk on our off rally, we are now seeing to becoming a risk on here, Scarlett. Lots to really dig into, especially as we're still experiencing this time period where people are really looking for any sort of economic data to really get an indication of where the Fed may be headed forward.
Yeah, this week has been really all over the place. We started with this idea that the government shutdown was ending, so there was relief, and then that gave way to all these fears about the AI valuation bubble and the idea that the Federal Reserve interest rate cut in December is no longer a sure thing. In fact, it's a bit of a toss-up right now, and it did look like the S&P 500 was on course for its second weekly decline, but that has turned around, as you mentioned, Nora, and the benchmark index is now up 1/3 of 1% as we head into the final 2 hours of trading.
Talk about a seesaw. This is a lot of waffling back and forth that we're seeing right now, but let's talk about what's going on a bit deeper here. Let's move over to Amy Morris with the Business Flash.
Thank you, Nora and Scarlett. You guys are absolutely right. We've been a little bit all over the place. Wall Street erasing early losses with a tech share resurgence. That was led by Tesla. It jumped about 2%, but those gains now starting to sputter. Traders are waiting for a deluge of economic data, and they want to see what the Fed decides at next month's meeting and how that data might impact that decision. We're going to check all of this, but first, the markets all day long. We bring them to you here at Bloomberg. The S&P 500 now up about 0.2%. NASDAQ up about 0.4%. The Dow is down about 0.4%. The 10-year Treasury yield at 4.14%. The 2-year yield at 3.6%. Kansas City Fed President Jeff Schmidt says more rate cuts could actually drive inflation pressures. He said during an event in Denver that more cuts could have longer-lasting impacts on inflation and not do very much to help shore up the labor market. And that is what has traders betting that the odds of a rate cut in December are now about 50-50, and that's what's leaving the market kind of lukewarm. Bitcoin also continuing to slide, now down more than, almost now 3.9%, hovering around 94,900. It wasn't that long ago when Bitcoin was at 100,000. Sedera shares are 106% higher, 106%. Merck agreeing to acquire the therapeutics company for about $9.2 billion. Merck is looking to expand its portfolio of treatments because the patents are expiring for a lot of the drugs in the next few years. The U.S. and Switzerland landed a preliminary trade agreement, lowering tariffs on many Swiss goods, including watches, from 39% to 15%. In exchange for this, Switzerland has committed to investing in the U.S., including $200 billion during Trump's term. And Trade Representative Jamieson Greer says the White House is unveiling fresh tariff exemptions to address high food prices, including reciprocal tariffs from agricultural products that are not grown or produced in the U.S. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Business Week Daily with Nora Melinda and Scarlett Fu.
Thanks for that Business Flash, Amy. I'm Nora Melinda here with Scarlett Fu. We are here in place of Tim Stenovic and Carol Masser, but they will be leading the show 3 p.m. onward on radio and YouTube. But let's take a look at where markets stand right now. Scarlett, I'm seeing a lot of uncertainty in the market. I mean, it seems as though traders are pretty cautious right now. Of course, the thoughts really remain on the Fed. Of course, government data that we're looking to come, tariff concerns still in focus. There's so many other things moving in the market here, but we are joined by somebody who will help us break a lot of this down and focuses on this very closely. We're joined by Emily Griffeo, and of course, she's a cross-asset reporter here for Bloomberg News. Emily, what are you looking at right now? What's driving this equity market sell-off uncertainty that we're seeing? Of course, we're up a little bit right now, but it really has been a cautious sentiment here.
Yeah, we had a pretty rough day for anyone who was long equity markets yesterday. And even this morning, the S&P opened a lot lower. And so we've been able to climb back up. But I think overall, when you look at how the macro is driving the equity market, it's clear that right now this idea that we're maybe not going to get as many rate cuts as we thought previously is kind of percolating through this feeling of, okay, maybe we're a little bit more risk on today, but we're still, only up about 0.2% on the S&P 500. If you look at Bloomberg Economics has an index of Fed speak, and it measures just how hawkish and how dovish the recent Fed speak has been. And we had a lot of Fed speakers yesterday. Kashkari was one of them saying, we have inflation that's still too high, running at 3%. The index of Fed speak that Bloomberg tracks rose to its most hawkish level in a month yesterday. And then when you look at where the bond market is pricing the odds of a rate cut at the next Fed meeting, earlier this week, the odds were at like 60%, and now it's dropped to actually less than 50.
And about a month ago, it was almost like near certainty.
It was like a 100% certainty. So I think people are starting to question, even though the government has reopened, we're still in this data glut, and we still have a chance that maybe we won't get a rate cut.
The amazing thing about this is happening even before we get all the data that's supposed to be released at some point next week. There's countless jobs reports or jobless claims reports. We also have retail sales. We have inflation on the consumer level and on the wholesale level. And on top of that, Emily, we're not totally done with earnings season just yet. I mean, we have the biggest one of them all coming out.
Yeah, that's right. So certainly if you're looking for kind of signals about the economy, you might not even need the economic data to get it, because we are going to get a big read on the consumer next week for earnings. We have Home Depot, Lowe's, Target, Walmart. We also have NVIDIA, which we'll get to in just a second. But yeah, in terms of, whether or not we get the September jobs report, I saw a couple notes in my inbox. Someone said, like, perhaps we'll get it released next week. There was a question mark, like maybe we'll get it.
And maybe it's not even complete too.
Yeah,
right?
maybe it's not complete. Like maybe we'll get the payrolls number, but we won't get the unemployment rate. At this point, the equity markets, the rates markets, everything's still trading without the government data. But you do hear more and more people saying, like, we just can't get a good grasp on the economy, because even though we've reopened, the data is not all of a sudden coming in all at once.
And a lot of people, before relying on a lot of those private data resources, especially as we're thinking about this vacancy or the fact that we haven't really seen much data here from the government. But of course, that should be coming up soon, as we've really been flicking at here. But let's move on to NVIDIA, because you did bring that up in conversation. We do know that NVIDIA is going to be reporting on next Wednesday after market close. And of course, we know this is basically the market Super Bowl, right? But how are sources that you're speaking with thinking about NVIDIA as we're heading into that earnings report, but then also just this idea of a potential AI bubble in the market?
Yeah, the concerns about there being an AI bubble it's certainly been something that people have been talking about for a long time. Oh, valuations are getting too high. It's interesting now to watch how it's even spreading into it's not just equities now, even in the investment grade corporate bond market. Companies are getting, that area of the market is now getting exposed to this AI trade, as we see these big tech companies, Meta, Alphabet, tap into the market and get billions of dollars to kind of build out data centers that will fund AI. For NVIDIA specifically, so I track ETFs, as Scarlett is familiar with. She tracks ETFs as well. There's an ETF that goes 2x long NVIDIA. People have been piling in this week. So it's had 4 straight days of inflows of people bidding up this company, this stock. Maybe they didn't do well yesterday, but there is certainly still buyers out there for this company heading into the earnings.
A lot of anticipation. And of course, this time we won't have the messiness of whether it includes the China estimates or not, because it's very clear that NVIDIA can't sell its highest grade chips to China. You mentioned the credit markets. There is some fear returning to the credit markets, especially on the high yield side. There was a company that managed to sell debt yesterday, but it had to do so at a pretty deep discount. And then, of course, you had another tech company that had to withdraw its investment grade offering. So all of this kind of adds up to credit investors being a little bit more cautious, even as we see the equity market recover. How do you read that? And what do you think is a read-through for equities?
I have been trying to ask a lot of portfolio managers on the credit side, specifically in high yield, that exact question of, what does this mean? How does this all end? It feels like everyone, both in the bond market and also on the equity market side, they have this sentiment of, like, we don't know what's going to be the catalyst that tips this over. And we might not need all of these data centers that billions of funding is now going into, but we don't want to be on the wrong side of the bet. If this is an emerging technology that changes the world, we want to be in on it. So we can't ignore, and particularly for less on the high yield side, but for the investment grade side, a lot of these companies that are lending to Meta, Alphabet, they point out that these companies have so much cash.
Right.
So watch the cash. If you're an equity investor, look out in earnings. How much cash flow do these companies have? If they're still generating more cash to pay off the debt, it's not really a risk for the bond investors, and it could be good for the equity investors
But something
too.
to definitely watch
But
out for,
watching
because
there, yeah.
nervousness there might portend nervousness in equities too. Emily, thank you so much. Emily Grafeo is our Bloomberg News cross-asset reporter. All right, we want to take a look at the big picture now when it comes to policy out of Washington and bring in Josh Wingrove. He is our senior White House correspondent, and he joins us now from the White House. And Josh, there's any number of directions we can go in here, particularly when it comes to the latest on the Jeffrey Epstein drama and the story there. But I want to start on tariffs. And specifically how the U.S. government is now carving out some tariff exclusions because they need to address this affordability crisis that became very acute after the election results came out. Josh, what are you seeing?
Yeah, we're told the president will sign an order today eliminating tariffs or reducing them at least. It's a little unclear on food products in particular that the U.S. either does not make at all or doesn't make enough of. Beef, coffee, bananas, tomatoes are among that list, we're told. My colleague Adriana and I just have a story on the terminal shortly about this. Speaking of all the things we could talk about today, forgive me if you hear a lot of sound behind me. The president is currently blaring a playlist on the Rose Garden, and you can hear it all through the compound. You can probably hear it in Virginia. That's a good question, but we just got off Phantom before this, so he's
I know he takes a lot of pride in that playlist.
Yes, exactly. So this is obviously, look, the administration is going to say that this is always part of the plan. There have always been exclusions. Jamieson Greer, the U.S. Trade Representative, told us that earlier today here at the White House. It is also, of course, an acknowledgement that tariffs have an impact on the price of things, which Trump has downplayed throughout his tariff campaign. And so it is in some ways at least a tacit sort of retreat or withdrawal. What is, I think, important and clear, or will become clear, and we just don't know right now, is how many of these exclusions apply to countries that have deals and how many are just to countries that don't. And if it's don't, then that I think is more of a step back on the part of the administration. Whereas if they're just confining it to countries that have reached agreements, for instance, they announced 4 just last night, then that, is maybe a bit more of a narrow action. So we just don't know the scope. We don't know what number of foods. We don't know whether the tariffs are simply being eliminated on them. We just don't know what countries. A lot up in the air, but what we're told is the president is signing it today, so we expect some details here pretty shortly.
Josh, keeping with this tariff theme, of course, we do know news came out that the U.S. and Switzerland did reach a preliminary trade agreement to lower tariffs on many Swiss goods, including watches, from 39% to 15%. That sounds like a big drop to me here. Talk to us about the developments here between the U.S. and Switzerland.
Yeah, and Liechtenstein, let's not leave them out of the party. Big deal with both of them. This has been in the works for quite some time. The Swiss were hit with a pretty high rate and argued that that was because of some weird distortions in the data and how trade is recorded, including flow of gold. And so they've been sort of clamoring to be treated the same as the EU. That's what this deal essentially, give or take, does. Treat them the same as the EU with a 15% rate. The flip side is the Swiss are agreeing to a $200 billion investment pledge over 5 years, $67 billion of it, or 1/3 in the next year here in the U.S. That follows models, similar to what we saw, for instance, with the Japanese and Koreans. So they get a deal that they've been waiting for a long time. Trump gets to, boast about these pledged increased Swiss investments. But that really, that was sort of one of the sore thumb trade deals that came out with the early math on how Trump calculated his tariffs, and I think is a signal on how a lot of this is really sort of still evolving, really. But between that and the deals announced last night, including with Argentina, but also some other Central American and South American countries, they're sort of starting to check off a lot of the list, and it will raise, attention on the other countries, which is starting to be kind of a dwindling number for which Trump has not made a deal. India, for sure, is one of them. Canada and Mexico are sort of in a different bucket, but we're watching those as well. So he's trying to sort of, knock these off, but the Swiss one is a big one.
Yeah, I'm so glad you mentioned the countries that we don't have deals with, because I think about Canada and Mexico. They're our biggest trading partners, and we still haven't hammered out final details with them. Are there talks scheduled?
My Canadian family do not let me forget it.
Yeah,
I hear
I'm sure.
about it every weekend. Yeah.
Yeah, it's a lot of uncertainty for Canada.
Yeah, I think with Canada and Mexico, they're in a different bucket because they have that USMCA carve-out. Trump doesn't like the word exclusion, but that's what it is. And so I think there's genuine conversation going on in both countries about how loud to complain, because they have one of the lowest total average effective tariff rates in the world. by merit of the fact that so much of the trade is simply not paying a tariff at all. So those two are in their own bucket, and we'll see where they go. Right now, there's really not a lot of momentum at all in either country for negotiations. This might just get rolled up in the USMCA conversation in the months and years to come. On the other countries, India, that has been a tough one to track. It was the first country that they announced trade progress with, and they just simply haven't gotten there. So I think it's anyone's guess where it'll go. The Swiss thing, I should give a shout out to our colleagues at Bloomberg in Switzerland. We scooped this story a few days ago that they were nearing the deal. We asked the president about it, and he dunked on me for asking all kinds of Swiss questions. But there was a reason, Mr. President. That's why we're here. They're on the cusp of a deal for it. He asked whether I was buying Rolexes, and I cannot afford a Rolex. I don't know about everyone else, but I wish you well. I wish you well if people can.
We should just mention Amy Morris, who's in our Washington Bureau, points out that "Don't Stop Believin'" is the song that is playing in the background.
That is, I can hear that loud and clear.
There
right
you
now.
go.
For sure. And to be clear, it's quite a distance. So the volume, like I am about 10 times farther from the sound than Trump's office is. So if I can hear,
So you're hearing it clearly.
he is pumping right now, for sure.
So lots of headlines flying, but what has also been dominating a lot of the news flow right now has been the recent release of some of Jeffrey Epstein's files. Does this conversation surrounding President Donald Trump's potential involvement with Epstein at all detract from the administration's agenda and goals? How are Republicans viewing this right now, Josh?
I mean, Trump clearly wants to change the channel. He, posted something this morning directing Pam Bondi to start investigating certain Democrats, including former President Bill Clinton, Larry Summers, and their potential or alleged ties to Epstein or the Epstein files. So he's trying to redirect the attention. I think you can tell that he thinks this is not a good news story for him. And of course, there are open questions right now, in particular from the release from oversight Democrats of these documents that, raise fresh questions about how well Donald Trump knew Jeffrey Epstein, and of course the core question of to what extent, if any, were the people around Epstein aware of what he was ultimately accused of, and has come to light since then. So right now, Trump is essentially trying to shift the channel, change the channel, don't stop believing, still cruising. And so we'll see where it goes, but this has been consistent since the administration that he just does not want to talk about the issue. He downplays the issue when people ask about it. He says that's old news. Trump has a superhuman ability to change the story and change the channel, but this has been a tough one for obvious reasons for him to do so. So it seems to be dogging him.
All right. Well, Josh, as we wrap up this conversation, what will you be watching for or listening for from the White House next week?
We have a story, I believe, on the terminal now. I hope so. I'm not scooping anything, but on expectations for the visit by the Saudi Crown Prince next week. That is a big one to watch. An earlier story that we had, sort of teeing it up, said that was actually kind of tense planning it, to the point that at one point people thought it might not proceed. So there's more tension, despite what has otherwise been kind of a love-in between MBS, as he's known, and President Trump. So we'll watch that, in particular questions on ship export licenses, F-35 sales, and other questions around whether the Saudis support normalization with Israel.
All right, Josh Wingrove, thank you so much. Senior White House correspondent Josh Wingrove joining us from the lawn of the White House as the president's playlist blares in the background.
We all heard it loud and clear here, but definitely keeping a look at markets right now. NASDAQ 100 up about 0.3%, S&P 500 almost about 0.2% higher.
It's 2:21 on Wall Street. I'm Amy Morris. This just crossing the Bloomberg terminal. The U.S. will allow some Lukoil transactions outside of Russia. The U.S. recently imposed comprehensive sanctions on Lukoil, which is Russia's second largest oil producer, in a move to cut Russia's energy revenues. A judge says he'll approve a $7 billion opioid settlement with the Sacklers Purdue Pharma, including money for victims. This new agreement replaces one that the Supreme Court rejected last year, finding it would have improperly protected members of the family against future lawsuits. The judge says he would explain his decision in a hearing coming up on Tuesday. A White House national security memo reportedly claims Alibaba provides tech support for Chinese military operations against targets in the U.S. The Financial Times reports the memo includes declassified top-secret intel on how Alibaba supplies the People's Liberation Army with capabilities that the White House believes threaten U.S. security. We check markets for you all day long here at Bloomberg. The S&P 500 is up 0.25%, NASDAQ up 0.4%, the Dow is down 0.4%. The 10-year Treasury yield at 4.14% and the 2-year yield at 3.6%. Bitcoin down now right at 3%, around $95,000. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Business Week Daily with Nora Melinda and Scarlett Fu.
All right, Amy Morris, thank you so much. Amy Morris in Washington with our Bloomberg Business Flash. This is Bloomberg Business Week. Scarlett Fu and Nora Melinda in for Tim Stanovic and Carol Masser. They will be back in the next hour reporting live from Boston Children's Hospital in Boston, Massachusetts. We talk a lot about Cantor Fitzgerald, and we throw the name around because obviously it's one of the boutique investment bank firms here in New York, but also because Howard Lutnick was the guy behind it, and he is now the Commerce Secretary in Washington, serving the President Trump administration. His two sons are now, I guess they've inherited the company, they've taken over the company. I'm not totally clear on what their role is within the company, but I do know the company is highly involved in a lot of the crypto deals that have taken place this year. Todd Gillespie is a Bloomberg News banking reporter, and he's been looking into this for, I want to say weeks, months?
Well, I've been covering them for, nearly 2 years now.
Okay, years then.
Yeah. But we recently did an interview that came out today, Scarlett, that basically broke news on their financials this year. They're having basically their best year ever. And then they've also obviously this year been facing various questions about conflicts of interest.
Okay, so here's my question. His sons are, I guess, running the show, but what does their position look like on the org chart of Cantor Fitzgerald, the overall business?
Give us a tree.
Sure. So Cantor Fitzgerald is a group that has basically 3 companies underneath it. One is a private investment bank called Cantor, not to be confused necessarily with Cantor Fitzgerald. And separately, it has 2 public companies in which it holds controlling stakes. Newmark Group, which is a property firm, property broker, and BGC Group, which is a financial broker across London and New York as well. But Cantor, which is kind of the core of the business, essentially, the most secretive, most private, kind of Howard Lutnick's, realm for the past 30 years before he went into the administration. I mean, this is the hub of the group where they are investing in, that they're building out teams that are dedicated to crypto. They are building out a lot of investment banking, trading, Bitcoin-related lending projects. They are really taking advantage of everything that is coming with the hype around Trump-related booms in those sectors.
And this part is controlled by Brandon and Kyle Lutnick.
Well, Brandon and Kyle Lutnick own the entire group. They have upwards of an 80% share, I think, if not even more, of the entire group. But yeah, Brandon is the CEO of the entire group, CEO and chairman of the entire group. Kyle, his older brother, is the executive vice chairman. Kyle's quite involved with Newmark specifically, the property group. But yeah, Brandon is in many ways the driver for a lot of this crypto-related business. But they have 3 co-CEOs of the private investment bank, Sage Kelly, Pascal Vandelier, and Christian Wool. And between those 3, they kind of drive a lot of the day-to-day operations. They build out the investment bank. They have been essentially Howard Lutnick's deputies for the better part of a decade before he went to DC. And they, in many ways, are sort of the driving force behind the company still, and they're very much in partnership with the Lutnick sons.
So taking a step back, just remind us of the relevance. How has Cantor really fit into this broader financial ecosystem, and what has that shift in power looked like?
Yeah, well, I mean, that's a good question, Nora, because, I mean, 5 years ago, Cantor Fitzgerald was a minnow on Wall Street. Well, some might say it's still a minnow on Wall Street. Let's be clear. I mean, their revenue is about 2.5 billion. That's roughly like a third of Jefferies. It's a similar model to Jefferies. It has a trading sort of broker dealer vibes. It's got an investment bank, M&A, but it also does brokerage. It has a big equities platform as well. But for years it was fairly small. And Howard Lutnick took it over in the 90s from Bernie Cantor and Bernie Cantor's wife. There was a big legal spat over this. For years, it was, it's been a relatively small-scale Wall Street bank. Obviously, now it's been launched into the limelight because of Lutnick's involvement with Trump. He fundraised for Trump last year. He became the chair of his transition team, so he was responsible for drawing up the list of candidates to basically go into the Trump administration, into the cabinet, and then himself ended up in the cabinet as well, which then forced this big transition to Brandon, to Kyle. And that was a transition that I think these sons expected at some point, that their father would step back. The fact that it was done for political reasons and the fact that it was done maybe quite early. Bear in mind, Brandon Lutnick is only 27. Kyle Lutnick is 29. For context, I'm 28. So when I meet these guys, I'm like, you could be, you could be in my class at school. But in many ways, they've sort of, they've embraced the challenge. Brandon Lutnick has been standing. He basically led this conference that was happening this week in Miami, where I was. He interviewed some big names. We had Ted Cruz there, who, by the way, is also the chair of the committee that scrutinizes Howard Lutnick's Commerce Department in the Senate. So, there are all sorts of overlaps, as you would expect in the Trump world, where business and politics probably interact more than in any other administration we've had. But, fundamentally, this business is now saying, they have been preparing for years for this moment, essentially, for the crypto boom, for a lot of the AI and data center work that they're doing. They've been hiring bankers as well who are trying to take advantage of the regional bank mergers in the US. There's a lot of different aspects to this. And I think being a leaner bank, they would say, not as clunky and slow-moving as some of the bigger Wall Street institutions, has allowed them to take advantage of these opportunities as well.
But have they been preparing for the advent of crypto being embraced by the government, given that this happened all rather suddenly when President Trump became, was inaugurated?
I mean, they have, Scarlett, to be fair to them. I mean, they hired their first crypto banker in 2020. I mean, years ago. They've been Tether's main banker for I think even longer than that. Essentially, Howard Lutnick created that relationship, built that relationship with Tether when it was essentially a pariah. Bear in mind, Tether is a company that is now trying to fundraise at a valuation of up to $500 billion, which would put it, a joint most valuable private company in the world, incredibly profitable crypto company. But now, obviously, we're talking years later, the Department of Justice just last year was reported to be investigating Tether. This week, the Tether CEO stands on stage with the chair of the SEC and the chair of the CFTC, embracing them, holding hands, well, not holding hands, but smiling, I should say, next to them. And it kind of gives you a sense of how times have changed.
So how have they leveraged their connections at all in Washington? Have we been seeing that playing out at all?
Well, they would say that they, any Washington, I mean, in their defense, they would say that any Washington interaction they would have is just the same as, any other firm would have, right? I mean, but Brandon Lutnick was invited to the White House to have dinner with Trump and other big Wall Street head honchos like David Solomon, Jamie Dimon. Ken Moelis was there as well this week. I think that was Wednesday night. I actually think I saw Brandon leave the conference event in Miami to head off to the plane, not quite realizing where he was going at the time. But, he's been invited and brought into this realm. Obviously, his father, Howard Lutnick, was also at this dinner. So make of that what you will. There's also a case here of kind of correlation versus causation, or these kinds of senses, right? Like if you are an administration that wants to embrace crypto, who are the kinds of banks whose conferences you're going to speak at? Where are the sort of partnerships?
Right.
Who are the industry leaders that you're going to be consulting? Maybe they might be the clients of the biggest crypto bank that everybody's talking about.
Which would make sense.
Which would make sense, but at the same time, there are very understandable questions that are being raised over conflicts here.
Yeah.
And, I think it's important for people to keep an eye on that.
So we are speaking with Todd Gillespie. He's a Bloomberg News banking reporter. He's written a story, Lutnick's sons score record year as Cantor denies any conflict of interest from the association with President Trump. This is the third most read story on the Bloomberg terminal over the past 8 hours. You mentioned that there's a lot of people wondering about these conflicts of interest, including including some Democratic senators, Ron Wyden, Elizabeth Warren. What have they done in terms of asking for more information, asking for clarification?
Yeah, so in August, I think actually back in July, even earlier, there was a report by Wired that Cantor was essentially trying to broker tariff refund deals, which is also a good story on the terminal today about this as well. And we wrote another story, I think just last week, over the kinds of companies that were brokering these deals. But essentially what they do is match hedge funds with corporates that are paying tariffs, and hedge funds are offering to buy the right to any tariff refunds that these corporates may get if the Supreme Court strikes down Trump's tariff agenda.
It's total hypothetical.
Total hypothetical, quite a risky deal. You're getting these for 20 cents on the dollar. But essentially there are various banks, who have special assets team, distress type teams who are brokering these deals on Wall Street. We know Jefferies are, Oppenheimer are as well, for instance. We've reported that. But Cantor Fitzgerald and Cantor, the investment bank, was considering doing this earlier in the summer, and this was reported. This provoked various questions. It provoked a letter from Elizabeth Warren and Ron Wyden, essentially just sort of saying, hey, this is the Commerce Secretary's son running an investment bank. The Commerce Secretary himself is responsible for the tariff agenda. Maybe there are some questions that are being asked there validly. But also the bank in its defense would say that, hey, everyone else in Wall Street is doing this just because we have this connection, why can't we? And also in this trade, bear in mind, you're not necessarily taking a position, you're just taking a fee on what's happening. So there are various things like that that have cropped up this year.
So you mentioned some of the pushback that we're seeing in Washington, but are we seeing any pushback from competitors, or is anyone talking about this, and maybe even in the crypto space?
Yeah, I mean, we have seen various tweets particularly from big name people in the crypto world who, bear in mind, there are a lot of factions within the crypto world. It's certainly not one monolith, as I've had to learn over the past year or two. But yeah, there are certain crypto people who, for instance, don't like Tether, they don't like Cantor, they don't like the Trump administration's take on for whatever reason. And people who have accused them fairly unsubstantiatedly of conflicts of interest. For instance, there was a unsubstantiated tweet that Howard Lutnick was trying to help Tether with this big fundraise that Cantor is advising on. There was no evidence for that provided. There was, no one reputable that ended up affirming that or reporting that. So there are these sorts of speculation. The same thing with this tariff trade. There were rumors that circulated around Washington after that story came out that, and people, there are Chinese whispers, as you can always imagine, and things sort of get twisted, but there are also obviously very fair questions as well. And I can tell you there's a lot of chatter on Wall Street about, what happens when big things come out with the administration related to tariffs and who profits, who advantages, who takes advantage, who can hear it first, that kind of thing. But those are largely in the fund space, so yeah.
All right, Todd, fantastic to get your take on everything you learned about Cantor Fitzgerald, Cantor and BGC and all the various entities of this empire that Howard Lutnick has passed on to his two sons. Todd Gillespie, Bloomberg News banking reporter, on his story, the Lutnick sons score a record year as Cantor denies any conflicts of interest with the Trump administration.
Yeah, I mean, let's just take a look at markets. I mean, that was a lot to digest, but I do want to look at what's going on right now. S&P 500 up just about 0.3% here, Scarlett.
This is Bloomberg.
It's 2:40 on Wall Street. I'm Amy Morris. A judge says he will approve a $7 billion opioid settlement with the Sacklers Purdue Pharma, including money for victims. This new agreement replaces one from the Supreme Court that was rejected last year, finding it would have improperly protected members of the family against future lawsuits. The judge says he will explain his decision on Tuesday during a hearing. Several Wall Street heavyweights have struck deals with companies that could be eligible for reimbursement if the Supreme Court strikes down President Trump's tariffs. Now, even if the court decides Trump did not have the authority to impose the tariffs, there's still a chance that importers might not get their refunds. And Trade Representative Jamieson Greer says the White House is ready to unveil fresh tariff exemptions to address high food prices. These exemptions are designed to remove reciprocal tariffs from agricultural products not grown or produced in the U.S. Markets are paring back their losses thanks to a tech surge being led by Tesla. We check the markets for you all day long here at Bloomberg. The S&P 500 up 0.3%. NASDAQ now up 0.5%. And the Dow is down 0.4%. The 10-year Treasury yield at 4.14% and the 2-year yield at 3.6%. Sedera shares jumped 106% after Merck agreed to acquire the therapeutics company for more than $9 billion. Merck needs to expand its portfolio of treatments because a lot of the patents for its drugs are expiring, including the patent for Keytruda. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Business Week Daily with Nora Melinda and Scarlett Fu.
Thanks for that, Amy. Nora Melinda here with Scarlett Fu. We're in for Tim Stenovic and Carol Masser, but there's so much to talk about right now on this Friday, whether it's in the markets or just broader company news right now. But one thing I did want to talk about is cybersecurity, Scarlett. I mean, cybersecurity is becoming increasingly more important, especially as we see a lot of online threats ramping up and honestly getting more and more creative.
Yeah, not a day goes by that you don't hear about a country or a company getting hacked by someone or some band of people. And, you know, at a consumer level, obviously, it's very concerning when you've got everything in your email or in your phone.
Absolutely. With us to talk about this and more is Vincent Pilette. He's CEO of Gen Digital, which trades on the NASDAQ under ticker GEN. You may be familiar with one of its brands, Norton, but we are joined by Vincent from Belgium, actually. Vincent, tell us a little bit about the current landscape right now as we think about protection from cybersecurity threats.
Yeah, as you mentioned, the threat landscape is very dynamic at a high level, now all enabled by AI, which really increased the complexity of the threat, the sophistication of the threats, and becoming very difficult to detect. And you mentioned that the enterprise are being attacked, but the enterprise are protecting themselves more and more. So who is left vulnerable in the middle is the consumer. And whether it's a deep fake, a scam, a phishing, leveraging your data that have been breached somewhere else, and then capturing that to create some damages. The overall damages for the consumers in the US alone is over $15 billion and growing double digit these days.
Pretty incredible growth rate there. What are the most common ways that people find their data, their personal data compromised? And what are some of the more unusual ways in which it happens?
I would say that today, 80% of the threat-facing consumers are scam or social engineering. And it's about collecting a vast amount of personal data that you have in the digital world. Whether you know it, you put them on your own social media websites, or whether those data have been breached as part of you shopping online or shopping into a different environment. And then the data is being captured solely in the dark web. And now with AI tools, very sophisticated, personalized emails or text are fooling consumers. We've detected last quarter over 140,000 websites that mimic real brand websites driven by AI, but actually are just meant to capture and create financial damages for consumers.
How is Gen Digital leveraging AI just to push productivity forward at the company as we think about it in relation to cybersecurity?
That's the topic of the day, of course, right? So not only is AI is a threat from being used by hackers, a threat for consumers, but we also at Gen Digital using AI to protect our consumers. So we're the first one to come with the full model for anti-scam and being able to detect real-time scams as they hit either your text, your voice, or your emails. And now we embedding that more into chip manufacturers to create deep fake solutions and really making sure we can detect what's the problem of the day. What's the reality? Is this message real or not? Is this video real or not? Is this voice real or not? And we heavily investing into moving our overall threat protection into an AI-powered threat detection.
So in terms of companies and consumer spending on protection from these cybersecurity threats, what have you observed so far in 2025? We know that earnings season has gone pretty well for most companies. You have just reported results as well. Your second quarter adjusted EPS beat analyst estimates by $0.01, and your second quarter revenue coming in slightly higher than what was anticipated. Are companies growing their spending on cybersecurity at a stable rate, or has that picked up? Do you see them pulling back a little bit if the economy starts going south a bit?
No, definitely people are investing more into making sure that the defense is becoming more and more sophisticated to address the overall threat landscape. You've seen our report. You mentioned that we had another outstanding quarter, a beat and raise here in Q2. That followed another beat and raise in Q1. As we're developing not only the protection of security, but enable the consumer to be secure, to be private, to also manage their identity and their reputations, we are expanding the pie, if you want, and that has enabled us to post it another quarter at about 25% growth with the help of our most recent acquisition, which is leading into the financial wellness. As you protect your data, you want to protect your financial position, you also want to help consumer manage and grow that position.
So we're headed into the holiday season. Do you all tend to see any sort of uptick in terms of cybersecurity threats or maybe identity theft even? And if so, how can consumers protect themselves?
It's definitely a higher risk season. Obviously, everybody wants to go out and shop more, dine more, and that's at every point in time you're exposing your personal data out. So we constantly educate our customers to make sure that these days they are really controlling where do they put their credit cards, which website they go and shop from, and making sure they use our anti-scam detection tools and models to make sure we can detect where the risk is. But definitely, we advise everyone to be cautious these days. Hackers are out there and trying to collect your personal digital footprint.
Does people's infatuation with cryptocurrency, Bitcoin, digital wallets, does that increase the likelihood that they might be a target of cyber attacks?
I would say that the overall penetration of your digital footprint, your life becoming more and more a digital life, and the method of payments that you mentioned is just another sign of moving more online, which then creates, of course, also more risk to be attacked. So the overall trend is to move more online in many different dimensions, including the method of payments.
What's your strategy for rebuilding or maintaining trust at a time where cybersecurity failures continue to make headlines?
And it's not only cybersecurity failure, it's also a time where with AI, it's difficult to detect what's reality and what's a fake. So is there still a reality we're discussing? Mm-hmm. And so definitely trying to making sure we equip our consumers in our tools with deep fake detection and ability to really see what is produced by a machine versus what is a natural piece of content is an important need that we're trying to address.
All right, good stuff. Really appreciate your joining us today with your recap of your results and to give us kind of the overview of what it looks like here in the cybersecurity space. Vincent Pilette is chairman and CEO of Gen Digital, trading again on the NASDAQ under the ticker GEN. And of course, Vincent was joining us by Zoom from Belgium. He's usually based in Mountain View, California, but traveling at the moment. Nora, I'm looking at a market that is remarkably resilient, given where we stood yesterday at the close, a big decline, and this morning at the open when it looked like it was very much risk off, and the S&P 500 was on its way for a second straight weekly decline, the first time since June, but that has dissipated, and we're now higher for the week.
Right, I am seeing us higher for the week, up about half a percentage point if we look at the S&P 500 and where it is on trajectory to close for the week on this Friday. It's been a little bit of a roller coaster ride this week, Scarlett.
Yeah, we're not sure what's going to happen, obviously, when it comes to the economic data. And there's now a big question over whether the Federal Reserve will move forward with interest rate cuts in December as well. Previously, people had pretty much thought it was a slam dunk. From New York, this is Bloomberg Business Week. This is Bloomberg.